have a buy on Bandhan Bank on a mild decline, say around 157, 156, buy with a stop at 153 for a target of 165. Adani Ports is a conditional buy. The pattern is very good, but with the gap down opening, you might get a slightly, a negative kind of a movement in the first few minutes. So once it crosses 1235, 1236, buy with a stop at 1290 for a first target of 1275. Similar kind of call on Prestige Estate, which is a buy about 1220 levels with a stop at 1199. Look for targets of 1265, and BHEL Bail is a buy with a stop at 220 for a target of 230.
Got it. Okay. All right. Sudarshan, what about you? What are the stock picks you have?
Yeah, I'll quickly amend my index calls. This is a festival and it's very unlikely that we will see adverse news during a festival. So traders could actually carry long positions using call options. Now my calls are also on the long side. ABB is a buy with a stop under 52.68. Alchem, another buying opportunity, stop under 48.51. Canfin Home from the NBFC is a buy, and I'm repeating, the NBFCs are likely to outperform. So Canfin Home is a buy with the stop under 678. And finally, Oil India is a buy, the stop under 370. Stay on the long side.
Stay on the long side. No, absolutely. Point taken. By the way, on Indocent, is there a view, Mitesh, do you have a view price-wise?
This is a stock which reversed after that big decline, and is heading towards that gap area, which is, when the news broke out and the stock opened with a negative gap, which is in the range of about 812 to about 870. I think anywhere between 820, 840, you'll see the stock facing massive supply. So if people have bought at lower levels, I think this is the area I would want to take profits.
Got that. Thank you very much, both of you, Mitesh and Sudarshan, with perspective on those names. Deepan, I was earlier talking about the pharma names, Zydus, which fell sharply about 7%. There was Lupin. Both companies launched this at-risk drug, which the courts ruled, the ruling is adverse. And this was substantial, about some $25 to $35 million in quarterly revenues is what was expected. Any thoughts? What's your take overall on the space?
See, Prashant, I think these are the risks which are always there in investing in pharma companies, and that along with US FDA inspections does cause a lot of volatility in the stock. But then eventually they overcome it as well because underlying trends of the industry are positive, and at least until these Trump tariffs, we were seeing secular improvement in pricing and a lot of new molecules also going off patent, providing opportunities to these companies, and globally also they were expanding their footprint. But this Trump tariffs have put a question mark on the prospects of the pharma industry, and how much is the tariff on what type of drugs it will come, very difficult to say. But it's a big industry, and I think that the best place in the pharma industry to be in would be the CDMO players, the likes of, say, Divi's Laboratories, Suven, Blue Jet, these companies, maybe even a Syngene, OneSource. I think that's where we are focusing our research in the pharma industry. And that's one segment within the pharma industry which may not get that impacted by Trump tariffs as well, given the nature of the business model. And they really benefit from the kind of tariffs which are there on China and other such regulations which are underway in the US as well. So very positive on the CDMO space. They're very expensive, but the results will surprise us on the upside.
Okay, all right. Deepan, I wanted to ask you about these EMS players. Companies like Dixon, they're up close to around 15% or thereabouts. And over the weekend, these companies were in focus because US, they import roughly on $250 million of, smartphones, computing devices as well. And out of that, China accounts for close to around 30%, while India accounts for only 5%. So there was that hope that some of these EMS players, they have a bigger opportunity. What's your view on some of these EMS stocks, and which one do you prefer?
See, Nigel, the likes of Dixon are really very expensive, although surprisingly the growth also is very strong, no doubt about it. But, buying a stock for 100p plus always is a bit of a risk factor over there. Other EMS manufacturers, I think gradually the valuations are getting more in the zone where it is comfortable. I particularly liked the numbers which came through from Syrma SGS for the September quarter. Good earning visibility, September and December quarter. Good earning visibility. I think March quarter also be pretty decent. and valuations which were extremely rich at some point of time, now because earnings have caught up and stock has corrected, are in that reasonable zone. So I would say that from a fresh investment perspective, that looks interesting. But existing investors in EMS companies should remain invested, because end of the day, the growth is fabulous. Just because the stock is expensive, I wouldn't look at exiting it.
Deepan, just two other names. We spoke about Indocent, of course. There are deals brewing in two other specific names. One is, we'll probably get the announcement soon, IDFC First Bank. I don't know if you have any thoughts specifically on that name. The other one, as Nimesh has been telling us, and now, of course, there's an exchange notice as well, 360 ONE, which is the wealth management business, where, what we understand is there could be a strategic player who comes in, takes a position. Any thoughts here, Deepan?
First, a disclosure, we are invested in both these companies and very positive on the prospects of IDFC First as well as 360. And especially wealth managers, I think, have a very great future. And you should intend to hold these companies for 5, 7, 10 years or so. And these companies can really turn out to be great outperformers, considering the kind of dynamics which are under play over here and the opportunity available for such companies. Also very positive on IDFC First Bank, amongst the top 2-3 fastest growing banks, pretty well managed as well. But for some reason or the other, it has underperformed, at least our expectation. But now that the climate has improved for the banks, the overall industry trends have improved, I think IDFC First should start to deliver very good returns going forward. So positive on both these companies, but as I said, we're invested in them, so our views could be a bit biased on the positive side.
Point taken. Right on cue, Deepan, stay with us. That news has come. Board has approved fundraise of up to 7,500 crores from two separate investors. That's a very large fundraise from IDFC First Bank. News hitting the exchanges, and we have the sort of details at the bottom of the screen. And we'll put out more in terms of who the two players are, the two investors are who are coming into IDFC First and putting this money in. In the pre-open, stock's high, but I think it should start to react. This is still very early days, within the first minute or so at this point. So more details in a bit from now. There are the two investors are Currency and Platinum, I think.
Yeah.
We'll have details. We'll put those names up as well in just a bit from now. These are CCPs. To these two investors, which are which is happening now. Lata is joining in with just a sort of take on the fundraise and what this would mean for IDFC First. Lata.
I'll just give you a few more details from the press release itself. The CCP's PS are done at around 60 rupees or thereabouts. To both these two, we have Currency Investments. That they are taking a larger chunk in comparison to Platinum. So that's another data point that's come out there. And at current prices, if I just try to pull it out, it's a dilution of roughly around 13% or thereabouts, just prima facie looking at that, going by the current market capitalization or thereabouts. Lata, that's just a couple of details I want to give. The pricing of the CCPS, which is at around 60 rupees or thereabouts.
Yeah, so that's very much at the market price that they are coming in. The gain is coming now after the news is hit. So it's pretty much maybe a slight discount to yesterday's closing market price that it has come. Actually, it was well capitalized. If I remember right, at the end of their the third quarter results, they were over 16% in terms of capital adequacy. So this is clearly a lot of capital that's coming in, but then it's almost a 25% growing bank. So they will be able to absorb this capital perhaps in a couple of, maybe in 3-4 years. At the moment, it'll be a bit dilutive. But, for all companies, you get capital when capital is available. When you look like you are in need of capital, you don't usually get it. So I think it's a wise thing. And foreign investors coming in, I looked up their shareholding pattern at the end of the March quarter. I think it was 25% foreign investors. So now I think that goes up sizably with two separate foreign investors coming in. Currency is one of them, and
25% is the FI holding. That's correct, as of March.
As of March, yeah. When they last reported, it was 25%. So now this goes up. We have to see how much is the dilution. You said 13%.
Yeah, approximately 13%.
Okay. So that would mean that it's at least 35% that you're going to see in terms of...
Current market cap is 46,000 crores or thereabouts, so 7,500 crores.
So, yeah, it's almost about a 10% addition. or no, a little more than that. Yes. Nearly 20% addition to the capital. 15%.
I think we have Deepan with us as well, so let's just toss it to him. Deepan, you heard we were just talking about it because you own IDFC First in your portfolio as well. Some of the details coming through. Any thoughts?
I think I agree with Lata that you raise capital when you can, and certainly it will improve the growth rates at IDFC First Bank. But look, when we're evaluating banks, no, we are not really looking at the growth rates, but more how they are managing their NPAs. And the banks which have the lowest NPAs and the lowest surprises when it comes to NPAs are the ones which are rewarded by investors. But nonetheless, I think, IDFC First Bank is reasonably valued and has a good growth prospect going ahead. They are gaining market share. And what I like best about IDFC First is you compare it with its peer group, its CASA ratio is very impressive.
No two ways about it, Deepan. It is a well-run bank. What I really like about them is that they concentrate on deposit growth. It's one of those banks, for a small bank, it's not very easy to raise deposits, but the accent is correct. If I remember the Q3 results right, the accent on deposit growth is to be appreciated. As well, they had stressed assets only in their MFI sector. It didn't spread to their unsecured retail portfolio, which also is a positive. Deepan, would you really worry about the asset quality? I thought, anyway, we will get to know only by end of today, I think. Results are today, right? I think the results today or tomorrow. The results are like round the corner. But is the expectation, do you have any fears of asset quality at all?
No, but you have to keep an eye out for asset quality on all of these companies, So I don't think it's so much of a concern. And the overall cycle also seems to be improving in the sense that the base effect will start turning favorable when it comes to NPA provisioning, because last few quarters we have seen 50, 60, 100% jump in NPA. I don't think that will happen going forward. And then the core profitability, the core operating profit margins, a lot of it will percolate to the bottom line. So that's going to be the theme for all the banks in the March quarter, according to me.
Got that. So we'll come back to the IDFC First Bank story, and hopefully Mr. Vaidyanathan, the top boss at IDFC First, also will be joining us, and Lata will be with us here for that as well. So that's in a bit from now. Stock's absolutely flat, with about 6 minutes of pre-open in. Well, the other big company today in focus will be Infy, because that will report numbers after markets close. Let's get a quick preview going with Rima, what the street is expecting. Rima.
Well, after both TCS and Wipro have disappointed the street, now for Infosys, the only question is, will they guide or not? Because Infy's guidance is typically an annual guidance. You don't know in the second half of the year if the macro situation deteriorates or it starts improving, discretionary spends come back, and that changes the entire picture. So it's very hard to, we spoke to the management of TCS and Wipro, and it's almost impossible to gauge how this year is going to be. Wipro had visibility only perhaps for 3 quarters, because we even asked them about how FY26 is going to be versus FY25, and there are no answers as of now. So the question is, will Infy guide or will they not? If they do guide, some of the estimates on the street are 2 to 4%, 1 to 4% is by Kotak and Ambit. But again, these estimates were set in towards the end of March or in the early part of April. And since then, it appears that things have gotten a little more uncertain. So maybe the management, if they choose to guide, could be a lot more conservative. In terms of Q4 numbers, there is less attention paid on them. But for Infosys, dollar revenue growth is seen down 1.4%. Constant currency revenue growth seen down 1.1%. Margins could come under a bit of pressure because of wage hikes. Back to you.
All right, Rima, thank you very much for that. So all eyes on Infosys.
I'm telling you, this guidance business, they should take a leaf out of United Airlines. I just pulled that up. You know what they said? A single consensus no longer exists, and therefore the company's expectations have become bimodal.
Bimodal.
So there is this and there is that. So
Two
we don't
different
know.
scenarios. Yeah, but by the way, what Wipro has said that the next quarter, Q1, revenue is going to fall from 1.5% to about 3.5%. That's the extent of so-called degrowth that they're talking about. Stocks taking it on the chin, 5% down. Margins are fine, but still, when you have the company coming out and stating that transformational deals are getting stalled, that discretionary spends are under pressure. Even on margins, they're saying that there is vendor consolidation going on. So even there is a fight on pricing, but they're trying to optimize internally and keep the margin at around 17% at least. Wipro, taking a bit hit this morning.
No, and Wipro is the one that from the frontline index is down close to 5%. Pull up the chart of Sonata Software. That one's down close to 9% as we speak, because they are saying that they're one of their large clients out there, they're facing some trouble, and that's why in Q4 itself, there'll be some kind of, pullback in terms of their numbers. So that's why that stock, it's down close to around 10% or thereabouts. Just wanted to point that out.
Absolutely. Actually, I was looking at some of the others as well. Look at LTI Mindtree, 3% lower. In general, get ready for a bit of a rocky ride on IT for sure. Let's see if banks can offer the right offset. Which brings us to the 9-10 calls as well. We've got Sudarshan joining in. Sudarshan, your 9-10 call, and also just a word on Wipro for those who have the stock. Any levels to watch?
Well, Wipro is a complete avoid for those who don't have it. If you have it, then you have to stick with it. There are no levels because you might end up getting out at the lowest. So just stay there. Canfin Home is a buy with a stop under 678.
Okay, and I think we have Mitesh as well. Mitesh, your 9-10 call?
I'll go with the buy on BHEL for targets of 238.
Okay. All right. BHEL. Gentlemen, thank you very much. We'll speak again soon. Just to sort of quickly go back to the IDFC First story, Nimish is joining us as well. Nimish had told us first, as part of his chatter, that something is coming. Well, something has come, and it's not something, it's pretty big. Nimish, you want to add inputs?
So, Prashant, now there is an official confirmation from IDFC First Bank. So, two large investors are putting money into IDFC First Bank, close to 7,500 crores. One entity is part of Warburg Pincus, and the other entity is part of Abu Dhabi Investment Trust, which is ADIA. So, two large investors putting in money. It's a compulsory convertible instrument is what through which they are putting money. So, it's at 60 rupees per share, whatever I could read in the press release. But the important part is the bank is raising 7,500 crores from two of the largest investors, Warburg Pincus and ADIA. As far as Warburg Pincus is concerned, Prashant, Warburg Pincus has been associated with Vaidyanathan and IDFC for a very long time. First, they invested in Capital First. Last year, interestingly, they sold completely out of IDFC First Bank, making some 8 to 9 times return on their investments. And now they are re-entering into IDFC First Bank, putting money via convertible. So, important deal for IDFC First Bank, 7,500 crores raised, and from two large market investors.
All right.
Yeah, actually, that's an important point. Warburg Pincus in the earlier avatar of IDFC First Bank, Capital First, they had 25% stake or something. Yeah. And they exited completely from IDFC First Bank exactly in March 2024. Yeah. So a year ago, and now coming back in another avatar.
Into the bank, absolutely. Nimish, congratulations. Thank you very much for that. Let's talk about the other big stock mover for now. Sonata Software, right? We were just talking about that. Rima is here with what she's picking up. Rima.
Thanks so much for that. So Sonata Software has issued a revenue warning. They've informed the exchanges that the revenue that they were expecting from their largest client is going to be a lot lower than what they were earlier anticipating. And therefore, there will be lower revenue from the international business. One of the analysts who looks at Sonata Software very closely indicated that earlier they were anticipating about a 3% revenue decline in Q4. But now the revenue decline could be high single digits. So we are looking at a big miss for Sonata in terms of the top line. The stock has been under pressure with a fall of about 44% already. Back to you.
Rima, thank you very much for that. Stock's down about 10-11% now. 3 minutes to go for market open. Maybe, the IDFC First flashes, we can change the names to Warburg and ADIA. If it is technically correct, we can maybe just check and put the names up. I think we are doing that.
Yeah, we had the alert on the screen.
Alerts out as well. So, much more identifiable kind of names and in that sense, helpful. So,
I remember GIC also had, when Warburg sold, if I remember right, I think GIC was also one. So, it looks like all sovereign wealth funds seem to prefer
coming in, absolutely. Well, I think 2 minutes to market open. Tahir Badshah is our market master, Chief Investment Officer at Invesco Mutual Fund. Tahir, good to have you with us here. Good morning, appreciate it. One of the first big market to come back to 1st April levels, which is the so-called reciprocal tariff levels. So it just tells you, right, the market wants to go higher, lacking triggers maybe for now. What's your sense?
Yeah, I think it's nice to have seen a recovery, and it was from obviously somewhat very beaten down levels, but then we've covered some distance as well. So it's hard to probably call a very strong market direction at this stage, one way or the other. I think we probably just float around at these levels, in my view. I think some of the issues will probably take a little bit of while to pan out, though I would like to still believe that the bulk of the damage on the first round of headline tariffs at least is behind us. We obviously now move to the negotiation table, and we'll see how it goes with different nations. But to me, it looks like the first round of the trade conflict or the trade war has probably been against the US in various ways, and evident from the fact that they've had to backpedal in many of the areas. So I think we'll have to see as to how it goes. Do they back down a little more, or is it going to be a more aggressive posturing going forward from here, from their side? Meanwhile, I think this 90-day deadline also is not something which is very feasible. But I would still, from their point of view, I think they will want to push it as early as possible so that they can get going with regard to the benefits that they want to derive. So point being that, look, I think we are at a stage where, we have to bank as of now on our domestic levers.
Absolutely, and that is what we will focus on, Tahir. Sorry, apologies, just interrupting markets opening. Just coming back and we'll finish that point. Nifty 50, 23,390. We're down about 1/3%. Bank Nifty is flat. I mean, this is just sort of, neither here nor there. Nothing on the Nifty Bank for now. The mid-cap index is down about 0.3, and I think you've got the small-cap index, which will come up on as well. And there is about a 0.25% cut on the Nifty small-cap index. Market breadth for now is positive, but this is just, the initial first minute or so that we have. So it's a slightly subdued kind of start. But, well, we all know what happened yesterday, right? I'm not saying, well, the same thing happens, but yesterday also till about 1:50, things were very subdued and then things took off like a rocket. But, as we go into today's session, remember, we got a 3-day holiday in front of us. That Nifty heat map, more down than up. You got about 13, 14 names which are higher, everything else starting lower. Surabhi.
Okay, so on the lower side, of course, is IT. No surprises there. Wipro's down 5%. HCL Tech 2%. Infosys ahead of numbers, 1.6% lower. TCS is selling off about 1.5%. Tech Mahindra, all those stocks are down. The other problem for the market is that consumer stocks aren't really finding much mojo this morning. Asian Paints, Nestle, Titan, most of them are on the lower side of the screen. Then come your heavyweights. L&T is not really contributing much. In fact, it's down 1.2%. Reliance, 0.5% lower. ITC is down about 0.3%. Lever, like I said, along with the rest of the FMCG pack, also weak. The only part that's working for the market are financials. ICICI Bank, 1.4%. HDFC Bank, 0.4%. And that's about it. Even financials, very, very selective for the time being. There's some buying on pharma this morning, which is interesting. Dr. Reddy's is up and about. Apollo Hospital, Sun Pharma, Cipla. Pharma is doing okay, and top financials are doing fine. Shriram Finance also about 0.7% on the higher side. So it's pharma and banks, to the rescue, but IT is in a trouble spot.
Well, that's right. Surabhi, a couple of stocks, though, that are in focus. Angel One, the stock is down closer on 4.5% because of those weak numbers. On the flip side, you have the Vare Group companies. I think Vare Renewables came out with its set of numbers, and that stock is higher. Vare Energies as well is one of the top movers on the upside in today's trading session. So both those two should come up for you. Big green is what we're seeing on both those two stocks. The other banking name that's doing well is Ujjivan Small Finance Bank. Well, that's up by closer on 5%. It's moving on very, very large volumes. I think you should get that one up for you on the screen. IDFC First Bank is now at the low point of the day. I'll tell you what, in the last 1 month, the Nifty Bank is up closer on 9-10% or thereabouts. It's done well. But IDFC First Bank was up 15%. So it appears there is some profit taking that's coming on this counter. And that explains why that stock, in fact, is actually down closer on 3%. It's seen some kind of profit taking post the recent big run that we saw. Tanla, well, that was one as well, had some positive news flow. So that stock, in fact, has opened up with some green on the screen. JTL, well, yesterday the stock got slammed back because some reports indicated that there was an ED raid. But for the time being, the stock has pulled back closer around 5% or thereabouts. You need to understand whether or not it's on the investor with regard to that betting scam, or was it on the company? So I think the street is still waiting for a response on the management. For the time being, the stock is up closer on 5% after getting slammed 18% in yesterday's trade. Vare Energies, though, that's the stock of the morning, up 6% as we speak.
Yeah, no, absolutely. 23.66 on Vare. And that is a big mover. And by the way, Wari is now the number 2 biggest volume-led gainer on the NSE. Number 1 is Mazgaon Dock. Mazgaon is up 3%, but I mean, outsized volumes on Mazgaon for this point in the day. I mean, just about starting 500,000 shares already on Mazgaon. And, you know, there is Wari Energy and Wari, the other Wari company as well, which is up 12%, 1151 yeah, that's the one, renewable.
That's the one that came out with its numbers.
Yeah, that's the 12, which is up 12.5% right now. So big one, and both have got tremendous volumes at this point. K Fintech is up 3%, 1,084 on K Fintech. Again, very large volumes. Garden Reach 2% higher. Again, another one more shipbuilder, along with Mazgaon, which is showing up with gains. You got Amber, which is up about 2%. KEI Industries is up about 2.5%. Cochin Shipyard. So you got all 3 shipbuilders now, which are up strongly. Yesterday, you know, you had some moves in these hospital names. On the downside, I can spot Narayana on the upside today, 1.5% on this one. You know, we were talking about the Wari sort of twins, but also look at Weber Solar, which is up 5%. Premier Energy, again, in that space, 2.5%. So yeah, I mean, there are shipbuilders, there are these solar names, both which are kind of sort of moving up as a pack. Wipro is now, by the way, the biggest volume-led loser. It's down 5.5%. Stocks at about 234. It's followed with Infi, the preview for which we just put out with Rima 5 minutes back. Numbers after market hours. And I think certainly with what Wipro has done, expectations from, you know, the consensus expectations, etc., the general hope from it would perhaps be a little lower. Angel, of course, we highlighted numbers, 4% lower. IDFC First Bank is down 2%, 62, and has got tremendous volumes in it as well. TCS is down 1.5%. Sonata Software, LT, I think IT on the downside is emerging as the sector. So maybe the IT index will come up. Yeah, 2% lower on the Nifty IT index after yesterday's near 1% cut. So 32,591 on the Nifty IT index. Tahir Bacha is with us. Tahir, I interrupted you there. You were talking about, of course, the global uncertainty and the wait and watch, but the local drivers here. I mean, rates is one, right, on the downside?
Yeah, I think rates obviously will be headed lower. Earlier, the expectations were for probably about 50 to 75. We are probably now looking at more like 75 to 100 over the course of the next 9 months or so. So I think that part is quite certain. We have some of the other drivers as well, in the sense that, you know, liquidity is up, regulations are somewhat loosening, government policy and actions are probably a little more vibrant compared to what they were in the prior 2 quarters. So I think there is obviously the one straw that we can probably hold on to at this stage is the fact that we can probably see improved domestic growth. However, you know, upcoming quarterly results, etc., will probably not reflect that. It will therefore require a certain amount of patience from investors to see some of these, actions which have been taken to translate into growth over the next couple of quarters or so. So I think that's basically the name of the game at this stage.
Tahir, hi, great to have you on the show this morning. So the question is that, I mean, what you said, that the market might not skyrocket from here, but it will continue to bounce around. Earlier, every time there was a dip, there was a template. You just have to go by and back the same leaders, the same PSUs, the same capex stocks, you know, the same EMS companies. Has that template broken, or has it been challenged? And what are you doing with the earlier leaders, the old favorites now?
So I think at least some of those that you called out are still relatively more domestic oriented, and probably even from a tariff perspective on the right side of things. So I would like to believe that they will still remain the go-to kind of areas. And even for us, I mean, beyond a particular point, if we have to identify places in the market which can grow ahead of system rate of growth, I think only some of these, whether it be industrial, some parts of consumer discretionary, parts of real estate, etc., are the ones which we can probably go to at this stage. So I think that continues even at our end. There have been a couple of other parts which have joined the fray, I would say, in some manner. Let's say value consumption at one level seems to be making some sort of a comeback, and rightfully so after a long cyclical downturn. And I think we have seen some initial reports on the monsoon, etc., which probably are also promising. So let's see how that pans out. These are all things which are up to see as to what how they turn out to be. But I think these are the areas where probably there is some value. I think pharma too is another area. Combination of some domestic pharma as well as some of those which are probably going to be somewhat better placed, even with a tariff scenario coming into play. So pharma healthcare is another area where we can probably, bank on somewhat better earnings outcomes compared to a few of the other pockets of the market.
Okay, all right, that gives us some ideas. By the way, just want to draw attention to the market once again, because now things have taken a bit of a deeper knock. It's a 120-point fall now on the Nifty. And the problem for the market is that barring one or two of your large cap financials, banks or non-banks, nothing else really seems to be working today. There's a little bit of pharma, but then the tech fall is really deep. Wipro is down now 6%. It's taken the whole sector down with it. FMCG is not working, and even stocks like L&T, Reliance, the other big boys, not able to help the bulls case, at least not right now.
Well, that's right. There's only so much that the Nifty bank can do. The Nifty IT index is under the weather. The Nasdaq was under pressure overnight. You had those numbers from Wipro. And there is a bleak expectation coming in for Infosys. So all those three factors, they are weighing on the IT index, though the Nifty bank is still holding with some mild green out there. And if we need to fight back today, the Nifty bank will need to lead the way. Tahir, good morning. Good to see you in. What's your take on these IT names? One argument is that, in fact, valuation-wise, they're pretty okay. They've come to the long-term averages. The problem is there's so much of uncertainty. Guidance cuts, weak numbers. And, you don't know what Mr. Trump is going to do next. What's your approach to these names?
I couldn't agree more, Nigel. And, I have also been kind of latching onto this view that tech will probably be, to some extent, a reasonably good defensive and probably, help us ride a little bit of the domestic volatility. But of course, after these developments, this is the most headwinded sector that we can probably think of at this stage, both in areas of growth. Obviously, we are probably going to find it difficult from everything from whether it is tariffs, slowdown in the US, what happens to Doge, and consumer spending and consumer discretionary as far as the US is concerned. So I think there is a fair bit of challenges which are around. And I think at this stage, the only argument that probably is can be made to work for the IT companies is their valuations, and not necessarily as much in terms of price to earnings multiples, but probably if you look at them from a free cash flow yield or an earnings yield perspective, or an cash flow yield perspective. So I think that is the only thing that you can probably latch onto at this stage. But then that clearly means that these now have turned into, they can only be seen as from the lens of value, and then you have to be a patient investor in order to probably get your returns over a period of time. So this, to my mind, is a sector where today, in my mind, is also a debate of whether we should even be a neutral. We should even be holding a neutral weight as far as the sector is concerned. But that's where we are.
The cash flow yield, you said, Tahir, was what, around 5-6%? I'm
sorry, what is that?
What is the cash flow yield for these companies right now?
So we are at the lower end of the band, more in the vicinity of 4.5, which is not bad. But that is the only hook that you can probably, as of now, latch on to. But obviously, both news flow wise, numbers wise, we're seeing that in some of the results which have come by, it's not going to be an easy ride. And it all, then we also have the obvious overhang of what happens to AI, at least in the short run, if not in the long run.
Okay, so that's IT, and it's clearly under the weather, like Nigel said. Pharma, something that you said perhaps offers a little more opportunity. Just expand on that point, Tahir, because I mean, a lot of these companies also have significant US exposure. We don't know if they'll be off the hook or not. There's still some uncertainty there.
Yeah, so at least, some parts of the pharma, system, pharma sector, which probably is not necessarily only generic based, even if it is exposed to the US, is probably going to be able to weather it better. So upcoming spaces for mid-sized companies, CDMO, CRDMO, that is the part which probably will hold up a lot better, because that is something which at least where there are companies which are relatively better positioned and probably can, are in a position to demonstrate growth which is in the vicinities of the 20s over the next 2-3 years. So I think that space holds, to my mind, a relatively better, attractiveness. And I think then we can always, we also have the option of supplementing that with some of the domestic pharma stories, plus some of the healthcare options also that we have. So that at least makes us a good combined, parcel which probably can occupy some decent overweight in the portfolios.
Just one point as we are winding up. I mean, this point on earnings and narratives shift with stock prices. I've always seen that in my stock market reporting career. When we started the year and Q1, Q2 were bad, we said, oh, it's because of elections and government is not spending. Second half is going to be very strong. It'll be a big recovery. Then we came to Q3. Q3 was a complete washout, 5%, 6% earnings growth. Now we're at Q4. I mean, do you see more downgrades ahead? What is your assessment, expectation from Q4? And more importantly, as we step into the new year, what lies ahead in terms of corporate earnings growth?
So if I were to go back, my memory serves me right. I think we saw the worst, from a market standpoint and from a shock and awe perspective was more like the September quarter, the second quarter of this fiscal, which was clearly subpar, significantly subpar and well below, early single digits. And that's something which probably was the biggest shocker. But I think after that, the expectations then have obviously moved down. There have been earnings cuts along the way. And now I think the market expectations are relatively more, I would like to think at least for the near term over the next 1 or 2 quarters, relatively more subdued. Having said that, I don't think the March quarter results also will probably be able to significantly surprise. I only am hopeful that the pace of earnings downgrades from here on probably will abate compared to the last 2-3 quarters. We are somewhat away from an upturn in that cycle, in the sense that we'll probably take some time before we get into an upgrade cycle. But I think the market will take comfort if there are no further downgrades. And that is what probably March quarter seems to be looking like. Look, like as I said, I mean, we are even while some of those domestic drivers are clearly starting to shape up, but by the time they reflect into numbers, will be a few quarters from now.
It'll be a few quarters from now, but maybe, I mean, Q4 will be weak. Overall, I don't think one should, too many expectations. But of course, the market's not pricing in what Q4 is going to be. It's trying to gauge what, where things will be 3, 6, 1 year down the line. And there, as Tahir says, maybe things are looking a little better. Maybe, just to take a quick look at what's happening around in the market, broader markets, apart from what we've already mentioned. IT, of course, I mean, the index is down 2, that's a big one. Hero MotoCorp is down 3%, 36.77 on Hero. So that's coming up with a large cut. And what else? I mean, Tata Elxsi and JSW Steel, Titan, Coal India, these are all down between 2-3%. There's Naukri, that is Info Edge, which is down about 3%, but that's again like an IT name. Chola Finance is down about 3%. AG's Logistics, but been sharp move up in the last 2 days. That is coming under some amount of pressure as well. Godrej Consumer Products is down about 1.5%. So that's the overall picture. 100 points lower on the Nifty is what
Prashant,
you have.
we have our guest with us.
Yeah.
The man of the moment, V. Vaidyanathan, the managing director of IDFC First Bank, has joined us. Mr. Vaidyanathan, many congratulations. I believe you've got 2 big marquee investors picking up stakes in IDFC. Can you just first take us through the numbers? What does it mean in terms of capital coming in? What does it take your capital adequacy to?
First of all, thank you very much, Lata. Yes, it's a really, really big deal and a very, very important day for the bank because we get 7,500 crores of equity capital. And it's coming in the name of Platinum Invicta Currency, which is an affiliate of Warburg Pincus. They're getting 4,900 crores approximately. And Platinum Invictus, which is a subsidiary of ADIA Private Equity Division. But ADIA is a really big name, the private equity division. So both are iconic.
Both are big names.
Big name, like iconic. And, we have worked with Warburg Pincus for like 12 years now. They're really like wonderful, wonderful people. I'm really...
Actually, that was going to be my question to you. I remember it was in March 2024 that they sold off their stake at a very high gain. But what made them come back in just 1 year and 1 week? They've come back to you. What was their thinking? Did they tell you?
Honest answer is I chased them.
Okay.
I chased them because I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, when we pitched the story, we told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time.
Okay.
So they felt excited to come again.
Yeah, it looks like they made some 8 or 9x, if I remember right, in terms of where they came and when they exited. But Mr. Vaidyanathan, you see, you needed the capital you don't really need. At the moment, you have a surfeit of capital with this 7,500 coming in, right? What is your capital adequacy now and what was it before?
Like 16.4 or 5 right now, and it'll go to 18 point, close to like 19% after this raise. The thing is, Lata, that, as the CEO, I have 2 very big responsibilities: to run a super safe bank. Super safe bank. Super safe bank is how diversified deposits are, etc., and how quality of loan book is good. All that is super safe. But capital is a very, very important part. I take that as a responsibility. And even though we were 16 plus, I have to be honest, I wanted to raise more capital. Capital positions us for growth, because you see, one of the key things is profitability.
Yes.
So the next phase of growth will give us operating leverage, will give us profitability. So I'm really keen about that.
Okay, but it would also mean immediately dilutive of several ratios, right? I mean, at the moment, the stock is showing a red tick, probably because of that. Of course, the market itself is in the red, and your share, I think, ran up a decent amount in the last 1 month, about 15% or something. You saw a good gain, so maybe a bit of sell-on news is also coming in. But it will be dilutive immediately when you have, 18, 19% capital adequacy.
Yes, this will have a dilution of 15%. But really, Lata, I want to just share one thing to you and to all investors hearing this program, that the main thing is that the bank has a phenomenal model. Otherwise, our operating profit could not have grown from 750 crores to 6,000 crores in 6 years. It's not possible. So we have a really good model. But my one big learning of life, one day I saw an interview of Jeff Bezos, about Amazon. He talked about, he said, I have a wonderful product, wonderful molecule, but without capital, there'll be no Amazon. It's like that. Today, we have a phenomenal product. People are not seeing the full power of it yet because of, liabilities, loss, and credit card loss, etc. If you take that aside, bank is very powerful, economics, but capital. So if you have capital, this can grow for a long, long time. I really believe that the next phase of growth is transformative for the bank. Bank will be very profitable in the future, and I think you will watch it happen.
Okay. No, I mean, if capital was important for Amazon, it is much more so for a bank. I take your point on that. But how much can you share now? I know you're in a pre-result silent period otherwise, but can you share what do you want to use this money for? Is it earmarked for branch openings? What is it for?
It's the growth. There are 2 things, actually. I'll keep it very simple for you. If you see the loan book of the growth of the bank, just the retail component of it, retail, MSME, agri, that SME kind of stuff, that was 100 crores in 2010. Today it is 2 lakh crores. So it should give you no surprise to guess what this will be, let me say, 5 years from now. It should go one way up. I'm very clear about that. So that growth, let me call it like at least 20% CAGR for 4 or 5 years, at least that much eyes can see. So for that is one thing to look forward to in the longer sense. And number 2, utilization. So basic answer is growth. Let me tell you, the bank has for 5 years not posted a loss. No intention of posting loss in any quarter, any year, any time now. I can tell you that much. So it's all growth. But second important reason is that there are some businesses which are also, at a stage where it needs scale up for profitability. And there are 2 such businesses.
Okay. You have a lot of sovereign funds. I mean, if I remember right, you had GIC also as one of your shareholders, and now there's ADIA. Can you tell us about the kind of shareholders you have? And also, what does your foreign holding now go to? When you announced your numbers after March, it was, I think, 25%. What does the foreign ownership now go to?
Okay, I don't have the number offhand of foreign ownership, but I can comment on this. The private equity side of RDA, which has invested in the Platinum Invictus entity. Now, whom we are allocating this stock. Now, them as well as, like I said, Warburg Pincus, they're really a phenomenal global name. So what this does is actually gives 2 things to us. Let me just tell you that, Lata, these people are really high quality investors. They see everything. They invest only in companies which have really good governance, when you can't raise a question on the governance, they are very long-term focused and very, very professional. I've dealt with them for a long time, like super professional. So what happens that when you get that kind of capital, then we are at total peace of mind. I can focus on the work, I can focus on building a good bank, and then value will get created.
Yes. Okay.
I want to just add one thing that, you know, in my opinion, broadly speaking, to create long-term value, you really will need a product that customers love. It's really important. And, you know, a brand which attracts. IDFC First Bank has become one such brand. It attracts today. And, you know, products are really superior and strong unit economics.
Okay. A final question to you. When Warburg first came in, I think 2012 in Capital First, and by the time they exited, they made, as you said, 9x. What have you promised them now?
You know, I promised them lots of things. I told them they'll make lots of money. Okay. So, and I really believe it can be, because let me tell you, Lata, that the first 5 years, you know, a lot of people sometimes say that, look why they are, your OPEX is high or your cost-income ratio is high. It is high. I don't deny it is high because of the liability franchise, credit card franchise. But I tell them that phase 1 was setting up the bank, phase 2 is operating leverage, phase 2 is profits, phase 2 is return on equity. And I have indeed suggested to them, like we say, nobody can promise anything, but I have definitely, like in my own way, told them with a lot of confidence that they will make lots of money.
You said 20% CAGR. So should we say you double the bank in 4 years?
Definitely, I think so.
Okay.
I mean,
all right.
think of 20%. And I believe that our profit after tax will outpace this growth. This is my belief. I mean, our numbers are looking like that. This year, by the way, has been a bad year for us because of the microfinance impact on us, and I take responsibility for that. I'm the leader. So think of this year like we had a massive turnaround on our PAT from the bank. We took it off from the loss position to profit. It was supposed to go up. It came down. It happened to us. But we believe from 26 onward for the next 4-5 years, you should expect good numbers on this bank.
Okay. Thank you very much, Mr. Vaidyanathan, for speaking to us. We will look forward to more searching questions and answers after you announce your numbers, your Q4 numbers. Many congratulations yet again for getting some marquee investors in.
Thank you.
Okay. So there you have Vaidyanathan now coming with the more granular details in terms of their capital adequacy, now going to over 18%. Of course, it will be immediately dilutive, and maybe that little bit of red is seen on the stock. But, you know, capital is big raw material for banks. So, you know, you would grab it with both hands when it comes.
Well, and this is an additional factor, you know, for the banking stocks itself, because you have a big name coming in there. They're showing you $1 billion or thereabouts. So it's a positive rub-off as well, besides valuations and the likes. And besides what it's doing to that particular bank, which in this case, it's IDFC First Bank. But someone writing $1 billion check is showing the kind of confidence, which is good.
Absolutely. At a time when things are otherwise wobbly, to detect and say this is a domestic-facing industry in a country which is showing like steady 6 to 7% growth, I think, clearly it's a morale booster for the sector as well.
Okay, all right, absolutely. Thanks for that, Lata. IDFC First Bank making headlines, and the clear takeaways: you're getting 7,500 crores in equity capital, 15% dilution, but the capital adequacy ratio goes up to almost 19%, as Mr. Vaidyanathan mentioned. Well, let's stick with banking, actually. There's so much of news flow. Right now, we're discussing, of course, the details and the fundraise at IDFC First Bank. And yesterday, it was actually IndusInd Bank which was hitting the headlines. The company now has declared that the external audit has found the 1,979 crore rupees discrepancy in its derivative portfolio, which is, of course, a little less than what was earlier estimated. Sources have also been telling us that the bank could perhaps see 3 senior-level exits as this matter is finally put to rest. So, I mean, where does this leave investors when we are talking about, some of these, I shouldn't call them really corporate governance issues, but let's say niggling worries that have emerged. I mean, IndusInd Bank being one of the examples. Hetal Dalal, President and COO of Institutional Investor Advisory Services, is with us. Hetal, thank you very much for joining in. So, just to sort of go over the IndusInd Bank example, what does it tell us? Where does it leave us? This derivative discrepancy came out of nowhere. The bank chose not to immediately disclose it, which is why the stock nosedived when they finally did tell the exchanges. And I believe that happened after some RBI nudging. And that is where the issue of investor confidence came about. Now the external audit has happened. Financially, there's not much impact, but it does leave a strange taste in the mouth, doesn't it, when it comes to investors and just clear disclosure?
That's very true. Good morning, everyone. I think the fact that this came as a surprise, it was a delayed sort of announcement given from when they figured it out to when they actually announced it to shareholders. It does leave open questions as far as investors are concerned. I think one of the things we keep telling companies, in terms of trying to build trust with investors is to be consistent communication. Bad news should be delivered faster than good news. And you need to keep investors in the loop when some of these things are happening. You're coming down 9 months after, almost at the close of the year, and then saying that all of this was, we found these discrepancies, indeed will leave investors open to thinking about whether there are more issues or not. I mean, at this stage, this issue seems to have been sort of capped. The numbers are out and the loss will be taken in the financial statements. But I think going forward, there needs to be a greater sensibility around communication and being consistent in its approach as far as investors are concerned.
Now, I mean, obviously, IndusInd Bank went through a serious amount of price damage, Hetal. Do you think the worst is behind? And, how should investors look at it? Because on one hand, I mean, the analysts will argue about good value. It's a great asset, perhaps good business. But then all this and perhaps impending management changes. We need to know what's the succession plan, what happens after Mr. Sumant Katpalia. Our reporters are telling us that there could be some other heads rolling as well. So from that standpoint, what should investors be doing?
Yeah, look, I think the CEO succession and the fact that Mr. Katpalia is on his way out was news that came out earlier. So everybody knows he had a 1 year, 10 years. I mean, he has a short window in terms of succession. I think this is clearly something, this entire episode of the derivative book would have worked RBI for sure. And there will be heads that will roll most likely. I think what we're going to expect going forward in our view is that while this issue seems to be curtailed, and I don't expect there to be significantly no news, when you do see a new leadership, typically what you see is a little bit of a cleanup of the balance sheet. The new leadership will always want to start on a clean slate. It's called the big bath. In banks, though, they tend to be well governed and they seem to be, and there are significant sort of checks and balances. Some of these things keep cropping up. I don't disagree, but the quantum and the impact is not as high as you would see as we've seen otherwise in in other companies which are not regulated by or not in the financial services. So I think by and large, this issue I would say is put to rest more or less. Will we see more issues? When the leadership changes, you're likely to see some, but we don't expect it to be significantly material. That's what I would look at.
All right. Okay, Hetal, thank you very much for joining in and giving us some perspective and clarity on this development. And hopefully we won't see too many of these because they end up creating a fair amount of uncertainty for shareholders. Thank you for joining in. We'll take a quick break on that note, come back on the other side, and we'll have Ben Powell of BlackRock Investment Institute joining in on Trump tariffs and the global uncertainty.
Welcome back. Well, the good news is the markets have recovered all of the losses. We're almost moved into the green. And as we said earlier, the Nifty needs to move higher. The Nifty bank will have to do bulk of the heavy lifting because the IT index is under the weather today. And as we speak, the Nifty bank is now up close to around 400 points, building onto its gains. And it's only approximately 2% away from an all-time high. So good going on the Nifty bank. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute, joins us on the show. Hi, Ben. Good morning and good to see you, Ben. Well, what are you making of the news flow? There's hope that there's going to be some kind of rationality that will come about. President Trump, as well as the Japanese, are having a discussion. A lot of comments coming in from the Chinese as well. And then you have news that various parts of America are looking at suing President Trump because of these tariffs. So a lot of news flow. Do you think things will get better from here on? Rationality will come about and the world moves forward?
Good morning. I think rationality is a high bar. I think we live in an emotional era. President Trump has talked extensively about how he feels for many years or decades America has been exploited by the rest of the world. Now, to some degree, it's payback time. So I think there's more to life than pure rationality, and politics inherently is somewhat emotional. So that's normal, and that's going to continue. That does confuse our lives in markets where we are, kind of always looking for a pure, clean, quantitative answer. It's going to be messier than that. We did think at BlackRock last week was very important, specifically where it seems that there are some constraints on the US administration. So they were, I think, a little bit worried by, in particular, the move higher in US Treasury yields. That, I think, was disconcerting to them. And since then, we've seen them adopt somewhat more of a positive approach bilaterally, as you're saying, including with big countries like Japan, India to come soon, we all hope. So I think there are things to be more positive about. There is a constraint, which is good to know, but I don't think we're going to have a purely reasonable kind of market or economic backdrop, because it's a time for kind of passion, and I think that's going to continue.
Oh, absolutely. I mean, we're still watching for all of those headlines and those social media posts, right, Ben? This morning he says that it's been, I think, a great meeting with the Japanese delegation. So let's see what the eventual outcomes will be like. But from a market perspective, first basic question, is the worst of the price damage over? Has a floor been put in place around global markets, equities?
So we're overweight the US, and the US obviously is the huge bulk of global equities. So if you don't mind, I'll speak to the US as an answer to your question.
Yes.
Yeah, look, we think there is something, as I mentioned last week, was very important. That Trump, who has signaled, I think, that he's much more interested in Main Street than in Wall Street. Yeah, that was very worrying for equity markets. But he is constrained, it would appear, by the bond market. So I think that was really important information that we got. That's the first thing. The second thing is there's still a lot to be positive about at this time, including the AI megaforce, some earnings growth stories that we favor. So, again, a lot to worry about, many things that are for sure kind of uncertain, but we shouldn't throw the baby out with the bathwater. There are still significant tailwinds that are out there, and we need to remind ourselves of that before we all become a little bit too emotional ourselves, I guess, and too kind of worried about the bad things, of which there are many, but there are some good things as well. So in conclusion, we actually, we're overweight US equities. We think valuation is sufficiently cheap now that we can start to carefully pick our spots as to where we want to be more positive. And again, AI continues to be a very powerful tell force, we think, and clearly America and other markets, but in particular America, is a way to play that.
All right. So, Ben, you're saying that you'll stick to the US markets. What commentary we've been hearing over the recent past is the dollar index got a little bit more weaker. Trump still has the problem with regard to deficit. So something's got to give out there. So we could see some money flowing to emerging markets. But you're saying that you still believe that the US market will outperform even from here on. Is that correct?
We're overweight the US, that's true. But I think implicit in your question, Nigel, is something super important, which is that we are moving to a much more fractured world, sadly, I would say, but that just seems to be true. And as investors, we need to reflect what's true rather than what we maybe would prefer to happen. So what seems to be true is the world is fracturing geopolitically. And as investors, that should mean less correlation in equities markets in particular. So in the calmer times, you could just be so-called risk on, right? You could sort of just buy the S&P, and that was a proxy for global risk, and that was sort of sufficient. Now, we think you, as investors, we're all going to have to be a lot more granular, a lot more kind of specific in exactly what risks we want in the portfolio. And that includes certain geographies outside of America. So I would highlight Japan as one. I'd highlight maybe India as another. But the broader point is, yes, we still like the US, but in a fractured world, we're going to need to be kind of more expansive and think beyond the US as to particular areas of the market, the global market, that we think can do relatively or even absolutely okay as part of this fractured, more fractured world.
Interesting. So you have to diversify risk, basically, and look at some of the other markets as well, like you're saying. Ben, on a side note, I mean, gold has been such a stellar show this year, right? I mean, if you look at the targets, I think most of the big Wall Street banks, they still have targets northwards of 3,500 USD. I saw one, I think it was Goldman Sachs, saying 4,000 plus. Do you think gold will still keep drawing in this kind of fund flow?
I think so, yes. I mean, look, gold has got a 6,000-year track record of being the diversifying asset, maybe all the time, but particularly in times of uncertainty. And heaven knows we've got one of those right now. So yes, it does feel like a time for gold. We'd only want to have a certain proportion of that in the portfolio. So, you know, again, obviously at BlackRock, the world's largest asset manager, we would always sing the song of diversification. I think that's like very important. But as part of that, gold continues to do well. And I think, again, over a very long period of time, the benefits of having some exposure to gold as part of a well-diversified portfolio, in particular during volatile moments, I think are well established, and we think that's going to continue. So yes, a lot of merit for gold in the broader portfolio.
And speaking of diversification, you mentioned the bond market, right, which I think finally forced the U.S. president's hand. That little drama that played out that finally perhaps made the U.S. administration back up a bit. Was that just a one-day event? We remember that surge, right? U.S. 10-year suddenly was shooting up to 4.5%. Conspiracy theories about whether China is selling treasuries or Japan is selling treasuries. Do you expect more of that? Because that's where markets really get rattled.
We expect more of that, yes. I think we're in the midst of a global rate reset higher, driven by inflation, which, as Chair Powell was saying overnight, continues to be much too high already. And that's before the inflationary impacts of tariffs start to feed through. So we're likely to be moving into, indeed, at BlackRock, we would say we are already in a structurally high inflation environment. That has implications for the Fed. Simply put, they can't come in and save the day. And then to your question, that also has implications for longer term interest rates, which we think should, over time, move higher. So you're exactly right. We had a particularly kind of exciting, dramatic moment last week, which for sure we need to focus on. But it's actually a bigger story than that for us at BlackRock. It's a part of a structural trend higher in interest rates, driven by higher inflation, which we think is going to continue, and actually is only going to be exacerbated by the tariff, the inflationary consequences of tariffs.
All right, Ben, I want to ask you, what do you make of Powell's statements overnight? You know, he said that they've got a tougher job than they were earlier thought about. And did he put to rest any kind of Fed put? What was your reading of what he said overnight?
Yeah, I think so. Look, I thought he spoke truth, right? He said, look, inflation's a bit high. I'm going to paraphrase here, but he said, look, inflation's a bit high, and that's a constraint. So the Fed has a dual mandate. And I always want to be really clear. Mandate means mandatory. It means they don't have a choice. Their mandate is given to them by Congress, and they do not have an opt-out clause, right? It's mandatory. And the dual aspect, one, kind of employment growth, two, inflation. So Powell, I thought, was just reminding us of that. And therefore saying, look, the inflation side is already a bit high. Tariffs are inflationary. That's a non-political, non-controversial statement. That's just true. and therefore the Fed is going to be somewhat constrained in how much it can come in and bail us out if there is a growth or market problem. So there is a Fed put, but the strike is probably a lot lower than we would all like. And we are not close, I think, to that Fed put. So Powell, I thought, spoke very well, very clearly, as he tends to do, reminding us about the binding nature of both sides of the mandate, and in particular inflation, which is just too high and potentially going higher as the ramifications of tariffs work through.
You're saying that you would not be surprised if US rates head higher, inflation. How much higher, Ben? Do you have some sort of a range in mind, 10-year?
Yeah, so we think ultimately that it's reasonable to think over time that the 10-year can start with a 5 handle. That seems totally reasonable to us. And that is potentially a real kind of issue for a US administration and a US economy that's obviously got substantial amounts of debt. One kind of really interesting aspect of this, by the way, is like 30% of that debt is owned by foreigners. So it's quite an interesting aspect. You know, President Trump seems to be moving towards, as he said many times, an America First policy approach. You know, sure, that's fine, but it's also true that 30% of your funding comes from foreigners. So I'm going to be very interested to see how the US administration squares that circle of being, as they've said, America First, but I guess also being somewhat friendly for the overseas funding, which has been such an important part of US growth and exceptionalism, I think, over the last many years and decades.
Well, indeed, Ben, it's going to be very, very interesting with regard to how he rolls over as well part of that debt at a higher interest rate, and as they're running a big deficit number out there. So interesting times. We'll keep an eye out on the markets, but also I think the bond markets, they deserve special attention. Thanks a lot for joining in. Always appreciate your comments here on CNBC-TV18. Well, time before we slip into that break, let's get Mitesh back in. Mitesh, welcome back. Well, that buy the dip is working out yet again. We were down 130 points. We've pulled back a little bit. And the Nifty bank, that's rock solid, right? Just thumping ahead as we speak. Your view?
So, I think the bias and the directional structure remains on the positive side. And therefore, I think, you will see declines or profit booking pullbacks being bought into. I have chosen, in fact, IT stock, given the fact that IT was sector going through bad news, and yet I think there is OFSS, which is now trading near yesterday's close and near the day's high. So buy here at the stop just below levels of 78.10, which is just below today's low as well. And we will look at targets of around 8,100 to begin with, maybe more, but that's the first target. And SBI card is a buy as well, with the stop at about 875 for targets of 920.
Okay, got that, Mitesh. Mitesh, just on, some of the financials, because that clearly is the strongest part of the market. Apart from, say, an ICICI Bank, which is the index leader right now, anything else? I mean, what are the other broader trades that you would want to take in either banks or non-banks?
I think the banks is, of course, one of the safest sector in the sense that the chart structure is one of the most positive over here. Though I think the only worry is that now the banks are reaching 53,800 level, which is where we had the highest weekly closing. It was 53,834 on the 27th of September. So maybe, when you reach a previous high, you will see some profit taking place. So around those levels, I would suggest taking some profits off the table. But otherwise, it remains a sector to be in. That apart, I think, stocks like Adani Group stocks are looking very positive to me. The insurance stocks like HDFC Life, LIC of India, and ICICI Pru also look very interesting in the short to medium term chart spaces.
Okay. All right, Mitesh, we'll leave it on that note. Thank you very much for joining in. I'll take a break right now. Come back on the other side. We'll get you the latest from the commodity markets.
हमारी सबर्बन रेलवे है, लोकल ट्रेन, हमारी मेट्रो, हमारी मोनो और हमारी जो ये बस सिस्टम है, बेस्ट हो या थाने की हो या और कहीं की भी हो, ये सबको इंटीग्रेट करके एक ही टिकट में एमएमआर रीजन में आप ट्रैवल कर पाएंगे। एक प्रकार से एंड टू एंड कनेक्टिविटी, ये ट्रैवलर को मिलेगी। ऐसा इसका जो आर्किटेक्चर है उसको 1 महीने में पूरा करके उसके बाद उसको हम लॉन्च करेंगे मुंबई 1।
Welcome back. Well, the big boy HDFC Bank has made a fresh 52-week high. I think that should come up for you on the screen. In December, it had gone all the way to around 1,880 rupees. And today it surpassed that, almost at 1,900 rupees. So HDFC Bank is now making a 52-week high, while the Nifty is still a good 10% away from that mark, 10 to around 11% or thereabouts. So the big boy has found its form yet again. But let's talk about a couple of earnings reactions. And Angel One, that's under pressure. Remember, the stock has pulled back a goodish bit from the recent peak, but Q4 numbers were disappointing. Upasana joins us to fill us in with a quick analysis. Upasana?
Well, the company has reported a weak set of numbers. It's a sequential miss across the board. Now, high operating expenses led to the decline in the margins and profitability, and company's cost-to-income ratio stood highest in Q4 this year at 71.6%. Now, in terms of gross client acquisition also, it saw a degrowth of as high as 22%, and it slowed down sequentially as well. Now, 30% is what we saw versus in the last quarter. So, if we compare sequentially, it is a big degrowth. Now, total client base also saw an uptick of just about 5% sequentially, and market share also saw a dip in equity, F&O and commodities, while there has been an uptick of nearly about 10 basis points in company's cash segment. Now, coming to the numbers, now revenue saw a downtick of 16%. This was mainly impacted due to 21% fall in the company's net broking income. Order volume, which is the key revenue driver, fell nearly about 23% sequentially, and EBITDA margins, as stated earlier, were under pressure, are down nearly about 680 basis points at 32.5%. PAT also saw a downtick of 38%, and company's average daily turnover also declined 19.7%. Now, company says that FY25 performance subsums regulatory changes and even softer market conditions. So, all in all, weak set of numbers from Angel One, and we can clearly see the stock price.
Okay, all right, got it. Upasana, thanks very much for that. Let's move back to IT now. IT obviously is taking it on the chin, the sector of the day for all the wrong reasons. Reema's back with us. Disappointment from Wipro and now nervousness about Infosys. Reema?
Indeed, and now the Nifty IT index is down 25% year to date, underperforming the Nifty itself by more than about 20%. That said, the IT index is still about 5% away from its 52-week low that it hit on 7th of April. For starters, Wipro is the top large cap loser after the Q1 guidance disappointed at minus 3.5 to minus 1.5. Then you had Sonata issuing a revenue warning for Q4, saying that the revenue that they were anticipating from the largest client will be lower than estimates. And some analysts are saying Sonata's Q4 revenues could actually decline in high single digits. As you said, there is nervousness now. What Infi will do? Will they guide or will they not? Given the uncertainty, will we see an FY26 guidance from Infosys? And if we don't, that means the uncertainty lingers on for the next 3 months. So far, if you remember, both TCS and Infi have missed the mark on the top line. Revenues for both the companies have fallen in the March quarter by 0.8% quarter on quarter. Both the managements have highlighted that there is cautiousness in the air. They are taking a wait and watch approach. Wipro said the clients are taking a measured approach when it comes to large transformational projects or discretionary spending. And there are some delays, some projects which are being put on pause, some decision-making delays. And finally, I'm just going to put up the IT calendar for you up on your screen. Today, it's Infi, Tata Elxsi, but over the course of the next 1 week, we'll have numbers from HCL Tech, LTI Mindtree, Cyan, LTTS, Mphasis, Persistent, Tech Mahindra. Basically, the entire picture will be clear, by the time next week ends. Back to you.
All right, Reema, thanks very much for that. So awaiting more IT numbers then. Let's now talk about the commodity markets. Let's see what's the headline with Manisha. Manisha, I was about to say happy Friday, but it's a happy Thursday. We're getting ready for the long weekend. What's the latest?
Well, ahead of the long weekend, especially, and it's not just for India, but most of the international markets as well. And we've seen some more buying come in for gold. Overnight, we've seen stronger gains in the Asian markets right now. We're trading at 33.57 of an all-time high yet again for gold. It's come off slightly, trading at 33.40 at this point in time. But in the overnight markets, we've seen 3% of gains come in for gold, and that's a report card of what we've done till now. On a weekly basis, we're up 4.5%, up 10% on month. And for this year now, we're up 27.5%. And if you look at the last 12 months in case of gold prices, it has given you a 41% of a return. Also, when you look at it on a year-on-year basis, as I said, for this year until now, we are up by 27%. Last year was 28% of gains. So even as we are into the fourth month of this year, it's almost an equal kind of gains that the gold prices gave you in the previous year as well. 2023 was 15% up. So the last couple of years clearly are doing very, very well for itself when it comes to gold. Well, gold has posted 25 all-time highs in 2025 till time, and it has posted 13 all-time highs above $3,000 an ounce. So clearly the distance that we've seen covered between 2,000 to 3350 has been the fastest that you have seen gold ever do in the history there. Well, it has been about escalating US and China trade tensions that has been supportive. It also has to do with Nvidia warning of all impairment in the first quarter, talking about $5.5 billion there because of the kind of tariffs and restrictions that are coming in trade, especially between the two countries, which is US and China. And then US also has ordered probe into possible tariffs on critical mineral imports. So this uncertainty, these concerns is what seems to be really getting in more safe haven money in case of gold there. The markets also are reacting to the US dollar index continues below 100, which is a 3-year lows for that currency there. And then there's a huge amount of ETF buying, which has been supportive. You know, between the months of August to November, perhaps, ETFs were redeeming. But if you look at the first quarter of 2025, the ETF inflow has been the highest in 3 years at around 226 tons. Now, this is what tells you on how the global ETF markets have seen tonnages in sense of gold there. So Jan, of course, started with 34.5 tons. But Feb and March have seen more than 90 tons per month go in. And the expectation is that month of April seems to be doing quite well as well. Well, the markets do believe that the momentum is still on the higher side. Gold prices can continue higher, except if you are looking at very strong central bank buying as well. In this year until now, we've done 44 tons. And if you look at the previous few years, 1,000 tons per year is what the global central banks have bought. 2022 was a record 1,082, and since then we've continued to hold above these kind of levels till time there. The markets believe that, as I said, momentum is still on the higher side, and any profit taking as and when it comes would be only after we hear some positive cues coming in from US and China in sense of trade talk development. Until then, you could be looking at higher highs.
Okay, all right. Thank you very much for that, Manisha. So gold continuing to sparkle. Well, we'll take a break. On that note, come back on the other side, and it's our special segment. It's the economy. Lata today discusses details with Rikin Shah, who is the banking expert at IIFL. He talks about whether bank margins have bottomed out.
Welcome back. Bank Nifty has become the toast of the market after a fairly long, lean patch. In fact, today, ICICI Bank and HDFC Bank have posted 52-week highs. Both these banks, along with Axis, have hurled surprises at us by cutting their savings deposit rates after the Reserve Bank cut repo rate twice, while the state-owned banks, SBI and Bank of India, have expectedly announced term deposit cuts. So does this mean banking sector as a whole has seen the worst of its margins? Now, the other surprise, of course, we got this morning was IDFC attracting two marquee investors, Ardia and Warburg Pincus, into its fold. Warburg Pincus coming back yet again. So banks all over the place in terms of news, and two of them are announcing their numbers over the weekend. To give us an idea of what to expect from this sector, I have with me Rikin Shah, the banking expert from IIFL. Rikin is the Senior Vice President at IIFL. Thank you very much, Rikin. Well, first up, I wanted to ask you this. Bank margins, have they bottomed out with, 5 of them cutting either savings deposit or, FD rates?
Foremost, Lata, thank you for having me over. Regarding your question on the bank's margin, clearly we have seen the RBI cutting the repo rate by 50 basis points, and our house view is of another 50 basis points of rate cut in the upcoming policies, 25 in June, and subsequently one more 25 basis point of rate cut in this calendar year. Now, we have known that usually a repo rate cut is a margin drag for the banking sector and a positive for NBFCs. But the banks, as you rightly pointed out, have responded to this repo rate cuts either via cutting the SAR rates. And it's not only the frontline private banks, but even multiple mid-sized banks, which have been cutting SAR rates anywhere between 25 to 200 basis points in last 2 months. On the other hand, only HDFC Bank, Kotak, and a few other PSU banks have cut the term deposit rates. Net, the way we think about it is that a typical 25 basis point of repo rate cut drives 8-9 basis points of margin contraction in the first year, and subsequently, as the deposits reprice, that reverses. But what the banks have done is that with the SAR rates now getting cut, there is some cushion to this margin sensitivity that we are talking about. So this 7 to 10 basis point of margin contraction goes down to 5-6 basis points given the SAR rate cuts that have been done by the bank. And hence the drag on the bank's margins will be lower than what we would have estimated few months ago. But net, just to summarize, I would say that 50 basis point of rate cut is built into the numbers and expectation. And with further 50 basis point of repo rate cuts on table, we'll see more margin pain in the coming quarters for the banks.
Okay. Well, just for the benefit of those who don't use abbreviations much, when Rikin says SAR rates, he means savings account rates, something which all of us have. But Rikin, there is a clear possibility that the rate cut cycle will go even further to probably 5 quarters, considering that we have got inflation rates coming below the MPC's mandated 4%. 3.3 for March, and April, the poll I got was 3.1. You can't rule out, is what economists think. So how long does the margin pain go? Assuming that, you're not just going to get in June and August, but also in September. Or if there is a 50 bips in June, who is to say? Then the margin pain is what, only up to Q1, or does it go to all of FY26?
So, Lata, we think it's the entire part of FY26 where we'll see margins continue to slide lower for the banks, partly due to the rate cuts in the first half, and subsequently in the second half, even the MCLR linked loan book will see lower pricing, because the lower deposit rates will translate into MCLR, and subsequently when the MCLR rates will start going down in the next few quarters. So FY26 margin pain is likely to stay. On the other hand, some other earnings driver like credit costs will start looking better from second half of FY26.
Oh, you expect credit costs to start lowering? For the PSU banks?
Stabilized.
Okay, it will stabilize. I just wanted to ask you whether, there will be a distinction between private and public sector banks in terms of margins.
Yes. So private sector banks typically have around 50-55% of their loan book linked to EBLR, which is largely T-bills and the repo-linked loans. On the other hand, PSU banks have larger proportion of their loan book linked to MCLR. So in the first few quarters, we'll see the private banks margins getting impacted more because the repo linked loans get reset almost immediately when the RBI cuts the rate. On the other hand, the MCLR linked loans will take some time to kind of get repriced. And hence, on a relative basis, PSU banks' margin contraction will be slower and a bit more back-ended vis-a-vis the private sector banks. But having said that, there are a few more nuances even within the private sector banks. Each private sector bank typically has a 1 month to 3 month reset even for repo. For some banks, it gets reset almost immediately. For other banks, it may get reset over a month or two. And hence, there can be inter-quarter movements wherein we may see margin contraction coming for a few banks first and then subsequently in the next quarter for the rest.
Okay, then let me just ask you about the results itself before I come with other questions. Which are likely to be the positive ones in the coming result season starting Saturday?
Sure. So foremost at the sector level, we are saying that the earnings are likely to be very sluggish for the sector as a whole. For the aggregate coverage of the sector, we are forecasting PAT to degrow 7% YOY and grow only 1% QOQ. It's a function of loan growth decelerating, margin contraction, and credit cost still remaining elevated for the sector. Now, within this, individually, we expect banks like ICICI, Bank of Baroda, and HDFC Bank to report better than consensus numbers. On the other hand, three names where we believe there could be misses to the consensus should be Federal Bank, RBL, and IndusInd Bank. The other banks should largely be in line with the consensus expectation, but the overall earnings growth trajectory, as I pointed out, is going to be very weak in this quarter.
Okay, well, actually, let me ask you a little more on IndusInd. Their ultimate number was not worse than the number they had prepared us for. They had prepared us for about 19-20 crores of financial accounting adjustment. It didn't turn out to be worse than that. Does it look attractive now?
Lata, we would refrain from talking on individual stocks, but all I'll say for IndusInd at the moment is that in addition to this accounting derivative loss, whether disclosures out there, the fundamentally as well, the loan growth is likely to remain under pressure and margins should see significant contraction, given that they have raised a lot of funds via high-cost certificate of deposits. And also because the slippages are going to be elevated, so there will be a lot of interest reversals and margin pain. In our published numbers, our FY26 ROE for the bank is only around 10%, which is meaningfully below its cost of equity. So it's going to be a slower fundamental improvement for the bank from where we are currently.
Oh, okay, that's a pity. Well, let me just tune out of results for a minute and then come back. This IDFC news is quite spectacular. Warburg sold off only in March of 2024, and they are now attracted back to the same bank. Will you include that in your coverage? Any opinion on IDFC itself? And is this a positive for the sector itself that, marquee funds are interested at current levels?
Again, without getting into a specific name in detail, many mid-sized banks, including IDFC First Bank, have seen significant correction given their exposure to the MFI sector. Okay. Now, as we stand today and looking at the bureau data, 4Q will see more residual pain for the sector given the slippages will be elevated from the loans which are already 30 to 90 DPD. But the early bucket trends, the collection efficiencies have started improving. And notwithstanding any big negative surprise starting from 1st April when the MFIN norms are getting further tightened and lenders can have lenders can have exposure to borrower only up to 3. We believe that MFI is at the fag end of the asset quality problem. In next 3 to 6 months, the slippages will start peaking out and the credit cost may take another quarter or two depending on what kind of lender we are talking about to peak out. Having said that, while asset quality problem for MFI sector will start abating, growth is something which we are still cautious about for the sector. The industry as a whole may not see a significant growth in FY26, and that is where some risk to the MFI growth estimates for lenders are likely to be there. In context of given that asset quality pain is abating, I would imagine that many mid-sized banks who have sizable exposure, including IDFC First Bank, can start reporting relatively better operational trends from next quarter onwards.
Okay. I'm going to ask you a head of research question, but I'm sure you will be in on this advice. Do you think Bank Nifty or banking stocks have a chance of outperformance in the next few months? Because the chorus seems to be that domestic-focused stocks, especially in a country like India, which is largely domestically driven, are likely to do better, and it is the internationally focused stocks that are likely to be a little more wobbly. So what's the IIFL opinion?
So our house view has been that in the last few months, we have already seen banking sector outperforming broader market. It's primarily a function of flight to safety because the valuations in other sector are relatively a lot more stretched, whereas banking sector valuations are inexpensive. So in that context, banking sector has been outperforming the broader market. But given that we are now talking about a longer and a bigger rate cut cycle, and the earnings growth for banking sector in the entire FY26 is at best going to be low single digit. I think the banking sector can take a breather in the near term. It's only in the second half of FY26 where we believe that as the asset quality starts stabilizing, a lot of margin pain gets behind us in terms of the numbers. And when we start looking at FY27, when the earnings growth is expected to be mid-teens, we expect the banking sector to start again doing relatively a lot more better than the other sectors. But in next few months, as the results kind of pour in, we would see that the earnings are going to be very tepid. There will be some more downgrades in the estimates. And hence, from that perspective, it's not one of the topmost or preferred sector for the IFL within the entire construct of all across the sectors.
So right now, NBFCs will be better than banking.
Yes, some high growth NBFCs would be better placed with vis-a-vis the banks.
Okay, we'll leave it at that and touch base with you after perhaps the weekend. The weekend will be a busy one for you and for us as well, with a bunch of banks coming in. I think ICICI, HDFC and Yes Bank as well coming in with results, and then there'll be more following. But for the moment, I think the Bank Nifty has a lot to cheer. It's not just the best performing index. Two of the index heavyweights, ICICI and HDFC, are at the moment at their 52-week highs. So a lot going in favor for the banking space. Among the other, of course, Eicher Motors and Bharti also at 52-week highs. So a lot of stocks have something to celebrate. Banks have a little more, perhaps. On that note, we wrap up on Bazaar. Chartbusters will come up after a short break.
Wipro is the top loser on the Nifty following a weak set of Q4 numbers. The company also guides for a revenue decline of 1.5% to 3.5% in the first quarter of FY26. The management speaking to CNBC-TV18 points to uncertainty in the market and indicates delays in discretionary spending decisions. Sonasa Software is down close to 7.5% as it issues a warning for the fourth quarter, stating that revenue from the largest client will be lower than expected. Analysts are now estimating a high single-digit decline in revenue in the fourth quarter.
IDFC First Bank's board approves a 7,500 crore rupee fund raised via preference issue to Warburg Pincus affiliate Current C Investments and ADIA subsidiary Platinum Invictus at 60 rupees a share. MD and CEO V. Vaidyanathan tells CNBC-TV18 that the bank will double its balance sheet every 4 years, expects good profitability from FY26.
Angel One is under pressure after the weak showing in the fourth quarter, the revenue, profit and margin decline. The company has also lost market share in the equity, F&O and commodity segment.
Waaree Renewable climbs nearly 4% after reporting strong fourth quarter numbers. The revenue rises 74%, whereas the EBITDA for the company rises 68% year on year.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And we have had a good run, Mangalam, in the last few trading sessions. And today as well is not too bad because the sense you get is the dips are getting bought into and the Nifty Bank. That's the batsman in top form and that's really holding its own.
The Nifty Bank is in top form, and what's in even better form on the Nifty Bank is HDFC Bank. You know, when the top run scorer goes ahead and accumulates or, leads from the front, it gives you Virat Kohli vibes.
Yeah.
At the time when the market has been struggling, facing a fair amount of volatility, you need someone like HDFC Bank, which had been an earlier underperformer, to go ahead and hit a fresh 52-week high. That's exactly what it has done at a time when there is global uncertainty and the street is looking at domestic ideas. When the RBI is looking to cut rates as well, change its stance to accommodative, maybe one of these rate sensitives like the financials, private sector financials, doing a lot better. HDFC Bank just under that 1,900 rupee mark. But while, bulls are clocking in gains on HDFC Bank and the Nifty Bank, let's see whether people are checking into the hospitality sector or not. As summer approaches, hotel bookings are set to rise owing to a surge in travel. We are now tracking the travel trends across the sector along with the outlook for the year as well. We have Nikhil Sharma, who's the MD and COO South Asia at Radisson Hotel Group. We also have Arjun Balji, who is the president at Royal Orchid, joining in. Thanks a lot, Nikhil and Arjun, for joining in. Let's come across to you, Nikhil, first. Over the last couple of days, there were a lot of summits that were taking place in the hospitality sector. Just wanted to understand what have been the key takeaways in terms of trends for the fourth quarter for the industry and the outlook for this year. Are RevPARs too high after the growth that we've seen, or do you believe there is room for more growth there?
Firstly, Mangalam, thank you for having me. I would just say, despite the global headwinds, supply chain disruptions that we're seeing, capital markets being very cautious, India's domestic travel market remains resilient. The GDP growth is a factor in that. Of course, we're seeing 9% personal consumption go up. At Radisson, we've seen in FY25 RevPAR growth by 13%, and we have a very strong pipeline for FY26 at the moment.
All right. And Arjun, your thoughts on the industry right now? How are you looking at openings in the next year, occupancies? How are they likely to rise up? And I'm looking at your average room rate. It's close to around 5,500 rupees odd. What is your prognosis on, moving away from the positioning that you're at, get a higher ARR for your products?
Well, thanks for having me. I think at Royal Orchid, our mix of about 120 odd hotels predominantly sit in the tier 2 and below cities. And in those cities, of course, we focus on the smaller hotels that fortunately people like Nikhil don't like. So, when we're targeting in India for India strategy, you've got the smaller 60 to 100 key properties where ARRs tend to be a little lower. But also, just taking a step back, a vast amount of our growth has come in the last 2 years. And hotels typically take 1,000 days to settle in. So we're in the upswing period. Now, just from the last quarter, or say if you look at the Q-on-Q growth, we've grown 27% in revenue, right, quarter on quarter. We've seen a PAT growth of 140%. So it's incremental. It is a cautiously optimistic approach towards growing the business. And we do see ARRs inching upwards. You will see that in our numbers with, the Mumbai hotel opening and some of the key tier one larger hotels that we're opening in the near future. We have a number of hotels in the upscale leisure segment that are coming on stream. So they will obviously add to the upswing in the quarters to come.
Okay. All right. Nikhil, let me come back to you. At what rate is it enough? I was I was on a staycation in this weekend itself. And on Saturday, when I was checking in and asked them, what is the occupancy today? They said it's around 95%. I said, okay, it's a Sunday tomorrow. Maybe it'll be less. They said, no, tomorrow's 98%. Wow, this is, a chain in Powai itself. So that's showing the kind of interest levels, people are totally booked out. But how much of upside is to go on the ARR, Nikhil? At some point of time, it's going to get too expensive.
Well, Nigel, if you look at the branded hotel supply in the country, right, it's growing at 4.2% CAGR, right? And the demand is really outpacing it. It's at 8 to 9% CAGR. So there is a widening gap, and that supports the ADR growth. And in my personal view, in this financial year, you should see a further rise of about 7.5 to 8.5% in the ADRs in key markets, and of course, leisure destinations and micro markets like the one you were in Powai on the weekend.
All right. I have to ask these questions to both of you all, and we'll start with, Royal Orchid first and then come back to Nikhil. There is a slew of signings lined up for all of you all. Is scaling up a problem given the limited supply and given the number of people who are aiming for properties? Because everyone we speak to, they say that, okay, demand is growing in double digits. Supply is likely to grow at best at, mid to high single digits. More importantly, everyone is chasing the same assets. So does that make it a lot more difficult for you to scale? And not only was it, difficult already with the larger players coming in, we had Interglobe and Accor renewed their promise to become fast. They have a target of almost, 300 hotels by 2030 from 60, 70 that they have right now. Arjun?
Well, I don't see that being a problem at all. I think India is a large enough market for all of us to grow and for all of us to add hotel supply. There is enough new builds happening right across the country. That is something that I think Nikhil will agree with, that there's enough room for Radisson and Royal Orchid to grow in the same markets because the hotels are coming up. The other thing is the conversions. So switching from unbranded to branded is something that we've seen over the last 5 years, and that is accelerating. So I do not see competition between brands being a reason for degrowth at all, or rather slowing down.
And Nikhil, your thoughts?
Well, Mangalam, India has about 185,000 branded rooms at the moment, and Arjun spends a lot of time in Dubai, so I'll take Dubai as an example. Dubai as a city has about close to 150, 160,000 branded rooms, right? So it just gives you the length and breadth of this country where we need branded supply. And one of the things that Arjun alluded to was conversions and getting more unbranded hotels into branded space. And you will see that growth. In the last 14 months, we've actually signed hotels in 45 new cities. We are in 75 cities at the moment with almost 130 operating hotels. We go to 114 cities in the country. So the real growth actually lies outside the top 10 key metros, if you may call them, or key cities. The real growth lies in Bharat, and that's where we are seeing 60% of our future pipeline, whether it's tier 2, tier 3, or new leisure destinations that we are creating, like Saputara, Karjat, and so on and so forth. So really the flag planters in making sure that tourism reaches the rest of the country. Of course, spiritual travel continues to grow, whether it is Ayodhya, Prayagraj, or Amritsar, and you will see more and more of spiritual travel.
We take that point. We are looking at JLL's recent report as well. Tier 2 and Tier 3 cities accounted for nearly 50% plus transactions in 2024. That's likely to grow here as well. We'll leave you both with just one number each. Next year, what level do you expect your occupancies to be at? How much higher would your RevPARs be on account of that? And if you would give us a sense of how many hotels are both of you all looking to open in the next year? Start with Nikhil.
Well, we intend to open 20 hotels this calendar year. So by next April, we should be operating 150 hotels in India itself. Like I said, ADR growth anywhere between 7.5% to 8.5%. I see MICE growth, and we didn't come to that point, but MICE is back. Of course, weddings have been back. Corporate offsites are back. And we've seen just that segment growing by 18% over last year. So that's going to lead to another strong growth. Again, in hotels that have convention centers and so on and so forth. So Mangalam, to your point, 60% focus on tier 2, tier 3 cities from an openings perspective, and an ADR growth of anywhere between 8.5% to 9.5%.
All right. Arjun, you said that Nikhil wasn't interested in the markets that you were operating in now, but now he's saying that 60% growth comes in.
He's not interested in the smaller size hotels that we are after, buddy.
Okay, but tell us, what are you planning for now in light of what's taking place in tier 2 and tier 3 cities? Next year, what's your target?
We have 28 hotels that we've announced that are opening in the next calendar year. We're signing hotels regularly. So I think from a listed company perspective, what I can tell you is that we've got 28 hotels that are confirmed opening, should take us to about 140 operating assets. As I said, the focus of the company last year and a half has been return on capital and return on equity. And I think we're in the top of the industry, of the listed players, at least on those two metrics. And having looked at those two metrics, we're doing flexi leases, we're doing management contracts, and now, of course, a big franchise push. We've had a 6% quarter-on-quarter RevPAR growth, and we certainly hope to see that increase as times come.
Is that tier 2 and tier 3 will lead growth, so the industry is poised for 6 to 8% between the two of you all, at least, RevPAR growth, with a higher share of revenue coming in from weddings, marriages, management, corporate events, etc., and all those offsites. Nigel.
Just thank you, gentlemen, for joining in, and wishing you all the best. And we look forward to chatting up with you all as the year progresses. Clearly, you're sounding very, very optimistic on business prospects going ahead.
Thanks for having us.
Mangalam, you're checking this weekend?
No, I'm not checking in this weekend, but my worry is the more optimistic they sound, the more pessimistic I become, because I have to spend so much more if at all we have to go there.
The only trick, Mangalam, is to book well in advance. You get some deals, try to squeeze it in there, and now since you're a father, it'll get even more interesting.
Let's see how that goes.
Okay, all right. I think, we should just focus on a couple of stocks. Our ticker team will put this out. ABB India, that's the stock that we're looking at. There's a big spike up that we're seeing, in the stock. That's because ABB Global, they have released their earnings. And the important number to look at is the India number. ABB India region, the order is up by close to around 1%. So I think we should get that number up for you. The consensus estimate was for a 6% decline. So that's the reason that the stock is flying away. I think we should get a couple of those lines up for you on the screen. We get some further analysis as well going. But early at around, I think, 10 a.m. or 10:15 a.m., we had the global parent that released those numbers. And that explains why the read-through is a little bit positive, I think, for the India business. Explains why the stock now is up close to around 4% or thereabouts. We'll get a further analysis going on that particular counter. Well, let's shift focus for the time being to our special segment where we get you a few ideas for profit from Money Control Pro. Khushbu joins us to help us out with the stock that she's tracking. Khushbu, take it away.
In today's idea for profit, we have ITC Limited. ITC is an Indian conglomerate with diverse business interests where the core cigarette business remain a steady cash generating machine. The premium cigarette offerings continue to perform well, led by high growth in the alternate channels, while heightened competitive intensity and cost headwinds in the FMCG business partially impacted the packaged food portfolio. ITC will likely gain scale and competitive edge in the core portfolio after the potential acquisition of 100% stake in Ample Food and Prasuma, with a large presence in the high-growth frozen and ready-to-cook segment. While the agri-business will continue to offer strong opportunities and will remain a key growth driver, a stable tax regime will keep cigarette volume growth steady. ITC remained a defensive bet with healthy dividend yield amid the macro headwinds and market volatility.
All right. With that, what we'll do is take a short break, but we're not taking a break from discussion around travel. These guys spoke about new destinations, right? How do you get to those destinations? You either take a train, you either take a bus, or you take a flight. We have Alok Bajpai, who's the group CEO of Ixigo, joins in to discuss on all travel trends, how the fourth quarter was, Mahakumbh related bookings, and what the next year looks like. Welcome back. We're talking about the travel space itself. We heard from the hotel companies wanting to, expand their reach into tier 2, tier 3, and they're developing new destinations. Alok Bajpai, the group CEO of Latravenue Tech, commonly known as Ixigo, joins in to talk about how he's planning to, increase traffic to these new destinations via his platform, but more importantly, what the year looks like, what the quarter was as well. Thank you, Alok, for joining in. Earlier, the conversation that was there spoke about spiritual tourism. In the fourth quarter, the biggest spiritual event of the last many decades actually took place, which was the Mahakumbh. I suppose that would have given a big spike to your fourth quarter volumes. If you could give us a qualitative indication of how that was and how the next year looks like for you.
Sure. So I think the fourth quarter was a blockbuster quarter for most travel players out there. I mean, anyone who had anything to do with ground transportation would have seen massive spikes for UP, especially when you look at the bus business where the capacity constraints were not as pronounced and bus operators were very nimble at deploying their assets, in routes in and out of UP. I think there were noticeable increases in volumes that one saw out there. Even on flights, thanks to, the Prayagraj airport operating in full swing. And then also during I think sometime middle of February when you started to see increase in capacity also towards that airport, it was quite a breather. But what we saw in February at the market level was that, fares obviously spiked up because there was a spillover on all other sectors, because remember that a lot of people were feeding into UP from, other sectors, including Delhi, Lucknow, Patna, whatnot. So in that sense, the whole market saw a little bit of a lift there. And when you talk about trains, there were quite a few special trains deployed, towards Prayagraj, and then there's a spillover into Ayodhya, Varanasi, and other spiritual destinations around. So I think for most travel players, that entire period was definitely seeing spikes, in and out of UP. And overall, I think as we head into summer, we are seeing continued surge in demand, especially towards places in the hills.
Hi, look, good to hear your optimism. So you said it was blockbuster for the industry as well. For you, what kind of a growth should we be working with for quarter 4? And also, since it was a blockbuster for the industry, what is your updated market share? Did you gain?
Well, if you look at our numbers for quarter 3, which was a precursor to what was happening in Q4, right? We had market share gains in all verticals that we operate in, across flights, trains, and buses. And we were the fastest growing OTA in the market, growing our GTV at around 48% YOY. So we crossed 4,000 crores of tickets sold in Q3. it'll be hard for me to guide what happened in Q4 given we're in the quiet period. But what I can tell you is that at an overall market level, definitely, there was acceleration partly thanks to the Mahakumbh out there.
So you are saying that you did grow faster than the market in the fourth quarter as well?
Well, I'm just saying that the overall market did that. And of course, us being the fastest growing player there, would have followed through.
Got that. We don't want you to get into any sort of regulatory troubles for the fourth quarter. So let's talk about FY26. Given the run rate that you've had in the first 9 months and, what you had earlier targeted for this entire year, on the base of that, do you think 1,000 crore revenue in FY26 with around 65 to 70 crore net profit is a possibility?
Look, I think at this point, given we are a very young company to the markets, we've not finished 12 months since our listing yet. So I think we are not going to go into guiding on revenue or bottom line at this point. All we can say is that we would love to maintain our ability to grow faster than the overall OTA market and other incumbents out there. And I think that's something which has been well on track and has been demonstrated already in the first 3 quarters that we've reported. And we hope to maintain that in the quarters to come.
And your new verticals, I mean, you've been significantly growing share in airlines on a very, very low base, and hotels was something that you announced just before your IPO, and you said that it'll take a couple of quarters. It's been a couple of quarters. Do you have any clarity on what you're aspiring from the hotels business in terms of revenue? Will it just be cross-selling, or you are, trying to make a new offering here itself? And on airlines, do you have a target of what proportion of your revenue comes in from airlines and hotels over the next, say, 3 to 5 years?
Yeah, I just want to reiterate our market strategy here. So we actually are very well penetrated in the tier 2, 3 markets, especially with train at the core there, where we are the market leading OTA. And then, of course, bus has been growing fast as a result of the audience base being very similar. But if you look at the secular story of India, the growth in air and the growth in hotels both are predominantly coming today from the tier 2, 3 markets. I mean, we just had a couple of other folks in this segment which were talking about the same. But essentially, I want to reiterate that a large part of the growth in travel, whether it is for the leading airlines, whether it is for the leading hotel chains, or even for large bus operators, is going to emanate from tier 2, 3 markets, which happen to be our core market, where we happen to have larger market share already. So in that sense, I think we've been a beneficiary of where the market is headed towards. And remember that this part of the market is also significantly under-penetrated. So if you look at hotel penetration in our part of the market, it's lower than what it is in the tier 1 sort of markets. If you look at bus penetration in our part of the market online, it's still much lower. It's almost 20% online penetration. There's still a long way to go in terms of runway over the next few years. So we remain very optimistic as to what the next billion user side of the market is going to do over the next few years. And what we said at the time last we spoke on hotels was it would take a couple of years actually for things to start showing up on that side, because it obviously needs a lot of work. So I think we are happy with the progress we've made so far, and as and when we have more to share, we will.
All right, we will leave you with the promise of joining us after your fourth quarter results. Then we'll have a better handle on what the numbers were during the fourth quarter, and more importantly, you can give us some more details as well.
Well, that's right, Alok. Appreciate you joining, and thanks a lot for helping us out with some details. Well, before we get into that break, just want to address the flash that was up for you on the screen. Nuvama, well, on ABB, they say that the global commentary implies an order inflow of around 3,800 crores. That compares with their estimate of around 3,200 crores, which explains why that stock did see a bit of a fillip. We've got an exact number out there. The India region order was up by close to 100%. We told you that before we went into the break. And now they've quantified it, 3,800 crores, better than what was estimated at around 3,200 crores. Slip into that break, come back. We'll continue our focus on stocks. Maybe we'll get you an updated analysis on ABB India as well. Don't go anywhere.
from an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Bessent has already said that we will, the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that, because they've always said we want to bring things onshore, we want to bring things near shore, which is Mexico and others, and then we want people which are friend shore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that, in a sense, for them. So in that context, the way they are laying.
Welcome back. Well, let's pull up the intraday chart of IDFC First Bank. We had, that big fund infusion earlier on the exchanges today. The stock was mildly in the red. Now it's recovered from the day's low. The stock has moved to the high point of days. Clearly, the street believes that, vote of confidence coming in there from big investors. They like it. It'll be a dilution of around 14 to 15%. So that stock has moved to the high point of the day. Venus Remedies, I think there was some positive news flow that was on the exchanges. So positive rub-off out there. That stock is at the high point of the day. And Ujjivan Small Finance Bank, that stock actually is bursting away, giving it company on the upside is delivery. So big up move is what we're seeing on both those two names. And Havells, the one that we were tracking yesterday as well. Yep. Today as well, it opened up in the red, and that continues with strength, moving up. I think it's around 1,635 and 40 rupees as we speak.
Yes, Nigel, the tagline is that wires that don't catch fire. It looks like the stock is the one where bulls, keep firing that
after
up
the
as well.
sharp pullback.
After the sharp pullback that we've seen, obviously that is something we need to keep on our radar. But we wrap up on this edition of Chartbusters. Let's get you some good news. The news leader, business news leader for India, which is CNBC-TV18, is on an app. It's the all-new app which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the CNBC-TV18 app from the Apple Store or Google Play Store. You can just scan the QR code which is there for you on the screen. Thank you for watching.
Board. I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. How many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth, because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain in a sense. Even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning and then you can start making your own product. Because we were just not in any of these global supply chains for so long.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your
Good morning. Welcome to Trading Hour. It's a Thursday morning, but it's also the last day of this trading week. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer. It's a quiet day. We've had 3 days of gains on the trot for our markets. And today, markets just seem to be consolidating, moving sideways. Though for the week, the Nifty is clocked in a gain of close to about 2.5%. The mid-cap index is up 3.5%. Banks have provided leadership in this leg of the up move. So, today as well, banks are up 0.5%. For the week, it's up nearly 4.7%. And that's helping offset some of the weakness that's coming through from the IT stocks. We'll talk more about it, but the Nifty IT index has a cut of close to about 2%. So IT is under pressure, but what's moving up? You've got an ICICI Bank right on top. Bharti Airtel is up and about. TVS Motor, Sun Pharma. So the gainers list is cutting across sectors, but what's firmly down is IT. And, Indian markets are shut tomorrow, but global markets are shut on Monday on account of Easter Monday. So it's pretty much a long weekend for everyone around the world.
That's right. Good morning, Reema. Pretty much a long weekend, something that we're all looking forward to. Bit of a recovery, as you can see, across the markets. Quite a lot of news flow, across. And across sectors, we're seeing significant news flow, and stocks are reacting quite sharply to the kind of developments that we've seen overnight. First on the list, some time ago, you just saw the results of ABB Global flash across on your screen. We're looking at the read across as far as India is concerned, and the global results are indicating that ABB India this time around could show a stronger order inflow compared to what the street was actually baking in. The second stock, of course, has to be IDFC First Bank. The significant preferential issue of fundraise coming in from two marquee investors, both Warburg Pincus as well as ADIA, that's Abu Dhabi Investment. And you're seeing that particular stock after the brief sell-off that the stocks saw post the news flow. It's recovered quite sharply now towards the day's highest point. KFin Technology, development coming in over there. The company has made an international foray. The street clearly likes it. Almost 8% higher today for KFin. And Wari Renewable, another stock from the Wari group, which actually is in solar EPC business. That particular stock also reacting strongly to results, higher by close to 4%, cooled off a little bit from the day's highest point. But news flow, stocks heavy. The only sector that's lower today is the one that you track closely, that's the IT pack.
There's so much nervousness surrounding IT. While the Nifty IT index is a cut of close to about 2% today, year to date, the Nifty IT index is down 25%. Versus the Nifty, that's the benchmark index, being down 1.5%. So big underperformance. That said, it's still about 5% away, the Nifty IT index, from its 52-week low that it hit on 7th of April. Now let's run you through some of the price action and the stories today. Wipro is down. That's because its Q1 guidance for June quarter missed the mark. It's a very dismal guidance, minus 3.5% to minus 1.5% on the top line. Sonata, that's the big one, down 7% now. This is after the company issued a revenue warning for Q4, saying that the revenues that they were anticipating from the international client is coming in lower than what they were earlier anticipating. And the street is now expecting that perhaps Sonata, in the coming quarter, when they report their numbers, could report a revenue decline of high single digits. There's also nervousness going into Infi's guidance. Infi's numbers and guidance, which is today post-market hours. Will they guide or will they not? And if they don't guide, that means the revenue uncertainty lingers on for 3 more months. So far, the picture that we have, both TCS and Infosys have missed the mark in Q4. Revenues for both the companies have declined by 0.8%. The managements have highlighted that clients are turning cautious. They're taking a measured approach towards large transformational projects, discretionary spending. There are decision-making delays. Some projects have been put on hold, and all that is impacting. Today, of course, is Infi and Tata Elxsi, but over the course of the next few days, Mastech, HCL Tech, LTI, Mindtree, Signed, all these companies will be reporting numbers. But today, it's Wipro and Sonata, which are taking it on the chin. Listen in to what the management had to say about Wipro, about the quarter gone by and the outlook and the reason behind this subdued guidance.
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
We've seen fixed price programs improve their productivity. We've seen acquired entities improve their profitability. We've rationalized overheads. We've also rationalized staff who are non-client facing in some of the functions and roles in G&A. So all around, it's been a very solid performance in FY25. We have said our endeavor would be to hold it in a narrow band. So yeah, 17% plus. There is pricing pressure for sure. Is this any worse compared to how it was, let's say, a few quarters ago? I'm not sure. How do I contextualize it? But I do see that increasingly a lot of the large deals are vendor consolidation and cost takeout. So yes, they're quite competitively fought, and therefore it does have pressure on margins.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded everyone.
Well, that was the management of Wipro talking about the results as well as the hiring outlook in the quarter that just went by. But moving on, remember, it was a confirmation of a CNBC-TV18 news break. IDFC First Bank earlier today informed the exchange that they'd approved a 7,500 crore fundraise. Our colleague Nimesh, who was the first to report this particular development, now joins in with more details. Nimesh, over to you.
Hi, Vivekana, we've seen a sharp recovery in the stock as well after the news got hit into exchanges that IDFC First Bank has managed to raise 7,500 crores via equity, and that too from two of the largest and marqueest investors in the capital market. One is Warburg Pincus. They're going to invest along with Abu Dhabi Investment Authority's private equity arm. So the two large investors putting money into IDFC First Bank via equity. It's done through a compulsory convertible preference. So over the period of time, it will be converted into equity. Post-equity conversion dilution would be close to 15%. The fact is that IDFC First Bank could manage to raise such a large equity from two of the marqueest investors has gone down well. So we spoke to the management as well, but the key news is that IDFC First Bank has raised 7,500 crores from two large investors.
Thank you very much for that. Let's also listen into what the management had to say on the fundraise in an exclusive conversation with CNBC TV18 earlier today.
I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, then we pitched the story. We told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time. So they felt excited to come again. This will have a dilution of 15%. But really, Lata, I want to just share one thing to you and to all investors hearing this program. that the main thing is that the bank has a phenomenal model. Otherwise, our operating profit could not have grown from 750 crores to 6,000 crores, like 16.4 or 5 right now, and it will go to 18 point, close to like 19% after this raise. The thing is, Lata, that as the CEO, I have two very big responsibilities: to run a super safe bank. Super safe bank. Super safe bank is how diversified deposits are, etc., and how quality of loan book is good. All that is super safe. But capital is a very, very important part. I take that as a responsibility. And even though we were 16 plus, I have to be honest, I wanted to raise more capital. I tell them that phase 1 was setting up the bank. Phase 2 is operating leverage. Phase 2 is profits. Phase 2 is return on equity. And I have indeed suggested to them, let me say, nobody can promise anything, but I have definitely, like in my own way, told them with a lot of confidence that they will make lots of money. So think of this year like we had a massive turnaround in our PAT from the bank. We took it off from the loss position to profit. It was supposed to go up. It came down. It happened to us. But we believe from 26 onward for the next 4-5 years, you should expect good numbers on this bank.
Well, very important news development as far as IDFC First Bank was concerned. Immediately post the news break, the stock actually saw quite a bit of a sell-off, but it's completely recovered all of those losses. The stock now trading with a gain of 0.5%. But one stock that is in focus is actually ABB India. Some time ago, around an hour ago, ABB Global, which is the parent entity of ABB India, actually went ahead and delivered its quarterly results. In that quarterly results, the commentary as far as the India business is concerned indicates that there is now an approximately 1% order inflow growth versus what's actually been a 12 to 15% average in the last 4 quarters. However, remember, ABB India last quarter actually saw a dip of close to 21% as far as the order inflow was concerned. So clearly there has been a significant order inflow recovery. Now, Nuvama came out with a note immediately post the results of ABB Global. They are saying that the global commentary now implies an order inflow in the range of 3,600 to 3,800 crore for Q1 CY25 for ABB India versus their estimate of close to an quarterly order inflow of close to 3,200 crore. So a slight beat to the order inflow estimates versus what the Nuvama poll was anticipating. Now remember, last 4 quarters, ABB Global has actually reported close to 3 to 9% order inflow growth, and ABB India has gone ahead and delivered average order inflow in the range of 12 to 15% growth, except for last quarter, which we just mentioned, that saw a degrowth of close to 21%. And the reason for that was that there were no large deals that the company saw in the quarter that just went by. ABB India will deliver its results on 9th of May, which is where we will get the actual order inflow. Despite that, on the back of the positive commentary coming in from the global parent, Rima, what we've actually seen is this particular stock is now near the day's highest point, almost 4.5% higher for ABB India today.
Interesting updates coming through from the global parent. Get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in on the other side. Don't go anywhere.
How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com.
Back to trading hour. Well, there has been a bit of a recovery, especially as far as some of the large cap names are concerned. Nifty trending just above the flat line, but individual stocks is where all of the action lies. Have a look at Reliance Industries. That particular stock has seen quite a bit of a recovery, now trading near the day's highest points. The entire metal pack has recovered very sharply from the opening lows. Have a look at Jindal Steel, that is JSPL. That particular stock is now up close to 4% and trading near the day's highest point. Another stock that had witnessed significant selling pressure in the last few weeks was actually Hindustan Copper on the back of falling copper prices, but that stock too has recovered quite sharply. In fact, some of the global facing names, that have seen quite a bit of volatility in the last few days, names like Bharat Forge, Motherson Sumi, Sona Comstar, all of these stocks too are recovering in today's trading session. But we'll now shift focus to the commodity space. Manisha joins in, and today you're focusing on crude, right?
Well, yes, thank you for that, Vivek. It's not just precious metals, as you mentioned. The base metal prices are doing quite well, and the crude oil prices is what I'm focusing on. And we are trading at a 2-week highs right now. It has been a strong gain, not just that the NYMEX is back above 60, but it's trading around 64. And the WTI, the NYMEX, the Brent prices also have seen a sharp gain. So for this week, we are up by 4.5% in case of the crude oil prices. And there are 3 major reasons for this support to be coming in for the crude prices there. One is that the US and Iran conversations, remember, it started last week, reconvened in this week, and we do understand from various reports that US is looking to tighten sanctions on Iran oil trade, and that has led to that premium coming in for prices. The second is that many of these OPEC producers now, by the way, OPEC and allies will increase production from the month of May, but this also is about conversation of keeping within that quota, and many of the OPEC members have now pledged to ensure that they do not overproduce and keep up to their quota. That has gone well with the crude bulls as well. The third thing really is about the drawdown in sense of distillate and gasoline inventories from US. That has also led to some buying. And even as the markets are looking at weak demand growth going forward, and that's the kind of report that the crude prices reacted to coming in from OPEC and IEA, Goldman Sachs, JP Morgan. Everybody's talked about more supplies, weaker demand, and weaker demand growth for this year, and that weighed onto the markets. But with the kind of economic data that we have seen, especially coming from China, the China import of crude oil for the month of March also was higher by 5%. All of that reaction can be seen in case of prices on your screens.
Thank you very much for that. We will slip into a break on that note. On the other side, we'll talk market technicals. Apurva Sheth from Samco Securities joins in next.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
And this project of TCS is expected to create close to 12,000 IT jobs in Visakhapatnam, which is the IT capital in the state of Andhra Pradesh. So we're really excited to have TCS land finally in Visakhapatnam, and we're looking forward to inviting the other larger IT players also to come down and set the shop up in Visakhapatnam. In Visakhapatnam, it's not just about the land. We have amazing talent that's available. And if you look at it in the IT sector, people from Andhra Pradesh and Telangana, the Telugu-speaking people, have a very large role to play. So we have amazing talent pool. We have great infrastructure. As a state, we're willing to give land at a very subsidized price. And I keep jokingly telling people that if go over to marry...
Welcome back. The Nifty is holding up in the green, but if you look at the losers list, right on top is Wipro, 5.5% gone. HCL Tech And then you've got Hero MotoCorp, and that's staring at a cut of more than about 2%. Now here, the company has informed the exchanges that production will be temporarily paused from 17th April to 19th April. So for 3 working days at 4 of the company's manufacturing plants. This is to navigate, they say, a short-term supply alignment. Production will resume on 21st of April. 2 of their plants, Tirupati and Halol, will continue to operate during this time, but 4 manufacturing plants, remember, will be shut for a period of 3 days. The company says that the pause will not impact the company's ability to meet retail demand across their domestic and international markets, and the company will recover any deferment on, in their production in the subsequent months. But for now, clearly, the street is a bit concerned that maybe it is to align with weaker demand that production has been shut down, though they're using it as an opportunity that shut down to do their maintenance.
Absolutely. Thanks so much for highlighting that one. One of the top laggers today, in fact, Hero down over 2%. But Apurva Sheth from Samco Securities now joins in for a quick technical check on the market. Thank you so much, Apurva, for joining us. How are you viewing the markets at the current levels? Even the intraday dip has been bought into. Do you see further upside from here on?
So thank you for inviting me on the show. Good morning. And now the markets have been in a range of 21,800 to 23,800. So we are now getting closer to the top end of the range. So we expect that 23,800 to 23,850 is likely to act as a very strong resistance, since the previous 2 peaks were around those levels. The 200 DMA is now trading close to 23,400, which is where Nifty is trading currently. So right now for me, the Nifty is in a no trade zone. We will prefer to wait and watch, since this is a short trading week and next week we'll have expiry. So we'll prefer to wait and watch. Since option premiums are also high, we would like to take it easy. On the stocks front, we have 2 picks from the fertilizer pack. So GSFC is the top pick. It is forming a double bottom pattern and breaking out of it. Fundamentally also, the stock is trading at a price to book multiple of 0.5 with 2,300 crores as cash balance, and it has holdings in Gujarat Gas, GNFC, GIPCL, Gujarat Alkali. So it is a good value pick currently to buy and hold. Apart from that, the next pick is RCF, which is so the target in GSFC would be 215 and stop loss would be 185, and the next pick will be RCF with stop loss of 132 and target of 165. Again, it is forming a double bottom pattern, and today it has broken out with very heavy volumes and also trading above the last 20 days high. So these 2 will be picks from the fertilizer pack.
Thank you so much for joining us, giving us your view on the markets as well as your individual stock picks. If you can see on the bottom of your screen, Angel One, the conference call is underway currently. Remember, the company came out with its results post-market hours yesterday. Slightly subdued commentary is what we are seeing. The company is actually saying that the next 3 quarters client activity may remain subdued. And in fact, what they're saying is that operational as well as other parameters may reach previous highs only in the 4th quarter of FY26. So still almost 3 quarters away for the company to go ahead and reclaim the previous highs. On the back of that, the stock that opened a significant gap down has recovered a little bit, still around 2% higher. But the other stock in focus today is KFin Tech. This is after the company announced that it will acquire a 51% stake in Ascent Fund Services. Hormaz joins in with more details.
This acquisition news came in yesterday, right? They are going to acquire that 51% stake in Ascent Fund Services for around $34.5 million, and they have a path towards 100% ownership in the company over the next 5 years. And this remaining 49% stake will be acquired at the end of FY 28, 29 and 30 with a 16.33% tranche in each of these 3 years is what KFin Tech has highlighted. And how is this acquisition likely to help? Now, Ascent will benefit KFin Tech with the immediate and scaled access to this global fund administration market, which has an over $12 billion revenue run rate. And they also will help them with requisite licenses and permits for services across multiple international markets. They will help them with a diversified portfolio of clients as well as sticky and recurring revenue. So multiple positives that KFin Tech has highlighted in this acquisition of Ascent. Now, what Jefferies has said in its note is that this acquisition will help the company in its international international expansion. It will complement its product suite, and they are also planning to lift the margins of Ascent, which are currently at lower levels, to its own levels of around 45%, which it reported in the third quarter in the medium term. And this deal valuation, which is at around 3.5 times price to sales, is at an attractive multiple, is what Jefferies is saying. They also say that KFin has a good track record of retaining promoters and staff post acquisitions, as it is evident from the previous ones that they have made, but they are cutting their earnings estimates for FY26 slightly because of the cash outgo in this acquisition, and of course for the fact that Ascent's margins are currently at a lower level. However, they don't see any risk of a downward repricing of any existing mutual fund contracts, and as a result of which they still have a buy rating on the stock, a 1310 rupee price target here, but the stock itself has corrected more than 30% from the top.
Okay, thank you very much for that. Get into a break. On the other side, market fundamentals lined up with Dheeraj Sachdev from Roha Ventures.
It's a ghost of 2008, which gives us all that.
It
would never leave you. So far, it's been moving along as Trump had planned.
Yeah.
And I think the worst is behind as far as the markets are concerned.
I remember doing a show when Zomato was listing with some of your team members. So I took early calls.
This is one of the lessons I learned, I would say, early in the TMT bubble, .com bubble. In my US portfolio, I never could buy Amazon.
Okay.
Thinking that it's not making money, and at that time it was also an assessment that it can never make money. Today I often get asked, because we are very cash flow centric and there are loss-making companies in our portfolio as well. Value of any business is present value of future cash flows. It's not necessary you have to make cash flows in year 1, year 2, or even year 3.
Is the post-COVID era dream run of 3, 4, 5 years?
7.
Is that over?
Post-COVID 5-year fantasy run is over. A dream run, I would call, is much longer term.
That would be Visakhapatnam.
DGTR has recommended 12% safeguard duty on certain products and with caps on prices of those products. That recommendation is under examination in the government. I think in very near future a final decision will be taken on that. On your second point about 20%, I really don't know, because it's as you know, the DGTR process, the safeguard duty imposition process, is a sort of a quasi-judicial process, and DGTR has heard everyone, asked for objections, and after that they have recommended this safeguard duty. I don't see any reason for the rumors about 20% safeguard duty. The per capita consumption in the country now is more than 100 kgs per person, and it has been seen with respect to other countries that when a country goes at this level of 100 kgs per capita consumption, then the elasticity with respect to GDP growth rate increases. So till now it is 1.2, 1.4. Now I expect that the elasticity will be more than 1.5. So even if with that, if you see our GDP growth.
Welcome back to Trading Hour. Well, markets continue to build onto gains. A couple of stocks that are now hitting intraday highs include names like Bharti Airtel, stock high by almost 1.5%. had a very good run, and even Motherson Sumi, something that we just highlighted some time ago, that stock too recovering quite sharply. The pharma pack that have been under significant volatility too is recovering. Names like Dr. Reddy and Sun Pharma now near the day's highest point. But Dheeraj Sachdev from Roha Ventures now joins us to discuss market fundamentals as well as its top sectoral picks. Thank you so much, Dheeraj, for joining us. First up, how have you viewed the last 2 weeks, especially in terms of the amount of news flow, so many tariff tantrums coming about. So eventually, what are you penciling as far as Q4 earnings is concerned, and what kind of impact do you see from tariffs?
Yeah, hi, good morning. I see the equity market over the last 2 weeks has been calm and after a roller coaster ride led by tariff tantrum. The 90-day window of pause on tariffs is creating a hope of a faster bilateral agreement between several countries, including India, with the US, to avoid any high reciprocal tariffs from US. Now, importantly, India's modest exposure to the US and its resilient consumption-led economy provides some comfort. Now, what will eventually happen to global supply chain will definitely be shifted in many products, and India can be one of those beneficiaries by gaining market share from China in a few sectors, giving India exports a relative advantage. So we have seen India's share in global supply chains rising, aided by PLI schemes. For example, Apple's iPhone export has risen from $3 to $20 billion in past 4 years alone. Similarly, several sectors such as pharma and specialty chemicals have a strong case for cost competitiveness in global supply chain realignment. So, of course, one has to evaluate how China reacts, whether by raising prices of key materials or dumping its excess capacity or rerouting exports to US via other countries. So coming back to India, I think domestic consumption trends are improving, supported by higher retail spending, quick commerce, rural revival, and supportive fiscal and monetary measures like tax reliefs have been given. There's been lower interest rates expected to be almost 75 to 100 basis points going forward. And also the capex cycle is expected to revive, driven by infrastructure or PLI schemes and green energy initiatives. Now, also one change in stance that has happened is RBI's liquidity measures and potential interest rate cuts further add to this positive outlook. So government spending on welfare schemes, tax cuts, rural demand recovery should aid economic activity as far as our country is concerned. So overall, we remain constructive on Indian market, which is likely to consolidate for some time rather than see any deeper correction. And what can eventually happen after this 90-day pause is also that Indian markets can surprise on the upside.
Dheeraj, while you've largely held on to this view, even, I remember the last conversation and the prior one, that you like the consumption story, you like financials, PLI, etc. But, things are changing so rapidly. The macros have been overturned, narratives have changed, prices are getting reset, valuations are getting reset. Any shift in the way you think about individual themes in the last 1 month? Any portfolio churn that you have done? Just talking about the change, the change from last month to this month.
No, Rima, I think if you see, these are all still domestic-centric opportunities that we are talking about. See, financials obviously will benefit out of rate-cutting cycle. A lot of provisions have been upfronted. Though the disbursement levels will be lower, but I think financials is in a sweet spot as far as growth and value spectrum is concerned. Similarly, consumption theme, we talked about several things about tax reliefs to driving rural consumption demand going forward, better monsoon forecast, etc. So financials, consumption, real estate, cement, renewables, CDMO, hospital companies in pharma, healthcare, and staffing businesses are mostly domestic-centric and driven by that demand environment. Even if you see quick commerce and premiumizations are also strong consumer trends, benefiting segments like auto retail, alcoholic beverages, and QSRs. So we have not really changed the stance materially, except for metals and consumer staples where we are avoiding, there is no change in the stance.
Understood that. Dheeraj, the other question that we have is, we understand that you like quite a few domestic facing names. But especially when it comes to some of the export-oriented sectors, there's been significant volatility in some of these names, especially if you look at the auto pack, names like Tata Motors, some of the auto ancillaries like Bharat Forge, Sona, Comstar, Motherson. Given the kind of volatility, given the kind of correction, do you think now is a good time to go ahead and add into these names, or would you stay away and wait for more clarity?
Question on autos specifically, I think even in domestic, the last few months sales data is disappointing with muted growth both in passenger cars and two-wheelers. I mean, we do expect some support from a potential decline in interest rates and better rural demand. Now, what is happening in autos is premium segments such as SUVs or greater than 125cc bikes and EVs are expected to grow faster. And we expect strong growth in EV segment as far as the penetration is concerned. I mean, that can rise to almost 4% for passenger cars and almost 8% to two-wheelers as far as EVs penetration is concerned. Now, the OEMs may still face issues on the export side, as you rightly mentioned, including tire companies, which are expected to get impacted by lower demand. CV cycle, even domestically, is showing a modest growth. So we are still evaluating and avoiding export plays on the auto side specifically. And evaluating ideas in the auto ancillary segment, which will benefit from rising EV penetration. I mean, that's the sweet spot that we are trying to hunt.
Understood that. Also, pharma is the other space, pharma, healthcare. Now, within pharma and healthcare, where does your preference lie? Does it lie towards export-facing generic makers? Do you like CDMO companies? Or would you play domestic healthcare companies or even hospitals for that matter?
I think you've already narrated a fairly differentiated heterogeneous segment in pharma and healthcare. See, Indian pharma industry supplies 30 to 35% of US generics, and drug shortages in the US are higher than what it was 2 years ago. Chinese pharma exports to the US will become costlier post tariffs, if any, on pharma, and that will create opportunities for Indian players to be competitive. Besides, Indian companies are set to gain from the continuing benefits of specialty products, as well as stable pricing scenario in the US generics market. So in addition, steady growth in domestic formulations will aid earnings growth. So we like select companies in API, CDMO segments, a mix of formulation in the domestic market, including some of the export companies, which will benefit out of cost competence. So it's a very heterogeneous selective play that we like in pharma. There is nothing that differentiates between domestic and exports.
While there is no growth for IT and growth is severely lagging, valuations are now getting into, I don't know if you'd call it attractive, but in the case of, say, Infy and TCS, it's pretty much lower than the long-term average. Wipro is almost getting there, close to about 18 times forward valuation multiple, which is its 10-year average. At what point does one start looking at IT?
The right observation, Rima. I think valuations have corrected. Even large caps are at 18 to 20 times up, when you look at the earnings. But the problem with top large IT companies have reported muted sequential revenue growth in the recent quarter with not so impressive guidance. On top of it, going forward, the sector is currently facing uncertainty from US spending. I mean, recent results do indicate that US clients in manufacturing or retail are postponing technology spending. And besides, large deals bring competition amongst IT service firms that typically squeezes margins. So the demand recovery pace is going to be gradual and depends upon certainty on US tariffs. I mean, BFSI and tariff travel verticals hold promise for any improvement in the technology spending. Now, structurally, of course, long term, we believe one can play positively because clients are prioritizing critical initiatives like digital, cloud, and data. And there is a possible profit pool expansion happening due to AI. Though valuations have corrected in the near term, there is still a weak outlook at the headline level. So, of course, over the next couple of months, there'll be more clarity when one can wait for some time in the near term. And then obviously valuations have already become attractive, but we still want to just postpone over the next quarter or so to get some more indications on tech spending in the US.
Got that. Thank you very much, Dheeraj, for joining in. Need to slip into a very short break on that note. Before that, a quick programming note for all our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing the boundary, making an impact, shaping the future. Nominations are now open. Scan the QR code now. Submit your entry for the SME Champion Awards Season 2. Welcome back. Bharti Airtel is a big mover now, 2.5% up on Bharti Airtel. There is a Bernstein note, and they say that telecom stocks have remained the most defensive sector in an otherwise volatile market. For instance, Bharti Airtel is up 16% on a year-to-date basis, and many of the other Asian telecom stocks have actually declined in the same period. So for Bernstein, they have raised the target price from Bharti Airtel to 2020. So that's about a 10-12% upside from current level. And again, they're basing it that, one, there will be another tariff hike in November or December. And even the fact that the government has converted its dues in Vodafone Idea into equity signals the government wants a three-player private market, and that will just provide that future tariff discipline. So on the whole, they're bullish in the sector, and Bharti is their top pick. And that stock has moved up, Bharti Airtel, 2.5% up. It's anyway been a big mover, outperforming over the last 1 year. But let's talk about realty. Realty stocks like DLF, Puravankara, Prestige, all buzzing in trade. Ria now joins in to tell us more.
Well, we have three real estate stocks in focus today. The first one is Prestige Estates on the back of its Q4 operational update. Now, the pre-sales have gone up around 48% on a year-on-year basis for Q4. But for the full year FY25, the pre-sales have come in at just about 17,000 crores, down around 19% over the previous year. And the company has missed its guidance for the full year FY25 pre-sales of rupees 23,000 to 24,000 crores. Collections as well have been weak in this quarter, declining by around 9% on a year-on-year basis. And the collections for the full year FY25 have gone up just about 1% over the previous year, coming in at around 12,000 odd crores in this in FY25, and this has also missed the guidance of rupees 16,000 crores. Now, the weakness in the full year performance for Prestige Estates was largely owing to the delayed launches in FY25, and this was because of regulatory approval delays. Moving on to Puravankara, we have a weak Q4 update coming in for this company as well. The pre-sales have gone down around 34% over the previous year for Q4, but the FY25 pre-sales are also down around 15% over the previous year, coming in at just about 5,000 crores in FY25. The collections in FY25 though have seen an increase of 9% over the previous year. The sustenance sales in FY25 have comprised around 85% of the total pre-sales. Now, the company has said that there have been approval delays which have temporarily deferred several launches in FY25. And out of the planned 13 million square feet of launches for FY25, the company has only opened 3 million square feet of launches. But the company has also said that projects with a total area of 5 million square feet are at advanced stages of securing approvals, and these are expected to go live within the next 2 quarters. Lastly, moving on to DLF, we have a positive update coming in here. The company has entered into an agreement with the Srijan Group and its subsidiaries to sell its IT SEZ project in Kolkata for about rupees 693 crores, and the company has said that the move is part of its strategy to monetize its commercial assets, and the transaction is expected to be completed within the next 12 months.
Thank you so much, Ria, for joining us and taking us through all of the developments as far as the real estate space is concerned. Well, if we could pull up the intraday chart of Angel One, remember that particular stock actually opened lower by over 6%, but it's seen a very sharp intraday recovery. The stock now near the day's highest point, up over 1%. So an intraday recovery of over 140 rupees, and this is post the conference call that is currently underway. But two stocks that are in focus are KEI Industries and Cello, this on the back of brokerage notes. Upasna joins in with more details.
First up, let me start with KEI Industries. Goldman Sachs has upgraded the stock to buy from neutral with a target price of 2,980 per share. It says that the cable and wire companies should continue to benefit from ongoing power and infra capex in the near term, but could see some moderation in FY27. Export opportunities for these companies also remain large. It has upgraded the stock to buy from neutral, and it says that the risk reward now for the company is looking attractive. Cello World also in focus, as Kotak says that the correction for this stock is overdone and has upgraded the stock to a buy with a revised fair value at 710 per share from 815 earlier. It says that the stock was down about 35% in the past 6 months owing to various concerns such as weak growth trends, delay in glass furnace commissioning and higher discounts, which was weighing on the margins of the company. Now, Cello has guided 12 to 14% revenue growth in FY26, which will be mainly driven by 100 crore of incremental revenue from the new glassware plant It now estimates a 12% EPS CAGR from FY25 to FY27 versus 60% EPS CAGR stated earlier. So hence, both these stocks remain in focus on the back of the brokerage notes.
Thank you very much for that. And you're looking at Bari.
Well, I'm looking at the Wari Group, and within the Wari Group, the company that I'm looking at is Wari Renewable Technologies. Now, this is the solar EPC arm of the Wari Group, and the company came out with its Q4 results yesterday. A strong set of numbers. If you look at the revenues at close to 475 crores, up almost 75% on a year-on-year basis. Remember, the pending order book is quite strong, and execution in this particular quarter has been good, leading to quite a strong top-line growth. The EBITDA has come in close to 62% higher at over the 122 crore mark. Margins on a year-on-year basis have dipped, but this account of the higher base. So close to 25.7% is where the EBITDA margins stand at, and profitability higher by close to 82.5%, coming in at close to the 94 crore mark. Now, what is the order book of the company? The order book is quite strong, of close to 3.2 gigawatt power, and the order book execution timeline is in the next 12 to 15 months. Suppose that order book accretion from what is essentially expected to be a strong ordering activity is something that we need to watch out for. What is the company saying is the bidding pipeline? Bidding pipeline is at close to 30 gigawatt power. So close to 30 gigawatt power of solar EPC projects are expected to be tendered out. It will be important to see what is the company's own win ratio when it comes to all of the bids that do come about. Now, remember, what does the company do? Works both for IPP producers, so close to 54.8 megawatt power of solar power generating assets. And along with that, along with EPC, there is also the O&M portion, which enjoys higher margins. That too will be in focus. Currently has close to 695 megawatt power of the O&M portfolio. But Rima, you're looking at Infosys results later today, right?
I am. So numbers typically come out at 4 o'clock. Their press conference is scheduled at 4:15, 4:30. And now here the only question is, will they guide? Right? Because theirs is an annual guidance, and it's that much harder to guide in this kind of an uncertain environment. All the company, both TCS and Wipro that we spoke to, indicated that clients are cautious. Projects are being put on hold. Decisions are getting delayed. But you don't know, when things are changing so rapidly by the day, you don't know what happens in the next 6 months. Does the macro deteriorate even more? Or will there be an improvement and the discretionary projects, which today may be put on hold, resume? And if they resume, then that changes the growth picture entirely. But if they don't guide, that means from a sell side or for shareholders, the uncertainty lingers on. You have absolutely no other way to assess what kind of a year it is. So it's a catch-22. It's a tough place for Infosys to be. And the street is clearly nervous. Now, when it comes to the Q4 numbers, expected muted quarter. Sorry. Constant currency revenue decline of about 1.1%. There will be margin pressure because in the case of Infi, they give wage hikes. So part of the wage hikes will be effective in the January quarter and some of it later in April. So margins will come under pressure. But the key is what they have to say about the year.
Well, thank you so much, Rima, for that. All eyes will be on the IT pack, especially given the kind of uncertain environment that its peers have called out. But it's now time for a short break. We'll get you more on the markets on the other side.
Has been and performing has been a dream for you, but in an era and in a society where we're so bound by log kya kahenge, and there's a whole genre of Hindi movies dedicated to that, to say that you're going to do this publicly.
I just was very keen that I don't take the one-dimensional view of life, because we're all businessmen, we're running listed companies, this is our job. And if your job is something that stresses you, then you need to find other avenues to de-stress you.
The 3 most important things to Ajay Bijli, please share.
Hairline, bottom line, and waistline. And now being able to sing. What's written on the stave is important.
Did you worry about how it would be perceived? Would people think that, oh, is he retiring? Is he giving up on business? I mean, did you worry
I used to
about
look at the CNBC ticker of my stock price for sure, with every note. And then when I sang "It's My Life," and it didn't go down, I said maybe I can sing Bon Jovi's song.
Welcome back to Trading Hour. Well, the Nifty rally has picked up steam, especially in the last 15 minutes of the session. What's taking the markets high? It's the banking pack. Have a look at Axis Bank near the day's highest point. Have a look at ICICI Bank surging in today's trading session. The rally or the recovery as far as IDFC First Bank 2 has continued. And some of the other NBFC names too are seeing quite a bit of rally. SBI Cards has picked up steam in the last 20 minutes. That particular stock is up over 1%. And when you're looking at some of the other names, especially consumption names like Warren Beverages, that particular stock doing quite well. Angel One has actually post the results and post the conference call picked up even further steam, now trading near the day's highest point. But we'll now have to cut across to the SEBI chairman, who's currently speaking at the CII Corporate Governance Summit.
Transparency and accountability. Good corporate governance is the foundation stone of a successful enterprise. From a regulator's perspective, high standards of corporate governance in listed entities are essential to protect the interests of the shareholders, especially minority shareholders. A major milestone for corporate governance in India was the introduction of Clause 49 of the Equity Listing Agreement in the year 2000, based on the recommendations of Kumar Mangalam Birla Committee. Clause 49 was further revised and strengthened based on the recommendations of the Narayan Murthy Committee. Corporate governance has evolved during the last 2 decades with revision in the Companies Act and codification of listing rules in the form of SEBI LODR Regulations 2015. And over the last 25 years or so, we have been keenly engaged in enhancing the standards of corporate governance in India. This engagement primarily stems from our mandate to protect the interests of investors. Today, we have over 13 crore investors in our ecosystem, investing across 5,400 plus listed companies as compared to 4.9 crore 5 years ago. Similarly, the number of mutual fund investors have now grown to 5.4 crore from 2.2 crore as at end of FY20. Increasing penetration of our securities markets, rise in retail shareholding, including through mutual funds, accompanied with increase in size of the listed universe, sets the stage for greater significance of corporate governance. In today's world, good governance is no longer a best practice. It is a necessity. It is a bridge between performance and trust. For listed companies, robust governance mechanisms are essential for enhancing investor confidence through transparent disclosures, board independence, and effective oversight. It promotes well-informed decision-making, strategic guidance, and accountability, thereby aligning the interests of management with those of shareholders. Companies with sound governance structures are better positioned to manage risks, respond to stakeholders' expectations, and adapt to changing environments. This long-term orientation supports value creation, financial resilience, and sustainability. A company known for strong governance enjoys a positive reputation, which can lead to better credit ratings, easier access to capital, and higher valuations. For us, governance is not just a matter of oversight. It's a strategic imperative to protect the interest of shareholders and maintain the integrity of the market. So governance failures in large corporates can have ripple effects across the market and economy. Preventing such failures is essential to maintaining financial stability. By mandating disclosures, board structures, and oversight mechanisms, we aim to create a self-regulating environment that encourages ethical and responsible corporate behavior. So SEBI has been instrumental in strengthening the corporate governance in listed companies. And as I said, that SEBI LODR regulations specify the corporate governance requirements for listed entities in India, which is a mix of principles and rules. The principles governing the disclosures and obligations include the right of shareholders, timely dissemination of information, equitable treatment, transparency, responsibilities of board of directors, while the rules relating to corporate governance include composition, role, responsibilities of board, its committees. Now, disclosures are periodic and event-based. To ensure transparency and information symmetry in the market, SEBI has specified periodic disclosures of certain information, such as quarterly disclosure of shareholding pattern, compliance with corporate governance requirements, financial results, and deviation in utilization of funds. To prevent information asymmetry, there are also event-based disclosures of material events or information, such as disclosure of material events within the specified timeline, disclosure of events which may have material impact on the performance or operations of the listed entity. Such disclosures ensure that the stakeholders have equal access to material facts and information related to companies' operations and performance. This promotes level playing field by bridging the gap between company insiders versus outsiders and the better decision-making by the investors.
Well, we'll keep cutting back to the conference. For now, it's a wrap on Trading Hour. Thank you for watching.
from an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us.
Stocks see a fair amount of green as markets digest a range of comments from Trump, Powell ahead of a long weekend. IT and metals are the big losers, while financials, utilities see some gains. Mid-caps fare better. The Nifty bank just 1% away from fresh highs.
Private investor Warburg Pincus and the Abu Dhabi Investment Authority will invest 7,500 crore rupees in IDFC First Bank via convertibles, translating into an eventual stake of nearly 15%. CEO Vaidyanathan says he sees strong growth ahead, though the fundraise will be return dilutive in the short term.
IT stocks in focus. Wipro delivers a weak fourth quarter, guides for a decline in IT revenues in the first quarter of FY26, while Sonata Software 2 alerts on likely lower revenues from its top client. These vindicate views of analysts warning of an adverse impact of global uncertainties. IT stocks slump.
It's a roaring comeback by the bulls after the initial slump as we head into the long weekend on this weekly options expiry. You're watching Halftime Report from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Mangalam Malu. Well, Mangalam, had there not been any action going into the long weekend, we wouldn't have complained. But looking at the screen, there is absolutely no reason to complain.
There is no reason for bulls to complain. The only thing is whether this sustains or not as we move towards, the expiry momentum, etc. as well. But the good part is that there were a fair amount of shorts in the system, and every time there was a dip, they've been, taken to the cleaners, and as a result of which, even yesterday, the second half of trade post 12 p.m. is where we saw that big up move coming by. Today, the dip was largely on account of the IT pack, which continues to be under pressure, but the IT index has recovered from the lows. Look at the banks. They've been continuously roaring. So we have HDFC Bank, which has hit a fresh 52-week high. ICICI Bank, the top contributor to the Nifty. And you can't leave telecom far too ahead as well. Two stocks from the Nifty hitting a fresh 52-week high today. We spoke about HDFC Bank. Let's pull up the intraday chart of Bharti Airtel as well. Has been a big outperformer. What's common between these two? That they are domestic facing and focused on the India market at a time when there is global uncertainty, maybe the street finding some support in these names itself. But speaking about the banking space, the big news of the day was IDFC First Bank approving a 7,500 crore rupee fundraise. Nimesh, who broke the story first on D Street Chatter, joins in with more details on this fundraise and what it means for the company going ahead. Nimesh.
Hi, Mangalam. So, as you rightly pointed out, it's a large fundraise for IDFC First Bank, 7,500 crores is what they're raising via equity, and that too from two of the largest and marquee investors in terms of Warburg Pincus, that's going to invest a sizable amount of 4,800 crores, and also Abu Dhabi Investment Authority's private equity arm, which is going to put money as well. So these are the two large entities who are putting in 7,500 crores. Post the conversion, it will mean equity dilution of close to 15%. The most important part is while the bank didn't need money at this point in time, they've still gone ahead and raised money, and that too from some large market investors. What is more interesting is, Mangalam, the fact that Warburg Pincus is re-entering into IDFC First Bank. Remember, they had a very long relationship with Vaidyanathan in Capital First, and from there in IDFC First Bank as well. Last year, they sold out completely out of IDFC First Bank, making some 8 to 9 times returns on their investments. And now they're re-entering for the next phase of growth. So what Vaidyanathan told us was the money has been raised for growth capital. So need to see as to where he puts in money. But the important news is 7,500 crores is what IDFC First Bank has managed to raise via equity from two of the large and marquee investors.
Right, Nimesh. Thanks a lot for that. And the stock too of IDFC First Bank at one point was down around 3.5%, has seen a very sharp recovery from the lows and is now trading around the flat line, is even into the green now. Is IDFC First Bank at 63.5. Let us also listen into what the management had to say on this fundraise in an exclusive conversation with CNBC TV18 earlier today, right after the fundraising announcement.
I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, then we pitched the story. We told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time, so they felt excited to come again. This will have a dilution of 15%. But really, Lata, I want to just share one thing to you and to all investors hearing this program, that the main thing is that the bank has a phenomenal model. Otherwise, our operating profit could not have grown from 750 crores to 6,000 crores, like 16.4 or 5 right now, and it will go to 18 point, close to like 19% after this raise. The thing is, Lata, that as the CEO, I have two very big responsibilities: to run a super safe bank. Super safe bank. Super safe bank is how diversified deposits are, etc., and how quality of loan book is good. All that is super safe. But capital is a very, very important part. I take that as a responsibility. And even though we were 16 plus, I have to be honest, I wanted to raise more capital. I tell them that phase 1 was setting up the bank. Phase 2 is operating leverage. Phase 2 is profits. Phase 2 is return on equity. And I have indeed suggested to them, let me say, nobody can promise anything, but I have definitely, like in my own way, told them with a lot of confidence that they will make lots of money. So think of this year like we had a massive turnaround in our PAT from the bank. We took it off from the loss position to profit. It was supposed to go up. It came down. It happened to us. But we believe from 26 onward for the next 4-5 years, you should expect good numbers on this bank.
Right, the IT sector is under pressure as TCS Wipro earnings disappoint. Rima joins in with more on that one. Rima, this one sector is still under the weather.
Oh, indeed. It's taking it on the chin. And now the Nifty IT index is down 25% so far this year. And it's still about 5% away from its 52-week low. Let's run you first through the news flow. Now, Wipro's under pressure because its Q1 guidance disappointed the street. Much lower than street expectations at -3.5% to -1.5%, which means your best case is revenues for Wipro in Q1 declined by 1.5%. Sonata then issued a revenue warning. They said revenues from their top client will be lower than what they were earlier anticipating. And now the street is saying that perhaps Sonata's revenues in the June quarter could decline by high single digits. Now you've got Infy, which reports numbers post-market hours. And the quick question is, will they guide or will they not, given the uncertainty? And it's hard to have visibility about the second half of the year or even tomorrow. So if they don't guide, that means the uncertainty lingers on for the next 3 months. And so far, both TCS and Wipro, which have reported numbers, have missed the mark on the top line. Both of them reported a revenue decline in the March quarter, revenues falling 0.8% on a quarter-on-quarter basis. They also highlighted in their commentary that clients are turning cautious. They're taking a measured approach, at least when it comes to discretionary spending. There are instances of projects being put on hold, some decisions being delayed. So all that is hurting demand. So today you've got Infy and Tata Elxsi, but over the next few days, you will have numbers from Mastech, HCL Tech, LTI, Mindtree, and the following week you also have Tech Mahindra, Sign, LTTS, Emphasis, Persistent, basically the rest of the pack.
Indeed, not good going for the IT names, although Sonata Software has recovered slightly from the lows of the day. It was down 12% in starting trade, is now down around about 7%. And Wipro, though, continues to maintain losses of around 5%. Let us also listen into what the management of Wipro had to tell Rima on the quarter gone by and the outlook going ahead amidst all of this global uncertainty.
There is definitely uncertainty in the market. We are hoping in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
We've seen fixed price programs improve their productivity. We've seen acquired entities improve their profitability. We have rationalized overheads. We've also rationalized staff who are non-client facing in some of the functions and roles in G&A. So all around, it's been a very solid performance in FY25. We have said our endeavor would be to hold it in a narrow band. So yeah, 17% plus. There is pricing pressure for sure. Is this any worse compared to how it was, let's say, a few quarters ago? I'm not sure. How do I contextualize it? But I do see that increasingly a lot of the large deals are vendor consolidation and cost takeout. So yes, they're quite competitively fought, and therefore it does have pressure on margins.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded everyone.
The management of Wipro, the guidance disappointing the street, the stock 5% lower. It's time to take a short break. Well, the Nifty is up 200 points now as we speak, nearing 23,650. And as we do that, here is some good news for our viewers. India's business news leader, now just a click away, and that is CNBC-TV18's all-new app, where you can get breaking news, in-depth articles, financial world updates, all of it at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can even scan the QR code that comes up on your screen. We take a short break. We'll be back on the other side.
Nepal, Sri Lanka were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Besant has already said that the first 4 deals we sign are with allies. And he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that, because they've always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others. And then we want people which are friend shore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that, in a sense, for them. So in that context, the way they are laying out this new chessboard, I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. How many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up.
Welcome back. Now shifting focus on to Sanathan Textiles then. The stock has surged more than 24% this year so far. We are now being joined by Sameer Dattani, who is the director of the company, on how tariffs may disrupt the global supply chain. Sameer, good afternoon. Thank you for joining in. There has been significant developments with regards to tariffs on a lot of these on all of these textile manufacturing nations, be it Vietnam, Bangladesh, or even Cambodia or Indonesia for that matter. How do you see this situation, and how do you expect as a company to benefit from this situation?
Hi, good afternoon. So I think this situation is very advantageous to the Indian textile industry at large. The USA imports more than $100 billion worth of textiles from around the world. And currently, India has only a 10% share supplying to the US of their textile and apparel requirement. Looking at the relative situation, I think we are at a very advantageous position compared to other suppliers. China and Vietnam obviously have the lion's share of supply to the USA. So I think we are at a very advantageous situation to take advantage of this opportunity. Some of our other neighboring countries have their own internal issues, but I think India is at a very strong position to capitalize on this situation. At Sanathan Textiles, since we are into manufacturing of yarns, and we have a wide variety of yarns, we are the starting point of the textile chain. So our yarns are used for many end-use applications, whether it's shoes, bags, apparels, garments, carpets, home textiles, innerwear, bed sheets, etc. So whichever segment does well, I think we will be able to gain from the growth in demand.
Let's move away from the industry and get more specific towards Sanathan Textiles. Samir, over the last few years, your exports have been ranging between 5 to 15%. And you've constantly maintained that for you, the domestic market is where the focus lies, with exports being just an opportunistic adventure if you'll have to go. Where do you see your domestic business grow over the next couple of years? And how do you expect the export part of your overall pie to grow?
So this agility that we have in our business model, where we're able to pivot our exports between 5 to 15, even sometimes as high as 20%, has worked in our favor. Look at the current situation with the kind of tariff wars and global uncertainty. It's been great that we're able to pivot more towards our domestic demand. And the India demand has been robust. The demand has been good. Last 2 quarters, the demand has been very robust, no complaints there. And we've pivoted very successfully to place our production, our material in the domestic market and take advantage of that. In the coming years, I feel like depending on how this tariff war plays out, India is at a situation of taking advantage as far as the textile industry is concerned. And we will see increase in direct as well as indirect exports for us.
So how much would they be? Where are they right now? Because it's been a range between 5 to 15%. At current period, what exactly is it? And how much higher are you likely to take it?
So right now we're at the lower end of the band at 5%, very strategically decided to keep it low because the India domestic demand and the net back is better. The turmoil in the global situation, it just makes sense for us to place our material, and there is no problem of demand domestically. In the coming years, it depends on how this tariff war plays out. I think there should be scope to improve this as long as there is a surge of demand, which will be in India's favor. And then that will also add to our netbacks and opportunity for exports.
Goes into the US because, that's the bigger buyer here because of tariffs, etc.
So it's very tough for me to sort of give a number right now, how much we'll be exporting to the US particularly. But let's not forget, we also have indirect export to the US because our yarns are consumed by contract manufacturers domestically who are then exporting their garments or shirts or shoes or bags or home textiles to the US.
What about the Punjab facility, Samir? You had plans of commissioning it in the first quarter of the current financial year, which is the ongoing quarter. What would your contribution to the top line be once this unit is completely on stream?
So we're on track to commission this plant in the first quarter. We'll be starting in a phased manner in this quarter. In the first phase of the Punjab facility, it's designed to produce 250,000 tons of polyester filament yarn annually. And in this year, we should manage to get at least around 70% of that production.
Does that imply in terms of revenues? Because I remember when you joined during the IPO, you said that at current reckoning, you're close to around 3,000 crores. This facility, at least in the phase 1, will double your capacity. And if you reach 70% utilization, should we expect 70% revenue growth in FY26 as well?
Definitely. That's what.
All right, 70% revenue growth in FY26. And what about your finance costs? Because with this facility being commissioned, your debt on books will also balloon because it will be on your balance sheet. It was close to, supposed to be around 1,400 crores with repayments of 300 crores. So is that on the cards? What's your balance sheet outlook for this year?
similar. You're right. It will be the debt on books will be around 1,100 crores, and we are very comfortable in terms of once the production starts to keep servicing the debt.
About margins, Samir, you ended the first 9 months of the year at 8.6%. What do you close the year at? And is there a target that you have set for FY26? Are you aiming for double digits?
So the last 2 quarters of the last financial year have been better than the beginning, and that's why we'll end the year at a higher number than the ongoing average. And looking at what Jan, Feb, March quarter was, looking at how this quarter is going, we're definitely looking at a double-digit margin for the coming year. EBITDA margin.
All right. Double-digit EBITDA margin for the coming year, 70% revenue growth. And when does phase 2 get commissioned?
That will be a year later, after we settle phase 1.
FY27. And what is the likely revenue from that plant?
That should give us some additional revenue of about 1,000 crores once that's fully commissioned.
All right.
All right, Samir, thank you so much for sparing time and joining us today. Wish you good luck for the upcoming year as well. The management there of Sanathan Textiles, 70% revenue growth, aspiring for double-digit margins in FY26 as well. The stock, 2.75% higher as we speak at 453. Take a short break. The Nifty still up 220 points at the 23,650 mark. Ajit Mishra of Religare Broking joins in with a chart check and some trading ideas on the other side. Stay tuned.
At holding range of 6% GDP growth, because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble, and that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain. In a sense, even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning, and then you can start, making your own product. Because we were just not in any of these global supply chains for so long.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and
Welcome back. Look at the market. So big up move is what we're seeing. 23,650. It's at the day's high, 1% higher for the Nifty. A big recovery from the lows as well, and it's led by the Nifty Bank, which is about 1% away from a fresh 52-week high. The mid-cap index at an index level is a slight underperformer in today's trading session, but remember, it's been a bit of an outperformer, and the advanced decline lines tell you that there are 3 stocks, nearly 2.5 stocks in the green for each stock which is in the red right now. Important news at the bottom of your screen. SEBI's internal committee will speak about or discuss on the NSE IPO. So we'll get some data out there as well. It's a long awaited one. Capital market plays in the marketplace are doing fairly well today. If you look at a couple of these stocks which are at fresh 52 weeks high, we have HDFC Bank and Bharti Airtel, top contributors to the Nifty, along with ICICI Bank as well. Like you pointed out, these are domestic plays, so in times of global uncertainty, the street is backing these names. The Nifty Bank, 1.5% away from a fresh high. The Nifty itself has seen a near 350-point recovery from the lows. So today's low of 23,300, extremely important. It's crossed past the 100-day moving average. Now we're very close, about 200 points away from March high of 23,870. Remember the big decline that we saw from January into February and then March. Thereafter, there was a recovery. We went all the way to 23,870 before falling back to 21,675 or 21,750 thereabouts itself. So this is an important level to track on the way up. Thereafter, we have the 200-day moving average for the Nifty, a little over 24,000. But today, here and now, it is the weekly options expiry. We are seeing a fair amount of put writing. So 23,400 puts are fairly active, telling you that supports has moved higher. 23,500 put writers also equally active with the market moving higher, telling you 23,450 to 23,500 is a strong support. But it'll be very interesting to see how the 23,500 call writers behave, because the premium on that has surged by nearly 317%. There are still 1 crore shares outstanding out there. If the Nifty continues to trade at higher levels, then we'll obviously see these call writers covering their positions, and we can't rule out a big melt up towards the second half of trade as well, were the Nifty to sustain at these levels for the next hour or so. A lot of long positions added on JSPL, so keep an eye on the metal space. And the one stock that may enter F&O ban, yesterday we had spoken about the possibility of Irida entering F&O ban. That happened. Angel One is one that looks like may enter F&O ban given the open interest activity that's taking place out there.
And just as you were finishing your link, Mangalam, the Nifty is now nearing 23,700 now, 250 points higher. The Sensex is now 900 points higher at the highest point of the day. The Nifty Bank now just 650 points away from its record high levels of 54,467. Almost there for the Nifty Bank, and it is the frontline banking stocks that are leading the rally, with HDFC Bank and ICICI Bank both hitting record highs in today's session. Ajit Mishra of Religare Broking now joins us on the show. Ajit, good afternoon. Well, the Nifty is continuing to see some recovery from the lows, but it is the Nifty Bank that's grabbing the spotlight. Is the risk reward more favorable for Nifty Bank even now as it is nearing record highs? What are the charts saying here? And couple that up with your stock recommendations as well.
Yeah, good afternoon, Homer. So yes, it's been 2 months now that we are seeing this roller coaster ride in the markets. Means what Mangalam was just sharing the data that we were at around the 23,800 levels around the February month, and we are again inching towards this area. The good part is that we have reclaimed all the major averages in the Nifty. The banking index, financials, they are leading from the front. We are almost close to the record highs. But needless to say that we have important results scheduled over the weekend, and we're going to react to those numbers on Monday after the long weekend. Stocks are already at the record highs. Yes, one can continue to anticipate that this overall momentum is likely to stay. But from the index point of view, I still feel that banking might see a breather around 54,500, the record high zone. And Nifty can surpass this 23,800, 870 area, which we have made the last swing high. So from the index point of view, Nifty looks comparatively better at current levels. Among these stock-specific ideas, since we have a long weekend ahead, look for something which is very consistent throughout this journey. Bharti Airtel, almost after 7 months of consolidation, we have seen a breakout. Stock is trading at record highs. Volumes are decent. So everything looks positive. So near-term, 20 is something that we are eyeing as a target area, with 1790 as a stop loss for Bharti Airtel. Another stock that we like from the rate-sensitive basket, we are anticipating recovery in auto counters also. So Bajaj Auto, after this recent correction, has formed a strong base now. And near-term target is 8,400. So with stop at 7,800, one can accumulate Bajaj Auto also at current levels.
Auto and Bharti Airtel are the names that he is recommending. Big move that we are seeing on a couple of these other domestic names as well. SBI is doing extremely well. Adani Ports has moved higher. And HUL too. The FMCG pack was conspicuous by its absence in terms of gains, but now that's picked up too. So everything's looking fairly good. Let's cut across to our colleague Parikshit Luthra, who's in conversation with Vijay Kedia. Parikshit.
Market regulator SEBI has called out promoters of Gensol Engineering for fraud, round-tripping of funds for personal use, and has now ordered a forensic audit. Investor Vijay Kedia warns that there could be more such cases waiting to tumble out of the cupboard. He joins us now to speak about the SEBI crackdown on Gensol and what retail investors should keep in mind, and also his views on the Indian markets amid global trade uncertainties. Mr. Kedia, thank you very much for joining us. You said that Gensol is not the only example. There could be more such companies tumbling out of the cupboard. What is your biggest worry here?
The biggest worry is what has happened and what has come out, what SEBI has caught. I think there are so many, could be many companies. I don't know about the numbers, could be hundreds of companies like this, which has actually come out with IPOs in the last 3-4 years. So biggest worry is about, obviously, every time it is only because of this is small and new investors, because they only get trapped in all these things. So my biggest worry is, how to protect them.
Right. So the biggest worry is how to protect small investors. What do you think retail investors should now keep in mind? What do they should look out for when considering newly listed companies for investments? Clearly, there were several wrongdoings in Gensol at multiple levels. The board also has to be accountable at some level, the independent directors. But if retail investors are considering such stocks, what advice would you give them?
No, read these all 10 points which I had posted yesterday. Keep them handy, and before investing in any companies or even after the investment, if you find such things, then then you have to be careful. So it's very simple.
Right. You've said that do not go by the hype around certain companies. You should look out for facts. So when it comes to cutting away the noise, cutting away the hype, what are certain fundamentals that one should look out for? And what are some of the warning signs that you see in the market in some of these companies that you're talking about?
No, the biggest sign, what I found, that they had become very vocal, very active on social media. As the point number 2, actually, it describes that. The moment they become very vocal, very, they try to portray themselves as they have become shareholders friendly and all. So that is one really red flag, because the good companies and the strong companies don't come out on TV channels or social media and talk every day about their doings. So this is out of those 10, this is one of the biggest red flag, I think.
Right. Too much appearance, too much focus on marketing and publicity. What do you think government and regulators need to do in order to put more guardrails before such a situation arises?
I think what SEBI is doing a wonderful job. But let me tell you, our system is such, because that is what I call autocracy of democracy. My biggest one thing I would like to pinpoint, like of course, because in our system, after SEBI is also after a regulator. No? They are not like a FBI or CBI or James Bond kind of thing they are doing. So what I think, that they can expedite the issues. Like the first time this issue came to the surface, that was in June 24. Some whistleblowers, whoever came, brought this issue. And even now in April 25, we found that, okay, they are guilty. In the stock market, this 10 months period is too much. Even 10 days are, too long, too a long period. So I think this is what one should understand, that how this that period can be shortened. That could really help the investors.
Right. You've spoken about 10 red flags. Which are the 3 most important red flags, according to you, which you would like to share with investors here on CNBC-TV18?
I think one, talking too much about their own company and too much appearance on media and all, and every time they want to raise money, and too much volatility into the share price also. As of now, while I'm talking to you and you ask for the 3 points, I think these 3 points coming to my mind.
Right. Now, speaking about India right now, and India is considered a safe haven amid global uncertainties around trade and trade wars. In the current context, which would be some of the sectors or stocks or companies which you feel most excited about?
I think tourism should do well, because government is focusing on tourism, and the way they organized and handled this Mahakumbh and all, it was just a trailer. Government has also understood now that tourism can really can help economy grow. Currently, revenue generation from the tourism sector is somewhere around $250 billion. And I think easily looking at the India, I think it can really go up to $1 trillion maybe in next 10 years. So government has also understood. So I think tourism should do well, infrastructure should do well, and hospital and hospitality should also do well.
Right. And what would be your outlook on the Indian markets overall? And this would be my last question to you, Mr. Kedia. Considering that India will also not be immune to the kind of trade wars that we are seeing, the US-China trade war as well. There are tariffs on India, even though we are negotiating a trade deal. But how do you see the trajectory of the markets, some of the concerns, some of the positives that you see along the way over the next 6 to 7 months?
I think it's very difficult to say, but what I am doing for myself, I can share this, that I think that whatever bottom market had made 15 days back, I think that could be and should be the final bottom for 2025. I think the worst is over, I think. But that does not mean that we are going to touch a new high very soon. I think market will be in a consolidation phase, maybe for next 2 years, maybe for 25 and even for 26. Now, coming to the point, this 90 days honeymoon period, which we had been granted, I think that is the golden opportunity for India to take advantage of it. We are better placed compared to many Asian countries and our neighbor and mainly our biggest competitor, China. So I think this India should take advantage of it. So it is like a blessing in disguise.
Right. And finally, there are many more startups which are looking to get listed on the stock exchange over the next few weeks and months. What advice would you like to give them in the context of what's happened with Gensol?
So just one has to be careful, as it is written, they write in the train bogie na ki yatrigan apne saman ki raksha khud kare. So investors ultimately have to protect their own things, So follow whatever I have recommended and find few more points and all, and maintain strict discipline and be organized. Don't try to become a millionaire overnight, and just follow the discipline.
All right. So be disciplined. Don't rush into growing wealth overnight. But thank you very much, Mr. Kedia, for joining us, giving your view on the SEBI probe into Gensol Engineering and your outlook on Indian markets as well. Back to you in the studios.
Thanks a lot for that, Parikshit. A very interesting conversation there with a market veteran, Vijay Kedia, for regards to Gensol Engineering. And of course, the key takeaway that we may have made a bottom for now, but do not expect new highs anytime soon is what Vijay Kedia had to say. Take a short break. More on the markets on the other side. Stay tuned.
Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Welcome back. 265 points higher on the Nifty at 23,700 now is where we stand. So strong comeback from the bulls after the initial dip that we saw. And there you see the reversal that began from 11 this morning is continuing, and how almost 400 point recovery now from the lows of the day for the Nifty, 1.25% higher on the index at 23,700 at the highest point of the day. But the other stock that's doing well for itself today is KFin Technologies, and that's on the back of the acquisition that it had announced yesterday, and that's of Ascent Fund Services Private Limited, where they are going to acquire a 51% stake initially for around $34.5 million, and the plan is to acquire the remaining 49% stake in 3 equal tranches over the next 5 years. So in FY 28, 29 and 30, at the end of these financial years, we'll see the acquisition of 16.33% stake each by KFin Technologies, that of Ascent. Now, how is this going to benefit the company? Well, Ascent is going to help KFin with immediate access and scaled access, that too, to the global fund administration market, which currently has a revenue run rate of well over $12 billion. It also help them with required licenses and permits for services across multiple international markets, a diversified portfolio of clients, sticky and consistent revenue as well, a recurring revenue. So beneficial for KFin Technologies is what the company has highlighted. Now, Jefferies, in its note, believes that this acquisition will help the company's international expansion. It will complement its product suite, and they also have plans to lift Ascent's margins to 45%, which is what they reported in the third quarter. Ascent's margins are currently at the lower end, and they plan on doing that in the medium term. The deal valuation at 3.5 times price to sales is an attractive multiple as well. And KFin has a good track record of maintaining promoters and staff of the companies they acquire, and that is also evident from their recent acquisitions, is what Jefferies wrote in its note. However, it is cutting its estimates for FY26 slightly because of the cash outgo that is involved in the acquisition, and of course because the fact that Ascent's margins are at the lower end currently. And but they still do not see any risk of any downward pricing of the existing mutual fund contracts, and as a result they have a buy recommendation on the stock, a 1310 rupee price target, a significant upside from current levels. The stock already up 8.5% in today's session, but is down around 30% from its peak even at the current level. So good going for KFin Technologies today, 8.5% higher on the stock. By the way, the Nifty continues to move from strength to strength, 23,710 now on the index, 275 points higher. ICICI Bank, HDFC Bank, Bharti Airtel is now at a record high at almost 1,875. So great going for the 3 index heavyweights. In fact, Bernstein has raised its price target on Bharti Airtel to 2020 now, and it shows on the stock. Some numbers on your screen as well, but we take a look at that in as well. Indosolar reporting numbers for the fourth quarter. Take a short break. On the other side, Manisha Gupta joins in with James Anderson of SD Bullion. Stay tuned, we'll be right back.
has been and performing has been a dream for you. But in an era and in a society where we're so bound by log kya kahenge, and there's a whole genre of Hindi movies dedicated to that, to say that you're going to do this publicly.
I just was very keen that I don't take the one-dimensional view of life, because we are all businessmen, we're running listed companies. This is our job. And if your job is something that stresses you, then you need to find other avenues to de-stress you.
The 3 most important things to Ajay Bijli. Please share.
Hairline, bottom line, and waistline. And now being able to sing. What's written on the stave is important.
Did you worry about how it would be perceived? Would people think that, oh, is he retiring? Is he giving up on business? I mean, did you worry
I used to
about
look at the CNBC ticker of my stock price for sure, with every note. And then when I sang It's My Life, and it didn't go down, I said, maybe I can sing Bon Jovi's song.
Welcome back, and joining us on the show now is James Anderson. He's senior market analyst at SD Bullion. James, hi, thank you so much for joining in. And the gold prices have been on a one-way run, $700 up in this year and perhaps 1,000 and more up in the last 12 months as well. Now that we are above $33.50 an ounce, where do you see prices heading?
At these points where you start to break out to new all-time highs, it's really hard to gauge in the short, medium term where it could go. You know, I saw Gary Wagner on Kitco News the other night doing a Fibonacci chart, and this is before the recent pop. And he was saying that, you know, with the Fibonacci chart, I posted it on my Twitter handle, he was saying the top likely could get to 3,500 by the end of May. So, you know, in the interim, you could have a run beyond 3,300, 3,400, up to 3,500 even by the end of next month.
3,500 as soon as at the end of next month. Well, who's buying this gold now, James? Because we've seen jewelry bars in India now kind of hesitant with the kind of volatile high gold prices that we have seen. But do you think that central banks, ETF investments, and that perhaps could continue?
I see it in the derivative market mostly. I think mostly what you're seeing right now is hot money coming in this trade and the momentum side. And you know, obviously, like you mentioned, ETFs and central banks. I mean, it has to be known and driven home. Most people don't understand that pretty much since 2022, 2023, 2024, central banks, especially emerging market central banks, have been buying gold at record volume. I mean, you can go back to World War II. We've never seen this amount of official gold bullion tonnage being purchased by central banks. What it reflects is a bullion over bonds trade, and that is a phase transition. That is something that's not just happening in the short run. That's something that's likely happening on the long run, where central banks are moving back toward the old allocation of having 30, 40% of their liquid sovereign wealth in outright gold bullion reserves. So that's on a longer term scale. I think people have to kind of adjust their minds to understanding that we're going back toward the old money, which is gold being the numeraire that matters most.
Oh, well, absolutely. But James, every bull run has a correction, and gold hasn't done that for a while now, while the momentum still is on the higher side. Do you see gold at some point in time get a correction, even a healthy one?
Yeah, every bull market, every one of them has to climb a wall of worry. Okay, so 3,500, if it goes there, say, at the end of May, and it recedes and it goes back and retests 3,000 or goes below 3,000, you have a 200-day moving average of gold that's at 2,700 roughly and rising. Okay, so it is possible that you could have an interim top where it goes toward that 3,500 number and then crashes back down over the North American summer, where it dips again below 3,000, because those levels, 1,000, 2,000, 3,000 for gold, they are always a wrestling match. They don't usually happen. We've already had one break above it, one test below it. And I think ultimately we may get one more test below it when it's all said and done. And that's my hunch, is that this summer we'll see that one more test below. And it's very common in a bullion bull market for gold to retest this 200-day moving average. But the thing is once it's done that, generally silver goes nuts. So that's the other thing that we can discuss.
Well, I was coming to silver really, and we have seen silver kind of underperform gold in last year and in this year as well. Where do you now see silver prices by the end of 2025?
So I think the general bullish consensus in the global silver analysts, it's basically 38 to 42 has been more or less the general consensus for the year in terms of silver's high, $38 an ounce, $42 an ounce, somewhere in that area. There's other people out there who think it could go higher and faster and retest that old ancient nominal high of 50 an ounce from 2011 and 1980. What it does by the end of the year, it's not really so concerning to me, because I see this more as a long-term trade. I'm holding bullion through this decade into next, because ultimately I see the gold-silver ratio crashing back down toward where it went in 2011. I worked, traded, invested through 2011's silver and gold bull market. This bull market that we're in blows that away. That bull market was a pipsqueak joke compared to where we're going in this one. And so ultimately, when I look out, I think in terms of 5-10 year timeframes. I don't think in terms of a 1 year trade. So if someone is going to get in this market to speculate, well, good luck, because silver is absolutely volatile, and you're going to get your head handed to you occasionally in the silver market. It's one of the more volatile and dangerous markets to be trading on a short term basis. But on a longer term basis, if you do the study and you do the work and you understand kind of ratios and take the fiat currency out of the equation and use long-term ratios of silver and gold versus the S&P 500, say, or silver and gold versus, you can use bonds, you can use real estate, you can use monetary base, you can use a whole bunch of variations to kind of take out the noise of the fiat currencies as they start to devalue further and further to bullion.
Well, James, as you said, that the gold and silver prices are reacting to a lot of things. As of now, for gold, it really seems like a safe haven and a hedge against various things that are happening in the international markets. What is it that you would want to watch out from here on in sense of fundamentals? I mean, tariffs is one thing, geopolitics another, the fiat currency is the third thing. And then, of course, it also is about interest rate cuts, global central banks buying. Where do you have your focus on?
So the biggest thing for me as a United States citizen is knowing that we have the largest debt in the world of all time in terms of nominal terms. And our debt to GDP is almost at the level where Great Britain was after World War II, after the war. In order for them to get out of that, they had to basically debase the pound. And ultimately, I think that's where we're headed in the United States. We have to devalue the dollar in order to meet nominally the obligations that we've made. We have 36 trillion in debt. We have a deficit this year that's probably going to be over 2 trillion. It's on its way. It's even larger than last year. We have a situation of unfunded liabilities that we have to pay on in terms of Social Security, Medicare, Medicaid, et cetera. That's depending on who you talk to, a net present value looking out of over 100 trillion to 200 trillion. It's just unpayable sums, right? And so what are the options that generally happen in history for countries and empires that are kind of fading, going from a unipolar world to a more multipolar world? Well, generally what they do is they don't default, they just devalue the currency. And so as time goes along, the world is going to realize that the dollar is no longer as good as gold. It hasn't been as good as gold for a long time, but it's going to become painfully obvious that that is the case. And all of a sudden, you're going to get a mania in precious metals, gold, silver, and even platinum later on.
All right, James, thank you so much for joining us today. Manisha, thank you for joining in as well. And as bullish comments come in, gold making new highs, what is also going from strength to strength is the Nifty, 23,740 now on the index, 300 points higher. And every time we try addressing the index, it goes up anywhere between 20 to 30 points. Another percent and a third higher now, 300 points higher, 23,750. Pull up the Nifty Bank as well. Let's see how close it has now gotten to its record high levels, because it is the heavyweight banking names that are leading the charge today on the index. 54,000 now, so just 400 points away for the Nifty Bank from its record high levels. Call time on this edition of Halftime Report. Business lunch for the next 30 minutes.
Stocks filter between gains and losses as market digests a range of comments from Trump and Powell ahead of the long weekend. IT and metals are the big losers, while financials and utilities eke out gains. Mid-caps fare better. Private investors Warburg Pincus and ADIA will invest 7,500 crore rupees in IDFC First Bank via convertibles, translating into an eventual stake of near 15%. CEO Vaidyanathan says that he sees strong growth ahead, though the fundraise will return dilutive in the short term. Wipro delivers a weak Q4 and guides for a decline in IT revenues in the first quarter of FY26, while Sonata Software alerts on likely lower revenues from its top clients. These vindicate views of analysts warning of an adverse impact of global uncertainties, IT stock slumps. Need to move from thinking of minimum compliance to maximum governance, says SEBI Chief Tuhin Kanta Pandey. He calls governance a strategic imperative for the regulator at the time when Gensol Engineering is hogging the spotlight on misgovernance. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, and thank you so much for tuning in as always. Markets almost near today's highest point is what it's trading at, 23,700. About that mark is what the Nifty is holding on to. Sensex seeing gains of more than 1,100 points in today's trading session. So interesting move that is coming in for the benchmark indices. Let's look at what is happening in terms of the contributors and who is giving the most in terms of contribution. We have the private bank side. Yesterday also we had seen private banks do well. Today also. So ICICI Bank, HDFC Bank among the top contributors for the Nifty 50. Reliance also is there and Bharti Airtel. So good names coming in there. Heavyweights coming in like Reliance as well. So support coming in for the market. As of now, 292 points uptick for the Nifty is what we're seeing. Advance decline ratio is also what we should watch out for as well. And that is in the favor of advances versus declines. And in terms of banks also, private banks seeing a clear up move like you saw on the screen as well. Let's move on and talk about the mid and small cap because that is doing well in today's trading session. We have the Nifty mid cap holding on to gains of almost 5/10 to 0.6% as of now. So 0.5% gain for mid cap. Small cap also is managing to hold on to good gains of almost 0.5%. So interesting moves that are coming in terms of the broader end of the market. Not an outperformance today, but that is something to watch out for. IT, that's the top drag coming in on the sector performance. So look at the Nifty IT of TCS, Wipro, HCL Tech, Mahindra, all of them seeing a sharp fall as well. And Wipro, obviously, in terms of the numbers that they reported and commentary that has come in, has not been something very exciting. But talking about Wipro, we do have, the analysis that is coming in from Wipro. And Rima is here to give us the update in what has happened in Q4 for Wipro and what are we watching out for now.
Oh, indeed. It's taking it on the chin. And now the Nifty IT index is down 25% so far this year. And it's still about 5% away from its 52-week low. Let's run you first through the news flow. Now, Wipro's under pressure because its Q1 guidance disappointed the street. Much lower than street expectations at -3.5% to -1.5%, which means your best case is revenues for Wipro in Q1 declined by 1.5%. Sonata then issued a revenue warning. They said revenues from their top client will be lower than what they were earlier anticipating. And now the street is saying that perhaps Sonata's revenues in the June quarter could decline by high single digits. Now you've got Infi, which reports numbers post-market hours. And the big question is, will they guide or will they not, given the uncertainty? And it's hard to have visibility about the second half of the year or even tomorrow. So if they don't guide, that means the uncertainty lingers on for the next 3 months. And so far, both TCS and Wipro, which have reported numbers, have missed the mark on the top line. Both of them reported a revenue decline in the March quarter, revenues falling 0.8% on a quarter-on-quarter basis. They also highlighted in their commentary that clients are turning cautious. They're taking a measured approach, at least when it comes to discretionary spending. There are instances of projects being put on hold, some decisions being delayed. So all that is hurting demand. So today you've got Infy and Tata LXC, but over the next few days, you will have numbers from Mastech, HCL Tech, LTI, Mindtree, and the following week you also have Tech Mahindra, Sign, LTTS, Emphasis, Persistent, basically the rest of the pack.
Absolutely, Rima. Thank you so much for that. But let's move on and also listen into what the management of Wipro had to tell us on the quarter gone by and the outlook going forward amid the global uncertainty.
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
We've seen fixed price programs improve their productivity. We've seen acquired entities improve their profitability. We have rationalized overheads. We've also rationalized staff who are non-client facing in some of the functions and roles in G&A. So all around, it's been a very solid performance in FY25. We have said our endeavor would be to hold it in a narrow band. So yeah, 17% plus. There is pricing pressure for sure. Is this any worse compared to how it was, let's say, a few quarters ago? I'm not sure. How do I contextualize it? But I do see that increasingly a lot of the large deals are vendor consolidation and cost takeout. So yes, they're quite competitively fought, and therefore it does have pressure on margins.
And now let's move on to a CNBC-TV18 news break that was confirmed. IDFC First Bank's board has approved funds, raising of funds of up to 7,500 crore rupees. Now, private investors Warburg Pincus as well as ADIA will invest in the bank via convertibles, translating into an eventual stake of near 15%. Earlier today, we spoke exclusively to V. Vaidyanathan, who is the MD and CEO of the bank, to give more details about the fundraise. Listen to what he had to say.
I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, then we pitched the story. We told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time. So they felt excited to come again. This will have a dilution of 15%. But really, Lata, I want to just share one thing to you and to all investors hearing this program, that the main thing is that the bank has a phenomenal model. Otherwise, our operating profit could not have grown from 750 crores to 6,000 crores, like 16.4 or 5 right now, and it will go to 18 point, close to like 19% after this raise. The thing is, Lata, that as the CEO, I have 2 very big responsibilities: to run a super safe bank. Super safe bank. Super safe bank is how diversified deposits are, etc., and how quality of loan book is good. All that is super safe. But capital is a very, very important part. I take that as a responsibility. And even though we were 16 plus, I have to be honest, I wanted to raise more capital.
And moving on, Indian bond prices continue to soar, touching a fresh 3.5-year high, and 10-year yields fell to a low of 6.37%, following lower than expected inflation readings and some fall in the US yields too. Lata has more details on this one. Afternoon, Lata.
Yes, this is a further fillip that bond prices have got since the inflation numbers for March came on Tuesday. We saw the rally actually start on Wednesday itself, when the 10-year bond prices rose and the yield fell below the 6.4% mark, which is the lowest level we have seen since December 2021. So basically from 2021, this is the lowest level we have seen. Bond prices actually have been rising in India from January 15, the day when, if you remember, Reserve Bank announced that massive liquidity injection in various ways, forex swaps, OMOs, repos, and that has continued. Actually, the Reserve Bank is continuing to supply money through what we call daily VRRs, variable rate repos. That is, they just stand ready to offer banks any amount of money that they are asking for practically. They're also doing OMOs. Recently, they announced 40,000 crore of OMOs. So the attitude of the Reserve Bank is that we are going to provide liquidity even when the call rate fell below the repo rate. The mandate is that the call rate should align to the repo rate, but call rate or the interbank, the rate at which banks borrow from one another for one day, that is falling below the repo rate at several points, and still RBI is continuing with its repo. So that's giving market the confidence that yields can go further lower. Plus, we have started seeing FPI flows this week. They had slowed a bit, and now we have again, the last 2-3 days, started seeing foreign flows into bonds as well, or rather more so in bonds. In fact, the overall view of foreign funds has become that even if US yields rise, Asian yields won't rise because there is clear disinflation in Asia. Already prices are falling, and the expectation is that as Asia, especially countries like China and Vietnam, are allowed to export less to the US, those goods will, find a home in Asia itself and drive prices down further. So foreign funds are extremely bullish on Asian bonds, and that includes Indian bonds. In fact, we spoke to Florian Neto, the chief strategist at Amundi, a very big fixed income investing fund. And this is what he had to say about the attractiveness of fixed income instruments in Asia and India.
The inflation issues that we have in the US, and we've seen Jerome Powell mentioning about this in your show just before, we don't have the same inflation issues in Asia. Headline inflation in India has been coming at 3.3, quite lower than the threshold of 4% from the RBI. And it's not an India story. It's the disinflation story is in Asia. So we like Asian rates, and we see that investors are turning a bit more constructive on Asia rates. When you hedge yourself, when you go on Korean curve, on Chinese curve, and you hedge the currency, you're actually having a higher carry than in the US. And we do believe that the central banks in the region have I would say, are less in the corner than what the Fed is facing today with potentially stagflationary environment. Growth will be slightly lower. Inflation will be slightly lower in Asia. FX is still relatively resilient because the dollar is in a bit of a free flow. So at the end of the day, we do think that there will be more cuts in the region.
Okay, on that note, we're going to submit a very short break, viewers. Don't go anywhere, because after the break, we'll come back and give you more news and updates.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Bessent has already said that we will, the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea and India. I was very intrigued to hear that, because they've always said we want to bring things onshore, we want to bring things near shore, which is Mexico and others, and then we want people which are friend shore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that, in a sense, for them. So in that context, the way they are...
Welcome back to Business Lunch on CNBC-TV18. Now let's move on. And amid the Gensol fiasco, SEBI chairperson Tuinkanta Pandey backed for a greater corporate governance standard in corporate India. Listen in to what he had to say.
So governance failures in large corporates can have ripple effects across the market and economy. Preventing such failures is essential to maintaining financial stability. By mandating disclosures, board structures, and oversight mechanisms, we aim to create a self-regulating environment that encourages ethical and responsible corporate behavior. We are conscious that over-regulation can stifle growth and innovation. At the same time, too little regulations can also lead to decline in trust of stakeholders and adversely impact growth. Thus, there is a need for optimum regulation. Regulations need to be rationalized by removing what is no longer relevant and reducing overlaps. Stable and adequate financial regulation can help in creating a high-trust environment, increase attractiveness for investors, and promote economic growth. What we can do about effective self-regulation by entities? We need to move from a thinking of minimum compliance to maximum governance. Boards must rise above routine and ask difficult questions, and auditors and independent directors must act as gatekeepers of integrity.
Okay, that was the SEBI chairperson, but let's move on. And Federal Reserve Chair Jerome Powell expressed concerns that the central bank could find itself in a dilemma between controlling inflation and supporting economic growth. Speaking at the Economic Club of Chicago, Powell pointed to President Donald Trump's tariffs as very likely to hurt the economic growth and cause higher inflation. Listen in.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs.
Okay, on that note, we're going to slip into a very short break. But as we slip into the break, here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen.
Chessboard. I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. How many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West, and gives those workers the income to then kickstart local consumption. That's how you got export, investment, and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth. Because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain in a sense. Even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning and then you can start making your own product. Because we were just not in any of these global supply chains for so long.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Welcome back to Business Lunch on CNBC TV18. Now let's move on. The US travel and hospitality industry is facing a downturn with a noticeable drop in foreign visitor numbers. Partially, this was due to the policies targeting illegal immigrants. Now we have Madhya, who's joining you with us to give us more details of this one. Madhya?
Well, the drop in arrivals doesn't augur well for the US travel and hospitality industry. The Trump government intended to target illegal immigrants living in the US, but as per data on different platforms, their rules and policies are keeping many people away. An analysis by American news portal Axios shows a 20% year-on-year drop in the number of foreign tourist arrivals at 10 busiest airports in the US in March. According to data published by International Trade Administration, total arrivals into the US saw an 11.4% year-on-year decline. Arrivals from Mexico were down nearly 23%. From Central America, arrivals dropped 24%. From Western Europe, the decline was 17.4%. Now, if we look at arrivals through all modes of transport into the US, then Germany saw a decline of 28%, UK saw a drop of over 14%, India and China, while less dramatic, also posted drops in arrivals. A major drop is from Canada. Several Canadians dropped their travel plans to US. As per Statistics Canada, return trips by land fell by nearly 32% and by air, the visits fell by 13.5%. So what is discouraging travelers? Few factors could be rising global tensions, policy changes, reports of detainment or harassment at borders. Countries like Canada and China have issued travel advisories, especially for transgender travelers. Now, travel policy changes like stricter visa requirement, mandatory registration for stays over 30 days, harsher penalties for overstaying visas are deterring travelers. The rule stating that passports must reflect the holder's biological sex, recognizing only male and female under federal guidelines, is also adding to the caution. In India, travel agents say that even green card holders are hesitant to travel home, fearing scrutiny upon return. Many are deferring US trips altogether unless absolutely necessary. Foreign tourists are a big contributor to the travel and hospitality industry in the US, and the drop in numbers is painting a worrying trend.
Thank you so much for that, Madhya. But a quick look at the market as well. Today, we are seeing that Nifty Bank, that is doing quite well. Now, just almost 100 points away from its record high levels. We've seen those flashes coming at the bottom of the screen from our ticker team as well. And I was reading that Nifty Bank is 13% up from its recent lows that was on March of 11th. So that is interesting to watch out for. As of now, Nifty Bank almost at the day's highest point is what it's trading at. And Nifty also continuing to gain its momentum that we've seen. And at the day's highest point is what the Nifty 50 is trading as well. Banks, particularly ICICI Bank, HDFC Bank, have hit record high levels. So keeping an eye out on that as well. That's the market setup that is right now. Also in terms of the green that we're seeing on the screen, and momentum is not stopping as of now for today's trading session. But let's move on. And OpenAI, that has launched a new AI reasoning model, O3 and O4 Mini. Now, the products which are developed focused with an improvement in coding abilities. Now, ChatGPT is also gaining immense traction in India, with users tripling in 2024 to become OpenAI's second largest global market. As a part of our Global Dialogue series, CNBC-TV18's Shireen Bhan spoke with Kevin Weil, the Chief Product Officer at OpenAI, to discuss their plans for the Indian market and the Ghibli image generation tool, which was and has gone viral in the country as well. Listen in to that conversation.
Let me start by asking you, Kevin, to give us a snapshot in very simple language. What does ChatGPT 4.1 mean for OpenAI and for consumers? And how do O3 and O4 Mini change the game?
Yeah, well, first of all, thank you for having me. I really appreciate it. Excited to be here with you. India is an incredibly important market for OpenAI and ChatGPT. It's our second largest market, it's our fastest growing market, and it's also the market where we saw our image generation just take off. But we had some great launches this week. You mentioned GPT 4.1, which was a model for developers that is fantastic at coding and complex instruction following. And so, for that was a model that we released focused on developers, and we're seeing them. We have over 3 million developers on the OpenAI platform, and they're doing amazing things. That is one of our fastest growing models by usage ever. And then just this morning in the US, we launched O3 and O4 Mini, which are our frontier reasoning models. They're the smartest, fastest, safest models that we have ever launched. They're incredible at things like computer programming. So if you look at measures like on competitive coding benchmarks, these models would be better at competitive coding than all but about 200 people in the world. And they can answer hard PhD level science questions better than 80% of PhDs in their field across all fields simultaneously. So they're really very intelligent models, but you can also use them for, more mundane tasks, understanding, medical jargon, or looking at what's happening in the world, creating images, helping you with writing, translating languages. These models are so dynamic, and we're super excited to see what people can do with them.
Let's talk about what you're seeing in India. You talked about how it is today your fastest growing market for ChatGPT. How many active users do you have in India? What surprised you about the adoption, the rate of adoption, the pace of adoption in India? Why do you believe you've seen this kind of an uptick here?
Yeah, I mean, our active users in India more than tripled in 2024. So it's been incredible to watch. A few weeks ago, we launched a new image generation tool using AI to generate incredibly, images that you can control to a great degree, whether you want them to be vivid and lifelike or cartoony or following a particular style. We saw, Prime Minister Modi tweeted using our image gen feature. We had cricketers like Sachin Tendulkar tweet images from ChatGPT. And it just took off. I mean, unlike anything I've ever seen. I've been fortunate to be at Twitter for many years. I led product at Instagram for a number of years. I mean, these companies were growing very quickly. I have never seen anything grow like ChatGPT was growing, because people were having so much fun creating these images, sharing them with their friends, on WhatsApp and in other places. And it's just incredible to see. So we marshaled a whole lot of resources. We really tried to support it. Especially in India. We released new features around our image gen, like image galleries that let you quickly view all of the images that you've created. There's just a huge amount of excitement in India for ChatGPT, and not just for this image gen feature, but also, ChatGPT speaks 100 languages. It can teach you any subject you want to learn. It can save you time at home and at work. And so, it's so broadly useful, and it's completely free. You don't have to pay us a dime. You can use it on an Android phone for free. So it's just, we deeply believe in bringing AI to the world and in the positive impacts that can make. And I can't think of a better example than, what's happening in India right now with ChatGPT.
You can catch the entire conversation with Kevin Weil this evening at 5:30 p.m. only on CNBC TV18. And with that, we're absolutely out of time on this edition of Business Lunch. Thank you so much for tuning in. Up next, your Midcap Radar.
Create effective strategies with insightful expert opinions. On the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most
The Bulls want to go into the long weekend in absolute party mode, and it can see on the screens as well. You can watching Midcap Radar live from the CNBC TV18 Motilal Oswal studios. I am Hormus Fatakia. With me, as always, is Vivek Iyer. Vivek, good afternoon. And we are heading towards new records on the Nifty Bank, but can't count out the Nifty either.
Can't count out the Nifty Bank on an absolute tear. Lot of positive news flow that's come in over the last 2 months, easing liquidity, deposit rates getting cut, and markets clearly cheering all of the moves that's happened, especially as far as the BFSI space is concerned. But we have quite a lot lined up in today's Midcap Radar. Let's start off with the key headlines. Markets at the day's highest point as investors digest a range of comments from Trump and Powell ahead of a long weekend. IT the big loser, while financials and utilities eke out strong gains. Midcaps relatively lagged.
Private investors Warburg Pincus and the Abu Dhabi Investment Authority will invest 7,500 crore rupees in IDFC First Bank via convertibles, translating into an eventual stake of nearly 15%. CEO Vaidyanathan says he sees strong growth ahead, though the fundraise will be return dilutive in the short term.
KFintech surges nearly 8% after announcing their global foray with the 51% stake acquisition in Ascent Fund Services. The company plans 100% ownership of the company over the next 5 years. Jeffrey says that the acquisition will complement the company's product suite.
Vari Renewables has climbed over 10% after reporting a strong fourth quarter. The revenue has risen 74%. EBITDA is up nearly 70% on a year-on-year basis.
Sonata Software slumps in trade as the company issues a warning for the fourth quarter, stating that the revenue from their largest client will be lower than expected. Analysts are now estimating a high single-digit decline in revenue for the company's fourth quarter results. Well, what you're seeing on the screen is a total green screen. Have a look at the Nifty Bank, just a few points away from hitting record highs. The Nifty 50 itself is up over 1.5%. And what is taking the markets higher today? Well, big boy Reliance Industries trading near the day's highest point. A very strong up move as far as Reliance is concerned. Whole host of other stocks, especially from the banking pack, that's aiding both the Nifty as well as the Nifty Bank up move. Have a look at names like ICICI Bank, Axis Bank, HDFC Bank. All of these stocks are now flirting near lifetime high levels. But Hormuz has stepped across to the wall. Hormaz is looking at all of the stocks in the broader end of the market, and this is our special segment, Mid-Cap Movers. Over to you, Hormaz.
The street is not paying too much attention to the broader markets because the focus is on the Nifty bank, but indeed there are a lot of movers in the broader markets as well. Fact is one of them. Fertilizer stocks in general are doing well for themselves today, 12.5% higher on Fact. Delivery is a big mover today, 6.5% higher there. Of course, significantly below its IPO price still. Bharti Hexacom, new highs for the stock, 6.5% high here as well. And Vijaya Diagnostics, good going on strong volumes as well for the stock. Some of the newsmakers in today's session, KFin Tech after the acquisition and some divergent brokerage commentary, still 7% higher. Sonata Software has recovered significantly from the lows. At one point was down 12%. 361 WAM, of course, the board meeting for the preference issue of shares, 3.5% higher than an IDFC First. Not a big move, but of course has recovered from the lows after announcing the fundraise. The other movers in today's session are stocks that are at a 52-week high, being Narayana Health, Chambal Fertilizers, SBI Cards is at a new high today. 900 plus on the stock, now 1.5% higher, and of course Indigo soaring to newer skies, now nearing levels of 5,400, another 2% higher on the aviation giant. But stocks that are doing well on strong volumes, India Cements is off the highs of the day, still holding on to gains of 3%. As we mentioned, fertilizer stocks doing well. RCF is one of them, 5.5% higher. GIC, RE and NTPC Green too having a good day at the office. And lastly, some stocks that are not doing very well even in a market like this. Akums Drugs, Ramkrishna Forgings, GSK Pharma, all down between 2 to 3% at the lows of the day, but the advance is significantly outnumbering the declines, Vivek.
Thank you so much, Hormaz, and get back to your suite quickly because what we have in store is a tech check on the market. Vinay Rajani of HDFC Securities joins in. Vinay, thank you so much for joining us. Well, what a day to come, and go ahead and reiterate what's been a good stance from you over the last couple of times you've been on the channel. What's your view on the Nifty? What's your view on the Bank Nifty? Do you feel that the kind of up move we've seen, especially in the Bank Nifty, can sustain?
Yeah, Bank Nifty was stronger and it is on the verge of making all-time high. Previously, we saw Fin Nifty actually hit an all-time high in the month of March itself. Now, Bank Nifty is following, and almost 35-40% weightage of banks are there in Nifty also. So Nifty is also into a momentum. So today is the expiry day. So Monday could be a altogether different day. But yes, overall markets are going very strong. More than 2,000 points recovery in last 7 trading session in Nifty, and from today's low, Nifty has risen by more than 500 points. So very strong setup technically. The immediate resistance is at 23,870, which happens to be the previous swing high. But overall, I feel that Nifty is headed higher. In fact, 24,000 should be there in Nifty in a couple of sessions. So overall, markets are looking very strong. Now, however, the steep rise is there. There could be some running correction, but overall market should remain firm. And Bank Nifty is looking much stronger, and it is likely to hit an all-time high by today also, or maybe tomorrow on Monday. But yes, traders should remain bullish. Mid-cap, small caps can follow the rally, and on Monday we can expect broader markets to participate in this rally.
So what's on your list now, Vinay? A lot of these frontline names have hit record highs in today's session, be it HDFC Bank, ICICI Bank, Bharti Airtel. Are you betting on some Nifty names, or do broader market names feature in your stock recommendations?
Yeah, so looking at the momentum in the larger stocks, I would go along with SBI. So SBI, State Bank of India, fresh breakouts can be seen. In fact, PSU Bank as a index is looking very strong. So SBI from the large cap banking, PSU banking, one can pick at 795. Stop loss can be kept at 760, and on the upside, I'm expecting 850. This is for 1 or 2 weeks time frame. The second pick also from the Nifty stocks, which is Ultratech Cement. This has been a very resilient stock, and cement counters have started participating, and Ultratech is the leader. So Ultratech Cement can be bought around 11,850. Stop loss can be kept at 11,450. This is for the trading pick. So 3 to 4 days time frame should be there. So on the upside, 12,500 target I'm expecting in next 1 week. So Ultratech Cement and SBA from my side.
Thank you so much, Vinay, for joining us and giving us both your view on the markets as well as your stock-specific calls. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded.
Welcome back to Mid Cap Radar. Well, the Bank Nifty once again has picked up steam, just a few points away. And when you're looking at the Nifty, comfortably above the 23,800 mark. Nifty Bank just a few points away from hitting record highs. But let's now shift focus on the retail leasing space. As per a latest Cushman & Wakefield report, retail leasing activity in India in Q1 FY25 recorded a 55% growth, with Hyderabad, Mumbai and Delhi NCR accounting for 75% of the total retail leasing activity. To discuss in detail on these trends, Saurabh Chaddal, Managing Director, Capital Markets and Head Retail India, Cushman & Wakefield, joins us. Thank you so much, Saurabh, for joining us. First up, give us the latest trends that are emerging, especially as far as the retail part of the Indian market are concerned. Do you feel there has been a little bit of saturation, especially when it comes to the urban areas?
So as you said, the retail has been a great start for the first quarter. It's around 55% more than what happened last year. So, however, where the demand we are seeing now, as you rightly asked, is, it's more on the premium side of the offerings, where it is more of, premium retail, people who are coming in, looking at more of, aspirational products, aspirational areas. And there is what actually we are seeing is a demand supply gap currently. There is supply being less and there is ample demand in the market. That's why we are seeing, because the malls are at an all-time, the superior malls, grade A malls are at a all-time lowest, vacancy levels in this quarter. And there is enough demand. Like last year, if you see, the demand has been more than 7.5 million. And now in the first quarter itself, we have demand of around 2.5 million, which has been consumed. So the demand is quite robust, especially on the aspirational product, especially on the F&B, beauty, fashion. Those are the demand which are driving demand in India.
Saurabh, good afternoon. Thank you for joining in. Now, is this premiumization the reason why a lot of these high-end malls in these tier 1 urban cities are doing well while the older malls remain largely vacant? What does that tell you about the environment currently? And part 2 of my question is, now given that we're expecting new mall additions this year as well, a significant amount at that, are we now entering a supply-led leasing cycle?
Answering the first question, it is, yes, definitely a yes, where we are seeing, good demand from that perspective. And as people per capita income is increasing, what we are seeing currently, people who are 5 lakhs or below kind of a annual salary, they contribute more than 50% of total demand. In the next 15 years, this 55% will go to 23-24%. And people who have salaries are above of 30 lakhs to 70 lakhs, 1 crore, 2 crore annually. Currently, they contribute around 4% of the demand. that will lead to around 17 to 18% of the demand in the next 15 years. So imagine the kind of demand for premium offerings, as I said, for premium fashion, for aspirational products, what India will come to. So that is where we are seeing the demand increasing. And the second question of yours on the new supply, which is around 7,070,000 square foot, which will come in India this year. Mind you that most of that spaces are already pre-committed with 70-80% already pre-commitment happening. So I don't see any of these malls because out of the 7 million, 80% of those malls are superior grade or grade A malls which are coming, and where the current vacancy is less than 3%. So I don't see the vacancy increasing and rentals coming down or any kind of pressure on the demand side or supply increasing more, at least for this year and next year.
Okay, so you're quite clear. You're saying that demand at this point of time outstrips supply, especially when it comes to the malls in demand. So give us a sense, what are the key constraints? Main street rentals are appreciating quite significantly in several cities. Galleria Market in Gurugram up 20%. Like you've mentioned, Kolaba, Kemps Corner in Mumbai up over 10%. Is it now a clear landlord's market? And also, give us the reason why we've seen such a sharp 36% year-on-year dip in Ahmedabad. Is it mainly due to, can you attribute that to a one-off effect?
No, so just answering on the Ahmedabad, it's more of a one-off effect. It's a cyclical effect. Structurally, there is no issue as far as demand is concerned in Ahmedabad. Actually, on the contrary, we ourselves are seeing very good demand in Ahmedabad as we move forward from various infrastructure and various locations which are coming in. But purely because of so much supply coming in Ahmedabad, this is more of a cyclical blip. It's not structurally any issues. As far as some of the other main streets are concerned in Mumbai, or as you rightly said, Mumbai, Bangalore, Hyderabad, Delhi, it's purely because of low vacancy in mall and high street both. So it's purely because of the low vacancy where some of these big brands want to come in and put their stores. And that is why you can say right now at this moment, especially in the main street, it's more of a landlord market. Because the supply is very constrained, and for the right store, there is enough players who are or retailers who are looking at that space. So demand is fairly, and as I said, demand on the especially on the aspirational product, especially on the premium spaces, F&B, fashion, those kind of demand is quite high. The value demand of your hypermarkets or your value products are diminishing as we are moving ahead as well.
Saurabh, I wanted your views on the potentially newest hot market on the block, and that's Navi Mumbai, because the airport is all set to get operational very soon over there. Could you please share your insights there as well? Is that now going to be the most sought after real estate market?
Like any real estate market, this airport is going to be a very large airport servicing the entire Mumbai metropolitan region rather than just, and then also there will be demand from Pune people traveling to use this airport. Obviously, from day one, everything will not be too big. Over the next 2-3 years, you will keep seeing the infrastructure as well as demand moving for people to use that airport. And like globally, or also what you have seen in AeroCity or any of the airports in India or the Bangalore airport, the retail will drive people coming into the airport as well. And we expect Navi Mumbai airport to have the same driver in a bigger way also, because Navi Mumbai overall with the Naina and the infrastructure getting connected from South Mumbai or from Mumbai and also from Thane, we expect Navi Mumbai to be the biggest hotspot in the next future to come, especially on the retail side and the kind of land availability there. And again, as I said, the access between Pune and Mumbai will become much better. So I personally very, very positive about the new airport, and in and around new airport, apart from retail, the whole real estate uplift of the capital values. We expect that to be much higher than any other parts of Mumbai.
Take that point completely, Saurabh. Thank you so much for joining us and giving us a sense of what exactly is panning out as far as quite a lot of the retail malls are concerned. But let's now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Has been and performing has been a dream for you, but in an era and in a society where we're so bound by log kya kahenge, and there's a whole genre of Hindi movies dedicated to that, to say that you're going to do this publicly.
I just was very keen that I don't take the one-dimensional view of life, because we are all businessmen, we're running listed companies, this is our job, and if your job is something that stresses you, then you need to find other avenues to de-stress you.
The three most important things to Ajay Bijli, please share.
Hairline, bottom line, and waistline. And now being able to sing. What's written on the stave is important.
Did you worry about how it would be perceived? Would people think that, oh, is he retiring? Is he giving up on business? I mean, did you worry
I used to
about
look at the CNBC ticker of my stock price for sure, with every note. And then when I sang It's My Life, and it didn't go down, I said, maybe I can sing Bon Jovi's song.
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
Welcome back to Mid Cap Radar. Well, one stock from the broad end of the market that's doing quite well is Waaree Renewable Technology. Remember, the company reported its results last evening. The stock, once again, after a brief dip intraday, is up almost 9%. What were the results of the company? Let's have a quick look. Revenues were higher by almost 95%. Remember, the company had a large order book execution, which has become much better in Q4 of the quarter that just went by. EBITDA higher by almost 63%. EBITDA at a little over 122 crores. EBITDA margins at 25.7% versus 27.5%. Profitability higher by 82.5%. what is the outlook of the company, especially as far as the next 12 to 15 months is concerned, we'll need to have a look at the order book. So the unexecuted order book that the company has is quite strong, almost 3.2 gigawatt power, which gives it enough visibility for the next 12 to 15 months. The bidding pipeline that the company says, which is likely to come up for tendering in this particular year itself, is at close to 30 gigawatt power, which indicates, so what we'll need to keep an eye out for is, number one, how many of these projects does the company actually bid for? And number two, what is the expected win ratio? But a good set of numbers, strong growth across all key metrics, that Hormaz is keeping this particular stock quite buoyant in the session today.
Quite buoyant in the session today, but what is buoyant and a little more than that is the Nifty Bank, and now less than 100 points away from its record high levels of 54,467. It made an intraday high of 54,407. So hovering around those levels, 1,250 points higher, 2.5% gain on the Nifty Bank. And two of its biggest constituents, HDFC Bank and ICICI Bank, both of them hitting record highs in today's trading session. HDFC Bank also at the highest point of the day, 2% higher. ICICI Bank a step further, 3.5% higher, now crossing levels of 1,400 on the stock. And don't leave the Nifty behind too, 400 points higher now on the index, 23,850 is where the index stands at, of course led predominantly by the Nifty Bank and the record highs seen on those levels. If you could pull up the contributors, you would see the two names on top of that list as well, HDFC Bank and ICICI Bank. And it is Reliance Industries too that is powering the Nifty ahead in today's trading session. And there you can see there 54 points on the upside is what Reliance Industries is contributing to. Not to leave behind Bharti Airtel as well, a record high for the stock there as well. The telecom operator making new highs, and Bernstein today raised its target on the stock to 2020. So we await new highs on the Nifty Bank, continue to remain within touching distance of that. We call time on this edition of Midcap Radar. From Vivek, me and the team that put this show together, thank you so much for watching. MF Corner on the other side.
Hello, good afternoon and welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala and thank you so much for tuning in as always. Now, with the Reserve Bank of India cutting repo rates by 25 basis points and shifting its policy stance to accommodative amid this global uncertainty that we're seeing, debt mutual funds are back in the spotlight for investors. Today, we'll be exploring how this policy shift impacts the debt funds in terms of strategies that you should follow, whether aggressive rate cut bets are justified, how to balance your risk and opportunity in such an uncertain time. We are joined by Kavita Menon, who's the founder at Probitus Wealth, joining in with us to talk to us about all of this and help you all understand what you all should be doing now with your debt mutual fund strategies. Kavita, thank you so much as always for joining in with us, and a very good afternoon to you as well. Let's just start by the basics about what should your mutual fund strategy be now. RBI has cut that 25 basis point rate. They've changed the stance as well. So is it the right time actually to invest now in debt funds or increase your exposure toward debt funds?
So hi, Vinny. Thank you for having me here. Always a pleasure to be here. So yes, RBI's rate cut has led to a rally in the bond prices. Already yields have come off, and those who had positioned themselves in long duration bonds before the rate cut have seen a real significant appreciation in their portfolios, in the bond portfolios. Now, having said that, the RBI has also, given an indication of further rate cuts in this financial year itself. So, given this reality, those who have, I would insist the words should be savvy investors. Okay, people who understand the bond markets. They would do well by positioning themselves in long duration portfolios. It could be typically gilt papers or even a mix of corporate and gilt would be good. But with longer durations, because typically whenever interest rates come down, these long duration funds tend to give superior returns. However, again, this is because I'm an investment advisor, I am compelled to give you the risk factors also. The fact of the matter is that inflation is always a very important criteria in RBI's monetary policy. Okay, and it has been very proactive when it comes to managing inflation. Now that inflation has come down, there is a lot of space for the Reserve Bank to reduce interest rates. So it looks like in the next 6 to 9 months or 9 to 1 year period, there could be rate cuts and therefore an appreciation in bond prices. However, this is going to be accompanied with volatility given the global conditions we are in. So volatility means there could be very severe price up and downs. If one is ready to absorb that, then this is a great time to be in long duration bonds.
In long duration bonds, but be prepared for volatility is what you're highlighting as well. So that is a key cursor that we should keep an eye out on. That volatility will be there. But if you have, just a 6 to 9 month, 1 year time period, long duration is what you could look at, but be prepared for volatility. Okay, what if I am already holding some bit of a debt fund? Anything I should do in terms of changing the strategies? How does that work over there, given this current scenario that we'll see?
So typically you have in investors, you have two type of investors. One who buy and hold, okay. They are long only kind of investors. For them, I don't see a big change in strategies anyways going to work. Because remember, every time you exit out of your paper, let's say because now you're sitting on a big gain, you're looking at, some of them are looking at double-digit returns, okay. Let's say you want to book out and then you want to look at reinvesting, then you have a reinvestment risk now because now the yields are looking lower for long duration papers, right? The yields have come up. Prices have gone up, but the yields have come up, right? So for those who have already invested in these long papers, I would suggest hold on. There is still a lot of steam left, so please hold. While those who are looking at investing in it for the next few months or a year or two, then I would suggest you get in, but with the understanding that there will be ups and downs. There will be volatility.
Okay. Kavita, can you just, elaborate a bit more? Like, what I want to also understand with US Treasury yields coming into play as well, they're seeing a bit of a rise. Global economic uncertainties that we're talking about. Indian debt market, how is all this going to be impacting that? And in turn, your debt funds, if you could just break it down for our viewers, in case if someone doesn't know how this process works, I just want them to understand how debt funds work then.
So very typically, Yeah. Whenever the RBI has a very dovish or accommodative stance, it starts cutting rates. Bond prices should start rising. Okay. But bond markets are just like the equity markets. There is a very vibrant bond market and trading happens on a daily basis. And there also the demand supply situations change daily basis news flows. Okay. So really speaking, while India looks great from the debt point of view, like I said, long duration bonds are looking great. And I kept emphasizing on volatility. It is really because the global situation is so uncertain. There is so much news flow happening on a daily basis. Not all of it is positive. Okay. And what happens is, so just to give you an example, when Trump announced his policy, his tariff policies, bond yields just went berserk all globally, so bond prices fell. It's an inverse relationship. When yields spike up, the prices fall. And that volatility we saw here in India also. हमारा कोई उतना लेना देना नहीं है उनके साथ, but we cannot escape global volatility. If it is there, it's there in our portfolios as well. Okay, so which caused a correction in the prices of bonds here also. However, if you look at the term, the direction, the trajectory is that we are going to see rate cuts in the future. So the trajectory is that you're going to see lower rates here in India, right? But global factors, global uncertainties will keep playing, and therefore there will be volatility. If one is okay with the volatility, see, generally what happens is debt investors tend to come with a point of view that they want safety. They come with the mind frame of wanting safety.
True.
So if you don't understand that in bonds also there can be this lack of safety. It's not actually a risk of capital. It is a volatility, which is the nature of the way bonds function, the market functions. So if you don't understand that and then suddenly you see a fall in your capital, which is also possible, then and you don't understand it, then I would not suggest that you go with long duration funds at all. Then you don't play the interest rate game at all. You are better off being invested in short duration funds, the shorter term, because there is no much interest rate risk, and you're pretty much going to be comfortable because the volatility is very limited.
Kavita, actually my next question was on that only. For investors maybe who have a low risk appetite, right? Even though debt funds is less risk already, but lower risk that one could want or doesn't want to take that much. And like you're mentioning, don't go for long duration funds. Then what specific kind of debt funds can one go for, right? There are so many options there as well, short-term, corporate bond funds, and portfolio duration also. I want to understand how important is that going to be a factor as well if you have a lower risk. How much of a time period should your duration be in this current scenario then?
So let me define duration in the simplest possible manner. Okay, it is the average of all the cash flows of the portfolio. Let me put it like that. It's the average time frame of all the cash flows in that portfolio. Okay, which means that a longer duration means most of the cash flows will come over a longer period of time. Okay, a shorter duration means the funds cash flows have a very close, the payouts will be much closer. Closer payouts or closer duration means lower risk in the portfolio, interest rate risk. Let me put it like that. It's lower interest rate risk. So if let's say I have a requirement of money in a 3-year period and I need to invest in a bond fund, then I should look for a fund which has a duration of 3 to 4 years. If I am okay with investing in a 10-year period, for a 10-year period, then I could look for a portfolio which has a duration of 10 years. Basically, as an investor, I need to match my requirement with the duration of the fund. Okay, that's a very good way of managing interest rate risk. If you don't want to play any interest rate risk, there are options. You can stay in very short duration funds. You can play arbitrage. Okay, you can also there are other opportunities in the short term. There are liquid funds, there are short term funds, there are mix of arbitrage and debt funds which have just 2 or 3 years period duration, and that works very nicely for investors who are risk averse. Okay, for somebody who wants a little longer, you can also go for corporate bond funds. You can go for credit opportunity funds, but there is a credit risk there. although limited and managed by the fund managers very well in India, but still those risks have to be known to the investors. Typically, if you don't want any risk, you will be mostly invested in a treasury, gilt kind of a combination.
Sure. Kavita, now I have to pick up a fund, then debt fund, as a debt fund investor. What are my key indicators that maybe I could look at while picking up the fund as well, right? What should an investor watch out for? What should they monitor before making a decision for debt funds specifically?
So the first thing is the most important thing is matching the tenure of your requirement with that of the duration of the bond portfolio. It's a very important thing. If it is mismatched, you will be exposed to interest rate risks, okay, or reinvestment risk, or one or the other risk is there in the portfolio. So ideally, most advisors will ask you to match their requirement along with the tenure of the fund. In fact, even if you have a longer period, there are investors who have been invested in short duration funds for the last decade. And that's because they don't want to take that interest rate risk at all. They're okay playing the shorter end of the yield curve, okay, because they don't want the risk. So that's so based on your risk appetite, the tenure of your investment is a very important criteria. The second criteria is you can select between passive and actively managed funds. Passive is simply your, funds like your Bharat bond ETFs, where they just buy a portfolio of bonds and keep it till the end of that period. You can buy it and you don't do anything. You can, although they are liquid, you can, you can trade in them in the market, but you don't trade in it. You just hold it to maturity, and thereby whatever is the yield to maturity of that portfolio, you will get it. This is a passive style of investing. You can also buy gilt funds which are having fixed term. Okay, so that is passive. You can have actively managed funds where a fund manager is taking the decisions on your behalf. Even liquid funds are managed by a portfolio manager. Okay, they will come with slightly higher expense ratios. So you can have a look at that also, what matches your requirement, whether actively managed funds are good for you or passive funds. Like I said, if you have a 10-year vision, then a gilt fund, which is say maturing in 2035, a gilt ETF can work for you. Okay, something like that. Then the third thing that you need to look for is the credit risk in the portfolio. Now, while liquid funds, short-term funds generally invest in very highly rated gilt and PSU bonds, they're all AAA rated. You have various others also where the yield is slightly better because they invest in less than AAA rated quality. You have corporate bond funds, you have credit opportunity funds. You could look at these. These have slightly longer duration, slightly better returns also, but they don't have all AAA rated or absolutely safe kind of investments. They will have lesser ratings also. Have a look at the ratings and see your comfort levels before investing in these funds. Okay, so credit rating, ये बहुत जरूरी चीज है.
Okay, right.
Okay, you can look at that. And there's a last one, which is taxation, especially when you're investing in mutual funds. There are funds where you pay 12.5% taxes. There are funds where you may pay at slab. So you need to see which funds match your taxation. Post-tax returns also is something that's important to look at.
That's very important as well. So yeah, everyone wants to save taxes well. So that's an important one for me in terms of priority also that comes in over there. But Kavita, thank you so much for explaining us this debt fund as well. But on that note, we're going to sip into a very short break, viewers. We'll be back and we'll have be talking about gold ETFs and gold mutual funds. What's the story there? So stay tuned in for that. Welcome back and thanks for staying tuned into MF Corner on CNBC TV18. We still have with us Kavita Menon of Probithis Wealth here to talk to us about what's happening in gold mutual funds now. Given that gold has hit that all-time high, every day you see new high levels coming in. Should investors add more in terms of gold ETFs or look at more in terms of gold mutual fund, or should they start booking their profit? What is the best strategy right now for you as an investor in gold mutual funds and gold ETFs? Kavita will be talking to us about all of that. Kavita, I'm going to talk about this itself, right? Because I'm looking at the numbers when I'm seeing it in terms of the return. Gold overall has gone up around 30, 39, 40% in this last 1 year, approximately that level. We've seen ETFs also, right? I've picked up certain funds that I'm just looking at. So SBI Gold ETF or HDFC Gold ETF, around 30, 31% returns is what they've given in the last 1 year. What is your thought now coming in terms of for an investor who has made so much profit? Should you actually start booking a bit of this profit as well? Because I was looking at the AMFI data also this time and seemed like that gold ETF has seen a bit of a reduction and gold mutual funds are seeing that reduction coming in. Is it time to book your profits and maybe just hold on now to some bit of a cash on that front?
So, the thing about gold is that its purpose in your portfolio is really not getting you those returns. It's a hedge against inflation. And because there has been so much uncertainty post-COVID, that is why you've seen a rally in gold prices. Now, my own opinion is that gold has to be a part of your portfolio. There is no two ways about it. Anything between 5 to 10% of any investor's portfolio has to be in a commodity or your typically bullion, which is gold. It has to be there. So if you have no requirement of that money, I don't see any reason why you should book out of gold, because I personally believe that uncertainties are only going to increase in the coming years. And everybody will need, why do we keep debt in the portfolio? We keep it for safety. We keep it for emergencies. We keep it for utilizing in case of opportunities, isn't it? Similarly, gold has the function of giving us safety when everything else is shaky. And that's why you need gold. So therefore, to all investors who have made tremendous money in gold, unless you need the money or you have completely overshot your allocations, asset allocation, I don't think you should be booking profits and getting out.
Okay, don't book your profits because it's a hedge that comes in as a bet for you when you're holding some bit of a gold. And the allocation also is what Kavita has mentioned, how much you should have. But yes, over allocated, then maybe book some profits and enjoy some bit of that profit on that front. But otherwise, continue to hold it. Kavita, what I want to understand, right? We have two options. Gold ETFs also come in and gold mutual funds also come in. One, what should you pick? If I want to invest right now, does it make sense to enter one of these? And what is the difference that one should be picking between both these?
It's they both underline. See, the underlying of both these structures is gold. Okay, one is purchased and sold in the markets just like you buy and sell stocks. Okay, gold ETFs. They are bought and sold. They're very liquid. You get intraday prices also of gold. Okay, so it's very, very much like a stock. So if you are very comfortable buying, selling in the market, you can place your trades with gold for gold ETFs also, provided, of course, you know the mechanism of buying ETFs. Okay. Gold mutual funds, on the other hand, are just like your plain vanilla funds, which you buy through your directly from the fund house at the closing NAV. Just like you buy your normal equity funds at the closing NAV, gold ETF also you can purchase at the closing NAV. The main difference is that ETFs give you intraday liquidity. Gold mutual funds don't give you intraday liquidity. They have daily liquidity, but it's not intraday. And of course, there is an expense ratio which is slightly higher in the case of funds. In ETFs, the expense ratio is lower. This is the main difference.
Okay. Kavita, in 2025, what should the strategy be? ETFs or gold mutual funds? Kavita?
Completely depending on the clients. I know Sorry, can you hear me?
Yeah, I can hear you. I can hear you now. Yes.
Okay. So completely depends on the client's requirements. If a client is savvy and can buy and sell intraday in the market, then please go with the ETF because it's a cheaper model. But there is again brokerage you must be aware of. You should know what you're paying when you're buying and selling. On the other hand, if you're not very savvy, don't have a demat account, then buy the mutual fund. It's an easier option. You can buy it like any other mutual fund that you hold. Completely, I'm agnostic to it. I'll just ask the client what he's comfortable with, and he can go with any of the two structures.
Absolutely makes sense as well. Kavita, anything specific that you look at in terms of gold mutual fund? Anything you could recommend to our investors as well, gold mutual fund or ETF side, or any recommendation on there?
Sure. In fact, you just showed a screen with the returns, okay? And one of the schemes seem to have a slightly better one-year return compared to the other two, right? How is that possible that all three of them are having the same product? The underlying is gold, but how can the returns be different for each of these schemes? The reason is the expense ratios and the tracking error. Okay, so when you choose funds, please look at tracking error and look at the expense ratios. This will give you an indication of which fund to choose amongst so many that are available in the market. Okay, that impacts your returns.
Okay, that surely does impact your return, and keep an eye out on that when you're picking up your fund that you want as well, because underlying is the same, only that makes a difference in terms of expense ratio as well. Just in a volatile market, how much allocation did you mention that one should have as in their gold or a bullion side of commodity side of investments?
So ideally, from an allocation point of view, I personally offer anything between 5 to 10% in gold to my investors. But again, this is up to the client. If they want allocation, I would like to have it in a range between 5 and 10, because more than that, one must remember that gold it's just an asset which doesn't have any cash flows. It doesn't give you any real income, right? So it's just a hedge. So about 5-10% in between this, it is up to the client to decide what he is comfortable with. But I think your viewers should at least keep a 5% allocation. It's a minimum in commodities like gold.
Minimum in commodities like gold is 5% allocation, at least, is what you should have. And even if you're making profit on this one, this is a hedge that you're making. That's what Kavita started with as well. So yes, if you are holding about 10%, maybe you can look at booking your profit, but otherwise continue holding gold. It'll always protect you in terms of hedge from the volatility that is there as well, plus safe haven demand. So nothing wrong in that terms. But Kavita, thank you so much, for joining with us on the show today. It's a pleasure having you and understanding debt funds as well as gold mutual funds and ETFs, what our investors should be looking at. And with that, we'll wind down this edition. Thank you so much, viewers, for tuning in to MF Corner on CNBC TV18. But up next, you have Closing Bell to take you through the last hour of trade.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Besant has already said that the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that, because they've always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others. And then we want people which are friend shore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that, in a sense, for them. So in that context, the way they're laying out this new chessboard, I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think Look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. You know, how many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth, because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain in a sense. Even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning and then you can start making your own product. Because we were just not in any of these global supply chains for so long.
Beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Most of the markets in Asia are trading higher, barring the Taiwanese index, which is down 1%.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects.
The support for the Nifty, which comes in at the 40-hourly exponential average, 23,030 is that number.
We are close to the max overweight we have been on India. It's our preferred country so far.
We are hoping in the next few months things would settle down and the clients will come back and restart the discretionary spend.
Now there is an official confirmation from IDFC First Bank. So two large investors are putting money into IDFC First Bank, close to 7,500 crores.
Nifty 50, 23,390. We're down about 1/3%.
Whether it be industrial, some parts of consumer discretionary, parts of real estate, etc., are the ones which we can probably go to at this stage.
When you get that kind of capital, then we are at total peace of mind. I can focus on the work. I can focus on building good bank.
Today, markets just seem to be consolidating, moving sideways.
From a regulator's perspective, high standards of corporate governance in listed entities are essential.
We are heading towards new records on the Nifty Bank, but can't count out the Nifty either.
Okay, it is boom time for markets, especially banks. It's a super screen as we go into this 3-day weekend. Markets looking super strong, 400 points on the Nifty. In a strange way, similar to what we saw yesterday. Yesterday the market did nothing for the first many hours, and then slightly before 2 o'clock took off. Today, of course, it started much earlier. But is it as broad-based as sort of wide participation as we would like? Probably not, but you can't take away from the fact that although it's led by banks, there is enough which is happening. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Reema here. And Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi. Can I just say happy Friday?
Happy Thursday, actually. Thursdays turned out to be happier than Friday, one could say. But guys, 3 days can be so powerful when markets have momentum, either on the way up or the way down. Just 3 trading sessions, 4.5% on the Nifty, 6.5% on the Bank Nifty.
Well, that's right. And the Nifty Bank is going to be the first one to hit those fresh all-time highs. So a few points away from there. Great going from the Nifty Bank. That's been the one that's done the heavy lifting. Very, bulls will feel good going into this long weekend. They would have been dreading it a few sessions ago. But the markets have bounced back and bounced back in style. The breadth of the market continues to be good for the last 4 trading sessions. The last tick has been at the high point of the day. The breadth has been good. I don't think the bulls could have asked for more.
Rima, by the way, you meant Thursday? You meant Friday?
No, I meant Friday because today is the last day of the trading week, right?
Thursday is new Friday. All right. No, I think, it's looking good. And banks, of course, as Nigel said, just what I think we're at the high point. We were about 30, 40 points away from a new all-time high for the Nifty bank. So yesterday that headline was doing the rounds, although it was one day late, that India is the first big major market to go back to the pre-tariff levels. And I think we can today, maybe if we do it, we'll have one of the big indices here out of a major market to go back to an all-time high in double quick time. Of course, Nifty Bank did not fall as much as Nifty, so it had that much lesser distance to cover on the way up. But it is what it is. And look at HDFC Bank, ICICI, Axis. So really a lot of participation. Just look at the Nifty and what is influencing this move. It's again all financials. And that's why what I was saying, that it's not as broad-based as you would like. It's largely led by, although there is a Reliance, etc., which is participating, but it's the bulk of it is all coming in from what's happening with financials. Even names like Shriram Finance, for example, Bajaj Finserv, Bajaj Finance, I mean, those names are also doing very well. Rima.
So it's banks, NBFCs, Reliance, and IT too has trimmed all its losses. At the session lows, the Nifty IT index was down 2.5%, and now it's pretty much flattened out. So now we've advanced for the fourth day in a row, and this week, the Nifty, the mid-cap index up 4.5%, the banking index is up 6.5%, and names like ICICI Bank, Bharti, HDFC are all hitting fresh 52-week highs. This is a truncated week. Next week, we'll have the monthly expiry. And then on Saturday, we've actually got the two very important banking numbers, HDFC Bank and ICICI Bank, and that will influence Monday.
No, absolutely. And I take the point on IT, obviously. And the thing is, you anyway expect weak numbers, but if the delivery is even weaker than expectations, then you have casualties. And Wipro is a classic example of that. But otherwise, while financials are leading, the rest of the market, I mean, if you look at the Nifty, this is classic FPI buying, in progress. Because apart from the financials, and they obviously, form the lion's shares, a lot of other stocks in the Nifty are also looking much, much better now. Reliance would be one. Names like Titan, names like even Trent, I mean, some of these consumer names, they're seeing plenty of traction this afternoon. And then, you have a little bit of pharma here and there, some auto here and there as well. So overall, things are looking good. Mid-caps are lagging, but Nigel, I guess when the large-cap screen is looking so dominating, eventually mid-caps tend to catch up.
Well, that's right, at the point of Reliance Industries, that one has got above the 20 DMA. So that's another important technical mark out there. And HDFC Bank has made a fresh 52-week high. It went around 1880 in December, and from there it saw a sharp pullback. But today, that big boy as well has returned back to form. So when you have both those two that are firing all cylinders, it definitely helps the Nifty as well as the Nifty Bank to move up. Mitesh Thakkar is with us. Mitesh, good afternoon. Getting into this long weekend, first of all, congrats on getting this call right. For the last few trading sessions, you have been saying it on the morning call itself, that you look to buy into any kind of dip, you'll maintain that long bias, and you believe the markets are good for more. So great going on that call. The question is, what do you do right now? Go and enjoy the long weekend, book some profits, or do you think you want to carry some positions?
Definitely. So I think, the structure had been positive and therefore trading long was, kind of an easy decision. My sense is that it's kind of even met and exceeded the targets of 23,800, which I was looking at. And this could mean that this move could, possibly head towards the 200-day average, which is 24,050. And in a good case scenario, even 24,180, 200 zone. So still maintaining positive bias. In fact, I have a buy on State Bank of India. Buy here with the stop just below levels of 780. A target of around 835 can be looked at. And Aurobindo Pharma is the other one, which I like. Buy here with the stop at about 1145 for targets of 1210.
Look at the moves we've seen in the last 3 days. So IndusInd Bank in 3 days is up 15.5%. Axis Bank is up over 12%. Shriram Finance has advanced nearly 9%. Adani Ports has rallied 8.5%. And Bharti Airtel has ticked up more than 7%. Mitesh, anything in these frontline, other than State Bank of India, any other banking, NBFC stock? NBFCs are also on fire. We spoke about Shriram Finance, but you look at Muthoot Finance and the others, all are doing well. Any other trades?
So I think you're right. Banking and financial names are the one which are leading the rally. I do like Shriram Finance a lot. In fact, that is one of the stock which I thought I could give a trading call upon. It's heading towards 720, which is the earlier closing high which the stock did. I think that was way back in September of 24. And once it clears 720, I think it's even good for 780 to 800 zones. So very, very positive pattern. Chola Finance is the other one, which I've been tracking and looks like could do very well. Chola has met the first targets of around 1630, which is where the stock had peaked out again, in September of 24. But maybe by this will decline. Once it clears 1630, we'll definitely see higher levels, and on declines, I think anything close to about 1560, 1550 is a good entry point.
Got that. Infosys is recovered fully, right?
Yeah, fully recovered.
Infi
and TCS are now in the green. It's only a Wipro and a little bit HCL Tech, which is something.
You want to just quickly tell us the... Mitesh, stay with us. Just a quick Infi preview. What are we expecting? If we have the graphics, we can just quickly pull those up.
Well, on the top line, we're expecting a revenue decline of more than 1%. 1.1% is the CNBC-TV18 poll. This would compare with TCS and Wipro, which has fallen by 8.8%. But remember, both Infi and Wipro disappointed the street on the top line. So these estimates that we're putting out were pretty much set towards the end of March or early April, and the commentary appears to be a little worse. There has been an impact in Q4, so don't be surprised if generally IT disappoints even in Q4. So on the top line, our poll is at minus 1.1%, but I think the street is braced for a little bit of a miss. For margins for Infosys will also come under pressure, and that's because of wage hikes. For Infosys, wage hikes are staggered over the January and the April quarter, so there will be some impact on the wage hikes. But the key is going to be the FY26 guidance. Estimates were for 2 to 4%. Some like JP Morgan, I think Ambit, Kotak, some of them were at 1 to 4%. So at the lower end, it was about 1%. Will the company guide? That's question number one. And two, if they do guide, what will the number be?
Absolutely. And I think we'll have to see this closely. Mitesh, how's Infi set up? I mean, the index, the IT index itself is down some 25% this year. But things can obviously get worse depending on which way things are headed in commentary, etc. But technically, price-wise, what's the view here?
So, Prashant, few things. I think one, the IT index, as you rightly said, has been down significantly, and roughly about 33% from the highs, and now looking extremely oversold. So I think what I'm waiting for is some kind of reversal signal. I think I mentioned OFS today in the morning. I had a trading call over there that's trading about 1% higher. I think now is the time when IT stocks might give you a sign of reversal. Wait it out. I think see if there's some good confirmation coming on the charts. Then you might want to buy into Tech Mahindra, TCS, Infosys, etc. Only for trading bounce, but I think you're extremely oversold. So I would not be shorting them right now. Waiting for an hourly chart or 2 hourly chart to give me a buy signal and then trade for them.
A lot of price damage perhaps has already happened in IT stocks, and the bad news is known. Infi and Wipro, both of them have already sounded very cautious in terms of the commentary. So incrementally, is it going to get worse in terms of commentary and numbers? That remains to be seen. The street seems to believe that incrementally, perhaps, we may not get worse news. And valuations now are coming to long-term averages or pre-COVID levels. For TCS, in fact, valuation is below the pre-COVID level. For Infosys, it's at the pre-COVID level. Wipro is very close. Wipro pre-COVID was at 15-16 times. So Wipro is still trading slightly above the pre-COVID levels. But for large caps, Infi and TCS, valuations are back to pre-COVID level. The only problem is growth. Look at the growth estimates. Jefferies is saying TCS will grow at 2% from FY25 to FY27, and Wipro will grow only 0.7% revenue CAGR. For the last 2 years, Wipro has given you degrowth. If it degrows in the current quarter, in the current year, that's FY26, it will be the third consecutive year of negative annual growth for Wipro. So yes, valuations are also down, but there is no growth. But on the flip side, you can always argue that these are, cash-rich companies, dividend is coming, buybacks are happening. Wipro, for instance, their operating cash flow in FY25, that's last year, was about $2 billion. So, that cushions the downside.
Absolutely. Another one, Mitesh, which is buzzing, and let me just quickly go across to Hormuz, who's standing by, right? K Fintech is the company which is in focus today. They announced that it will going to pick up a 51% stake in Ascent Fund Services. Hormuz is here with what the street is making of this deal. It's come off a little bit from the highs. Hormuz, take it away.
divergent opinions coming in on this acquisition. There are bull case scenarios and bear case scenarios as well. We'll start off with Jefferies, where they are the ones that the bulls, their buy recommendation there, 1310 with a price target. They're saying that this deal will help their international expansion for KFin Tech, and it is also complementing their product suites. The deal valuations are attractive, but they are cutting their FY26 earnings estimate because of a cash outgo because of this acquisition, and of course the fact that the acquiring company, the company that they are acquiring, their margins are at a lower level as well. The bear case comes from two of them. Citi has a sell rating, an 830 price target. They're saying that they are enthused by KFin's incremental customer acquisition capabilities in the global markets, but the execution risks and talent retention will be the key monitorables going forward, and they have raised their target multiples to 36 times from 32 times to capture any potential synergy benefits from this deal. And lastly, Kotak too has a sell rating on KFin, a 1,000 rupee price target. Now, they're saying that this acquisition will allow stronger market presence in newer geographies for KFin, but the financial implications of the deal are less pertinent. Valuations are a constraint, and they would await a better entry point.
All right, Hormuz, thank you very much for that. You know, we'll get the opinion on KFin Tech from Mitesh and others in just a bit from now, but let's now cut across to my colleague Shireen Ban, who's in conversation with Indigo CEO Peter Elbers. Shireen, over to you.
On a good and tourism industry has been on a good run, and the hope is that things will continue. The momentum, of course, has been built up, and as we look at the new financial year, which has started, we are already seeing signs of the domestic move strengthening further. Of course, international at this point in time a bit uncertain given the escalation of the trade war. Back home, the big story, of course, emerging is Indigo. It has become the world's most valuable airline, with its market cap crossing $23 billion. To talk to us about Indigo's aspiration of being India's first global airline is Peter Elbers. Peter, always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back on the program. Let's start with India, and let's start with domestic travel at this point in time, still looking very, very strong. You know, as we start this new financial year, I know you can't give us specific numbers because you are in your silent period, but what's the mood in the market at this point in time?
Yeah, thank you. Thanks for having me here today, and it's a pleasure to speak to you always. You know, if we look about the development of the domestic market and we take the most recent published official numbers, and as you said, I cannot give any speculation about today's numbers since we're in that silent period. But for both the month of January and February, the DGCA data was released, and both of them actually had an 11% increase, which basically are very, very good numbers. So there was some slowdown at the beginning of 24, around the election time, there was some slowing down, but actually ever since, we can see a very solid demand and a very positive development of that demand.
Well, speaking of demand and speaking of positive developments, I'm just taking a look at the numbers. For your summer schedule, 14,158 weekly flights. That's much higher than the 13,050 flights last summer.
Yeah, you know, we keep adding and we keep growing. And for the financial year which is past, we announced a early double-digit growth. We have actually the same outlook for the next year. And for an airline of our size, today we operate a little short of 2,300 flights a day. You know, if you think about that, take a step back, we're welcoming every 3 days 1 million customers. You know, by the time this interview is over, we've welcomed another 7,000. So it just shows that the numbers are there and the numbers continue to grow. So our ambition really is to double towards the end of the decade. That's a long-term projection. But in the meantime, we keep adding these numbers.
Well, speaking of adding numbers, it's what, a plane a week at this point in time? That's the run rate that you're working with?
Yeah, that is still the runway. I mean, the last year, 24, we received 58 aircraft. And, you know, I think it gives a lot of pride to everyone at Indigo and probably India also. You know, the single largest taker of planes on the world, not the region, but the world, was Indigo. So here we are, an 18-year young Indian airline taking the highest number of plane deliveries from anywhere in the world, 58 planes. That means more than one a week we had last year. And our ambition is actually to continue that growth path well into the next decade.
Well, I know it doesn't directly impact Indigo, but let me ask you about what you make of China's decision not to order Boeing jets any longer. We don't know whether that will eventually happen or not, but how do you see that development?
that entire discussion today around the tariffs and that US China development, especially when it comes to aircraft, I think the world today is in need of having multiple suppliers when it comes to aircraft, and clearly Boeing and Airbus being the two largest. So I would assume that a resolution is found one way or the other at that point in time.
Well, speaking of finding a resolution for the capacity constraints that you're faced with, you are continuing to lease aircrafts. You've just leased 4 more from Norse. What's the plan on that front, especially as you have these big global ambitions?
Well, the Indian market is growing at a great rate. Despite our large order book, still some of the global supply chain challenges are really affecting us when it comes to delivering the capacity. So ever since this started to occur 3 years ago, we have taken a whole range of mitigating measures in terms of extending leases, getting temporary planes, doing some damp leases. All these things have really helped us to live up to our capacity guidance. Now we have ordered the wide bodies. So we have 27, the first wide bodies are coming in, and actually we don't want to wait for that. So as a bridging until that time, we started to damp lease 787s from Norse.
So does this give me a sense that the decision to not wait for the wide bodies and actually go in for leases is a way for you to accelerate and speed up your international expansion plans?
It surely is. The market is there. A lot of Indian travelers today don't have the opportunity to travel either direct or travel on an Indian operator. I think by us providing that capacity, there's an opportunity for people to start flying direct, or to, we have announced Manchester is going to be the first direct connection from Delhi into Manchester. That's great, both for the people in Delhi and actually India, and the people in Manchester. Amsterdam is the other destination we'll be starting adding, and there's more to come. And
so what more can we expect, at least as far as this financial year is concerned? How many more destinations do you intend to add?
Well, we will have the number of Norse planes going up from 1 to 4 in this year. We will start with the XLR. That's a very important development for Indigo. That will allow us to further stretch the range. We haven't disclosed yet which destination, which number, but let me share the following number with you to get a bit of an indication. When I joined Indigo 3 years back, we had like 25-ish international destinations. Today we're 40. And Fujairah has been announced as number 41. So that is in a time span of less than 3 years.
You've doubled.
We've pretty much doubled.
Yeah.
And of course there's an end to, you cannot endlessly double it. But India was so largely underserved, and the demand for the Indian consumers, ranging it from Karabi in Thailand to the Middle East to Europe, is just massive.
So coming back to specifics now, in terms of your international ambitions, because when we last spoke, you said you want to make Indigo India's global airline. So in the near term, what does that mean in terms of the number of people that you will fly on your international operations? What does that also mean in terms of your margins and change of margin profile?
The Indigo International Network, Shireen, is started some years back, very traditional, if you wish, between India and the Gulf and the Middle East countries. We've been slowly expanding that. So in 23, we started flights into Central Asia. We started flights into Nairobi. We have moved, and I had a meeting earlier this week with the CEO of Changi Airport. We moved from moving into Singapore from 3 Indian cities to 9 today. But that's still within that 5 to 6 hour radius. I think the next step for Indigo is to make sure that even Europe and further parts of Asia would be accessible directly, operated by Indigo. And if India is going to be the 3rd largest economy in the world by 27, the country needs and deserves actually an airline of the size and scale and potential of the nation.
So what is the indication and the timeline that you're working with in terms of the wide body deliveries because of the backlog that we're dealing with?
Just some numbers here. Today, we have ordered 30 wide bodies. The delivery start from 27. We don't want to wait for that. That's why we have the temporary bridging. We used to have around 25% of our available seat kilometers international. This year we're reaching 30, and we've put a projection out there to move that percentage up to 40%. So the foundation of who we are as Indigo will remain strongly and deeply rooted in India. We operate a little short of 500 routes in India itself, direct city pairs. That's the foundation of who we are, and that continue to be. Out of that 500, pretty much half of them are unique. So that provides suddenly air connectivity, connecting the nation, giving wings to the nation. But on top of that, that international dimension is being built. And 40% is the number which we put out there.
40% is the number. We're still waiting for your results to be announced, which will be sometime in May, so you can't give us specifics, but the street is working with estimates as far as what profitability for you could look like. It's been 9 quarters on the trot, with the exception of 1 quarter of positive bottom line for you. At this point in time, given where crude prices are and have come up very, very sharply, as well as demand, you're looking at significant tailwinds, I would imagine, aren't you?
Well, I think in another configuration, one would call that a leading question. As you rightfully pointed out, we're in a silent period, so I cannot give any indication.
Don't talk to me about numbers.
Looking back to what we have done, and I'm very proud what the Indigo teams really have achieved. In the middle of 22, we were exiting from COVID, and I remember joining at that point in time. We made a sort of small profit, but was very meaningful because it was actually, the dark days of COVID were behind us, and we started to emerge from that. And ever since, we have been building not only our network, our customer proposition, our profiling, but actually creating the margins to start investing in the future of the company. If you want to become a global airline, we should have a service, IT, digital tools, all centered around that.
So what does that mean in terms of investments over the next few years, whether it's on IT, we know what it is going to cost you as far as the aircraft is concerned, but just building out the ecosystem to be able to deliver to the promise that you've just articulated, what will it mean in terms of investments?
Well, there's going to be serious investments, and obviously fleet is the largest part of it. Next to fleet, it's people. This is the training center, and really very important part of Indigo is the people we have. It's also very much all our investments in digital. We start to invest heavily in AI. We were a bit behind that, but if India is home, we should invest to that, and we should actually lead that. So we have our own sort of AI center now building and working on.
Is there a number that you can share in terms of what you've invested so far on AI?
I don't have a number of crores, but it's multiple crores. Obviously, we're investing in that. And last but not least, it's not only our own investment, but also partnerships. So as recent as last week, we signed up a big partnership with Accor. So it's the first of its kind in India. And basically what we will be having now, that all our blue chip members can start using their points in staying in Accor hotels, and Accor members can using their points in flying Indigo. Accor is present in all our 40 international destinations. So what does it mean for an Indian consumer? You fly a lot domestic, you use your points.
All right, we'll accumulate those points as the CEO of Indigo says, but great conversation there. We'll get you more as we go along. But we have to take a quick commercial break here. Sanjay Parekh of Soham Asset Managers on the other side.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influential influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed.
Welcome back. Markets are looking very, very solid. Sanjay Parekh is founder and CIO at Soham Asset Managers. Sanjay, good to have you back in the program. Thank you for joining us. Suddenly it looks just like that. It looks different, right? That's the beauty of markets. And Bank Nifty is almost at an all-time high. Although mid caps and small caps, etc., are kind of taking a backseat today. Those indices are up only 0.5%. Frontline indices like the Nifty Bank, etc., about 2% gains. Nifty is up 1.5%. I was looking through what you own, and we've discussed many of these names. Some are recent additions as well. Not that many, but a few are, right? Which had a bit of a swoon, and they are coming back very, very strongly. Pondy Oxides is the name that I recall. But what have you been doing, Sanjay? Give us a flavor before we get into individual names.
So it's been a roller coaster ride, and at least at the lower end, and we sent you a note as well that we realized that at 22,000 that it's overdone. But in such a volatile and chaotic world, it's tough to call a bottom. But all our balance sheets really were in good shape. RBI was very supportive. We saw rate cuts, and certainly I think what's coming out is that on a relative basis we are much better placed in a global chaotic environment. And hopefully, it's tough to call. You all cover it so well that the China issue over a period of time should get resolved, because that will certainly will not be good for the world as well. So I think the recent discussions that we see that both of them slowly and steadily, it's still too far, they're too far away, but it should gradually resolve, and then back to sanity. At what levels they'll settle is yet to confirm. But I think markets are taking a hope that maybe things will get resolved soon. India, we were better placed, and I think this move, global FIIs, they started buying, possibly taking a cue that we are coming out to be quite a winner in this. Why we would be vulnerable on imports and dumping possibly from China, and export vulnerability also goes up, but we are definitely better placed in certain segment of EMS, or we see it as it comes in more sectors as well. And that is, I think, where this rally started, because we know that our earnings this quarter is going to be weak. But despite that, the only major reason I see is we are getting better placed within the world, and valuations in larger cap had got comfortable. That is at least my feel of what is happening in the market.
Hi Sanjay, good afternoon, good to see you in. Sanjay, most of exposures to large caps, if indeed the worst is behind, India is better placed. Do you think you look at at least keeping large caps as the highest exposure, but maybe incremental money going to mid and small caps?
Yeah, so always, last time also we discussed, we were never averse to mid and small cap. We only said that the margin of safety has to be higher. That is all. So we said that we will actually get opportunities in this carnage. And certainly, we added in a small way, but we did add one of them in small cap. So overall, we are still open to it. It's just that the environment in India is still tough in terms of earnings, and we need to have a higher margin of safety. So whenever there are opportunities, we are very, very open. We are overweight on large caps. The mandate is to have at least 70% large cap. We are today 77% large cap. But we are certainly open to looking at mid and small cap with a higher margin of safety.
Sanjay, hi, afternoon. Is IT approaching value zone to your mind for you to increase your exposure? Large cap or mid cap?
We've been now 3 years underweight, 6.5%. Of course, we got hit when the IT did very well in the last a few months, barring last month again it gave in. So, now the question what you're saying is absolutely apt, that we are also seeing that what is the implied growth and the current price. And now the implied growth is coming to be reasonable, at more like 5, 6, 7% long-term growth rate. But what is happening is the near-term pain also is there, and still we see the analyst estimates, they're still at 5, 6, and some of them are now moved down to 3, 4%. But in a low-growth environment, the return ratios are phenomenal, but growth is missing. So, how bad they can derate is even we are trying to question. In the last cycle, they did get further derated quite down. So we just watching it, remaining underweight. But at a point, you're right, there will be value, and one can act contra, and we are positively looking at it to reduce our underweight, but not now.
Okay. Sanjay, hi. Good afternoon. I was looking at your portfolio. I think you're going to have a fabulous weekend, right? Because for viewers, banks are 31% of the portfolio. Diversified financials are another 7.8% of the portfolio. And the party here has really begun, Sanjay, hasn't it? I mean, and you've got everything out there. Axis Bank, HDFC, ICICI, even IndusInd, SBI, you've got Bajaj Finance, Shriram Finance. So I think it's a big party weekend for Soham India.
Yeah, I think this week has been good. We did take our set of pain when they were underperforming. But banking, we had our conviction, and that's why we have an overall financial overweight. And we had this view of domestic overweight. And honestly, we didn't know it's going to be chaotic world. But all throughout, it was a domestic overweight, global underweight, which helped us. So be it transmission play, a telecom play, a tower, Indus Tower, or a power or utilities, or grassing through cement. All of it, or ports also, if the trade is going to increase from India, hopefully they'll also do better. So
Sanjay, my question, allow me to just quickly dive a little deeper into financials, because you have such significant exposure. Now, what is the story from here on? And you have everything, so you're absolutely fine. But if we try and narrow this down a little more, where will the earnings kicker acceleration, whether it's top line, whether it's margin, where will the kicker be felt the maximum? So where is the risk reward looking the best in financials?
The near term. The near term, as we know, the asset side repricing happens faster. The liability takes time. You will see actually pain on earnings in NII growth and NIMs. And with these 2 rate cuts, the repricing of asset side will certainly have a problem. But the other side is that when your repo rate cuts happens, the risk-free rate actually slowly edges down, and your price to book logically has to go up. So it's very logical, right? Interest rates going softer, your valuation has to go up. But for near term, yes, there will be challenge on growth. But structurally, I think, we have to see through this 1 or 2 quarters of pain on NII. And if you think the longer term, they're very, very well placed. It was always well placed, but it took some time before now it's starting. And the valuation, you see SBI even today is at 1.2 times, Axis is 1.4 times. You go up, SBI, even HDFC Bank after this move is 2.3, 2.4 times. ICICI Bank is 2.5. So when you see the Nifty, and then you see a clean book on price earning or price to book, they're still very reasonable. So we are positive, but having said that, near term, I think we will see some earnings growth challenge on NII.
All right, Sanjay, great conversation. Next one, we will get into some individual names here, but good run and a good showing. Thank you very much for joining us here on CNBC TV18. We'll take a quick commercial break here. As always, we get you a quick check on what's happening in dealing rooms. And dealing rooms, I'm sure, are buzzing. Deal chatter, of course, has been very, very high, as Nimesh has been telling us. So we'll do that in a bit from now, and some trading ideas as well coming up.
India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people.
Welcome back. Markets holding strong. Good time to get to D-Street chatter. Nimesh joins us to tell us exactly that. Nimesh, what are you picking up? The FIs have turned buyers for the last couple of trading sessions. And today the screen is looking good, but what are the flows looking like?
Nigel, today I think it's a bit of a surprise to me as well. I mean, it was not anticipated that we'll see this kind of a move. The Nifty is up almost 2%. The bank Nifty is up almost 2.5%. At least for private banks, the feedback is there has been flows for the last couple of days and delivery-based buying. So that's showing up in the numbers as well, right? If you dissect the FI data for the last few days, majority of the buying is coming to the private bank names, especially HDFC Bank, ICICI Bank and Kotak and also. Clearly, that is one space which is doing good and there is buying as well. Having said that, the screen is looking good today, but it's not like the broader markets have done well.
Yes.
Today, a lot of people are surprised as to what my portfolio has not done well, so to speak, where the Nifty is up 2%. So that's a kind of a day. It's largely driven by large cap stocks. So maybe you'll see a large FI number driven by flows into the bank stocks. Technically now, this is an important level to watch, 23,800. We're just about those levels. If we sustain and close about those levels, and if global market support us, you'll see further short-coming rally in the days to come. But clearly, this is one big resistance level to watch out. But needs to see, we have a long truncated weekend, so how global markets behave. But clearly, the buying seems to be largely biased towards the financial names.
Well, that's right. Nimesh, the last time around, we did a U-turn from around these levels, 23,850 or thereabouts. And it seems that we have things going for us. The FIs are buying. They're doing the reverse arbitrage in the futures market. And also, you have fair bit of liquidity in the domestic market itself. What about individual stocks? What are you picking up?
So, a lot of stocks are buzzing in the broader market names today. And the first stock on my list today is Restaurant Brands Asia, RBA. That's been buzzing on large volumes, up 7% last when I checked. Again, the buzz is that maybe a large family office has been accumulating the stock in the last couple of days. So that's the reason why RBI has been buzzing off late. Second couple of stocks where there is delivery-based buying today, Marico and Indus Tower, both stands out in terms of aggressive buying from larger FIs. So expect high delivery volumes on both those names today. The third stock is MQR Pharma. Again, up 6%. Volumes have picked up as well. Even in MQR Pharma, the buzz is that a couple of large HNI investors have been aggressively buying in the last couple of days, and hence that big move. And the last name is IRB Infra. In a market where there is so much of buzz in the broader market stocks, IRB is pretty much flat. And the reason is, for the last couple of days, there is very strong delivery-based selling happening at leading FIs. So it looks like some large FIs are looking to exit into IRB Infra at higher levels.
Thank you very much for that. HDFC AMC Q4 numbers up for you on your screen. Top line up 30%. Bottom line is up nearly 18%. The stock is higher by 1.7%. Mitesh is now back with us for a few last calls before the long weekend. Mitesh, would you hazard a trade now? Can't hear you.
Is the audio clear now?
Yes, go ahead.
So logically, you're taking good profits, and you would want to carry much long positions. But pharma still looks like a safe space to me. So I have Sun Pharma and Torrent Pharma as a BTST call. Torrent Pharma BTST can be taken with a stop at 32.35 for target of 32.80. And Sun Pharma is something which I would recommend taking a BTST position with a stop at 17.40 for targets of 17.70.
Okay, thank you very much for that. Enjoy the profits that you've made. Sudeep Bandyopadhyay is now with us, Group Chairman of IndiTrade Capital Now. Sudeep, quick word on HDFC AMC. Is this a stock that you like, and how do the Q4 numbers look at initial glance?
All the AMC stocks from a long-term investment point of view, I think, financialization of saving is happening in India, and it's happening at a rapid pace. And this trend is expected to continue for a very, very long time forward. So as far as, the AMCs are concerned, the well-performing AMCs with large AUM should definitely be looked at. HDFC AMC is, of course, a well-managed AMC with a track record of performance. The profitability also is good. So there is absolutely no problem for somebody to hold this for a long term, in their portfolio. If you are looking at short term, I think then you should stay away. But from a long term perspective, this is a good investment.
Okay, that's HDFC, AMC, got that point. The market's continuing to charge ahead, 23,845. That's where we are at. And by the way, Eternal, the erstwhile Zomato, is in lead position on the Nifty. Eternal's up about 4%. Bharti Airtel's having a stupendous run as well, almost 4% up on Bharti. So the financials is a consensus trade. Everyone knows that, you have to buy the banks and the NBFCs. Beyond that, this move on Zomato that we're seeing today, this is pretty interesting. What do you think of the stock?
I do like Zomato. In fact, there is Swiggy, there is Zomato. But if somebody has to buy one stock in this space, I think Zomato is the place to be in. There are some short-term pain because the Blinkit is scaling up. And while they're scaling up, their profitability is under pressure. But if somebody is looking at a long-term perspective, I think both the businesses, which is the food delivery business as well as quick commerce, both have significant potential and scope for expansion. Also, the District app, which they acquired for events, has a significant potential of scaling up. I think they will definitely be giving Book My Show a run for their money. So that can become a big money spinner for them as well. So I do like Zomato from a long-term point of view. But if you have the money and the investment capacity to expand the basket, then I will definitely recommend looking at Policy Bazaar as well.
Sudeep, Sonata kind of scared the mid-cap IT stocks with a revenue warning. So after TCS and Wipro missed, then you had Sonata saying that one of their largest clients, the revenue that they were anticipating from them will be lower. Analysts are saying so it's going to be a tough quarter for Sonata Software in Q4. Considering the base, any miss, any hit on one client, any project which gets paused will hurt them. Are you worried about mid-cap IT and the kind of earnings we might see, and any particular thoughts on Sonata if you look at it?
Well, absolutely, I'm worried. In fact, look at Wipro. I think they also commented that some of the projects are getting stalled. And this is bound to happen in the scenario which is currently prevailing in US. I think the US corporation, the CEOs and the CFOs are not sure about the future. And when they have this kind of uncertainty, they will definitely like to hold back on spending, cut down spending wherever possible, press the pause button. Now, this, from a Wipro point of view, I think still they can manage and move forward. And that's what pretty much we saw as far as their margins are concerned and other things are concerned. But from a smaller IT company, mid-cap IT company, these kind of challenges can pose a big threat. So I have been extremely cautious on IT, and I'm definitely more cautious on mid-cap IT compared to large-cap IT. There are so many of these companies, let's say Emphasis, they are dependent significantly on financial services. Now, if the US is getting into a recession kind of a scenario, the deal flow in US have slowed down significantly. Obviously, the financial services will also slow down. The new projects will not come. So you have to be very, very careful on mid-cap IT. And each of these companies needs to be examined individually. We need to, more than the Q4 numbers, we need to understand what they're talking about the future.
Okay, all right, got that. Sudeep, stay on. The weekend's going to be pretty busy when it comes to earnings because some of the biggest lenders are reporting numbers. HDFC Bank as well as ICICI Bank will be out with their Q4 performance over the next 2 days. We have Abhishek joining in with the key expectations. Abhishek.
Well, HDFC Bank has already given the pro forma business update, which shows that they had, on a sequential basis, one of the best deposit growth in last 4 quarters and one of the best loan growth that they had in last 5 quarters. So the key thing to watch will be the net interest margin, which is largely expected to remain stable or flat on a sequential basis. Last quarter, it was at 3.43%. Now, slippages can increase quarter on quarter. Analysts like Kotak Securities is estimating an annualized slippage ratio of 3.1% when compared to 1.4% in the previous quarter. Credit cost expected to improve on a sequential basis. Now watch out for the asset quality, which is expected to remain stable or improve. So analysts like DAM Capital estimate gross NPA ratio at 1.3% versus 1.42% in the previous quarter. Management commentary with respect to business growth will be seen closely. Our polls suggest an growth of 5.8% of YOY and about 0.4% sequentially. We are working with a profit growth of 3.3% YOY and about 1.9% sequentially. We also have ICICI Bank, which is going to report its Q4 FY25 numbers. The key thing to watch will be the business momentum. Now, Motilal Oswal estimates a deposit growth of 12.3% YOY and about 4.5% sequentially. They are expecting loan growth to be at 14.8% YOY and about 3.5% sequentially, which means that the credit to deposit ratio that can decline on a sequential basis, and hence net interest margin can come under pressure. So net interest margin is expected to decline YOY and quarter on quarter. Analysts like Kotak Securities is estimating net interest margin decline of 24 basis point YOY and about 10 basis points sequentially. Now provisions could rise on a sequential basis. Again, Kotak Securities is estimating credit cost to increase by 20 basis point on a sequential basis. Slippages can also rise marginally on a sequential basis. Kotak Securities is estimating slippage ratio of 2% versus 1.9% in the previous quarter. Asset quality expected to improve on a sequential basis. Motilal Oswal estimates gross NPA ratio of 1.8% versus 2% in the previous quarter. Watch out for management commentary with respect to business momentum going ahead. Our poll suggests an growth of 9.2% YOY and about 2.5% sequentially. We are working with a profit growth of 11.7% YOY and about 1.5% on a sequential basis. Back to you.
All right, Abhishek, thank you very much for that. So, busy weekend. HDFC Bank and ICICI both with numbers. HDFC Life will also be reporting earnings. So, let's quickly get a preview from Yash, who's joining in. Yash, tell us.
Well, HDFC Life Insurance to report its 4th quarter results today. And as far as the numbers are concerned, it's expected to be a strong performance when it comes to the top line or the premium collection which the company is expected to make, but margins are expected to remain subdued or muted. I'll come to the specific numbers. Total annualized premium equivalent or total APE, that is expected to see a growth of about 13%. The number that we're looking at is 5,343 crore rupees. Value of new business of VNB, again similar growth expected there, about 13.5%. The number that we're looking at here is about 1,400 crore rupees. As I said, margins are expected to remain muted. So just about 9 basis points improvement is expected in the margins. The number that we're looking at here is 26.19% as compared to 26.1% on a year-on-year basis. Now, 3 key takeaways or expectation in terms of the qualitative side of the numbers. The company, that is HDFC Life, is expected to be best placed in the sector when it comes to APE as well as VNB performance in the 4th quarter. VNB margins, as I said, could remain muted, and that is largely because of 2 reasons. One is higher share of ULIP, and the second one, a stronger growth which could come in as far as the group segment is concerned. The third one, if the numbers do come through as per what the street is anticipating, then the stock has a limited upside potential. That's because the stock has already run up in the last 3 months. It's up about 12% in the last 3 months, trading at 2.3 times FY26 price to embedded value.
Yash, thank you very much for that. Get into a break, the last one before we wrap up this week. And as we do that, good news for all our viewers, because India's business news leader is now just a click away. Introducing the CNBC TV18 all-new app, you can get instant access to our breaking news, in-depth articles, financial world updates at your fingertips. So download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you could just scan that QR code on your screen.
The iconic line from Top Gun, was there ever a moment in that phase where you were creating this movie-going experience where your father maybe told you that, son, you're writing checks that your body can't cash?
He made me cost conscious. He made sure that I didn't spend that kind of capex, that there'll be no returns.
A lot of the scale has been driven by way of M&A and acquisitions, and of course Inox was the big one.
Yeah.
What would you say have been the non-negotiable?
I think non-negotiable right from the beginning was to stick to the fundamentals. And I was really privileged to have somebody like Renuka and Vishal Mahadevia, who's Warburg Pincus,
yeah.
and mentors like Sunil and Rajiv Singh and so many people. Fundamentals, unit level economics. So when I was doing organic growth as well, location has to be right, the rent has to be right, developer has to be good, development has to be good. That was organic. Inorganic also, am I acquiring something which is going to be value accretive or value destructive? Is it an ego, vanity acquisition, or is it something that is missing in the current portfolio and is going to add value?
How it goes. So far, whoever we had committed, we have onboarded everyone.
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
Welcome back. Just 4 minutes to go before the day and the week winds up. We've still got Sudeep joining in. Sudeep, a lot of people will be very happy to finally see Reliance move higher. I mean, it's been a very long, patient wait for Reliance investors. What do you see ahead? I mean, levels of around 1270 on the stock today.
Well, I've been a bull on Reliance for quite some time. I think, there's a major value unlocking opportunity sitting there. Even performance-wise, they deserve a much better valuation. It was subdued, and there were a lot of selling in this counter because of multiple reasons. But as things stand, somebody taking a 6 months to 1 year view, I think 1500 can be the target as far as Reliance is concerned. Value unlocking of the telecom business is bound to happen. It's a matter of time when. Somewhere retail also will get unlocked. These two are big potential. Apart from that, the traditional oil to gas business also has started performing. There are multiple pulls and pressures on account of the global oil prices and the petchem prices. But in spite of that, I think we are expecting good set of numbers overall from Reliance in Q4 as well.
I mean, that's and absolutely, some visuals coming in. I think these are the shots coming in from BKC, where BSE is celebrating 150 years, and it's a historic milestone. Absolutely. I mean, of course, for the exchange, but for markets overall as well. The finance minister, by the way, is in the audience, and I think we should be able to cut across to the FM when she starts speaking as well. So, I mean, some of the stuff which is coming through right now. 3 minutes to go for close. Maybe I can just quickly start wrapping up things before anything. By the way, interesting moves, and I was just looking at stocks which have moved this week. And of course, we were talking about all the big ones. But there was SW Solar, a completely bombed out name, which came up about 16% this week. Actually, if you can have these intradays up for the week, it'll give you a quick sense. So SW Solar, 16% move this week. GMDC with about a 16% move this week. Intellect about 15%. Delivery 14%. There was Home First 13, NTPC Green 13. A name like MCure was up 19%. And of course, I mean, there was Fact, which was up about 22%. I mean, but that's lesser traded and not that tracked as well. So these are some of the big movers in the broader space. And of course, I mean, as far as the larger space is concerned, it is the IndusInd and the Axis and the ICICI, Shriram Finance, Geo Finance, etc., which really did very, very well. And for the week, by the way, there was only one loser on the Nifty, Wipro, which is down about 1.5%. I think bulk of the damage, of course, coming in today. So that is short and sweet 3-day week that we've had so far. Not very much by way of recovery from the day's low. The absolute low, of course, was made early on in the morning. Did you track this one at all? Have you looked at it? SW Solar, Sudeep?
Not really. In fact, this is some of these stocks we don't track, so I won't be able to comment on this. But overall, I think there are a lot of interesting things happening on the solar power and the green energy segment. And things can be looked at from a long-term perspective. Leave aside what US is doing, but as far as India is concerned, there is still significant opportunity and potential for solar energy. Overall, the value chain, whether you are a battery manufacturer, whether you are a contractor, whether you are an energy producer, I think the upside is significant over the next few years.
I think in the last 10 months, stock went from 800 to 200. And it's a Reliance company, by the way. It's now back to about 290. So swift recovery from the lows, but of course, I mean, the damage has been quite a bit. Sudeep, thank you very much for joining us. That's the close which is coming through. Nifty about 1.7% higher, and a phenomenal day, really, led, of course, by banks.
Well, Bharti Airtel also catches your attention. 3.25% higher for the day. In the last 1 year, Bharti Airtel is up 54%, and in the last 3 years, it's up 150%. So it's really been a defensive stock in the face of all the volatility, and stock 150% in the last 3 years. And today, Bernstein raised the target price further to 2020 as they anticipate another round of tariff hikes in November and December. But the gainers on the large cap screen, ICICI Bank, Bajaj Finserv, Kotak Mahindra Bank, State Bank of India, SBI Life. So the gainers list is full of banks, financials like insurance, AMCs across the board. Other than that, Reliance Industries was a big mover. Reliance Industries today, with its 2.6% up move, crossed the 50 and the 100-day moving average. So that's a big gainer. On the way down, you had Wipro, 4% lower, top loser. Tech Mahindra ended in the red. Hero MotoCorp, where the company's announced that for 3 days, 17 to 19, there will be a production shutdown to align with the supply chain. So Hero MotoCorp ended down 0.25%, BPCL, Hindalco, JSW Steel, Coal India, some of the other large caps ending in the red.
Absolutely. Quite a day for mid-caps today. However, just to point out some movers and shakers, you've still got names like KFin, 5.5% higher, Cello World, 5% higher, Vijaya Diagnostics, about 5%. And some of the small finance banks have done really well. Jana Small Finance Bank, Equita Small Finance Bank, and Ujjivan Small Finance Bank. All of these stocks up almost 6 to 7%. Overall, a solid week for the Indian equity market. Well, that's a wrap, but stay tuned because we have Editors Roundtable coming up next.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Besant has already said that we will, the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea and India. I was very intrigued to hear that.
Stock markets are recovering from the tariff jolt across the world. The Sensex and the Nifty are up over 4% this week, the biggest weekly gain in 2 years. The Wall Street is now back to levels seen in January of 2025, before Donald Trump assumed office as the US president. So is this recovery sustainable? What next? Well, you're watching Editors Roundtable. I'm Surabhi Upadhyay, and with me as always are Prashant, Nimesh and Nigel. And today joining us on the show would be Harish Bihani, Senior Fund Manager at Kotak Mutual Fund. But guys, what a super week. 3 days, turbocharged, and the bulls are back.
Bulls are back, and how? You know, I mean, from the lows, Nifty's up 2,000 points, and nobody realized. I mean, everybody was, cautious, careful, not committing capital, and so we are back to 23,800 from 28,800.
Phenomenal.
So, phenomenal
and
move.
I think the consensus mood also, just this last weekend, it's not as if there was no big teasy mood or anything. People generally were all, chalega, dhire chalega, but
one needs to be careful, cautious.
Just this weekend. And 3 days, markets are up. Bank Nifty is up 6.5%. Nifty is up 4.5%.
And look at today's market. We have a 3-day long weekend, right? A truncated week. And on a day like this, the Nifty to close 2% higher, Bank Nifty to close 2.5% higher. When we know that there's going to be a 3-day holiday and we don't know what's going to come from the global market, that's to my mind was a big surprise today. Nobody expected such a move today.
The other thing is gold, right?
Yeah.
I mean, I was thinking gold last night was up 3%. I mean, that is 3% on gold after such a large move. It's a safe haven. And you need safety when there is risk everywhere else.
But equity and gold both moving together.
That's the thing.
That's a surprise.
It's been absolutely phenomenal. And let's not forget flows. I mean, the FPI flows are back. Large caps are dancing, and the party, for now at least, seems to be on.
Well, that's right. And you have that benefit, right? Because the FIs were net short. And then, in fact, you have them showing us the money in the cash market as well. Always feels good. And I'll tell you what, earlier we went to 21,900. Then we saw a 1,000-point rally. And everyone says second dip is coming. Second dip came. And people said, no, now we'll get a further dip. I don't know whether that's coming or not. But, you clearly missed out if you're sitting on the sidelines. And I think, those monthly installments should keep going, because then you get the best entry point, I think so.
Absolutely. Okay, so what we'll do is I'll quickly recap in numbers what we've been discussing, and then we'll straight away get to the conversation with our guest. It's been a solid showing, like we're talking about it. 3 days, and look at this. The Nifty has not only recovered all the losses from the 2nd of April, it's actually trading 2.5% above that level. 23,800. I mean, this is what we're talking about. And on Thursday, which was the last trading day of the week, the Bank Nifty was just shy of hitting its all-time high. So this is how it's been. India, by the way, is leading this global recovery. If you look at price moves across the last 5 trading sessions, X of all the holidays, just 5 trading sessions. Then China, Shanghai Composite is up about 2%. The Japanese market also recovering, but more measured, 1.3, 1.4%. The US market is still struggling because of the up and down. The S&P 500 is down about 1.5%. And look at the Nifty, 5 trading sessions, 6.5%. That's the kind of impetus that we're talking about. Now, this recovery is definitely backed by FPI flows, because we've had a couple of very large days in between. One of the days, it was 6,000 crores of buying. Another day, it was over 3,000 crores of buying. And it's really showing up in large cap stocks, particularly in the financials. They have taken on the leadership mantle, and they're making sure that while IT is faltering with a lot of questions, the market itself is running higher and higher. So for the week, the Nifty Bank, 6.5%. Nifty Private Bank, almost 7%, and Nifty Financials, go beyond the banks, go look at the non-banks and the NBFCs. Even this index is up about 6.2%. As a contrast, Nifty IT is up 1.6%. Actually, no sector has ended negative this week. IT is the least performing, but even there, the gain is about 1.6%. What are we looking forward to? Well, we'll definitely be looking at the earnings over the weekend. Infosys, HDFC Bank, ICICI Bank, earnings continues to drive the market action from here. FPI flows, will we keep getting in those big 4-digit buy numbers or not? And last but not the least, we can't fully ignore the global headlines, right? Because a lot is still up in the air. And next week, we'll have the US Vice President, J.D. Vance, in town, not particularly in Mumbai, but he'll be in Delhi and in Agra. And the market will watch out for any clues on the progress in the India-US bilateral trade agreement. So plenty to keep us busy next week.
Plenty and more. Let's bring in, I think, Harish Bihani, who's with us, Senior Fund Manager at Kotak Mutual Fund. Harish, good to have you with us here. Thank you for joining us. We are the big market, the first major market to get back to pre-tariff levels. Nifty Bank is almost at new highs. What are fund managers across schemes at Kotak been doing? Give us a sense.
No, it's amazing what's happened over the past few weeks and months. And if I had told you, Prashant, say about a month back with the benefit of hindsight, that there'll be a significant US tariff across the world and how will markets behave, in all likelihood, your and all the other answers would be the market would correct fairly sharply. And here we are at this point in time where markets are up about 6-7% from about a month back. If I had told you again about a month back that if this happens and then US dollar will go down, US bonds will go down, and US equities will go down, and how will Indian markets behave? And again, we would have got a fairly similar answer that Indian markets will come off. So we have fairly interesting times. The entire narrative that is getting built up is that US exceptionalism is over. And with that, a lot of financial capital that used to move to US will look to go to other emerging markets and other markets, which are growth markets, better return on equity markets. And that particular narrative is gaining prominence as we speak. Very, very early days. I think that this is a long way to go. Still, despite all the impact that India too will have in the near term with regard to growth slowdown. If global economy is slowing, India will certainly see a growth slowdown. We'll see earnings cut in the coming earnings season. So we'll certainly have a lot of impact in the near term. Is market looking beyond the near term and thinking about medium term? We'll need to see very, very early days. But we should be prepared for earnings cut and slower growth in the coming quarters.
Well, that's right, Harish. And if you look at it, quarter four is not going to be anything great, in terms of earnings. So it appears the street is looking ahead. I guess the commentary could be positive because of the kind of capex, push that we have seen. The RBI rate cuts as well will help our costs, particularly for the latter part of this fiscal. But Harish, I wanted your view on banks as well as financials. First, I just wanted to, brush through what happened in the past week. The Nifty bank financials, well, they were really the ones that took this market higher. You have the FI flows that are coming back in. Remember, most of the holding of FIs is in banks and financials. So when the flows come in, it obviously helps the Nifty bank. And that's why now the Nifty bank was a couple of 100 points away from the fresh all-time highs. Besides that, you also had the RBI governor when he cut rates. He was sounding very, very pro-growth. That definitely helps sentiment as well. But there were two big factors that played out in this week. HDFC Bank, they went ahead. They cut rates by close to around 25 basis points. Remember, it was at around 3%. They brought it down to around 2.75% on. They had some cushion out there because the other big lender was SBI. They were already sitting at around 2.7%. So that's why they had a bit of a cushion. So even after this cut of around 25 basis points, it's more or less similar between both these two. Macquarie says because of this cut, well, the cost of deposits goes down a little bit. And that's why they're saying NIMs could go up by around 5 basis points. Remember, that's one of their biggest overweights Macquarie, the sell side report had mentioned. Well, the other big cue was IDFC First Bank. Nimesh had alerted us there's likely to be some kind of infusion. There's likely to be some kind of preference. And that's precisely the way it played out. They said they're going to be meeting for a preference issue. They have issued close to 7,500 crores or two marquee names. You had Warburg as well as Adya coming in there and pumping in close to around $1 billion or thereabouts. Now, how does this change things? Well, rough calculations suggest that the net worth goes up by close to around 20% or thereabouts. And we had a chat with Mr. Vaidyanathan, and he said that in fact, the capital adequacy ratio will go up by around 300 basis points or thereabouts. You have equity dilution to the tune of close to around 15%. And he's saying there will be better times to come. Profitability is something that he's focusing on with better return ratios in the times to come. So clearly, those are the big two talking points. Lowering, the deposit rates as well as the preference issue to IDFC First Bank. Harish, how do you read this? Big funds coming in there, signing $1 billion check for a private bank. Well, that definitely gives you some kind of confidence. How would you view this, and how does this change things around? There'll be a couple of other banking names in there that are trading at similar valuations as well. So do you think interest will go up from here?
I think we are cautiously optimistic on the banking names. And I was speaking to someone yesterday and we were discussing that is the narrative catching up with the fundamentals, or will fundamentals improve significantly from here on? Clearly, it's more of narrative at this point in time, because if you look at there are positives and negatives, maybe the negatives outweigh the positives at this point in time. First of all, as we spoke, if you look at the global growth, we'll certainly see weaker global growth in the coming quarters. And weaker global growth will flow through to the Indian market too, and which will have an impact on the overall credit growth. Second is that large banks will have NIM pressure from a repo rate cut. So if there is weaker global growth, it will lead to higher repo rate cut, about a 75 to 100 bips. Some people are expecting even higher. Let's assume a 50 to 100 bips, which should also lead to a NIM contraction, all else being equal. People got excited by a 25 bips SAR cut, rate cut, but that will not do much. Finally, what we'll all have to look at is whether the core deposit rate cuts is happening or not, which is clearly not happened at this point in time. It's happened in some one-off schemes, but the core deposit rates are still similar versus what it was a couple of months back. So that is what we are watching at this point in time. Narrative is playing up much more versus fundamentals. When you look at the positives, I think from a positive, we're clearly seeing that the RBI has clearly indicated both with its intent, and it's already reflected in terms of the overall liquidity improvement, whether you look at open market OMOs or whether you look at many other measures that have been taken. We have a couple of more measures which will help improve the liquidity. First, in May, we'll have RBI dividend coming through. Most market participants are expecting a 2.5 lakh crores of RBI dividend. Second is we are expecting the central bank spending to improve in the coming quarters. That should also improve liquidity in the system. Third is that despite the entire global volatility, rupee has behaved very well, and that also has a bearing on how and will RBI intervene in the currency market or not, which has a bearing on liquidity. So liquidity has certainly improved, which has helped the overall narrative. On average, I think that valuations have moved up for private banks, and maybe with the catch up that has played out over the past 1 month, we'll take a pause for the time being.
By the way, I just want to say, guys, Donald Trump has woken up.
Oh, is it? Has it tweeted something fresh? And he's going after Powell now.
So
he wants the rate cut, or Powell has to go.
Even earlier he said, right, don't play politics and all that. It's time to cut the rate.
That's
What
not
is
the
he saying
important
now?
point. The point is it is 3:30 in the morning in Washington. And he's up and he's tweeting. They says the ECB is expected to cut interest rates for the 7th time, and yet too late, Jerome Powell of the Fed, that's the nickname, I think, who's always too late and wrong, yesterday issued a report which was another and typical complete mess. Oil is down, groceries are down, US is getting rich in tariffs. Too late should have lowered interest rates, like the ECB long ago, and he should certainly lower them now. Powell's termination cannot come fast enough.
Ooh, that last line. I mean, it's just so much for the freedom of central banks and monetary policy makers.
I'm just thinking, it's 3:30 in the morning. But I think as Trump famously back in the 90s, I think on the Oprah show, back in the 90s, he once claimed that he said, I don't need too much sleep. I'm built different. So, I mean...
And market participants are just kind of bracing themselves for the open. But yeah, it's really incredible. I mean, Harish, just come in on this. We're talking about, of course, the Indian market recovering and rejoicing, and we want to go back to looking at earnings, our own domestic issues. But this worst of the global volatility, do you feel that this at least is over?
Very difficult to say, but given the noise that was created post April 2nd, market participants are presuming that we'll see some kind of relief in the coming quarters. On average, we'll see more deals, tariff deals. We're already talking about early deals with Japan, with a couple of other countries. So the noise will keep reducing. And as we see some deal signing, hopefully better sense will prevail and we'll come to a normalized tariff, which is win-win for both the parties concerned. So that's very, very important to see, because Fed finally, we were speaking about Fed a couple of minutes back, Fed can't do much if there's a scenario of stagflation in USA, right? So we'll need more help from Trump and his team to ensure that global market stabilizes, and then we'll have to see how it impacts growth, earnings outlook, and take a call on both the Indian and global markets.
Okay, all right, Harish, stay on. We've got Nimesh with some analysis. Nimesh has been looking at some of the leaders in individual sectors. So what is this analysis showing up?
So I was just looking at some data, and if you look at the stocks which have hit all-time highs this week, all are sector leaders within those sectors, right? So if you look at, say, Indigo has hit an all-time high, leader in aviation. HDFC Bank, the leader of banking, has hit an all-time high. Eicher Motors in autos has hit an all-time high, and so is Bharti Airtel in telecom. So all 4 leaders, 5 leaders within the space have done an all-time high. But that's not the story. The story is within the sectors itself, there has been a stark difference between the leaders and the peers as well. I'll just identify within those 4 names, right? Look at Indigo. Y2D returns. Y2D, the Indigo stock is up 15%, whereas SpiceJet, even after the fundraise, is down 12%. So that's the kind of divergence we've seen within the aviation stock. Second stock is Bharti Airtel. Y2D, the stock is up 17%, whereas Vodafone Idea is still down 10%. HDFC Bank, Y2D, the stock is up 6%, and Bandhan Bank is down 1%. And so is the case with Eicher Motors. The stock is up 16% Y2D. At the same time, Ola Electric is down 41%. This is the Y2D data. But even if you look at a longer period, say 1 year period, that gives a similar story. The leaders have actually outperformed in this market. Indigo in last 1 year is up 47%, whereas SpiceJet is still down 20%. Bharti Airtel, everybody's chasing the Vodafone story and AGR and whatever. Bharti Airtel last 1 year is up 47 versus Vodafone Idea down 45. So the alpha is almost 90% if you're in the right stock in the right sector, right? So that's the story there. HDFC Bank, the stock, Y2D, the stock is up 27. Bandhan is still down 8.5%, 9%. And even in Eicher Motors, Y2D, the stock is up 30%, whereas Ola Electric, which all the fanfare, is down 34%. So even in auto, the alpha could be as high as 70% if you're not in the right stock or if you have to be in the right stock. So what is the key message? In uncertain times, normally the market seems to chase the leaders or hide with the leaders. So that's one big message. The other is, it's a very old saying, the turnarounds rarely turn. A lot of people bet on this turnaround stories like SpiceJet and Vodafone, but the fact is if you stick to the leaders, you normally make a lot of returns. So that was a key message. I was just looking at not all-time highs which have hit the stocks, but within those sector leaders, it's definitely the sector leaders which have outperformed the peers in a very big margin, especially in these uncertain markets.
Okay, so the big boys are standing up tall and they're shining bright.
Absolutely.
All right, interesting observation. We do have to take a very quick break, but we'll come back on the other side and continue this conversation.
Always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others. And then we want people which are friendshore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that in a sense for them. So in that context, the way they're laying out this new chessboard, I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really...
Okay, welcome back. You're with us here on Editors Roundtable. Harish Bayani is with us. Harish, that interesting piece which Nimesh put out, right? And that message is clear. You in uncertain times, you want to bet on a proven thing, a certain thing. And the number one player in each of these 4-5 sectors which Nimesh pointed out has done far better. Even though as people have tried to do a little bit of this, a little bit of that, trying to see if something works out, buy cheap, etc. It's not really worked. It rarely works in that sense. Any thoughts, Harish?
No, absolutely. It's very simple, Prashant, that if you look at post-COVID, there was a lot of mean reversion that happened in many, many weaker companies. And why does that mean reversion happen? Because the previous sins of the past cycle that you had done got cleansed, whether it's the banking sector or any other sector that you take into consideration. Once that past sins have been cleaned, you start with a fresh slate. And you start seeing an earnings improvement. And your earnings improvement from a low base looks so good that markets start getting excited. So that entire trade played out over the past few years. We've come to a point where that mean reversion trade is over And which is why people talk about that value trade versus the growth and quality trade. It's very simple that value trade has already happened. It's more about growth, more about quality at this point in time, because the mean reversion that happened in the past won't play out in the future. And that's the very reason why all the names that you showed, whether it's the top banking names, top telecom names, or in any other sector, the leaders are going to take more prominence. And that will help happen across sectors, across companies as we go ahead.
Okay, all right, Harish, take that point, and thank you very much for joining in with the perspective on the market and the recovery that we have seen today. Thank you very much for being with us. So the good news, guys, is that the tweets are coming and the Truth Social posts are coming, but our market is shut for the next 3 days.
3 days.
So,
We just have to relax for the next 3 days.
And I think Nigel has some big plans, especially on Sunday.
No. Oh, yeah.
Easter Sunday.
He lost 5-6 kgs of weight.
So what's happening on Sunday? Where's the party?
So, yeah.
I'm feeling healthy, so I'm wondering whether I'm going to go party or not. But
we'll find out. I'll call you.
Good to lose some weight. But markets have been good. For the European markets and for Western world, they'll be shut actually for a longer weekend because they have Easter Monday as well, holiday. So I'm off. All the best to you guys.
We'll deal with Trump on Monday.
I think Trump on Monday and Nigel is back on Tuesday, right?
Yeah.
So, yeah, I mean, enjoy that one, Nigel. I think we'll wrap up things here on this edition of Editors Roundtable. More news and updates follow on the other side. Stay tuned.
So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. You know, how many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth, because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain in a sense. Even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning and then you can start making your own product. Because we were just not in any of these global supply chains for so long.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty gained 4% this week as stock markets attempt to recover from the tariff jolt. This is the biggest weekly gain in 2 years, with major indices trading near 4-month highs.
Markets are struggling with a lot of uncertainty, and that means volatility.
Fed Chair Jerome Powell delivers a stark warning on Trump's tariff war, says the policies are slowing growth and pushing inflation higher. Plays down hopes of any intervention by the central bank. Trump hits back, saying Powell is always too late and wrong. Wall Street ends lower after Fed chair brushed off chances of a Fed intervention. Asia breaks ranks from US. Gains in trade. Europe opens lower ahead of ECB policy decision. Gold prices hit a fresh high as safe haven buying picks up. Capital cushion for IDFC First Bank private equity investors. Warburg Pincus and Abu Dhabi Investment Authority to invest 7,500 crore rupees into the bank and pick up a 15% stake.
This is the year that ChatGPT goes from answering questions for you to doing things for you in the real world.
OpenAI is betting big on India. Chief Product Officer says India is the company's second largest and fastest growing market. Active users in India have grown threefold in 2024. That's an exclusive. Supreme Court stopped short of staying the Waqf Act after an undertaking from the government. The centre will not make any new appointments or change the status of the current Waqf properties. Government gets 7 days to file a response to a batch of petitions challenging the new legislation. Mamaearth's parent Honasa scores a legal victory over rival HUL. Delhi High Court orders the takedown of a Lakme ad, which Honasa claimed was disparaging. HUL will make changes to the existing ad and not press a lawsuit against Honasa in Bombay High Court. All right, let's start with the market action. Stock markets in India and around the world are recovering from the tariff jolt. Sensex and Nifty gained nearly 2% today. Bank stocks led the rally, with the Nifty Bank Index gaining over 2%. Mid-caps fared slightly better than the blue chips. Nifty gained 4% this week, the biggest weekly gain in 2 years. Nifty Bank Index gained over 6% and the Real Estate Index gained 7%. This week, the markets are shut tomorrow on account of Good Friday. Prashant Nair is here with the market wrap.
It was a short week, only 3 trading days, but it was a punchy one. I mean, the number of days, the sort of lack of them did not stop the market from notching big gains. And, instead of sort of wrapping up what happened today, I'm just going to run you through the week per se, because, we've done quite a bit. The Nifty Bank, as of today's close, is almost at a new all-time high. We were about between 30 and 40 points away from reaching a new all-time high. This week, the Nifty Bank is up 6.5%, by far the biggest winner. The Nifty is not very far behind, but it's up 4.5%. There's only one Nifty stock in the red over the last 3 sessions from last Friday's close. That is Wipro, which is down about 1.5% or so. And of course, the broader market, the mid-cap index is going to end about 4.5% higher, the small-cap index with about 4% in just 3 trading sessions. So that's the kind of a week that we've had. The big winners this week coming through on the Nifty, at least to begin with, IndusInd Bank, all financials. IndusInd Bank, 15% gain. There was ICICI Bank, which was up 7%. Axis Bank was up 11%. Shriram Finance was up 8%. And Jio Financial Services, about 7% gains as well. There were 1 or 2 other names from other sectors, but the bulk of it, of course, was all banks and financial services. Broader market, mid-caps and small caps. I looked at the NSE 500 list, and this is what came up. Fact, the fertilizer company, 22% this week. Mcure, 19%. SW Solar, big absolute sort of, the stock's been beaten up no end. 16% over the last 3 sessions. GMDC, Intellect, Delivery was up 14%. Home First 13, and NTPC Green was up about 13% this week. But this week was, of course, about large caps more than the broader markets, really. Markets, of course, are going to be on headline watch, but next week as well, you're going to be coming out from a 3-day weekend. It's the Good Friday weekend, so Friday to Sunday. Many markets are shut on Friday, US, India included. So that is one. US-Japan negotiations. I mean, first off the block in terms of talks, Trump has said that he's going to join them, and that perhaps should provide us with the template of where these negotiations go. Markets, of course, will watch for any hint, however small, of China or the US initiating or showing their willingness to talk, because that's the big one. And of course, I mean, here in India, you'll have the US Vice President J.D. Vance and his family in town. And I think, there will be talks and a lot of excitement around that visit as well. So I'm not going into all the numbers, etc., which are going to be reported. And that, of course, is bread and butter. But some of the important stuff as we come back after a 3-day weekend. Back to you.
Right. Thank you, Prashant, for that. Moving on, US Federal Reserve Chair Jerome Powell has played down hopes of any intervention by the central bank to temper the market volatility. Speaking at an event in Chicago, he said that the markets are dealing with a lot of uncertainty and are still orderly and functioning as expected. He, however, said that US tariff policies are slowing growth and pushing inflation higher.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And, it's really the policies, particularly the trade policy. And really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function.
Now, US President Donald Trump has responded to Powell's comments. He wrote on Truth Social that Powell was always late and wrong. Powell downplaying hopes of a Fed intervention and mounting tariff worries weighed on Wall Street as well. The S&P and Dow Jones closed the day with losses in the range of 2%. The tech-heavy Nasdaq ended down 3%. Down 19% of its December high, pushing it closer to bear market territory. Asia, however, broke ranks with Wall Street. All frontline indices gained in trade amidst US President Trump claiming big progress in trade talks with China. Europe opens lower ahead of ECB policy decision. Now, Fitch Ratings has revised its growth forecast for India and the world, citing concerns over a severe escalation in trade war. The ratings agency, in an update to its global economic outlook, has lowered India's FY26 GDP growth forecast by 10 basis points to 6.4%. Fitch has warned of ripple effects from trade disruptions and policy uncertainty. It expects world growth to fall below 2% this year, excluding the pandemic. This would be the weakest global growth rate since 2009. USA's annual growth is expected to remain at 1.2% for 2025, but China's growth is expected to fall below 4%. Fitch also said that it was hard to predict the trade policy of the US under Donald Trump with any confidence. Now, Commerce Minister Piyush Goyal met a delegation from Starlink to discuss the satellite internet service providers' existing partnerships and investment plans in India. The meeting comes as Starlink is awaiting approval for its satellite communication license. The government has already granted license to Starlink rivals OneWeb and Geo Satellite Communications. However, it is yet to finalize spectrum allocation rules. Private equity investors Warburg Pincus and Abu Dhabi Investment Authority have inked a deal to buy stake in IDFC First Bank. Affiliates of Warburg and ADIA will pick up 15% stake for 7,500 crore rupees. The board of IDFC First Bank has approved the investment. IDFC First Bank has more than 970 branches and a deposit base of over 2.2 lakh crore rupees. Warburg's affiliate will invest over 4,800 crore rupees for a 9.8% stake. Abu Dhabi Investment Authority's wholly owned subsidiary will invest over 2,600 crore rupees for 5.1% stake. The deal is subject to regulatory and shareholder approvals. The bank's CEO, Vedyanathan, said they needed capital and he reached out to the PE investors.
I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, then we pitched the story. We told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time. So they felt excited to come again.
Right, the big news maker today, Indigo's CEO Peter Elber says the airline hopes to double its fleet size by the end of this decade. Speaking with Shireen Bhan, Peter Elber's laid out the blueprint for the expansion plan. Take a look.
So our ambition really is to double towards the end of the decade. That's a long-term projection, but in the meantime, we keep adding these numbers.
Well, speaking of adding numbers, it's what, a plane a week at this point in time? That's the run rate that you're working with?
Yeah, that is still the runway. I mean, the last year, 24, we received 58 aircraft, and I think it gives a lot of pride to everyone at Indigo and probably India also. The single largest taker of planes on the world, not the region, but the world, was Indigo. So here we are, an 18-year young Indian airline taking the highest number of plane deliveries from anywhere in the world, 58 planes. That means more than one a week we had last year. And our ambition is actually to continue that growth path well into the next decade.
Well, I know it doesn't directly impact Indigo, but let me ask you about what you make of China's decision not to order Boeing jets any longer. We don't know whether that will eventually happen or not, but how do you see that development?
That entire discussion today around the tariffs and that US China development, especially when it comes to aircraft, I think the world today is in need of having multiple suppliers when it comes to aircraft, and clearly Boeing and Airbus being the two largest. So I would assume that a resolution is found one way or the other at that point in time.
Well, speaking of finding a resolution for the capacity constraints that you're faced with, you are continuing to lease aircraft. You've just leased 4 more from Norseed. What's the plan on that front, especially as you have these big global ambitions?
Well, the Indian market is growing at a great rate. Despite our large order book, still some of the global supply chain challenges are really affecting us when it comes to delivering the capacity. So ever since this started to occur 3 years ago, we have taken a whole range of mitigating measures in terms of extending leases, getting temporary planes, doing some damp leases. All these things have really helped us to live up to our capacity guidance. Now we have ordered the wide bodies. So we have 27, the first wide bodies are coming in, and actually we don't want to wait for that. So as a bridging until that time, we started to damp lease 787s from Norseed.
So what is the indication and the timeline that you're working with in terms of the wide body deliveries because of the backlog that we're dealing with?
Just some numbers here. Today, we have ordered 30 wide bodies. The delivery start from 27. We don't want to wait for that. That's why we have the temporary bridging. We used to have around 25% of our available seat kilometers international. This year we're reaching 30, and we've put a projection out there to move that percentage up to 40%. So the foundation of who we are as Indigo will remain strongly and deeply rooted in India. We operate a little short of 500 routes in India itself, direct city pairs. That's the foundation of who we are, and that continue to be. Out of that 500, pretty much half of them are unique. So that provides suddenly air connectivity, connecting the nation, giving wings to the nation. But on top of that, that international dimension is being built.
SEBI Chairperson Tuhin Kanta Pandey has urged corporates to move beyond a mindset of minimum compliance and embrace maximum governance. His remarks come after SEBI uncovered financial irregularities at Gensol Engineering, raising fresh concerns about corporate accountability and oversight.
What we can do about effective self-regulation by entities. We need to move from a thinking of minimum compliance to maximum governance. Boards must rise above routine and ask difficult questions, and auditors and independent directors must act as gatekeepers of integrity.
SEBI's internal committee is set to review a no-objection request from the National Stock Exchange for its IPO. The exchange has submitted its response to the concerns raised by the regulator, including on executive salaries and ownership structure of the clearing corporation. SEBI Chief Tuhin Kanta Pandey said that the regulator will try to take a decision on this matter as soon as possible and will prioritize public interest. Yash joins us with more.
Well, just last month, that was on March 28th, the National Stock Exchange or NSE had filed for an NOC with market regulator SEBI for its IPO proposal. An NOC or a no objection certificate is a precursor which enables the National Stock Exchange to go ahead and file the DRHP when it comes to its IPO. Now, what we've been given to understand from SEBI is that an internal committee at market regulator will look at NSE's proposal when it comes to this no objection certificate. Last time when this NOC was filed, there were certain concerns also with market regulator SEBI had flagged when it comes to, it requiring the resolution to those concerns. These were salaries of the KMPs of NSE, technical glitches, resolution of ongoing cases around co-location, also ownership of the clearing corporation. NSE, as a part of its NOC document, had submitted resolution or addressed all these concerns which market regulator SEBI had pointed out, and that's what SEBI's internal committee is expected to do, which is to discuss all these resolutions or how NSE is trying to address these concerns from SEBI and then finally decide on whether to approve that NOC for NSE's IPO or not.
Right, thank you Yash for that. It's time for a short break. Coming up next, Supreme Court stopped short of staying the Waqf Act after an undertaking from the government. Details in just a bit.
The 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded everyone.
Welcome back. OpenAI is betting big on India. In an exclusive conversation with CNBC-TV18, the company's chief product officer, Kevin Weil, said India is OpenAI's second largest and fastest growing market. He added that active users in India have grown over threefold in 2024. He believes that OpenAI's chatbot will transform its functionality in 2025. Take a look.
India is an incredibly important market for OpenAI and ChatGPT. It's our second largest market, it's our fastest growing market, and it's also the market where we saw our image generation just take off. Our active users in India tripled, more than tripled in 2024. So it's been incredible to watch. A few weeks ago, we launched a new image generation tool using AI to generate incredibly images that you can control to a great degree, whether you want them to be vivid and lifelike or cartoony or following a particular style. We saw Prime Minister Modi tweeted using our image gen feature. We had cricketers like Sachin Tendulkar tweet images from ChatGPT, and it just took off. I mean, unlike anything I've ever seen. This is the year that ChatGPT goes from answering questions for you to doing things for you in the real world. So, by that I mean we launched a product earlier this year called Operator that can browse the web like a human and do things for you. It can order food for you, through an online food ordering website. But it can also fill out forms. It can shop. It can do anything that you would do on the web, and of course you're in control the whole way.
And you can catch the entire conversation with OpenAI's Kevin Weil on Global Dialogues at 5:30 p.m. and 9:30 p.m. right here on CNBC-TV18. A day after nationwide ED raids linked to the Mahadev betting scam, Ease My Trip has said that only one of the over 50 premises raided belonged to the company. Ease My Trip, in its statement, denied any direct or indirect association with the Mahadev betting app. They said they were willing to cooperate with the authorities throughout the course of the investigation. The Commerce Ministry is preparing proposals to address the short-term credit requirements of e-commerce exporters. Abhimanyu Sharma gets us some more on the government's game plan. Abhimanyu.
Amidst very little year-on-year growth in overall exports in FY 24-25, sources have indicated that the Commerce Ministry is working on a proposal to meet the short-term credit needs of e-commerce exporters. In FY 24-25, India's total exports grew by just 0.08% year-on-year to reach $37.42 billion. Sources explained that talks are underway between the Commerce Ministry and the Reserve Bank of India for faster reconciliation of export payments as the government works on a larger scheme to promote e-commerce exports. The proposal involves provision for an offer of support to exporters having warehouses abroad via lower borrowing costs, as well as a note for the Expenditure Finance Committee's approval to boost exports.
Right, thank you for that. The Supreme Court stopped short of staying the Waqf Act after an undertaking from the government. The centre agreed to not make any new appointments or change the status of the current Waqf properties. The government needs to respond in 7 days to a batch of petitions challenging the new legislation. Ashmit Kumar is here with the details. Ashmit, could you please take us through the court's interim order?
Well, a whole host of petitions being considered by the Apex Court in a huge day as far as the life of this newly passed bill is concerned. Again, newly passed by the Parliament, now facing challenges, constitutional challenges before the highest court of the country. Now, bear in mind that these proceedings began yesterday, and then there were two critical aspects that the Apex Court had pointed out. Two aspects. Number one was Waqf by user being discontinued. Waqf by user, of course, being the legal doctrine under the earlier Act, which allowed for a property which had been recognized as Waqf to continue as Waqf, provided it's been used for religious or charitable purposes over an extended period of time. This practice, this doctrine is being discontinued under the Act. The question that was posed by the Apex Court to the government is that how is it that the centre is now insisting on some form of registration for recognition as a Waqf property when a lot of these properties, which are Waqf by user, have been going on for the last hundreds of years. In fact, the Supreme Court had given the example of Jama Masjid and said that 14th and 15th century is when this entire mosque had in fact been constructed? How is it that the government now in 2025 is asking for registration? And these are the questions which were raised by the Apex Court in asking how the centre can travel back through this law hundreds of years and ask for documentation going back hundreds of years. Again, another second point that the Apex Court had raised is that what about the question as far as going forward, as far as non-Muslim members of the council and Waqf boards are concerned? In fact, the question, the direct question that was posed to the centre by the Apex Court is that Hindu endowments, will the centre now provide for Muslims to be a part of the managing committee of a Hindu endowment? These are questions that were posed. Now, in response to this, the centre came back to say that it is willing to make two key concessions. It's willing to give an undertaking that no fresh appointments, no fresh non-Muslim appointments will be made to the Waqf boards as well as the council. And the second key undertaking was that the status of Waqf properties as it exists right now will not be denotified under the new Act. And it is only after recording these two undertakings that the Apex Court has said that, fine, we will not stay the Act as of right now, but we'll put on record these two undertakings that the centre has given. The centre has now been allowed 7 days' time to respond to these challenges, and that's when we'll begin to get more clarity on the road forward as far as the new Waqf Act is concerned.
Ashmit, the Supreme Court has also set aside a content takedown order against Wikipedia. Remember, the Delhi High Court had passed the order after news agency ANI alleged defamatory content on Wikipedia's pages. Could you take us through this order, please?
Well, allow me to just fill in some context. Now, ANI, the news agency, had moved the Delhi High Court, basically flagging this one page on Wikipedia, which had recognized ANI as a propaganda tool of the government. This is what ANI had called a defamatory content, had lodged legal proceedings in the Delhi High Court. On April 2nd, the Delhi High Court single-judge bench had allowed for takedown of that page, which had quote-unquote defamatory content. This was upheld by the division bench of the Delhi High Court, and today this matter travelled to the highest court of the country. Here, the Supreme Court has, after due consideration, made certain observations. The Supreme Court observed that the Delhi High Court has given an injunction that's too wide. The Delhi High Court has directed for takedown of all defamation or misleading or false content with respect to ANI. But the question that the Supreme Court raised is that who decides what is defamatory, who decides what is false or misleading? And therefore, on that ground, the Supreme Court has set aside the Delhi High Court injunction, has set aside the takedown order that the Delhi High Court had issued with respect to ANI, and now, importantly, has said that it is too difficult, it is too vague, it is impossible for it to be implemented, this judgment. And therefore, on that count, the Supreme Court has allowed ANI to go back to the Delhi High Court and make a fresh case for takedown of very specific portions of the web page that has been uploaded on Wikipedia. So to that end, some relief coming in as far as Wikipedia, as far as Wikimedia is concerned. But the story is not over. ANI now being allowed to go back to the Delhi High Court to raise its concerns once again.
The story is not over. Thank you, Ashmit, for that. Let's quickly shift our focus to Infosys, which has reported its fourth quarter earnings. Let's go across to my colleague Rima Tendulkar for more. Over to you.
Thanks so much for that. So Infosys Q4 is sharply lower compared to street expectations. The company has reported a revenue decline of 4.2% in dollar terms quarter on quarter. In constant currency terms, it's a decline of 3.5%. This is much worse than consensus expectations of a decline of 1.5%, and also lower than peers. Both TCS and Wipro had reported a decline of 0.8%. Compared to that, Infosys constant currency revenue growth decline is at 3.5% sequentially. Year on year, there is a growth of 4.8%, but again, it's lower than street expectations. Now, because of the miss this time around, the company has missed meeting its annual guidance for FY25. For the full year, I think the company has clocked in about a 3.9% dollar revenue growth. In constant currency terms, it's a growth of 4.2%, and this is lower than the 4.5% to 5% that the company had guided for. So Q4 misses the mark substantially, and as a result of which the company is unable to meet its FY25 guidance. The guidance was for 4.5% to 5%. Compared to that, the company has clocked in a 4.2% revenue growth. They've met the margin estimates. So margins for the full year have come in at 21.1%, within the company's guided band of 20 to 22%. So right in the middle. Deal wins continue to remain fairly robust. The large deal TCV stands for total contract value, stands at $2.6 billion, similar to the $2.5 billion that the company had in the prior quarter. Just trying to understand what the guidance is for next quarter. Okay, the company has given a guidance of 0 to 3% in constant currency terms for FY26, and they've given a guidance of 20 to 22% in terms of margins. So the guidance is lower than street expectations slightly. The street was looking for a 1 to 4% kind of growth, but given the Q4 exit run rate, maybe the uncertainty, and that Q1 is likely to be subdued based on what Wipro has already indicated, I guess this guidance of 0 to 3% would be, par for the course, or, something that the street would not be surprised with, because things have turned sour in the last 1 month or so. We have Prakash Diwan now joining in. Prakash, these are the initial takes, and it clearly looks like the macro uncertainty has impacted even Q4. Because otherwise, the company's guidance for Q4 was anyway so conservative that for them to miss it would have implied that things, what have transpired is way out of the realm of what they, imagined. So Q4 has been impacted, and you've got a guidance of 0 to 3% for FY26. And I suspect that would also be fairly conservative, considering the miss in FY25. You don't want a repeat of that.
No, absolutely. I think given the macro conditions, it's quite understandable. But what's heartening, two things that I find still very, comforting. One is the margins. At least they've not compromised on that, which means that they've not been, contracts haven't been renegotiated downwards in terms of margins, but it's just the overall reduction in value of contracts that's evident. So they've probably, and the TCV, constants is also a fairly positive thing, which again means they have no ramp downs yet. So I think if the macro condition improves, you'll probably see a, ramp up which could go beyond this level as well. And that's why the guidance is fairly conservative. I was quite surprised that they did offer some guidance. My guess was they would probably skip that given the uncertainty in the macro situation. But at least conservatively, they've given that, which is quite positive. And the stock's already reacted to this anticipated weakness. So I wouldn't be very, very disappointed in that sense.
Not be too disappointed. Shaji Nair is also joining us on the show now. Shaji, give us your initial take. The company, I'm just reading out Salil Parikh's statement. Sorry, this is the CFO statement. Let me just try and get Salil's statement. Well, he says we've built a resilient organization, sharp focus on client centricity, responsiveness. He talks a lot more about the depth in AI, cloud, and digital strength. Just trying to find out. Okay, the CFO talks about the macro uncertainty. FY25 operating margins expanded by 0.5%, which reflects our relentless focus on identifying opportunities for efficiency, executing Project Maximus with discipline. After navigating through multiple headwinds in a challenging macro environment, the companies also deliver their highest ever free cash flows. That's the dividend that they've announced is about 22 rupees. Give us your initial take, Shaji.
So basically looking at the numbers, with respect to the Q4 numbers, there's a clear miss. So we are anticipating a decline of 1.8% among the tier 1 companies that we were expecting Infosys to report weak numbers, but this is weaker than expected. And with respect to the guidance, we, as well as I think the street, was anticipating closer to 2 to 5% revenue growth. So this has come in at 0 to 3%. So I think the street it's a bit disappointing on that front as well. The only solace is that the EBIT margin, despite the weak numbers on the revenue front, the EBIT margins have seen a slight dip of 30 basis points on a sequential basis. So that is Diwan mentioned, it's heartening. Other than that, the deal wins, the large deal TCV seems steady. So all of these numbers that have been reported, we are seeing the deal wins have been, the large deal wins have been pretty steady for the tier 1 companies as of now.
Indeed, I think the two positives that stand out, one is the deal wins and two is the margin performance, and that's resonating even with the rest of the IT pack, TCS and Wipro. The problem is on the growth front. Things are challenging right now. The macro is tough, but once I think the macro situation improves, discretionary spending starts coming back, perhaps things will, the tap will open up. For now, clearly Infosys Q4 is a miss. Those of you who've just tuned in, Infy's reported their Q4 numbers. It's a miss on the top line. In fact, a big miss on the company's top line. The dollar revenue growth has declined by 4.2% sequentially. Constant currency revenue growth is down 3.5% on a quarter-on-quarter basis. This is much lower than street expectations, which was anticipating a 1.5% decline, and lower than peers TCS and Wipro. The positive is the company, their margin performance has been strong. They've reported EBIT margins of 21%. It's down quarter-on-quarter, but better than what the street was anticipating, especially in the face of negative operating leverage. And two, the deal wins are steady at $2.6 billion compared to $2.5 billion in the prior quarter. And three, the company has given a guidance which in itself will provide some sort of a comfort. If you remember in the COVID year, in April of 2020, which is the guidance for Q1 of FY21, they had abstained from giving a guidance for 3 months, citing uncertainty, and they gave it then, subsequently in the July quarter. But at least this time, the company has given a guidance, 0 to 3%, albeit it's lower than what the street would have hoped for, but I don't think it's going to come as a surprise after the numbers that we've seen and the commentary that we've heard from the IT majors. Margin guidance remains unchanged at 20 to 22%. Prakash, the question, the top management will be getting ready to address in a quick. Prakash, how much of the pain is already in the price, according to you, for Infosys, and what would be the key things you'd want to hear?
Most of it. See, there was anticipation that the quarter would be soft. It's been a bit softer, but the market always looks at things going ahead, and from that perspective, given the margin guidance, given the constant currency conservative guidance, I don't think there is any disappointment. I mean, there could be some marginal on Monday, there could be some marginal sell-off of sorts, but I don't think there's a major reset. And, had Infosys numbers come before TCS and Wipro, the disappointment would be far more stark. But the fact that we'd already kind of started getting geared up for a softer quarter, I don't think there's too much in the price that's likely.
We leave the conversation here for now. Thank you very much, both of you, for joining in. Salil Parekh, CEO, MD, is now addressing the media, talking about the Q4 numbers, the way forward. Let's cut across.
Moving from a use case approach to an AI-led transformation approach. This is using AI agents, which are playing more and more of a critical role, and we believe we have a very leading position in AI agents with over 200 agents we've developed. We continue with our strategic expansion and acquisition in the energy and consulting space in the US, acquisition in cybersecurity space in Australia, and a new strategic partner becoming part of our joint venture in Japan. So all three areas are areas where we have strategically looked to expand, and we are further committed with this expansion in the US in a very critical area for that market. We have a set of capabilities that support clients in their growth, whether it's AI or cloud or digital, and in their efficiency, whether it's automation, cost reduction, lean, and consolidation. So we feel well positioned in this environment to look at both growth and both cost areas as clients look at them. Based on what we see in the environment today and building on our large deal wins in the past quarters, our guidance for growth in financial year 2026 is 0% to 3% in constant currency terms. The environment is uncertain, and we will execute our plans with agility while keeping a close watch on changes. Our margin guidance for the financial year 2026 is at 20% to 22%. Thank you. And then let's open it up for questions, Rashid.
Thank you, Salil. Joining Salil is Mr. Jayesh Sangrajka, Chief Financial Officer, Infosys. With that, the first question is from Ritu Singh from CNBC-TV18.
Hi, Salil. Hi, Jayesh. Quick word with your guidance of almost no growth in this year, 0 to 3%. If you could give us more in terms of commentary on what you're seeing. For instance, from TCS, we heard about delays in decision making. From Wipro yesterday, we heard, one of the large clients paused a transformational deal. So what are you hearing? Are there ramp downs? Are there delays? Are there, any sort of cancellations in large deals? Also for Infosys, in the last 12 to 18 months, we've not seen any mega deals, being announced. What's happening in the market? Are some of these large deals drying up? What's your sense? Given that this puts larger reliance for you on discretionary spend picking up. Also in terms of sectors where you'd started to see shoots of recovery, for instance, last quarter you spoke about BFSI, et cetera. Is that continuing, or given the uncertain environment, you expect some sort of a reversal there? And just one question on the hiring and wages. The wages that were expected to be rolled out in the second phase in April, are you on track to do that? And your hiring plans for the year, 20,000 that you'd indicated, if that's also on track. Thank you.
Okay, so thanks. A few questions. So first on the environment, I think we see there's uncertainty in the environment. We have several deals that we closed in the last quarter and the quarters before. Those are today moving into the appropriate next phases. We've not seen a change in that. We are seeing in areas where there's focus on changes which may come. There could be in industries where there are changes that could come because of the changes in the regulations. There could be an impact. Jayesh will comment a little bit about how we've constructed the guidance based on that. In terms of mega deals, we had 2 mega deals in the last financial year. We have a pipeline of mega deals today. What is sort of what we saw in the past when things of this nature happen, which is changes in the environment. There's also an interest with clients on cost takeout, automation and efficiency and consolidation. We will see how it plays out because it's only a few days as clients have looked at it. But we have seen our large deals moving, meaning which we have closed, moving into the next phases as was evident.
Yeah, so adding to what Salil said on the guidance, look, we run multiple models which run up to the guidance at various ends of the guidance, bottom end, middle end, or the top end. The fact that we gave a 3-point guidance reflects there is uncertainty in the environment. At the bottom end of the guidance, we have baked in some deterioration in the environment, some heightened uncertainty. At the top end of the guidance, we have assumed a steady to marginally improving environment at this point in time. Coming to the second question on wages, we are on track on our wages. Large part of the wage increments were rolled out in January, and the balance is rolled out in April, effective 1st April. So we are on track on that. And in terms of FY26 hiring, we are expecting to hire 20,000 plus freshers. 20,000 plus, what we had said earlier, we are on track of that.
Off, some of these fresh campus recruits, because according to your own statement, there were 337 of these as opposed to media reports of 700 plus. And you said that was because of their weak performance. If you could clarify, what exactly happened there? Are you not able to find the right talent? Is the number still, at what you'd said in your statement? Is it larger? Just a statement from you on that.
So let me take that one. So first we made some statements, so those are, we stand by those statements. In addition to that, within Infosys, we have an approach for making sure that we have a rigorous way to train and then to assess and test individuals. This is a process that has been ongoing for the last 20 years within the company. At every time that the training batch comes in, they have 3 opportunities for testing, and at each time, if they succeed in that, they stay on. After 3 attempts, we have now found a way that we have found other opportunities for them and also supported them in outside of Infosys in some training that can be offered to them. So that's the approach we have taken. In terms of the numbers, whatever the statements we've made in the past remain as they are.
Thanks, Ritu. The next question is from Haripriya Suryaban from NDTV Profit.
Hi, sir. Salil, give us some idea on, like you said, you remain confident on the current deal wins that you have. But do you see any kind of changes going forward in your conversations with the client? Any possibility of ramp downs or cancellations that you have visibility on right now? And on the fresh deal wins that you'd try to bank on further, what kind of deal wins would mostly come in? Is this most towards the cost takeout side that you would be expecting? And what's your read on the discretionary spending? Do you see that go down at least in terms of the sentiment? And would it pick later towards the year? And also, how many quarters are you expecting this uncertainty to stay on? Because one of your competitors said at least towards the second part of the year, things should get better. And Jayesh, on the margins, stayed on the narrow band. What are the levers that you'd have going forward? How do you plan to, what are the impact that this current environment will have, and how would that be baked in?
So on the environment, what we see is it's an uncertain environment. And as Jayesh shared, we've taken different scenarios to look at the way we've put together the guidance. In terms of specifics, as of now, we have seen the deals that we have won in the recent quarters are now continuing to ramp. My view is we will see, because of the changes in the economic outlook, there will be some discussions which will be focused on more consolidation, more cost pressures with clients. But at this stage, we have not seen a change in that. However, the guidance has factored in what we anticipate in different scenarios, because all of this is happening in the last few days.
Yeah, on the margins, if you look at FY25, we have expanded margins by 50 basis points. That's a clear reflection of our endeavor, which we had said at the beginning of the year, to improve margins. We have improved margins despite multiple headwinds. We had a full year impact of the comp that we did in the previous year in November. We have paid higher variable pay to our employees. We had many of the large deals ramping up during this period. We did an acquisition, so there was an acquisition-related impact. And despite all of those headwinds, we have been able to increase our margins by 50 basis points. So that's just a clear reflection of what we have been doing. And we do see opportunities in terms of increasing from VBS in terms of pricing, etc., in terms of lean automation, of doing more productivity, increasing nearshore in multiple of our geographies, etc. So there are opportunities to improve margins from where we are today.
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
Welcome back. Here's a quick recap of the headlines of the day. Sensex and Nifty gained 4% this week as stock markets attempt to recover from the tariff jolt. This is the biggest weekly gain in 2 years, with major indices trading near 4-month highs. Infosys misses estimates in Q4. Dollar revenue declines 4%. Company expects 0 to 3% revenue growth this financial year.
Markets are struggling with a lot of uncertainty, and that means volatility.
Fed Chair Jerome Powell delivers a stark warning on Trump's tariff war, says the policies are slowing growth and pushing inflation higher, plays down hopes of any intervention by the central bank. Trump hits back, saying Powell is always too late and wrong. Wall Street ends lower after Fed chair brushed off chances of a Fed intervention. Asia breaks ranks from the US, gains in trade. Europe opens lower ahead of ECB policy decision. Gold prices hit a fresh high as safe haven buying picks up. Capital cushion for IDFC First Bank. Private equity investors Warburg Pincus and Abu Dhabi Investment Authority to invest 7,500 crore rupees into the bank and pick up a 15% stake.
This is the year that ChatGPT goes from answering questions for you to doing things for you in the real world.
OpenAI is betting big on India. Chief Product Officer says India is the company's second largest and fastest growing market. Active users in India have grown threefold in 2024. That's an exclusive. Supreme Court stopped short of staying the Waqf Act after an undertaking from the government. Centre will not make any new appointments or change the status of the current Waqf properties. Government gets 7 days to file a response to a batch of petitions challenging the new legislation. Right, that's a wrap for now. An exclusive interview with the Indigo CEO Peter Elbers is up next.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Bessent has already said that we will, the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea and India. I was very intrigued to hear that, because they've always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others. And then we want people which are friend shore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that in a sense for them. So in that context, the way they are laying out this new chessboard, I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. You know, how many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars.
The travel and tourism industry has been on a good run, and the hope is that things will continue. The momentum, of course, has been built up. And as we look at the new financial year, which has started, we are already seeing signs of the domestic move strengthening further. Of course, international at this point in time a bit uncertain given the escalation of the trade war. Back home, the big story, of course, emerging is Indigo. It has become the world's most valuable airline with its market cap crossing $23 billion. To talk to us about Indigo's aspiration of being India's first global airline is Peter Elbers. Peter, always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back on the program. Let's start with India and let's start with domestic travel at this point in time. Still looking very, very strong. As we start this new financial year, I know you can't give us specific numbers because you are in your silent period, but what's the mood in the market at this point in time?
Yeah, thank you. Thanks for having me here today. And it's a pleasure to speak to you always. If we look about the development of the domestic market and we take the most recent published official numbers, and as you said, I cannot give any speculation about today's numbers since we're in that silent period. But for both the month of January and February, the DGCA data was released, and both of them actually had an 11% increase, which basically are very, very good numbers. So there was some slowdown at the beginning of 24. Around the election time, there was some slowing down, but actually ever since we can see a very solid demand and a very positive development of that demand.
Well, speaking of demand and speaking of positive developments, I'm just taking a look at the numbers. For your summer schedule, 14,158 weekly flights. That's much higher than the 13,050 flights last summer.
Yeah, we keep adding and we keep growing. And for the financial year which is past, we announced a early double-digit growth. We have actually the same outlook for the next year. And for an airline of our size, today we operate a little short of 2,300 flights a day. If you think about that, take a step back, we're welcoming every 3 days 1 million customers. By the time this interview is over, we've welcomed another 7,000. So it just shows that the numbers are there and the numbers continue to grow. So our ambition really is to double towards the end of the decade. That's a long-term projection. But in the meantime, we keep adding these numbers.
Well, speaking of adding numbers, it's what, a plane a week at this point in time? That's the run rate that you're working with?
Yeah, that is still the runway. I mean, the last year, 24, we received 58 aircraft. And, I think it gives a lot of pride to everyone at Indigo and probably India also. The single largest taker of planes on the world, not the region, but the world, was Indigo. So here we are, an 18-year young Indian airline taking the highest number of plane deliveries from anywhere in the world, 58 planes. That means more than one a week we had last year. And our ambition is actually to continue that growth path well into the next decade.
Well, I know it doesn't directly impact Indigo, but let me ask you about what you make of China's decision not to order Boeing jets any longer. We don't know whether that will eventually happen or not, but how do you see that development?
That entire discussion today around the tariffs and that US China development, especially when it comes to aircraft. I think the world today is in need of having multiple suppliers when it comes to aircraft, and clearly Boeing and Airbus being the two largest. So I would assume that the resolution is found one way or the other at that point in time.
But speaking of finding a resolution for the capacity constraints that you're faced with, you are continuing to lease aircraft. You've just leased 4 more from Norseal. What's the plan on that front, especially as you have these big global ambitions?
Well, the Indian market is growing at a great rate. Despite our large order book, still some of the global supply chain challenges are really affecting us when it comes to delivering the capacity. So ever since this started to occur 3 years ago, we have taken a whole range of mitigating measures in terms of extending leases, getting temporary planes, doing some damp leases. All these things have really helped us to live up to our capacity guidance. Now we have ordered the wide bodies, so we have 27. The first wide bodies are coming in, and actually we don't want to wait for that. So as a bridging until that time, we started to damp lease 787s from Norseal.
So does this give me a sense that the decision to not wait for the wide bodies and actually go in for leases is a way for you to accelerate and speed up your international expansion plans?
It surely is. The market is there. A lot of Indian travelers today don't have the opportunity to travel either direct or travel on an Indian operator. I think by us providing that capacity, there's an opportunity for people to start flying direct, or to, we have announced Manchester is going to be the first direct connection from Delhi into Manchester. That's great, both for the people in Delhi and actually India, and the people in Manchester. Amsterdam is the other destination we'll be starting adding, and there's more to come. And
so what more can we expect, at least as far as this financial year is concerned? How many more destinations do you intend to add?
Well, we will have the number of Norse planes going up from 1 to 4 in this year. We will start with the XLR. That's a very important development for Indigo. That will allow us to further stretch the range. We haven't disclosed yet which destination, which number, but let me share the following number with you to get a bit of an indication. When I joined Indigo 3 years back, we had like 25-ish international destinations. Today we're 40. And Fujairah has been announced as number 41. So that is in a time span of less than 3 years.
You've doubled.
We pretty much doubled.
Yeah.
And of course, there's an end to, you cannot endlessly double it. But India was so largely underserved, and the demand for the Indian consumers, ranging it from Karabi in Thailand to the Middle East to Europe, is just massive.
So, coming back to specifics now, in terms of your international ambitions, because when we last spoke, you said you want to make Indigo India's global airline. So in the near term, what does that mean in terms of the number of people that you will fly on your international operations? What does that also mean in terms of your margins and change of margin profile?
The Indigo International Network, Shireen, is started some years back, very traditional, if you wish, between India and the Gulf and the Middle East countries. We've been slowly expanding that. So in 23, we started flights into Central Asia. We started flights into Nairobi. We had moved, and I had a meeting earlier this week with the CEO of Changi Airport. We moved from moving into Singapore from 3 Indian cities to 9 today. But that's still within that 5 to 6 hour radius. I think the next step for Indigo is to make sure that even Europe and further parts of Asia would be accessible, directly operated by Indigo. And, if India is going to be the third largest economy in the world by 27, the country needs and deserves actually an airline of the size and scale and potential of the nation.
So what is the indication and the timeline that you're working with in terms of the wide-body deliveries because of the backlog that we're dealing with?
Just some numbers here. Today, we have ordered 30 wide bodies. The delivery start from 27. We don't want to wait for that. That's why we have the temporary bridging. We used to have around 25% of our available seat kilometers international. This year, we're reaching 30, and we've put a projection out there to move that percentage up to 40%. So the foundation of who we are as Indigo will remain strongly and deeply rooted in India. We operate a little short of 500 routes in India itself, direct city pairs. That's the foundation of who we are, and that continue to be. Out of that 500, pretty much half of them are unique. So that provides Sunday air connectivity, connecting the nation, giving wings to the nation. But on top of that, that international dimension is being built. And 40% is the number which we put out there. 40%
is the number. We're still waiting for your results to be announced, which will be sometime in May, so you can't give us specifics. But the street is working with estimates as far as what profitability for you could look like. It's been 9 quarters on the trot, with the exception of 1 quarter of positive bottom line for you. At this point in time, given where crude prices are and have come up very, very sharply, as well as demand, you're looking at significant tailwinds, I would imagine, aren't you?
Well, I think in another configuration, one would call that a leading question. As you rightfully pointed out, we're in a silent period, so I cannot give any indication or guidance.
Don't talk to me about numbers. But
looking back to what we have done, and I'm very proud what the Indigo teams really have achieved. In the middle of 22, we were exiting from COVID, and I remember joining at that point in time. We made a sort of small profit, but it was very meaningful because it was actually, the dark days of COVID were behind us, and we started to emerge from that. And ever since, we have been building not only our network, our customer proposition, our profiling, but actually creating the margins to start investing in the future of the company. If you want to become a global airline, we should have a service, IT, digital tools, all centered around that.
So what does that mean in terms of investments over the next few years, whether it's on IT, we know what it is going to cost you as far as the aircraft is concerned, but, just building out the ecosystem to be able to deliver to the promise that you've just articulated, what will it mean in terms of investments?
Well, there's going to be serious investments, and obviously fleet is the largest part of it. Next to fleet, it's people. This is the training center, and really very important part of Indigo is the people we have. It's also very much all our investments in digital. We start to invest heavily in AI. We were a bit behind that, but if India is home, we should invest to that, and we should actually lead that. So we have our own sort of AI center now building and working.
Is there a number, that you can share in terms of what you've invested so far on AI?
I don't have a number of crores, but it's multiple crores. Obviously, we're investing in that. And last but not least, it's not only our own investment, but also partnerships. So as recent as last week, we signed up a big partnership with Accor. So it's the first of its kind in India. And basically what we will be having now, that all our blue chip members can start using their points in staying in Accor hotels. And Accor members can using their points in flying Indigo. Accor is present in all our 40 international destinations. So what does it mean for an Indian consumer? You fly a lot domestic, you use your points to either fly with us international or have your hotel in Bangkok or Dubai or Singapore, wherever you go, and use the Accor hotel.
So, Accor is one of the partners that you've signed up as far as the Blue Chip loyalty program is concerned. I just saw that you've announced a partnership with Swiggy today as well. So, as you look at building out this partnership ecosystem, what should we look forward to next?
I think the philosophy here is we'll have a couple of leading partners in different spaces, and building an ecosystem is exactly what the word is. So it will have, Accor is clearly such a great global hotel brand that we sign up with that one, and then probably we have a couple of smaller ones. Swiggy is a very different notion, but also helping us to build that ecosystem, and especially in the high speed of India. The speed of having partners adding it, that I think Indigo is very well placed to participate in that boom.
Let's talk about Indigo Stretch, which is, of course, the business class offering and part of the premiumization strategy as far as Indigo is concerned. What's the response been like? I mean, you launched in November, so it's well over 6 months at this point in time. You've gone from Delhi now to Mumbai, Chennai, Bangalore. What can we expect in terms of Indigo Stretch?
Maybe first to address one point. You said the premiumization strategy. I wouldn't call it the premiumization strategy. What we have is that very foundation. So we have a little short of 500 domestic routes. We'll have 10 out of those 500 having this stretch product. So we're basically adding a product on top of what we have. And then even on those 10 routes, if we take Delhi, Mumbai, there's 20 flights a day. There's a plane has 220 seats, 12 of them are premium, and all the rest is economy. But it's very important for us because it starts to prepare for the next phase for international, start to prepare for our corporates. Delhi, Mumbai was the first route to start. That one has been received very, very well. The reviews we get on social media from customers, emails, whatever, is very, very positive. It's a tailor-made product. It's very much geared to what we have. For example, we have now all these flights there, and people just love it. So Delhi, Mumbai is doing well. It started. It's in full operation. Delhi, Bangalore is just recently completed its full 14 daily flights are now all being accommodated. We have Chennai launched, and Hyderabad is the next one to be on the list.
And so the planes that you're getting in, the one a week that comes in, all will have these 12 stretch seats.
Yes, Shireen. So we have taken a decision to have 45 of these aircraft with stretch. We started in November last year, each and every plane. So pretty much every Monday a new plane comes in, sometimes on Friday. But we have these planes coming in, and every new plane comes in, we put it on the route immediately. So the actually The incubation period, if you want to call it like that, for us is like 12 months, and then all these routes should be in operation, which is incredible speed.
With speed and efficiency, and let's talk about efficiency and where you believe you can draw out more efficiency at this point in time to try and give you a further bump up as far as margins are concerned. I mean, you continue to be the market leader, well over 60% share at this point in time. What else do you believe that you can do to squeeze out more from the business, to juice it out even further?
I think Indigo has developed and optimized its processes in a formidable way. The 3-point disembarkation, the turnarounds of planes, the efficiency of the processes. In an environment where sometimes capacity constraints, airports in renovation, air traffic control. So it's the weather, it has a lot of challenges. Despite that, I think Indigo has optimized that. So that's where small innovations like adding a third ramp is helpful. I think the next breakthrough really is going to be in the field of digital, where a lot of information to our customers could be further digitized, could be further optimized. Self-rebooking tool, if there's bad weather, why should we rebook your flight? You may want to do it yourself. You choose yourself. So there's a lot of these processes in the works where we really believe that that's the next level of optimization.
Over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth, because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain in a sense. Even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning and then you can start making your own product. Because we were just not in any of these global...
Let's talk about some of the regulatory challenges that perhaps could be on the anvil. We've once again seen the parliamentary panel recommend the possibility of looking at intervening in the market as far as prices are concerned. We've now got the government setting up a special cell where customers can actually talk about their complaints as far as pricing is concerned. Would you worry about the possibility of government intervention on pricing at this point in time?
Well, when there's a body where customers can complain about certain things, I think that's a good thing. There's always good for companies to have a body which keeps sort of things in balance and things. So I think in general to have a body like that is a good thing. Having said that, looking at the Indian market, it's one of the most, if not the most competitive market in the world. The average price levels are extremely competitive. There has been some recent reports which made a comparison. How did inflation go over the years and how did airfares go? And actually you could see that the inflation has gone much faster than the airfare. So we need to catch up in that in efficiency and sort of in order to keep the margins. Because in the long run, there must be a correlation between the cost of doing business and the price of airfares, right? Otherwise you'll be out of business. I think this is some part of the history of aviation in India. Last and very importantly, if we want to build global aviation giants in India, we should also look at what's the global dimension and global dynamics we're playing in and what type of airlines and size of airlines we need for that. So a good thing that the body is there. We fully support and we're fully transparent on that. When it comes to average prices, it is one of the most competitive markets in the world. Yes, there's peaks, but so is that in hotels. And let's look at it more from a global level rather than at the specific domestic route.
But has there been any conversation with the government on this issue?
There's permanent conversations. If there's questions, there's conversations, right? And I don't.
I would imagine that you got a lot of calls during the Mahakumbh.
No, as an airline, we should never shy away from those conversations. And when there are certain prices which, if there's one ticket which has, 40,000 rupees on the route, That are occasions, sometimes these systems push up the prices. I think the real discussion for the Maho Kumbh is when it became clear that there was so much demand, we pretty much doubled the number of flights we have. If you've been to Prayagraj airport, it's not a very large airport. So I think the collaboration between the airport, the air traffic control, the authorities, ourselves, to put in all these additional flights, that worked out very, very well. And then, yes, there's a lot of chatter about, there was someone booking a flight in the south of India, connecting over Delhi and Hyderabad. But let's park that for a minute. Let's look what we have collectively achieved in making sure that all these people could travel there. I was one of them.
You were? How many people did you fly to the Maho Kumbh?
I think we operated close to 1,000 flights. There's 230 seats per flight. So that pretty much back and forth. So that's what, 5 lakh in and out together.
Yeah.
A very rough estimate.
But staying with possible regulatory challenges, I mean, there was a pushback from industry on the change as far as flying norms were concerned for pilots and the crew. Now the norms are expected to kick in July, the new FDTL norms. What will that mean? I mean, I don't know whether they will or won't. As of now, they're slated to come out in July. What will that mean in terms of operations and your turnaround times?
No. Safety for us is of paramount importance, and clearly it's important to continuously review all these rules which are related to that. What we also find important, let's take some of the best practices of other parts of the world as well, include these best practices in the discussion. Some other countries or continents have gone through a long phase of growth and development. India's aviation is actually taking off now, so I think it's a great opportunity really to incorporate some of these learnings. So the fact that the entire discussion on FDTL is starting and should be a very mature discussion, because there's no dispute on the importance of safety. Everyone fully subscribed to that. As it stands now, that 1st of July is there, and we're in the process of evaluating and detailing what exactly does it mean at what point in time.
Will you need to hire more? July is not very far away. If those norms kick in, will you need to hire more?
July is not very far away, but still, again, we're reviewing what's going to be the precise impact, what possible ways of network alignment, and it has a lot of elements linked to night flying. What does it exactly mean? Should the network be changed? Should we stop some of the flights in the night? Could also be a consequence. So I think even there it's a holistic picture, and I think India at large has benefited a lot from the development of aviation. I think it's important that we sort of keep that momentum, and of course against the backdrop of safety first.
User development fee being hiked across majority of the major airports, whether it's Mumbai or Delhi. Do you believe that's likely to impact travel demand? How do you see that affecting the sector?
Well, that's a fine balance. I think a lot of the investments which are taking place in airports today are great investments, and probably we're really up to those investments. And I think with that, some of the airports in India are now world-class airport facilities. And again, we need that. The country needs to have world-class airport facilities. If we want to be a global aviation hub, hubs are created by airlines, but can only be created in close collaboration and working together with airports. So that's what we need. Having said that, looking at the price sensitivity, a few hundred of rupees sometimes is enough to have people flying or not flying. So we should be mindful of looking how these user fees will eventually find their way into ticket prices. Because at the end of the day, there's a correlation between what is the price and the cost price of a product, and what is the price for the consumer eventually. So full support for all the changes. I think it's important that it's being done. But we should be mindful that, at the end of the day, the price of the ticket is based on different elements, and this aspect is an important part of that, and that should be in line with it.
Is it in line with what you believe is the kind of threshold, or do you believe it's tipped over?
I think at some points it runs the risk of tipping over. If you take the price of a ticket, the price of some of the UDFs should, in terms of percentage and correlation, should be not too much as the total price of the ticket, right? There's going to be fuel and flying and this and that and the other. So I think, again, full support for all the changes we're making, but we should be mindful of what would it do eventually for the total ticket prices.
You've also got new airports coming up. You've got the new airport coming up in Mumbai. Of course, you've had to move airports here in Delhi. There's Jewar expected, and that's on the anvil as well. In terms of the new airport infrastructure coming in, what does that mean as far as perhaps opportunities, but also adding to the complexity as far as an airline is concerned?
Well, I see it as a big opportunity, and all the large cities in the world, the mega cities in the world, are having 2, 3, or even sometimes more airports. London, Paris, New York, Shanghai, Tokyo, they all have multiple airport systems. India didn't have that system so far. Therefore, 25 is a big year for Indian aviation. So we welcome very much the opening here in Noida. We welcome the opening in Navi Mumbai. Indigo has committed very much to both new airports. We had the honor to do the sort of first test flights on both airports. They went very well. We will start building without decreasing on the existing airports. So I believe there's room for us to operate from both and not to decrease at the existing airports.
You pick up on this on social media. You pick up on this from customers who sometimes even reach out to us and so on and so forth. You are today the world's most valuable airline. But are you India's most loved airline is the question. And do you aspire to be India's most loved airline?
I would say, yes, we are. If I see what we do for the communities in terms of providing air connectivity, in terms of providing services, half of our routes are routes where others are not operating. So we're actually creating that opportunity. When I traveled to, not so long ago, I was in Durgapur and Deoghar. If you see what we are doing there in terms of creating that connectivity, so that's that much appreciated, recognized. So that is, if you want to call it, the hardware of the equation.
But what about the software?
When we look to the software, exactly, I was coming to that. When we look to the software and see what our staff is doing in often very difficult circumstances. You know, if there's a flood at the Chennai airport last year, our people stand there and they deal with all the challenges which are there. It's outside anyone's control what's happening, and yet they deal with it. If I see the work we're doing, we now moved from the Delhi Terminal 2, temporarily closed, everything had to go to Terminal 1. That's a massive operation, and yet they do it. So be it on the ground, be it in the air. You know,
but the user experience, I mean, I'm sure you see the feedback as we do as well, whether it's the quality of seats, whether it's the fact that there's virtually no cushioning on some seats, whether it's food. I mean, how do you respond then to that feedback? Are you using that feedback to try and do something about the user experience?
It would be arrogant not to use it. So yes, we do. Yes, we do that. Looking at, and we monitor our net promoter score and we monitor social media. So we do that and we take that serious. You know, if we have 3.5 lakh customers a day, there's going to be complaints of those customers. And when seats are not correct or when planes are, then of course we're addressing that. And even when staff behavior is not correct, we're addressing that. But by and large, and I think India has a system whereby customer complaints are all registered at the DGCA. It's all monitored very, very well. Our statistics look very, very, very strong there. Yes, there are still cases where people send, and all these complaints are being followed up. And if you put it even on the more international scale, our service stands out. So I think we have the hardware in place, we have the software in place, and with that together, the India's preferred airline is a subtitle we are proudly adding to the name Indigo.
Okay, well, Peter, I'm going to end by asking you to give me a sort of broad picture of what you're most excited about for 2025. We'll come back to the numbers when you can talk about them, but leave us with a broad picture of what you're most excited about for 2025.
2025 is exciting for the Indian aviation industry because we'll be hosting IATA, and finally we'll have a second airport in Delhi and Mumbai. That is for the industry. For Indigo specifically, we accelerate our internationalization. So we grow to more destinations. We got the wide bodies coming in. We got the XLR coming in. And that will basically be a very important step in the building of our global footprint. And from a customer perspective, we'll have the stretch domestic. We have a loyalty program and we have a lot of new services on offer.
Well, it's always a pleasure, Peter. Many, many thanks for joining us, and we look forward to speaking with you after your earnings are out.
After the earnings, we do that. Thank you so much.
Thanks very much. Appreciate your time. With that, it is time for us to wrap up this CNBC TV18 special from me and the team on the show. Thanks very much for watching.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded everyone.
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. 2024 was a breakout year for OpenAI's ChatGPT, and 2025 promises to be equally exciting. Joining us now to talk about the innovation pipeline, what we can expect as far as the AI war and the AI race is concerned, is Kevin Weil, the Chief Product Officer at OpenAI. Kevin, many thanks for joining us. I know it's late in the evening for you, and it's been a busy week, an exciting week with lots of launches lined up, including tonight, where you had the O3 and the O4 Mini. So let me start by asking you, Kevin, to give us a snapshot in very simple language. What does ChatGPT 4.1 mean for OpenAI and for consumers, and how do O3 and O4 Mini change the game?
Yeah, well, first of all, thank you for having me. I really appreciate it. We're excited to be here with you. India is an incredibly important market for OpenAI and ChatGPT. It's our second largest market, it's our fastest growing market, and it's also the market where we saw our image generation just take off. But we had some great launches this week. You mentioned GPT 4.1, which was a model for developers that is fantastic at coding and complex instruction following. And so, for that was a model that we released focused on developers, and we're seeing them. We have over 3 million developers on the OpenAI platform, and they're doing amazing things. That is one of our fastest growing models by usage ever. And then just this morning in the US, we launched O3 and O4 Mini, which are our frontier reasoning models. They're the smartest, fastest, safest models that we have ever launched. They're incredible at things like computer programming. So if you look at measures like on competitive coding benchmarks, these models would be better at competitive coding than all but about 200 people in the world. And they can answer hard PhD level science questions better than 80% of PhDs in their field across all fields simultaneously. So they're really very intelligent models, but you can also use them for, more mundane tasks, understanding, medical jargon, or looking at what's happening in the world, creating images, helping you with writing, translating languages. These models are so dynamic, and we're super excited to see what people can do with them.
Well, thanks very much for giving us that update. But, I want to link this back to comments that you've made previously, including a tweet that I saw from you about 10 hours ago, where you talk about the fact that these are the worst AI models that you'll ever use for the rest of your life. As the Chief Product Officer at OpenAI, with things changing so quickly, and in your words, you believe that these are the smartest models to date. How does that get you to kind of constantly reinvent yourself, constantly disrupt yourself? I mean, how concerned are you not just about competition, but about creating moats that continue to give you the advantage that you enjoy today?
Yeah, it's one of the most exciting things about this industry. These are simultaneously the most intelligent models in the world, the best that we've ever created, we believe the best in the world. And they're the worst that we will ever use, because the models are progressing and getting more intelligent, getting safer, getting smarter. Every few months, there's a new breakthrough, and all of a sudden, computers can do something that computers have never been able to do before. If you go back 2 years or so to when ChatGPT launched, if I asked you to use those models, at the time, they were amazing. They were mind-blowing. If I asked you to use those models now, you would be disappointed. And that's just because of the pace that everything is getting better. We've kind of whooshed past the Turing test, which used to be the high watermark for, is AI here? Yeah. And now that's in the distant past. Every AI model is passing the Turing test. So It's an exciting time, and the fact that ChatGPT has gone from 0 users a couple years ago to over 500 million active users today just shows how valuable these things are in people's lives.
I want to double down on this, Kevin, because you've also said that models are getting smarter, faster, cheaper, safer, more personalized, and more helpful. The future is bright. That's a lot to pack in. If I were to ask you what you prioritize today when you look at how you develop and build the next line of products, are you going to be prioritizing making this much more accessible, i.e. cheaper, given the kind of breakthroughs that we've just seen with DeepSeek? What do you prioritize in the attributes that you've outlined that models will need to focus on?
I think first and foremost, I care about making these models more broadly accessible and more useful to people. And that entails making them smarter and safer and things like that. But first and foremost, I want ChatGPT to help people live better lives, to help them accomplish their goals more quickly, to help them learn new languages, to help them learn new skills, to help them do the kinds of things they need to do for their family or their job faster so that they can spend more time on the stuff that they really care about. These models are, and ChatGPT helps me do this every day. As we think about building models for developers, for programmers, for entrepreneurs who are running startups or working at companies, one of the things that we care a lot about is reducing the cost of our models, even as they get smarter. If you compare today to 2 years ago, again, when we launched GPT-3 was more than 100x more expensive than are some of our models today. And our models today are smarter and faster. And so, I talked before about how rapidly this industry is progressing. You can do so much more today with an AI model than you could 2 years ago. And it's cheaper, and it's faster, and it's safer. And so that it affords an incredible set of opportunities for people, for businesses, for developers all over the world. And we're very, proud and humbled to be able to help provide that.
But Kevin, how much cheaper can we expect things to get? In the near term, what are we talking about?
Well, so I said 2 years ago, our kind of flagship model was more than 100x what many of our models today cost. So you're talking about maybe 10x a year in price drop for sort of a constant level of intelligence. So the same level of intelligence in a model maybe gets 10x cheaper every year. And that's, Moore's Law, which has transformed the world and powers our lives, and every little thing that we do every day has a transistor in it. Moore's Law was about the number of transistors in a chip doubling every 18 months. And that changed the world. AI is on a trajectory of going down by a factor of maybe 10x in cost every year. So it's a much steeper exponential than Moore's Law, which means I think we're going to see AI transform the world even faster. And that's exciting. I'm very optimistic about that.
You're talking about AI transforming the world, and I know previously you've spoken about the fact that you believe AI will surpass human coding, perhaps even by the end of this year. To parents and to kids who are looking at grad school, at people who are graduating from engineering colleges today, you talk about a bright future, but as they look at the expanse of what's going on and the disruption and transformation that's expected to happen, what would you tell them? Because it almost sounds like, you're writing the obituary in a way for coders.
I actually don't think so at all. Jobs evolve, they don't evaporate. If you go back and look at, I watched the movie Hidden Figures recently, which is about some of the rocket scientists from back in the 50s and 60s. They were doing longhand calculations on paper to calculate rocket trajectories. And today, that seems wild that you would have people doing it, right? Computers are just better than humans at doing hard calculations. And so, of course, computers do all of that for us. But that doesn't mean that there aren't rocket scientists today. And in fact, we've probably made far more progress if you look at things like SpaceX and also things like, the ISRO, the Indian Space agency, which is, you know, an incredible space agency, one of the premier rocket launching agencies in the world. I think we're far better off because we have computerized these things and computers do it better than humans do. I think that will be true of code as well, but that doesn't mean that it won't pay to be technical, that it won't pay to have a computer science degree. I think these skills will still be important. They're just going to evolve.
Well, speaking of evolution, let's talk about what you're seeing in India. You talked about how it is today your fastest growing market for ChatGPT. You know, how many active users do you have in India? What surprised you about the adoption, the rate of adoption, the pace of adoption in India? Why do you believe you've seen this kind of an uptick here?
Yeah, I mean, our active users in India tripled, more than tripled in 2024. So it's been incredible to watch. A few weeks ago we launched a new image generation tool using AI to generate incredibly images that you can control to a great degree, whether you want them to be vivid and lifelike or cartoony or following a particular style. We saw, Prime Minister Modi tweeted using our image gen feature. We had cricketers like Sachin Tendulkar tweet images from ChatGPT, and it just took off. I mean, unlike anything I've ever seen. I've been fortunate to be at Twitter for many years. I led product at Instagram for a number of years. I mean, these companies were growing very quickly. I have never seen anything grow like ChatGPT was growing because people were having so much fun creating these images, sharing them with their friends, on WhatsApp and in other places. And it's just incredible to see. So we marshaled a whole lot of resources. We really tried to support it, especially in India. We released new features around our image gen, like image galleries that let you quickly view all of the images that you've created. There's just a huge amount of excitement in India for ChatGPT, and not just for this image gen feature, but also, ChatGPT speaks 100 languages. It can teach you any subject you want to learn. It can save you time at home and at work. And so, it's so broadly useful, and it's completely free. You don't have to pay us a dime. You can use it on an Android phone for free. So it's just, we deeply believe in bringing AI to the world and in the positive impacts that can make. And I can't think of a better example than, what's happening in India right now with ChatGPT.
Well, you talked about the Gibilization of India, and we've seen that go viral, as you just explained to us. But I want to link this to the broader issues that are being debated at this point in time, issues related to copyright, issues related to data privacy. Is this a great way of data capture for OpenAI? That's the question that's being asked as well. And Sam Altman has said that he believes it's a net win for society, but there are negatives. I want to ask you this as the chief product officer. When you're developing and designing products, you do need to factor in his words, the negatives. As you look at where you are today in your innovation cycle, how much more of that is a focus area for you?
Oh, we think about it all the time. I was at Twitter in the early days. I was at Instagram. I think we know, we know the promise of those platforms, and we also now know a lot better than we did 15 years ago some of the challenges inherent in broad scale platforms. OpenAI and ChatGPT, we spend more time and effort, and we put more thought into trying to understand both the positives and the negatives of how our work can be used. Far more than any company that I've worked at in the past. Doesn't mean we're going to get it right every time. I'm positive that we will make mistakes. We have made mistakes before, but we work very hard at trying to understand how this can be used. We also have a philosophy of iterative deployment. And when we say iterative deployment, what we mean is we want to get our products out to people early and often. We don't believe in developing something and keeping it in-house and then kind of launching it massively globally all at once to everybody. We believe in getting it out as soon as possible and in kind of co-evolving with society, learning as we go from how users are using the products, and where, if and when we make mistakes, we can fix quickly and continue to move forward. So there's this sort of humility to working to bring our products to people in an iterative fashion, listening, learning, making improvements, and then continuing to move forward. And I really appreciate that about OpenAI.
We are going to take a break here on the Global Dialogue and return with our conversation with Kevin Weil, the Chief Product Officer at OpenAI.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Bessent has already said that we will, the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that, because they've always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others, and then we want people which are friend shore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that in a sense for them. So in that context, the way they are...
Welcome back. You're watching the Global Dialogue. We're in conversation with the Chief Product Officer at OpenAI, Kevin Weil, on the big launch that they've announced last night. Launches, you have, of course, had a busy week, but ChatGPT-5, is there a pushback there? How much, what is the kind of delay that we should expect? And what should we be looking forward to now in terms of next steps? There's a lot of rumors and speculation around a Twitter kind of product. What can you share with us on that?
Yeah, well, we're very excited about GPT-5. There are teams working on it as we speak, and I think it's going to be a fantastic new model when we get there. But in general, this is the year that ChatGPT goes from answering questions for you to doing things for you in the real world. So, by that I mean we launched a product earlier this year called Operator that can browse the web like a human and do things for you. It can order food for you, through an online food ordering website. But it can also fill out forms. It can shop. It can do anything that you would do on the web, and of course you're in control the whole way. It's before it takes a sort of definitive action, it will pause and ask you if you want it to continue some action. But when I think about the time I spend on the web, I bet 30 or 40% of the time that I'm browsing the web, it's not because I want to be doing what I'm doing. It's because I have to get something done, and there's some series of pages and you know, forms I have to fill out and other things. I would love an AI to do that for me. I would absolutely love for an AI to fill out those forms for me so that I can concentrate on, you know, either getting more work done or spending more time with my family. And this is the year when AI begins to do more things like that for you. I'm very excited about that. It comes because of the advances that we're making with these reasoning models that are getting smarter and safer. And it comes with, you know, integrations into the sites that you know and use every day, so that our models can understand them and can take action on your behalf.
You didn't respond to the rumors and the speculation around a likely Twitter-like product launch.
We'll see. We'll see.
Kevin, I know you don't sleep a lot, so let me end by asking you, what's keeping you up at night? I mean, you know, is it Anthropic? Is it DeepSeek? What's keeping you up at night?
Honestly, we have so many fun things coming. What's keeping me up at night is much more trying to make sure that we deliver as fast as we can and deliver the best products that we can as fast as I know we can to all of the people around the world that rely on us. There's a lot of good stuff coming. I wish I could, you know, take you through the entire roadmap here. But I'm very excited by it. You know, the whole industry is moving fast. Our competitors are doing great things as well. But, you know, I've never seen something grow the way that ChatGPT is growing globally and specifically in India. It's such an important market for us. So we've got a lot more great stuff coming, and I think people are really going to like it a lot.
You know, I want to link this and end by asking you about the use cases, and education, I would imagine, is the big one. And I know that you've spoken about that previously as well, Kevin. Especially for a market like India, you know, what can we expect? Is that going to perhaps be a focus area or priority that you would want to consider doubling down on?
Yeah, I think there are, you know, people think about ChatGPT as you can make your job more efficient, you can write emails more quickly, things like that. But I think there are a handful of things that we can do, products that we can work on that will fundamentally make the world a better place. One of them is in the area of scientific discovery. These models are getting good enough that they are actually contributing to novel scientific research. They're advancing fundamental science. And, you know, GDP and world advancement and human growth comes from advancing fundamental science. So, you know, if these models can help scientists advance, if they can speed the pace of discovery 2x, 3x, 5x, 10x, that's an incredible impact in the world. If they can help people understand, you know, my son went through a medical procedure not long ago, and you know, we expected it was not going to be a big deal, but there was a small chance that it was a big deal. There was something wrong. I got a note later from the hospital that was full of, you know, medical jargon that I didn't understand, but it sounded scary. And I couldn't get a hold of the doctor to ask. I uploaded the image to ChatGPT and said, what is this? What's going on? Is this something to worry about? And it said, oh, no. Here's what it is. You don't have to worry. This is totally benign. And, you know, that was 72 hours of worry and stress that I would have had that was gone because ChatGPT helped me understand something that I didn't have the background to understand. You know, and that's our family with, you know, we're fortunate to have great medical care and all of that. There are lots of people around the world who don't have access to that, where having the ability to talk to something like ChatGPT could be life-saving. And then, you know, you asked about education. Every study I've ever seen says that when kids get individual tutoring, they get personalized education, their advancement rates are standard deviations better than kids that don't get personalized tutoring. And again, ChatGPT is free. It knows the curriculum for every class and every topic in the world and can give students personalized learning that evolves with them. Like I want to see every kid in the world have a personalized tutor that is helping them learn any topic they want to learn, whatever they're excited about, as fast as they want to go. The world will be a fundamentally better place when that exists. And I think we can be a part of making it happen, whether it's directly in ChatGPT, whether it's one of the developers and entrepreneurs using our APIs. I deeply want to see that happen because the world will be a better place. And, you know, I would love to see that come from India.
Well, I'll end with India then, Kevin, because, on the back of the usage, the adoption, the acceptance that you have seen in India, is there anything specific that you've taken back in terms of learnings to iterate for the next wave of product launches that we could expect?
Yeah, I mean, we just had 10 or 12 people from the team in India doing a bunch of user research, talking to people in different, urban and rural parts of India. I was there a month ago with Sam Altman and meeting people, talking to users, talking to developers. The amazing thing is how broadly ChatGPT is used. You ask a room full of developers who uses ChatGPT, and they all raise their hands. It's really exciting to see. And they all have 100 things that they want to see us implement or do better, new features, new ideas. We know that one thing that's really going to be important for us is performance in low bandwidth environments. Not everybody has a great network connection. We really want ChatGPT to be broadly usable across the entire country, no matter what, cell phone, no matter what network connection you have. That's important. We're also thinking a lot about how we broaden our language support. So ChatGPT, I believe, is the best ranked model in the world for the top 11 Indian languages. But there are a lot more than 11 Indian languages, and we want ChatGPT to be great for everybody in India. And so we're thinking about broadening language support and making more of ChatGPT voice forward for those kinds of use cases. So we have a lot of ideas. They're going to benefit people in India, and they're going to benefit users all around the world, and we're very excited about it.
Well, Kevin, thanks so much. We look forward to seeing more of you here in India and appreciate you taking our time very late at night to be able to speak to us today. Thanks so much, and we wish you the very best. Look forward to seeing you soon.
Yeah, thank you. And by the way, when I was prepping for the interview, I told our new model, 03, that I was going to be meeting with the premier broadcast TV interview or broadcast Indian business-focused TV station in India. And I said, what station do you think it is? And it said, oh, clearly, that's going to be CNBC-TV18. So 03 is a genius.
Clearly, 03 is a genius. But Kevin, what an absolute pleasure. Many thanks for joining us. And we look forward to having a deeper, longer conversation with you. Thanks so much for your time today. We are going to take a break here on the Global Dialogue, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more.
Chessboard. I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. How many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West, and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth, because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down the value chain in a sense. Even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning, and then you can start making your own product. Because we were just not in any of these global supply chains for so long.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before craft?
Go back to 1989, which is when you actually started your project, your passion, which was how do you take Priya and make it a modern cinema-going experience for the Indian consumer. Same time as the iconic Amir Khan movie Qayamat Se Qayamat Tak, which was set to capture the imagination of the Indian moviegoer. You know, was Papa Kehte Hain the anthem playing in your head at that point in time?
Well, Papa Kehte to the in my case as well. But I was really never thinking of the Indian consumer or the macro economics of the business or the vast potential. Simply speaking, I just want to prove to my father that I'm not a failure.
We're starting at a new financial year. You know, is there a silver lining that you can spot?
Sid Field is one of the writers I read a lot. So he used to always say, in every story in life, or there's Act 1, Act 2 and Act 3.
Where
Act
are we
one
today?
Act 1 is a setup. Act 2 is a conflict. And Act 3 is a resolution. My Act 2 has become very long.
Do you believe that there are likely to be regulatory headwinds?
Regulation should not happen at all. It is not part of an Essential Commodity Act. We don't come into that. So every time there is something that we hear from any state government, that's the only thing that saves us.
Music has been and performing has been a dream for you. But in an era and in a society where we're so bound by log kya kahenge, and there's a whole genre of Hindi movies dedicated to that, to say that you're going to do this publicly.
I just was very keen that I don't take the one-dimensional view of life, because we are all businessmen, we're running listed companies. This is our job, and if your job is something that stresses you, then you need to find other avenues to de-stress you.
The three most important things to Ajay Bijli, please share.
Hairline, bottom line, and waistline. And now being able to sing. What's written on the stave is important.
Hello and welcome to this episode of the Young Turks Reloaded podcast. My guest today inherited a single-screen cinema theatre from his father, but then had an epiphany when he was all of 23 and on his honeymoon in Orlando. That is when the idea of modernizing the cinema-going experience struck Ajay Bijli, and he decided to return and convince his father that that is what he intended to do with Priya. Cut to 2025. Today, PVR Inox is the largest chain of multiplexes in the country with 1,745 screens and over 350 cinemas and counting at this point in time. And the company has, of course, made several pivots along the way. To talk more about the PVR journey, the lessons in business and in life, is the man himself, Ajay Bijli. It's great to have you back on the Young Turks podcast. Wonderful to see you today.
Thank you, Shireen, for having me.
You know, I want to go back to 1989, which is when you actually started your project, your passion, which was how do you take Priya and make it a modern cinema-going experience for the Indian consumer. Same time as the iconic Amir Khan movie Qayamat Se Qayamat Tak, which was set to capture the imagination of the Indian moviegoer. You know, was Papa Kehte Hain the anthem playing in your head at that point in time?
My God. So you know how to articulate a question, don't you? Wow. Well, Papa Kehte to the in my case as well. But I was really never thinking of the Indian consumer or the macro economics of the business or the vast potential. Simply speaking, I just want to prove to my father that I'm not a failure. That I wanted to be somebody he was proud of. 88, I finished college, Hindu college in Delhi, and the transportation business was the mainstay of the family.
Which is your father's business?
My father's business. My grandfather started that in 1939, Bijli Pehlwan, and then Amritsar Transport Company. So it was very natural for me to go and join that business. But I struggled. I wasn't able to do a good job over there. But the second next thing that we had in the family was the cinema.
Which was courtesy an arbitration that your father had
that's right.
helped settle.
That's right. So that was his passion. He used to work in the day and then in the evening settle family disputes of various families in Delhi. And this is how one cinema came into the fold. So I said, if I can't do anything in the trucking business, let me try and do something to the cinema business. Somewhere I was very, I think I had an affinity towards movies.
Yeah,
definitely.
Did you watch a lot?
I used to watch a lot of movies over and over again. A lot of Mr. Bachchan's movies used to get played. So Parvarish, Hera Fairy, Mr. Natwar Lal. So I think somewhere there must have been some connection that I must have felt. And I used to always be a little restless about the environment. Is the screen okay or not? Why are the seats dirty?
Dark and
why is it
dingy.
dark? Why is it dingy? Maybe something can be done to it. So when I got the opportunity, I was inspired by a lot of cinemas in India. One was Chanakya, in Chanakyapuri, and then Sterling in Bombay, Metro in Bombay. These were like iconic cinemas. Raj Mandir in Jaipur. In fact, I was in Jaipur. My children went to see Raj Mandir just now. It's still very good cinema. And I said, oh, if they can do something like this, let me ask my father if I can do something. And then I got married. When I got married, then as you just mentioned, I saw a multiplex in Orlando.
While you were on your honeymoon.
And I called up from there and I said, listen, Dad, when I come back, can I revamp the cinema now properly? This is what I want to do. But the building bylaws didn't permit a multiplex. Only a single screen cinema you could renovate. So that's how it's happened. I just made the walls a little more colorful, put Dolby, where again my father played a very big role, and just played only Hollywood films because there were 93 cinemas in Delhi at that time. And mostly everybody was playing Hindi movies. Only Chanakya, Archana used to play English movies. And there used to be a backlog of Hollywood movies. And people used to feel that the movies come very late from Hollywood. But that was not the reason why they came late. They came late because if a movie did well, it ran for 10, 12, 14 weeks. So the next new movie could not be played. So I just, spoke to the producers, like distributors like Warner Brothers, MGM, Fox, Sony, that do you need another house? They used to call it a cinema house in Delhi where I can play. And they were just very happy. He said, yeah, Delhi is a great market. Priya is in South Delhi, where in any case the demographic is more acclimatized to
younger
urban.
and English speaking.
They'll watch English movies. So I got my first film, which was 3 Men and a Baby. I still remember.
How appropriate.
And that's it. That's where my, I started really enjoying the experience of creating an experience rather than just a movie, watching movies. How to watch movies was more important to me than the movie itself.
So you were ahead of this whole business of creating an experience and, getting into the experience economy, so to speak, like 30 years ago.
That's right. That's right.
But, and to quote the iconic line from Top Gun, was there ever a moment, in that phase where you were creating this movie-going experience where your father maybe told you that, son, you're writing checks that your body can't cash?
Every time he kept reminding me. Actually, he was, in a way, it was good because he made me cost conscious. He made sure that I didn't spend that kind of capex, that there'll be no returns. The other impediment was the entertainment tax. So entertainment tax was very high at that time. The decontrol of tickets hadn't happened. Still, you had a price cap of 14 rupees of balcony. So a lot of these factors were happening, which made me actually not spend too much money, just spend money. Yet within these constraints, there were cinemas in Delhi like Chanakya, Archana, and Sheila, who were doing very well because they were running at very high occupancies. So I said, even if the ticket price is 14 rupees, and even if there are these government restrictions and entertainment tax was at 60%, but if the occupancies go up to 70, 80%, you can still make a viable business. But honest to God, this is divine intervention that by the time Priya finished, 80% of the ticket prices were decontrolled. And there's no lobbying, nothing I had to do. But at that time, the CM Sheila Dikshit was very forward-looking. She herself realized, and the Association of Delhi, NAMPE it was called, National Association of Motion Pictures Exhibitors, they also were lobbying that this decontrol should go. Suddenly, the business became very profitable.
Well, speaking about decontrol, and I'll get to that in a second, because, are we coming a full circle on that from a regulatory point of view?
I should not give you any ideas for new questions.
No, you should give me
I'm going to keep my
many
answers
more,
very short
many
now.
more ideas. But, that period between 1990 and 1995 was a difficult period for many reasons. One, of course, you were getting started. Two, you lost your father in 1992. You had a fire as far as the transport business was concerned in 1994. In that period, you also managed to get into the multiplex business by bringing Village Roadshow on board. But they left in 2001. So, that was a pretty sort of up and down kind of moment for you, a period where you probably saw a fair degree of volatility. Did you think that you had the strength to continue?
Well, I think the biggest body blow is when your father passes away at an age of 25. I think nothing was more, devastating for me than that, because the business of transportation he was looking at. Somewhere his hand was on top of me, metaphorically speaking, that even if this experiment doesn't work, I can always go back to my trucking business. So but him going away really put things in a complete different zone for me. And then I had to ride two boats, because somebody had to take care of the transport business as well, and also this new baby that I was very excited about. And this was, touchwood, doing well. So that was a difficult period. And then when 94, the fire happened and we lost a lot of money. Luckily, nobody died in that fire, but we lost a lot of money. That's the time I was quite demoralized. And I said, no, now forget about Priya. Okay, I'll give it to a manager to run it. I need to take care of the trucking business. But every single day, going to the trucking company in Chandni Chowk was a bit of a chore. I just couldn't handle it. Then my mother, God bless her, and she's still there in the house, she said that you just don't look yourself when you're looking at when you're running the business. Don't worry, your uncle can run it, which is my Mamaji. Whatever strategic direction you want to do, you do with him, but go back to cinemas. That's the time I, was looking frantically for a partner to create multiplexes, because single screens, with due respects to them, I just found them very difficult to fill them up 52 weeks in a year, because 1,000-seater cinemas, some movies do well, some movies don't do well. You don't get 52 blockbusters. Till date, you don't get 52 blockbusters globally. So I just found the model becoming a little outdated. So I was very keen that multiplexing is the way to go. In a country where 1,600 films come through the system in a year, you can't have one single screen. And scale is something. Our common friend, Sunil, we used to bowl with him, Sunil Mittal, used to always say, whatever you want to do, scale should be there. Never look at mom and pop. So that little restlessness came in me, that I can't be just a single screen cinema. So therefore, I was fortunate to find, I looked for, by the way, lots of partners. I went to America, went to England, but I found Village Roadshow in Australia, who found the Indian market with a very high potential. And they said, okay, fine, let's do a JV. So you're right, 90 to 95 was very, very tumultuous. But with this JV, I suddenly once again got excited that this is the way to go and this is what I want to do.
Well, let's cut to the future now and where we are in 2025, and you're still recovering from what you have described as a body blow, which is, of course, the pandemic. One, you underestimated the impact of the pandemic. Two, you perhaps hoped for a faster recovery and a faster bounce back, which has been relatively elusive. As you look at the business today, we're starting at a new financial year. Is there a silver lining that you can spot?
Well, Sid Field is one of the writers I read a lot. He used to be a professor in USC. He used to teach film. So he used to always say, in every story in life, or there's Act 1, Act 2, and Act 3.
Where are we today?
Act 1 is a setup. Act 2 is a conflict. And Act 3 is a resolution. My Act 2 has become very long. Because of the
no intermission or too many ads.
because of the pandemic. The protagonists conflict is in act 2, as in life. That's where you're finding your feet. Lots of things happen in life. And I did underestimate that act 2 will become so long. So I think father's passing away was the numero uno body blow. This was also a coup de grace because cinemas were shut down. 2 years you didn't have any business, and habits changed. And both sides of the both engines that make our business work, the supply side and the demand side, there were changes. On the supply side, the content makers, India and globally, got distracted, and shooting stopped. And also they said, okay, people are sitting at home, so maybe we should, put our energies in creating TV shows and films for the OTT platforms, which was not happening pre-pandemic. Pre-pandemic, we used to all see Game of Thrones, TV shows, never short form films. So that happened. And they got distracted. A lot of money was spent. Even the streaming platforms did not have much shooting happening. So they also didn't mind, throwing a lot of money on
getting
content
these films on
and
board,
getting films on board and content on board. And on the supply, on the demand side, people got used to sitting at home and consuming entertainment on their TV platforms, and which is the reason why both things got disrupted. So it's taken a long time. Now, what we're seeing after 5 years, I call it like 12 quarters or maybe more or post-pandemic, what we're seeing is that water is finding its level. The producers have realized that the economic rationale of releasing the movie on the big screen is incredible. Because like you said, you saw a movie recently, Superboys of Malegaon. Prior to that, 12th Fail came. A lot of smaller movies came. Munjia came, where you made it only for 10 crores, 5 crores, but it did 80, 90 crores box office. So the economic rationale, there is no cap to when a movie gets released theatrically. So the supply side, I'll start with them. They realize that if we make the movie, we can monetize it in the entire journey. So first window of monetization is theatrical. Then comes OTT, satellite, all that sort of stuff. And if a movie does well, it clicks, then you can monetize it much better on all platforms. And then you can negotiate with everybody. The streaming platforms also realize now the world has opened up. So you don't need to pay an arm and a leg to get content. Let the movie theatrically perform first.
And then bring it
and
back.
Then bring it back. So that has happened. And of course, the consumers, the most important, they also realize that we need to get out. We've already been incarcerated at home for so long. But there I'm finding a bit of a mixed bag.
How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me,
Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded everyone.
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that
On the consuming habits changing,
Yeah.
and what this potentially now means as far as occupancy is concerned. It's been stagnant at around this 25%, 25.7% for the last
Yeah.
quarter is the occupancy levels. What do you do now to drive footfalls? Because the experience is in your control. The content is not. You
Correct,
can't do
correct.
anything about the content.
So, like I said, Act 3 is not over. I'm still as sanguine and optimistic about the business. So when I go and look deep into what happened 2021, 22, 23, 24, 24, 25, which is going on just now, the number of movies, first of all, got reduced. Only 85 Hollywood films got released, as opposed to 174 movies. This year, again, the number is going above 150 because that screenwriters strike and all that happened. So if the movies become 175 or 174, that means you've got more content.
Yeah.
The chances of hits and misses will always remain.
Sure.
But because
Hopefully more hits.
So our businesses in India, this is the only market I'm comfortable with, is a volume-driven business. Volume in consumption and volume in supply. So therefore, if one or two movies don't do well, doesn't bother me, because you'll always have a sleeper hit that makes up for a movie with high expectation that gets compensated. So I think because the movie flow coming in, it'll be more appealing even to the consumer. Even in India, a lot of movies got bunched up in 23 and 24 because shootings had stopped. So Shah Rukh Khan, 3 movies got released in 1 year, which is unheard of. Amir Khan, no movie has still got released post-pandemic. Ranveer one, Hrithik only one. All these guys also, to be honest with you, and obviously that's my supply side, were also a little figuring out what does the consumer want. I think now they've got their act together. A lot of work got done on the script. And as I say, it has to be on the page before it goes on the stage. Sorry, I'm quoting these
Please quote away.
movie-oriented.
More dialogues. We are in a movie theater.
So I think a lot of time is getting put on what's on the page. And I feel that this 25, 26 onwards, these occupancy levels that we're talking about are bound to improve, because the supply side
But hope
is
can't
looking,
be a strategy, right? So
hope is not a strategy.
Yeah.
So what we are doing is a couple of things. I'm saying, okay, if we reach the 31% level, excellent. If we don't, let's align all our costs and our strategies to 25, 26%.
Right.
Okay.
Right.
So therefore, one is that FOCO model, where I've already spent 5,200 crores on this circuit by inorganic and organic.
Yeah.
So we are only doing what hotels have done all their lives.
Yes.
Okay. Get, basically monetize the brand.
Yeah.
And have
So somebody else sets up the infrastructure, you run it for them.
Correct.
To put it simply.
Absolutely.
Yeah.
And I must confess that I've been fortunate enough to meet a lot of chief executives of Trent, various other Titan, hotel like Puneet Chatwal. I've exchanged a lot of notes. Nobody in the exhibition business has done this globally. First time in India, this has been done.
And first time worldwide?
Worldwide,
Okay.
yeah. So we're very fortunate, and some of the developers, I mean, have been incredible. People like DLF, I don't mind mentioning them. I'm a big fan. They've also realized that this is the model to go. Cinema is a necessity for their shopping centers. They will invest some money and we will manage it. And in smaller towns, tier 3, tier 2 also, we've had this response. Like people feel very proud to be part of a hotel.
Right.
People own a hotel or a Tanishq.
Yeah.
Or a Titan or a Zudio or whatever. Similarly, they have this pride that, oh, PVR is mine or an Inox is mine, and they spend the money. We've had to spend more money on our SOPs, brand, and what we bring to the table. So that's one thing that we've done to make sure our ROCE improves.
Yeah.
If we can do more and more screens, around 100 screens got signed last year. This year also about 100 odd screens.
So who are these developers who are coming on board for the 100 screens that you've already got in play and the additional that you are looking at?
Mix of people who are organized and unorganized. One are just one off, two off, in Jaipur, Udaipurs of the world, Nandeds, Ujjains, Indore, Kota, these kind of Ajmer, these kind of places, and then big ones who definitely need a cinema, and then they are also so a mixed bag. But we've got a tremendous response.
So
on
what
this
does
as
it
well.
mean in terms of additional revenue? Because on the back of the management fee that you're going to be able to get in from this.
So initial fee, technical fee, and then management fee. That is one. That's one model that we're doing. And then line by line costs. We're looking at, and also all the new deals that we're doing are all on revenue share. That will make sure that the volatility taken care of. So the minimum guarantee are paid, but their minimum guarantee is not very high rentals. And also when the business is good, then they share the spoils with us because we give them a revenue share. So that's one model. Other is line by line, zero based, costing of every single, whether it's manpower, marketing, electricity. We're looking at a lot of solar to help us bring the cost down. So we're saying that if we, even at 25%, if we can get those margins that we were getting pre-COVID, we are okay. But if we do go back to the occupancies we were getting pre-COVID, then fantastic. That's all gravy. Other than that, the 3 Fs that I spoke about, I'm saying that we already have an infrastructure. We have 15 million square feet, in India, which is, by the way, I think the largest for any retailer. I think so, I've been told. Why can't we use those spaces for alternative, kind of entertainment? So that's the fun part.
Yes.
Some by repurposing the cinemas, some without repurposing. So if we're showing IPL, we don't need to repurpose. If we show Taylor Swift's Eras tour, we didn't have to repurpose. BTS, we didn't need to repurpose. A comedy, stand-up comedy, whatever, all those kind of things. We did something called Candlelight show. Those are without any repurposing.
Right.
There's one more strategy that we're doing. We're doing about 4 pilots just now. One in Bangalore, Gurgaon, Bombay, everywhere, where we're repurposing certain cinemas, creating green rooms, having bleachers where, your seats can, combining 200-300 seater cinemas into one seat, this thing, and doing gaming. Going, and by the way, everybody's not Ed Sheeran and Coldplay or Diljit Dosanjh.
Yes.
You have so many artists who are happy with 1,000 seating capacity getting filled up. So I'm, as you know, fond of music as well.
Yes, we know.
So I'm in touch with a lot of artists, a lot of managers. There's so many artists.
You're getting into the kind of Book My Show, Zomato district kind of space?
Only providing the infrastructure.
Right.
So I don't want to do something that I can't. There are experts who are doing it, whether it's district or whether it is.
So do you tie up with them?
We tie. They can, sell our tickets. And so that's the fun part. Where can we repurpose our cinemas? Some amazing things are happening on some of the projects which are basically still under fit out. We can have pickleball. We can have, so bowling centers, small bowling centers, gaming centers. So youngsters are coming out anyway. We're also looking at in Bangalore and Gurgaon to get some liquor license.
Okay.
Where we're sitting just now, we have a liquor license. Because kids do want to mingle. So one is passive socializing, which is watching a movie. One is active socializing, competitive socializing. Pickle is a pseudo sport, I call it.
Pseudo sport.
Definitely.
You'll have many pickleball fans writing to you
because
now.
I played squash all my life. I know it's a pseudo sport, but but it is active socializing because people are playing and then they have a beer after that and all that sort of stuff. So I'm saying, why can't these things be brought into our
The
fold
fund
as well,
space.
the fund space.
Hmm.
And food is what we've done with Devyani.
Yeah.
Food courts,
Yeah.
again, we have relationship with all developers. Zomato tie-up to be able to deliver at home. Some of our branded, things like, which are non-benchmarkable. Hot dogs are non-benchmarkable. So we have a brand called Dog Father,
Okay.
which we are taking out
Dog
of cinemas.
Father. Very original.
Where does
Very
that come from?
original. Very original.
So these are the things that we do.
So are you going to be doing more like that? I mean, private label stuff as far as the food business is concerned?
Getting out of, so not having everything post-ticketed, have something pre-ticketed, because it's one lesson that pandemic has taught us. It's all binary.
Yeah.
Shutters down, all revenue is gone. Whether it's cinema, whether it's tickets, whether it's F&B, whether it's advertising. So I said, God forbid, we must have a strategy where even if shutters are down,
outside of the theatre.
So it's early days.
On the fun side, I want to talk to you about how the IPL is doing, because we're in IPL season at this point in time. And what's the expectation as you look at many of these pieces that you just took us through on the fun side? What do you believe this engine, this vertical could be in the next few years for you?
It can be, these are early days. But as I said, I first have to look at the infrastructure that I've already got. I've already got 15 million square feet.
So you're sweating your assets,
I first need to
essentially.
sweat this up before I say, okay, let's take over a stadium. That's another real estate. But if we can do it without any capex involved, then I think it's something that PVR definitely should be looking at. Nothing should stop us from going out and also having artists and because it's the same consumer.
Yeah.
We, even at this time, we'll get 150 million people to our cinemas, and they're all youngsters. There's the same guys.
So you're actively looking at that possibility?
We're looking at that. We may do it ourselves, or we may tie up with an expert. But definitely, that's an area that should not out of home entertainment, not in home.
But how far are you into putting those plans into play?
Well, conversations have started. Conversations have started. We're evaluating
In India or global conversations as well?
like India. India to look at bringing the. I just like to be in the Indian market.
No, I mean conversations with Indian players or also with global players to bring global artists into India.
Inside, we still need to look at the economics, because I think the infrastructure still needs to improve. You still need to have studios like O2. You need to have studios. I'm saying stadiums, which can have a 52-week programming, not sporadic programming. So sporadic programming is like cinemas again. You've got this infrastructure, and only one Ed Sheeran will come or Coldplay will come, then what do you do the rest of the years? But I've seen, at least whatever little studies I've done, that 52-week programming is done throughout. So therefore, you don't have to keep rebuilding the infrastructure only when one big event happens. So I think we need to examine it. But that is something that I think will come pretty naturally to us. So, but as I said, I don't want to again go ahead and invest capex in something new. First, I have to look at my core. How do I get my core even at 25-26% to get the same margins that we were getting earlier?
So let's talk about the core, which continues to be film at this point in time. And, many experiments underway there as well, whether it's passports or it's ad-free films and so on and so forth. I mean, what are you now seeing as far as the core business is concerned? And what could we expect in terms of fresh innovations from you?
Well, you see, first of all, I must tell you that our ETP, we've just declared our results, which is average ticket price, is still 281. But people take the perception of coming to a director's cut or a Juhu or a Koramangala and then extrapolate that as our...
Because that's 1,200.
No, on the weekend, for a big movie, it can go as high as 1,200. But you cannot extrapolate that to be our average ticket price. Having said that, the consumer is sensitive. Some consumers are sensitive. Some consumers are not sensitive. They're more sensitive to experience, what movie it is, F&B, hospitality. So for that, we have 20% of our circuit is premium. Okay, whether it's recliners, whether director's cut, Lux, Insignia. But 80% is price sensitive. So for that, we've got... So I still feel that we have to be aspirational and affordable. If you just be affordable, then we've seen what's happened to a lot of cinemas where they've not invested at all in the infrastructure. So some aspirational, I always think all over the country, we need to be. So Passport was one such experiment that Monday to Thursday is an off-peak period anyway. and senior citizens, students who go to schools, colleges, a lot of people, they can get an opportunity to come and see cinemas, movies of their choice on an off-peak period. So that's what Passport was done. It was very successful. So like that dynamic pricing, weekday, weekend is something that we keep playing around with. But we also don't want to leave too much money at the table when a very big movie comes and people have the discretionary income and the desire to watch a movie, because even these movies are not made cheap.
Right.
So you need to get a return on that. So I think pricing is an important tool, but these experiments we continue to do and they're doing very well. So if that's answers your...
That does answer but some part of my question. But on again, one of the ancillary revenue streams that you are looking at, and that is advertising. Again, what do you foresee as far as that side is concerned? And do you believe that there are likely to be regulatory headwinds there?
I think we are regulation should not happen at all, because ultimately.
But that's again something you can't control.
Well, the only way I can control it is that it is not part of an Essential Commodity Act. We don't come into that. So every time there is something that we hear from any state government, that's the only thing that saves us. We're not an essential commodity. We are like any other leisure activity where people can come or not come, depending upon whether they are attracted to us or not, offering and the price. So therefore, like airlines, hotels, hospitality, any product, any service is allowed to market itself or price itself. So I think that's the bracket. It's just that the hangover of in 1990 only, the industry got decontrolled. The people still remember how much an orange bar was, how much a popcorn was, how much a samosa was, how much a ticket was. So we still haven't gone into, it's only been 35 years or whatever. So it's still very much in people's memory. That's why we suffer once in a while where suddenly some regulation comes. Having said that,
how
now,
worried are you about the possibility of price caps coming back into force? You just talked about an era of control and then decontrol, and you believe that we're still not past the mindset of an era of control. How concerned are you today about price caps? I mean, the Karnataka government did bring that.
And luckily they haven't gone through with it, because they also realize that this is not something. If you're giving an offering at different price points. So we've got cinemas in Karnataka which are at 100 rupees as well. And then we've got like maybe 10 screens which are charging 1,000, because our objective was to get everybody out of their cinemas, even of their homes, and watch movies on the big screen. It's a very heterogeneous market, people with different tastes and preferences. But coming back to your question, how I am, I get concerned when suddenly we get targeted as somewhere there should be a control, because we should not be having any control. It's a free economy and free market, and we should be allowed to price the way we are.
I'm seeing, but overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue, because that's going to help the client in a situation which is a lot more uncertain for them.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Besant has already said that the first 4 deals we sign are with allies. And he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that, because they've always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others. And then we want people which are
we're at the start of a new financial year. How confident do you feel about scripting a turnaround for the movie business this year? And what does it mean in terms of your debt levels as well? You've been able to cut debt by a little over 200 crores in the previous year. What's the expectation on that front?
Well, because we're doing this FOCO model and because we're doing an asset-light model where the contribution from the developer comes, I think the accruals should be enough to reduce our debt levels. And the movie lineup this year is looking very good. And so I'm very optimistic about 25, 26. We started with Sikandar, which didn't do well. But now we have a lot of Hollywood films like Mission Impossible is coming, Avatar is coming. And our circuit is very, very dependent on Hollywood. So Hollywood was the main reason why we had not such a good year, 24, 25. And 25, 26, all the movies are, F1 is a big one. Apple for the first time is releasing a movie on the big screen, which is again a great sign. Jurassic Park is coming. Amir's 2 films are coming. This big movie called Love and War of Ranbir is coming. Raid 2, another movie of Akshay is coming. War 2 is coming. So we got a good lineup. And Kantara 2. After a long time is coming, which I'm always looking forward to.
As you map out, the next leg, the next phase of growth, of expansion, of pivots, give me a trailer of Act 3.
I think cinema companies, pure form cinema companies, will be okay. No, not at all. Please. No. It will be okay, but the cost structures have to be aligned according to the. People will definitely go and watch movies. There's no question about it. But can you align your costs with the occupancy dip that has happened after pandemic? That's the critical thing. So if somebody was starting from zero base and he still wants to be the exhibition business, then he must be, he align his costs accordingly and just don't get carried away that India's only got 9,000 screens. And China's got 40 or whatever has got 30, 35, whatever. So I think cinemas will always be there. So I'm optimistic about that. But I think there's no harm not putting all your eggs in one basket and say that, okay, you have a brand, you have a consumer base of 150 million people coming. They're not just movie buffs. They like to do other things as well. There is no harm in creating some other out-of-home entertainment activities also for that consumer who's loyal to your brand.
So the diversification is more out of a need at this point in time as opposed to something that you would have chosen to do.
Well, pre-pandemic, I never thought of doing that diversification because I thought, there was enough happening. Even pre-pandemic, I used to think about out of home and how do I remember with Renuka and all the board members, we used to sit and say, oh, that's a lot of people coming. 160, 170 million people coming. Let's look at what else do they want. Can we do merchandising? Can we do some F&B? Can we do something else, something else, something else? There's so many little avenues, adjacencies, then you can come out with. I even spoke to McKinsey. What else can we do? So I was very keen to expand the brand.
How did you pay McKinsey to tell you what else you can do?
Yeah, because sometimes sometimes it's a good idea to bounce off what else. The brand is strong.
So did they
people
come up
are
with
coming.
any of these ideas that you're
taking
forward?
Some of them were this, and even the popcorn vertical that we have, 4700 BC, PVR, that was also something like that. So there were a lot of thoughts, and I think that's not a bad idea. I know Cineplex Group in Canada, they've got something called Recreation Room. They call it the Rec Room. I don't like the word wreck. It can have different
Yes,
connotations.
with a W, it's an entirely
That's what I'm saying.
different meaning.
Enough wrecking is happening in the world. So I thought that was a good idea, because the same consumer who's coming. This is actually part of diversification.
This is a rec room.
Yeah, because we are watching a movie, and I think 50% of our customers who watch movies come here before or after and watch and have a drink or listen to some music or something like that. So I think these kind of adjacencies cinema companies should do. There's no harm. And just that's a massive lesson from the pandemic that one should do.
A lot of the scale has been driven by way of M&A and acquisitions. And of course, Inox was the big one. Who reached out to whom?
I think we both sort of, we knew what was going on in each other's heads. And I don't remember whether he reached out or I reached out, but I remember, and there were the people, there were a lot of intermediaries like common board members or board members who felt that this should have been done. Nitin CFO was pretty instrumental at that time as well. And when we looked at, if you put the 2 and 2 together, the two halves together, it would make a complete. And there was a logical thing to do. And again, fit was good, because Inox also was building very high quality circuit. And so, that's it. So it had to be done. But again, we didn't anticipate that the
bounce back would take as long.
Bounce back would take that long. That's
as
the
long
only.
as it has.
This is the only thing I didn't anticipate will take so many quarters to bounce back. But the only saving grace is that there's explainable reasons of everything. So when I say, oh, what happened in 21-22? Well, shootings had stopped. Okay, fine. What happened in 22-23? There was a strike. What happened in 23-24? So every year there's been a reason. Oh, windows were short. So every year, this year when I looked at, and I was in Karnataka, met a lot of producers, I'm in touch with, everybody is making movies. Very, very encouraged that the feast that happens, so there's feast and famine, they say. Feast is another level.
The famine is over and the feast.
Yeah. And the feast is like incredible. Biggest movies ever have happened post-pandemic. What explains that? The biggest movie pre-pandemic was Bahubali 2, 1,000 crores. Post-pandemic, Pushpa 2 is 1,200. KGF 2 was 800. Shah Rukh's 2 movies was 600. Third movie 350 or 400. Animal was 600. Stree 700. Chama 600. These numbers are unheard of.
We look forward to hearing more from you about that. But, speaking about life coming a full circle, I want to talk about 1988, which is when you were in modus operandi, and cut to now with Random Order. And for those of you who don't know, Ajay is actually performing with his band Random Order, and performed at the CNBC-TV18 Global Leadership Summit in Mumbai. But Ajay, and I have to say, I think it takes immense amount of courage to be able to not just live your dream, because music has been and performing has been a dream for you, but in an era and in a society where we're so bound by log kya kahenge, and there's a whole genre of Hindi movies dedicated to that, to say that you're going to do this publicly. I mean, what was that moment like for you when you finally decided, to hell with it, I'm just going to do it?
I think pandemic, I just was very keen that I don't take the one-dimensional view of life, because we are all businessmen, we're running listed companies. This is our job. And if your job is something that stresses you, then you need to find other avenues to de-stress you. So in the pecking order, of course, my family being with me was the most important de-stressor. And then I said, okay, what else can I do? And keeping fit was important to me. I didn't
want to... The three most important things to Ajay Bijli. Please share.
Hairline, bottom line, and waistline. And now being able to sing. What's written on the stave is important. So I think I told Selena, I told my family that, listen, I've always been very passionate. Should I start again? So I said, why don't you do that? And there's only so many Zoom calls you could do. It was exhausting. So then I found myself having a lot of time, because no traffic, nothing, sitting at home. And I started taking some lessons. I didn't want to get into it straight away. I got this lady from Berkeley School of Music. That's the best in the world. And asked her to teach me how to improve my vocal skills. I got a Hindi teacher, and who taught, because I love Hindi music as well, and English. And I said, let me try both these techniques. And after about 6, 7, 8 months of training, I got the confidence to be able to sing properly, hit all the notes, whatever, within my range. And then I said the next step is random order. And I didn't want to do that romanticized what happened in Rock On, get my old buddies back, because nobody was interested. I said, what? Drummer? I've stopped that ages ago. What guitar? Forget it.
And
Which
what's
world are
wrong
you
with
living in?
you?
What's wrong with you? Then I spoke to Gaurav of Medieval Pundits. And he's a good friend.
Yes.
And he said, Ajay, don't go to these guys. That was a movie. Okay. Go to these professionals and jam with them and see how, and be very frank with them. And then if they think that just is like a ego vanity thing and you can't sing to save your life, then they'll tell you. But if they think you can sing and jam and there's a music, and they'll be a band. So I was fortunate. There were some pluses and minuses, but finally I was able to form a band of some incredibly dedicated and good boys.
Yeah, but forming a band of incredibly talented musicians and playing in your drawing room is one thing. But to actually step out and do this publicly, I mean, that's an entirely different game.
Yeah, I mean, I was fortunate that I practiced and I got that confidence and I got the encouragement.
Did you worry about how it would be perceived? Would people think that, oh, is he retiring? Is he giving up on business? I mean, did you worry about
I used to look at the CNBC ticker of my stock price for sure, with every note. And then when I sang It's My Life and it didn't go down, I said, maybe I can sing Bon Jovi's song.
No, but really, to have the courage and the audacity to say it is my life, and it's not something that comes very easily, and certainly not something that comes very easily in the Indian business circuit. To do that, I mean, what was the initial response?
Well, people were saying that, just don't get carried away. I mean, initial response was, as long as it doesn't affect my business hours and people still take me seriously, all stakeholders.
Did you worry about the fact that people may not take you seriously?
Yeah, I did actually. And I said it shouldn't eat into my work hours. And then that's why that unearthly hour I have to get up at 5 every day to be able to sing and do my riyaz at 5 in the morning. And even because she's in LA, my teacher, my classes start at 6 in the morning. And so therefore, I was trying to make sure my work doesn't suffer. If anything that suffers is my singing, because there's only one set of vocal cords for talking and singing.
And I have to say, you're absolutely spectacular. It's been wonderful to see you perform on stage. But speaking of the kids, and we talked about how you kind of came into the business that your father had started. What's the plan now as far as the kids and work?
Kids are, now look at the state of the company. I mean, it's very transparent. I'm at 11%. Jains are at 16%. Widely held. Incredible institutions who've supported us in the past and now and in the future. I think it's difficult for kids to now just come in. They're very passionate about everything because they've grown up in cinemas and watching movies. So with all the approvals of NRC, I've given them some small roles, and I've told them that, okay, let's create value. Okay, let's all forget about remuneration, forget about designations, roll up your sleeves. Can we create value? It could be anything. It could be an experience. It could be the F part, fun part, food part. Like Naina is looking at the fun part. Amir is looking at the innovation part. Niharika is looking at programming and re-releases. This was our own initiative. But there's no need to get a designation or a remuneration for which you have to go to the NRC or the board or the shareholders. Why have egg on your face? Why do all that? Why show that just because I have to, reconcile to the reality? That's what my stake is. At the same time, have other avenues where we can grow, which is beyond movies, beyond cinemas. Of course, my eldest is very keen on making films, Niharika. She was in Brahmastra and she wants to be a director and producer. But that'll happen, on a personal front, I'll do something. I'm doing something for her. But other than that, we'll find they'll all, create whatever value they can for PVR. At the same time, look at other avenues, I think.
Well, Ajay Bijli, we hope that you always continue to hit the right notes and continue to create magic in film, food and fun. But thanks very much for your time, and we wish you the very best of luck. As always, appreciate you joining us here on the Young Turks podcast.
Thank you so much, Shri. Thank you.
Well, with that, it is time for us to wrap up this edition of the Young Turks podcast. From all of us here on the team, for now, goodbye and many thanks for watching.
And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of.
Well, the newsmaker, the Chandrababu Naidu-led Andhra Pradesh government has allotted over 21 acres of land to TCS in Visakhapatnam for a price of 99 paise. Yes, you heard that right. It's not a mistake. The IT bellwether will invest over 1,300 crore rupees to build a development centre. The press release from the Andhra Pradesh government cites the example of Tata Motors getting subsidised land in Sanand from the Gujarat government when Narendra Modi was the chief minister. We're now joined by Nara Lokesh, the Minister for HRD, IT, Electronics and Communications in the Andhra Pradesh government. He's also the chairman of the group of ministers for job creation in the state. Mr. Lokesh, many thanks for joining us here on CNBC-TV18. Appreciate your time. Let me start by asking you to elaborate on the terms of the deal that has been inked with TCS. The press release is short on details. Can you take us through how you arrived at this deal where TCS essentially takes the land for 99 paise and sets up a development centre in Vizag?
Just to be clear, Shireen, this is actually a sale of land at 99 paise. And this project of TCS is expected to create close to 12,000 IT jobs in Visakhapatnam, which is the IT capital in the state of Andhra Pradesh. So we're really excited to have TCS land finally in Visakhapatnam, and we're looking forward to inviting the other larger IT players also to come down and set the shop up in Visakhapatnam. Now, Visakhapatnam, it's not just about the land. We have amazing talent that's available. And if you look at it in the IT sector, people from Andhra Pradesh and Telangana, the Telugu-speaking people, have a very large role to play. So we have amazing talent pool. We have great infrastructure. As a state, we're willing to give land at a very subsidized price. And I keep jokingly telling people that if go over to marry Bangalore and have a child, that would be Visakhapatnam. So we have it all. And we believe that this could be the trigger for large investments coming to Visakhapatnam.
You know, if I could unpack what you just said there, in your own words, you have it all as far as Visakhapatnam is concerned. You talked about the infrastructure, you talked about the talent pool. Why then did you feel that you needed to sell land to TCS? And once again, I'm pointing out now, as you just corrected us, that it's not leased. You've actually sold the land to TCS for 99 paise. You had all these compelling reasons that you yourself just articulated for us. Why did you then feel the need to sell the land for 99 paise to TCS?
Well, we need a catalyst, and we believe TCS is going to be the catalyst in our IT growth. And that's why we believe that we should give favorable terms to companies that are willing to bet on Visakhapatnam early on. And this is going to come about as a policy, and which we're going to encourage more and more IT companies to come and set up their shops in Visakhapatnam and give favorable terms for them too. And if you look at it as one of our whole promises to create 20 lakh jobs in the state of Andhra Pradesh, both in the private and the government sector. And the cornerstone of that is creating IT jobs. So we are not going to leave any stone unturned in terms of attracting investments.
Okay, so you said that TCS gets the first mover advantage, so to speak, and hence it's been able to get this deal done for 99 paise. Does this now not create a floor or a cap, so to speak, tomorrow if it was to be Infosys or HCL Tech or any other tech company that came your way, would you not have to offer them the same deal?
Well, I'm ready to do some deals and create jobs in Visakhapatnam. I think that's the singular focus that the government currently has.
But this is prized real estate that we're talking about, and you're not leasing, you are selling the land. So I come back again to the possibility of questions being raised, as has happened in the state of Andhra Pradesh previously as well, about under what policy these terms have been arrived at. How will you take forward these decisions? Because I would imagine you want to be mindful of discretionary power and discretionary decision making.
If you look at it, this is how Andhra Pradesh has always done business since the 90s. I mean, that's how we landed ISB in Hyderabad. That's how we got Microsoft to Hyderabad. And if you look at the work that we've done, in 2014, that's how we got Kia to Anantapur district. I mean, you have to take bold decisions, and these decisions have stood the test of time in politics. And if it's going to create jobs, I believe people will bless us with it. No second thought.
Yes, jobs, of course, are important, but you mentioned Microsoft and some other companies, and you said this is how Andhra Pradesh has always done business. But, were those deals done at 99 paise or anywhere close to that amount?
No, absolutely. I mean, if you look at the kind of incentive packages that were given to them, it was very favorable. to bring Kia to Anantapur district, we had to give a favorable incentive package, and we did it. And just because of that one decision, today the per capita income of that one district is among the top 4 in the state of Andhra Pradesh. So that's what makes Telugu Desam Party unique in the way it does things and the way it attracts investments to our state.
No, so I want to come back and labor a little bit more on this. So would it then be fair to assume that this deal, in a sense, becomes the floor for the IT services sector, or even outside of that? I mean, what about manufacturing companies, for instance? Because will you offer a manufacturing company that's looking to set up land at this price?
No, it depends on the kind of jobs that they're going to create.
So is it linked? So TCS 1,300 crores, 2,000 jobs. How did you arrive at this 99 paise?
It's 12,000 jobs.
12,000 jobs. How did you arrive at the 99 paise?
Because it's an IT company and it'll create higher order jobs for us, and we believe that IT sector should be promoted because the kind of impact it has on the larger ecosystem is massive. And that's how we arrived with that. And we believe that that's how every state should actually compete and attract. And we felt that giving land at this price is going to create a unique competitive advantage for the state of Andhra Pradesh to attract the next wave of IT jobs coming in.
Okay, you said that this is going to be part of an IT policy as well. So is that IT policy going to now take forward the decision that was cleared by the Andhra Pradesh government? Will the contours of the policy reflect this deal that's been done with TCS, or will it be different?
No, it'll be quite similar to what we've announced recently, and we expect to bring that policy to our next cabinet meeting, which is the end of this month.
Okay, and what about manufacturing? I go back again, whether manufacturing should expect similar deals and similar pricing from you?
We've already done it. We've showcased it. Look at the way we've landed ArcelorMittal to Andhra Pradesh. We got Premier Energy to come set up their solar panel manufacturing in Andhra Pradesh. And we got Kia in our last term to Andhra Pradesh. And we got few other companies now already lined up to invest in our state. So we are offering favorable terms to investors based on the kind of jobs that they're going to create. And, they're really excited to invest. Even in the solar renewable energy sector, recently Tata Power has made an announcement to deploy 7 gigawatts of renewable energy assets in Andhra Pradesh. We are here. We're here to move fast, and the speed of doing business is the new mantra for Andhra Pradesh.
The speed of doing business is the new mantra for Andhra Pradesh, as opposed to the ease of doing business, which was anyway promised. But, I want to go back to the linkages. You said it will depend on the kinds of investments a company commits to making. So is there a bare minimum in terms of the quantum of investments, in terms of job creation? If you can give us some idea of what this policy will encapsulate in terms of the minimum required investment as well as the minimum job creation committed or guaranteed.
The IT policy will have a minimum job creation of 500 jobs per acre of land allocated. So that's going to be the thumb rule by which we're going to go. Renewable energy has a completely different parameters on which we take decisions on. The compressed biogas project, which Reliance Industries has landed in Prakasam district, they're going to do 500 plants. That has a completely different policy under the integrated clean energy policy. So we have very, very sectoral specific policies that are already out there. And those policies will drive our incentive packages to the various companies. And it's very dependent on the type and quality of jobs that they're going to create in the state of Andhra Pradesh.
Okay, so sectoral packages in each will be different depending on the kind of investments committed as well as the job creation that will accrue on account of that. But if I could also ask you to articulate for us, what is the current land bank that the Andhra Pradesh government is sitting on? How much is being allocated for these different sectors at this point in time? How much are you allocating, for instance, for the IT sector to start with?
If you look at it, APIIC has close to 1 lakh acres of land already under its possession, and we are in the process of identifying another 2 lakh acres to create MSME parks in every assembly constituency of the state, because MSMEs also create substantial part of jobs. So that's going to be very, very critical for us. And IT is all about Visakhapatnam, and of course, we keep this open to the investor who's willing to invest. They can choose Amravati, they can choose Tirupati. The option is left to them. And we have substantive land available in all these zones to allocate to the IT companies.
Okay, so 1 lakh acres under the Andhra Pradesh government's current land bank. Are you looking at acquiring more? Is the state of Andhra Pradesh looking at further land acquisition at this point in time?
See, more than land acquisition, we believe in the partnership model where the farmers are also part of this entire growth journey. It's called the land pooling. And this is something that we've showcased in our capital, which is Amravati. So we're looking at making the farmers part of this growth journey. So, you know, we will take land from them and they'll get certain percentage of developed land back. And they can also enjoy the fruits of development. And this is going to be very, very important that wealth trickles down all the way to the bottom.
Okay. I also wanted to get a status check from you on some of the conversations that were underway when you were in Davos. You did meet with investors there who were looking at the possibility of setting up facilities in India and particularly in the state of Andhra Pradesh. Has anything moved forward on some of those conversations? I mean, TCS is one decision that's been done. Anything more that we can expect?
Well, in the next 100 days, there'll be quite a few announcements coming out from our conversations at Davos. It's across the logistics sector, in the IT sector, with private universities coming to set up shops, set up the schools rather in Andhra Pradesh. So there's a lot of excitement across sectors and we are ready.
Shipbuilding was another possible sector that you were hoping to draw in investment. Is there an update there as well?
I mean, I think at this juncture, I'll be speculating. So you should wait for an announcement and you'll be the first person to know it from me.
Okay, we look forward to that. But, you know, if I may, how much of the announcement is linked to the competitive federalism that we are seeing? I mean, you know, you were part of 6 states pitching your story to foreign investors, to global investors in Davos. They're trying to get pretty much the same universe, the same catchment of companies to set up shop, whether it's in Telangana or Karnataka or even in the north in states like UP, etc. How much of these incentives or subsidies for industry that you're willing to put on the table has to do with the fact that it's a fairly competitive environment? Have you been pushed to offer these sweeteners to draw in investment?
See, we're no longer competing with other states. We're also competing with other countries. It's very important that we understand that. You know, Vietnam plays a very important role in electronics manufacturing. So an investor who's looking at to invest in this part of the world is going to compare countries and then compare states. So it's important that we compete at that level. And I believe that this is very good. Competition is always good and we learn from each other as states. And, you know, some states have specific strengths and certain companies sort of go in that direction. And Andhra Pradesh has its own unique competitive advantage. And that's what we're showcasing at this juncture.
So would it be fair, I mean, you have, of course, listed out a bunch of sectors that you intend to focus on, renewable energy being one of them, electronics, EV manufacturing, oil and petrochemicals, where we've already seen an announcement coming in, food processing, you spoke about MSMEs as well, IT, ITES. Would it be fair to assume that at least for now, in the near term, that IT and ITES will perhaps get top priority in terms of attempting to draw in more investors and more investment?
I mean, our chief minister is an impatient politician. He wants things to be done yesterday. He's very clear that we need to attract investments across sectors. I'm part of the cabinet subcommittee. I'm the chair of the cabinet subcommittee to create 20 lakh jobs in Andhra Pradesh. So our goal is to create 20 lakh jobs across sectors. And we have a very thematic approach based on the districts where we want to create the entire ecosystem, including education, skills, and the whole 9 yards in that particular district. And with a very thematic based approach, we are now building the entire ecosystem. And we believe that we're going to attract investments across sectors. We've already done it. You know, ArcelorMittal is done. We're attracting investments in the pharma sector. Compressed biogas is one thing that's done really well. Renewable energy is done exceptionally well. TCS is a great announcement. You'll see more coming in the IT sector. So it's quite diverse in that sense.
In light of the latest set of tariffs that have been imposed by the Trump administration and the escalation that we are seeing at this point in time as far as the trade war is concerned, how do you position the state of Andhra Pradesh? Are you actively going to be reaching out to investors, particularly in the ASEAN region, who may be looking for supply chain diversification? Are you going to be focusing on Europe as well? I mean, which are the areas, which are the markets that you intend to go after, given the opportunities that you just spoke of that have opened up?
If you look at it, as soon as this government came into power, we revived our Economic Development Board, where we have vertical specialists and we also have country-focused specialists. So we appeal to the broader diaspora out there, and we're looking at attracting investments across sectors and across nations, and that's been our core strength. So we've had Japanese land here, we've had the Koreans being part of our ecosystem, our growth story. Electronics, we've seen a lot of Chinese companies already investing in that sector. So we have been attracting investments across board. And not only that, we're also excited about Indian companies investing in Andhra Pradesh. I think it's very unfair to just chase international companies, but there are a lot of Indian companies who are willing to bet big on states that are very progressive and proactive. And even companies within Andhra Pradesh. So while I chase new dollar, I'm also focused on ensuring that the existing companies do not have any problems. It's been an amazing journey. The cost of doing business is low. The cost of energy is low. So this is something that we're very, very focused on. So it's inward looking. We're looking at our investments within our country. And then we're, of course, looking at investments across countries.
Okay. I want to focus on Amravati because that has, of course, been the Chief Minister's passion project. And with the funds, the 65,000 crore rupee phase 1 funding in place, of course, things are moving on that front. But what about the debt burden, which is very, very significant? And of course, you've been talking about that, and of course, requiring central assistance has been part of the negotiations that you had with the BJP and with the Prime Minister. How do you address that? How confident do you feel about being able to address that at this point in time?
Well, we have close to 10 lakh crores of debt as a state. Yes, we had a lot of huge pending payments. Those liabilities also inherited from the previous administration. But if you look at it from growth rate, we are already number 2 in the country. Our aspiration is to grow at 15% year on year to be a $2.4 trillion economy by 2047. So the only way we can achieve all this is by speed of doing business. And being out there and attracting investments. This is going to be very, very critical, and aligning all the ministries with that agenda of creating jobs. So with this singular focus, we believe that we can actually grow much faster than any other state. And that will enable us to recoup and deliver on our poll promises also to the people of Andhra Pradesh.
Well, along with the investment-related milestones that you're hoping to clock, there is an important milestone for the Chief Minister coming up. He's going to be turning 75. Can we expect any announcements to mark that milestone?
Well, it's one more birthday for him. He's a 25-year-old impatient Chief Minister who really wants to do good for the state and the nation. So it's just another day for him personally. And, every day is a new day, a new challenge for us. And we attract investments every day and on a daily basis. So that's what makes Andhra Pradesh and this government unique.
Is he a tough taskmaster?
Absolutely, he is. No second thoughts about it. And he expects all of us to run faster than him, which, is a big challenge for all of us. But it's exciting to work with him, and we learn a lot on a daily basis. And him challenging us, pushing us to edge, enables us to innovate. And he's one leader who's given absolute freedom to ministers to do what they can do best and show results. And he only holds us accountable to outcomes.
Well, we do wish him the very best as he marks that milestone. But I want to end by asking, you said that the IT policy is going to go to Cabinet by the end of the month. But some of the other sectoral policies that you spoke of, have those been approved by Cabinet already, or will some of those also require Cabinet approval?
All those policies have already received Cabinet approval.
So those are already in place. The IT policy is the only one that requires Cabinet approval.
IT policy is already in place. This particular decision that we have taken, which we want to extend to various other IT companies and GCCs who want to invest in Andhra Pradesh, this particular thing would be an amendment to the existing IT policy. And that would be part of our next cabinet meeting.
Okay, so that's an amendment, because that's what I was wondering, because you had talked about nominal pricing for the IT-ITES sector when we had last spoken. So this is an amendment to an existing policy that you're now bringing about in light of the deal that's been done with TCS.
Exactly.
Now, Lokesh, always a pleasure. Many, many thanks for joining us and explaining the rationale behind the big announcement that came in from the Andhra Pradesh government, selling over 21 acres of land to TCS to set up an IT hub in Vizag in the state of Andhra Pradesh, and an amendment being brought in to ensure that similar terms will be offered to other IT-ITES companies that are looking to set up in the state. A pleasure speaking with you. Thanks very much for your time. We are going to take a break here on the CNBC-TV18 Newsmaker. We're back in a moment with more. Hello and welcome to the Global Dialogue. I'm Shireen Bhan. We are living in a VUCA world. CEOs around the world have been used to the idea of dealing with volatility, complexity, ambiguity, and uncertainty. But what we've seen happen in the last few weeks is perhaps VUCA on steroids. To help make sense of the global reset, where India finds itself, and more importantly, how we should position ourselves as this global reordering takes place. Joining me now is a global managing partner of McKinsey, Bob Sternfeld, and the managing partner for McKinsey in India, Rajat Dhawan. Bob, Rajat, great to have you here joining us on the Global Dialogue. Let me start by asking you just that, Bob. When you talk to clients today, what are they telling you? Is there a sense of panic? Is there a sense of fear? Is there a chilling effect that nobody wants to do anything at this point in time?
Well, it's great to see you again, Shireen, and thanks for having me on. And yeah, I would start with, it's clearly the context. There's a lot going on in the world today. But if you take the lens of at least what I'm hearing from CEOs around the world, which I think was the departure point of your question, I think it's very different than a year ago. So if we backed up a year ago, most were saying, and you were clear on this, that, hey, 2024 is the year of elections. And there were more elections around the world than I think in any year in recorded history. And so as a result, many CEOs were saying, let me wait and see how things play out. Let's see what happens with this particular election. And so if I can defer some decisions, I will. And I'll play for time. Well, you fast forward to the beginning of 2025, and folks are saying the elections have happened.
Yeah.
The world's no less volatile, and might even be more volatile than it was a year ago. But I can't afford to wait. I actually have to make decisions. And I find that's one big departure point from even 12 months ago, that despite this volatility, there's a real desire to still need to move forward.
You know, when you talk about moving forward, and as I pointed out, CEOs are used to dealing with uncertainty and ambiguity. But in a situation like this, where on an hourly or even on a minute-by-minute basis, you don't know whether a tariff is going to stick or not stick, whether there's going to be a further hike or there's going to be a rollback, as we've seen in the last 2 weeks. How do you make decisions in this environment? And are people now essentially saying, let the dust settle before we make big calls, whether it's CapEx or expansion? I mean, that's the kind of feedback that I'm trying to understand how that's playing out.
I think you're really getting to the root of the issue here. And how do you make decisions given so many different impulses, and the fact that these inbound new bits of data can happen multiple times a day? I think all of us look at our phones many times a day to see what's the latest, particularly coming from my country. But what I hear from CEOs underneath this are a few things that I think are useful in these times. And on the one hand, making long-term decisions on things that may not have long-term assurance is not a recipe for success. And so many CEOs are coming back to a couple principles that at least I hear. One is the notion of resilience. How resilient is my company to future shocks going forward? Because these may not be the last. And I'm hearing more and more, I may need just to plan for a world that is fundamentally volatile, as opposed to hoping for a return to some kind of normality. And so how resilient is my company? And the resilience notion is not just defensive, but how do I have enough capital, enough talent to make a few bold bets while I protect myself from shocks? So I hear resilience as one. The second thing is this notion of timeframes. Will the decisions that I'm making be durable over the time frame of that investment decision? So if it's moving a supply chain, if it's developing a natural resource, if it's making an R&D decision, these are often decade-plus decisions with decade-plus payback cycles. And so what I often find is, how do I marry the return profile with the volatility profile to say, is this something that is robust no matter what? So take a practical example on this. Many are asking around the world, how much of my supply chain should I have in the US, right? Given tariffs. Well, if you back up, we had done some work in the pre-tariff era that said supply chains aren't resilient enough, that COVID and the Russia invasion of Ukraine showed that we actually had fragile supply chains. And there was a logic for moving part of your supply chain closer to the source of demand. The US is the largest source of demand, irrespective of tariffs. And so several CEOs are coming back to that foundational logic to say, would I make this decision even without tariffs? What portion of this is robust long-term, based either on resilience logic, long-term demand logic? That's a practical example of this time frame piece. And maybe the third thing I'm hearing, if it's resilience, time frames synchronized with the investment decisions, the third is this notion of where are no regret moves just to speed up? And in particular, one of the topics that's around that is the implementation of new technologies to change my business. No matter what happens in the world, I am going to have to implement technology faster to change my business. That's a no regret move. And so I'm often asked the question, Bob, what are the no regret moves that I can be implementing irrespective of these external stimulus that's going on?
We don't have the ability to pay your fee today, but we're going to ask you, Bob, nevertheless, to give us some of those no regret moves in just a second. But let me get Rajat to comment on the feedback that you're getting from your Indian clients today, because the way that we look at the narrative that's shaping up, the feeling is that India is going to be a beneficiary of this tariff move, or even as Bob put it, even outside of the tariffs, India has been positioning itself as a manufacturing hub. Case in point, the smartphone success story. Build on that. What are you hearing now as far as the near short-term implications of this global reset and the decisions that you believe CEOs are likely to take on the back of it?
Yeah, great. So as I talk to the CEOs and I'm in the boardrooms here in India, I think you called it. I think the general posture is let the dust settle. Because I think this news flow, which is a flip and flop going on over the last couple of weeks and will continue, there's a lot of short-term noise. But equally, I think to Bob's point, there are some no-regret opportunities coming out, right? I mean, electronics value chain you already cited out. It's starting to play out, and I think continued investment there is going to work. But I step back a little bit to say, hey, from in this moment, what is the real long-term signal emerging for the Indian economy, right? And firstly, I'd say that we are at a good place already, not just because of the global dynamics and where we are positioned, but also a lot of hard work over the last 5, 10, 15 years, where the Indian economy has now gotten to and what is the potentiality. I think we're at a good place. I think the real long-term signal emerging in this moment is that we need a new playbook to take it to full potential growth. And by full potential, I mean 8.5% real GDP growth consistently for 20, 25 years. And that's possible. That's possible. I think there are 3 elements of this new playbook. And I think the sooner we embrace it and start to execute it, the better. I think the first one is we need a new playbook for investment formation. And I'll come back and talk about it. But at the second level, I would say we need a new playbook to raise our competitiveness, and innovation goes with it, especially in manufacturing. And again, I'm happy to talk about the elements there. And then third, I would say, is really a new playbook needed to dovetail skilling with job creation in a significant way, because that starts to get us closer to where we would get our demographic dividend to play out. Let me talk about the first one at least, and then pause and then see where you want to take the conversation. On the investment formation, look, at the end of it, there are three elements to it. I think there's a government spending around infrastructure.
Which has been doing the heavy lifting.
Which is doing the heavy lifting. If I take the IPL cricketing analogy, Bob, the IPL tournament is going on. That's the batsman that's making the runs in the last 5 or 10 years. We've got to about 11 lakh crore, what's about 120, 130 billion. I think the new playbook now is go away from what I call linear infrastructure development, linear and point infrastructure of roads, railroads, ports, to what I call economically dense infrastructure. Think of cities, new cities, 20, 30 new cities. It could be brownfield next to already existing city hubs. It could be around economic clusters. But imagine, I mean, our analytics tell us that if you really go for even a brownfield city, leave alone a greenfield new city, over a 20-year period, it could be anywhere between 80 to 120 billion dollars of cumulative GDP that accrues. Jobs happen, and the government, the federal government, along with the state governments, if there was a way to partner with a very efficient vehicle, right? I remember the DMRC phenomenon of 20 odd years ago, and then Delhi happened, and then so many other cities came forward with the metro. I think something similar, could be a great way of what I call economically dense infrastructure creation, and government could be the catalyst. Let's talk about corporate investment, private sector investment. Stagnated about 12-13% of the GDP. Yeah. There you see, there is an underlying, improvement or strengthening that has happened which has not been noticed, which is that, look, erstwhile it was all debt finance. Most of the investments were debt financed. Over the last 4 or 5 years, with capital values appreciating, equity markets going up, particularly in mid and small caps, a lot of that risk has shifted onto equity. People have, companies have infused capital, they have deleveraged, and now the interest rate cycle is also turning, right? With the RBI adopting a pro-growth stance. So I feel like the timing is right. We're waiting for the demand signals. But the mix of capital as we go forward in the new playbook will be a lot more equity-oriented, a lot more risk capital-oriented. Because, I mean, promoters and CEOs don't want to lose their sleep. I think they're sleeping better because of all the deleveraged balance sheets.
Oh, without a doubt.
Goes back to the resilience bit that Bob talked about. And then the final bit on investment is really the MNC capital. You see, our domestic savings rate around 30% is not going to go up substantially, right? Because, I mean, as income demographics grow, households want to consume rather than save and so on and so forth. I think we need foreign capital. We need FDI capital, MNC capital. And there, I think the only big shift we want is not so much ease of doing business. A lot has been done. And frankly, no boardroom or CEO globally decides based on whether I have to fill 20 forms or 70 forms, right? They decide, is there an upside for value creation in the country? And if there is a downside, am I protected with the right legal framework, the right settlements? So I would shift from ease of doing business to a new playbook called facilitative foreign capital, inviting and facilitating a fair play for the MNC capital.
So equal level playing field for foreign companies in India. Is there a feedback coming in that they feel that the playing?
There is definitely uncertainty in the market. We are hoping, in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us, with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Bessent has already said that we will, the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that, because they've always said we want to bring things onshore, we want to bring things near shore, which is Mexico and others, and then we want people which are friendshore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that, in a sense, for them. So in that context, the way they are laying out this new chessboard, I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson is charged 100%. You know, how many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst which is, I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export investment.
J.D. Vance is set to make his first official visit to India next week. He will be meeting Prime Minister Narendra Modi, External Affairs Minister Subramaniam Jaishankar, Commerce Minister Piyush Goyal. The External Affairs Minister believes that his visit will provide an opportunity for the two countries to review the progress in bilateral relations.
अमेरिका के उपराष्ट्रपति भारत आ रहे हैं, इसके बारे में हम लोगों ने आपको जानकारी दी। उनकी यात्रा 21 से 24 अप्रैल तक है। उस यात्रा के दरमियान उनकी मुलाकात भारत के प्रधानमंत्री से होगी। उस दौरान जो बातचीत होगी उसमें जितने मुद्दे हैं भारत और अमेरिका के बीच, द्विपक्षीय मुद्दे हैं, उन पर बातचीत होगी।
Immigration and trade are expected to be among the top issues on the agenda. This is because several Indians have expressed concerns about being stopped at US airports and the mass deportations from the US as well. Indian students in the US have been facing sudden visa cancellations, and US immigration attorneys have been advising clients not to travel overseas. The energy partnership, the security cooperation, the Russia-Ukraine war, the Middle East tensions, all of that may figure in the agenda as well. As we speak, virtual discussions are underway between trade negotiators of India and the US for ironing out any kind of issues that are stopping a bilateral trade agreement. Now, that trade agreement may happen by fall this year. The terms of reference for a potential trade deal were finalized this week. India is aiming for a deal by October, September. And what is the American industry, the American government expecting from this bilateral trade agreement? And what is the larger message that J.D. Vance will bring to India? Joining us right now is Nisha Biswal, Senior Advisor at the Asia Group. Nisha Biswal, thank you very much for being with us. What is the message that J.D. Vance will be carrying to India? This is also a personal visit, but a very important time in ties between India and US as well.
Hi, Parikshit. It's wonderful to be with you. And listen, I think that the visit of the Vice President comes at a very important time. Clearly, there is a lot in the air with the trade and tariff issues that are roiling relationships around the world. But India is a priority, and the U.S.-India relationship has been one that the current administration has prioritized from its first week in office. And so I think the Vice President's visit comes at a critical moment to ensure that that the negotiations on the trade side continue to be ambitious and move at speed, as well as an opportunity to talk about the Indo-Pacific geopolitical priorities that both administrations share.
Right. Considering that reciprocal tariffs and reducing the trade deficit seems to be the #1 priority for US President Donald Trump, do you think reducing those non-tariff barriers, trade barriers, will be J.D. Vance's #1 priority during this visit as well?
I can't speak to what his #1 priority will be, but I can certainly say that this will be high on the agenda. And I know that the Commerce Minister, Piyush Goyal, has been engaging in discussions with his U.S. counterpart. And I know that both the U.S. and India believe that negotiating a bilateral agreement is in the best interest of both countries.
Right. Also speaking to you about the issues related to the trade deal, could you give us a sense of what is the expectation of the U.S. industry? Well, they want barriers to come down. They want more market access to the Indian market, tariff barriers to be brought down. But if there were certain areas where you feel immediate attention is needed, what would those be?
Well, certainly, I think that there will be conversations about the tariff rates, but the non-tariff barriers have certainly been a priority in the U.S.-India corridor and have been a sticking point for really accelerating U.S. investment into India. That will be everything from ensuring that there is predictability and rationalization on the tax schemes for U.S. investments coming in, looking at some of the barriers on component parts as more and more U.S. industry thinks about India as kind of a de-risking strategy. India needs to rationalize some of its policies with respect to how it deals with component parts that may be coming in, for example, from China, and the tariffs that might be against those. Some of the other regulatory areas, some of the technical barriers to trade and other areas where I think the negotiations have been ongoing may be areas that can be dealt with relatively more quickly than areas that are going to take perhaps more protracted conversation.
All right. Nisha, my question would also be about immigration. There's a lot of concern about the clampdown on immigration, on visa denials for Indians. This is not just for Indians, but of course for students around the world. But there is greater scrutiny, greater questioning of Indian nationals, even green card holders, attorneys telling them not to leave the United States. Could there be any reprieve for India? Because I'm sure these concerns will come up during conversations between Prime Minister Modi and J.D. Vance, and also J.D. Vance and External Affairs Minister Subramaniam Jaishankar. Will the U.S. make any change for India?
It remains to be seen. I certainly do agree that this should be an important topic of conversation between the two governments and during the Vice President's visit. Indian foreign students represent a very important element of revenue for U.S. universities. Foreign students generally tend to bring in higher revenue, and most universities cannot right now be financially viable on just the U.S. domestic market alone. On the other hand, if there is and continues to be additional restrictions on foreign students studying in the United States, it may also create an opportunity as U.S. universities might be more interested in opening up campuses in India and expanding opportunities for Indian students to attain U.S. education in India itself. I hope that that is something that the Indian government is thinking about, how they can perhaps amend some of the legislation with respect to universities to encourage more university investment into India.
All right, Nisha Biswal, thank you very much for joining us on the program with your views on the very important trip of J.D. Vance to India and the ongoing trade negotiations between India and the U.S. as well. Time for a short break, but don't go anywhere. Chinese President Xi Jinping is on a key visit to multiple Southeast Asian countries this week. As the U.S.-China tariff war continues, we break down how Xi's trip could reshape regional alliances.
From a hiring perspective, we have gone ahead and hired around 10,000 people from the campuses as we had called it out. We have a plan to onboard people, but we are also cognizant that we should not onboard and then not able to deploy. So we'll see how the market looks at market growth comes in the coming year. So far, we have been able to make sure that all our people actions, promotions are happening every quarter. We did a salary increases ahead of time. We are giving variable pay. The full year variable pay is around 95% to a majority of our employees. So it's been a more consistent approach from an employee expectation and aspirations point of view. For the new fiscal, our plan was to onboard about 10,000 people. We'll have to see how it goes. So far, whoever we had committed, we have onboarded everyone.
There is definitely uncertainty in the market. We are hoping,
Welcome back. Chinese President Xi Jinping embarked on a three-nation tour across Southeast Asia this week, aiming to strengthen Beijing's economic and strategic influence in the region. The visit comes at a critical time as China navigates an ongoing tariff war with the United States. With trade tensions rising, Xi is expected to push for deeper regional cooperation on infrastructure, investments and security, seeking to position China as a stabilizing force in Asia. But it's not just trade. China's military ambitions in the Indian Ocean are also growing. This also comes at a time when the Quad security cooperation has taken a backseat under Trump. Arzan Tarapur, a research scholar at Stanford University, has argued that America needs to get serious about building military power in the Indian Ocean alongside its Quad partners. To discuss this argument, joining us right now is Arzan Tarapur himself. Arzan, let me begin by asking you, this clearly is a worry in the region that there will be an Indo-Pacific pivot to China. Do you feel that the current US administration, and looking at its domestic priorities, is committed security-wise to the Indo-Pacific and would like to take that relationship a notch higher?
Thanks very much for having me. It's a real honor to be on. Listen, I think when it comes to trying to discern the direction of the Trump administration, we always confront the issue of uncertainty, right, and unpredictability. The one thing that I would say with some confidence is that when the Trump administration, when Washington looks out around the world, the Indo-Pacific is certainly one of those areas that is always going to be one of its top priorities. Now, how that actually manifests in policy is going to be a different question. But clearly, senior officials in the Trump administration have made clear that China is a significant rival of the United States, whether it comes to trade policy or somewhat more ambiguously on strategic matters. And so the article that I've written is an argument that says that Washington should get serious not only about China per se or those strategic issues that have traditionally been of concern to Washington, but also to look and think more systematically about the Indian Ocean.
Right. Speaking to you about the meetings that have happened place over the last few weeks, how important are those meetings of military leaders? Of course, foreign ministers met in January, but do you think now the Quad will come out with its, not its military ambitions, but its clear ambitions to secure the Indo-Pacific by military means, by more military drills in the region?
So there's a number of different things that the Quad does, right? And so traditionally for the last few years, a lot of what the Quad has done has focused primarily on what it calls providing international public goods. That is, doing things that help countries of the region become more resilient to build their capacity. And I think that's critical. The interesting thing and the relatively new thing is that in recent months, there seems to be a growing appetite for the Quad to do even more work when it comes to security. Now, security has traditionally taken a back seat in the Quad's agenda. The Quad's agenda has been usually dominated by things that are not security, even though security work has continued, albeit at a lower profile. Now, the interesting thing is that there is an opportunity or a sense that the Quad may rethink how it provides security to the region. I don't think this should be at the expense of other things that the Quad does, but the argument that I make is that security is an international public good. And so if the Quad is serious about providing international public goods to the region, then security should be part of that.
Right. Give us a sense of the Trump administration's priorities on the Indo-Pacific. What do you think is the message that J.D. Vance will be bringing to India? He's coming to India next week. This is the first high-level visit from the United States. And Donald Trump, of course, will be visiting in September or October this year. But how prominently will the Quad and the Indo-Pacific cooperation figure in those discussions between J.D. Vance and the Indian government?
So look, I hope certainly that greater coordination among or between the United States and its allies and partners should be a key part of any American policy in the Indo-Pacific. Now, like I said, China is obviously and always going to dominate American policy in the region, but I think a key part of US policy to the region can and should and probably will remain the continued cooperation that the US does with its allies and partners, including India, right? So India is obviously not an ally, not a formal ally, and won't become one. But the United States has for decades recognized that India is one of the key powers of the region, and that the United States must engage it. And so when it comes to American priorities, obviously a lot of what the Trump administration is trying to do is driven by domestic politics, right? It's his domestic agenda. And so regional politics and regional dynamics have to be consistent with that. They have to fit in with Trump's domestic agenda, which is why we see issues like tariffs dominating so much of the foreign policy agenda so far. But I think as things settle down, as the Trump administration settles down and reaches some sort of equilibrium in coming weeks and months, what we'll see is hopefully a return to some to the mean, a reversion to the mean, where the United States does also pursue policy agendas in concert with partners and allies like India.
All right.
And for India, you know, the relationship is partly about strategic coordination. It's partly about economic trade, etc. But it's also largely and recently about things like cooperation on technology. And I think every indication thus far, including with Prime Minister Modi's visit to Washington, those sorts of the key pillars of the relationship will remain the key pillars of the relationship. And I hope that the US and India and the Quad keep working along those lines.
All right, Arsen Tarapore, thank you very much for joining us on the program. Let's also focus on Xi Jinping, Chinese President Xi Jinping's visit to Malaysia, Cambodia and Myanmar. And he has sent out a message that the relationship with these countries will be very strong in future. The camaraderie and brotherhood will continue. And China wants to foster very close people-to-people ties, business ties, and industrial ties with these nations as well. Now, the Wall Street Journal has argued that Xi Jinping is on a charm offensive, and he's on an outreach mission, not just to countries in Southeast Asia, but also Europe, to make sure that the trading relationship with China and all these nations remains intact despite what's happening with the United States with the tariff wars. Peter Seidel of the Wall Street Journal is joining us. Peter, thank you very much for being with us on the program. Give us a sense of the big message that Xi Jinping is trying to send out through his visit to Malaysia, to Cambodia and Myanmar.
Thank you. Xi's visit is sending a message on several levels. One is, as you pointed out, he's trying to show that China is a friend to the nations in Southeast Asia, the nations in the region. He wants to present China as a reliable trade partner in contrast to the US, which has placed tariffs, removed them, adjusted them on every country that it trades with, most notably Vietnam, which is a key trading partner for the US and China. And the other message she is sending is the global message. This is his first trip abroad since Trump took office. And the message to the world is, we're here to build alliances. China is a steady, stable partner and can be a good trading partner for countries not just in Southeast Asia, but throughout Asia, Europe, Latin America. So come to us with your trade, even if you've been spurned or find the US to be too unpredictable to deal with.
Right. So, Peter, even as countries like Vietnam, like Europe, are ready to make concessions for the United States in order to avoid those very high tariffs, do you also feel that a pivot towards China is very much possible under these current circumstances?
I think that China would like to present its case that's possible. I think that the nations in the region in Southeast Asia, as well as Europe, this is not the first time they've dealt with China. They're not going to be easily convinced by a message of stability. China, since Trump launched the trade war, even starting with Canada and Mexico, China has been promoting the message that it's a force for global good, for globalization, for integration and harmony. While China can present itself as stable, given the stability of the Chinese leadership, the region and Southeast Asia in particular knows that there are challenges. One is on the economic front. China now has a lot of goods that are not going to go to the US. Its trading partners in Southeast Asia can't take them all in, can't take in that much at all. And the region also knows about security concerns, territorial concerns in Southeast Asia, in the South China Sea in particular, tensions with countries such as the Philippines. And in particular, China's Xi Jinping's visit to Vietnam, which kicked off this tour. Vietnam is a country that is deeply embedded economically with the United States. China is Vietnam's top trading partner, but the US is only a little bit behind. So it's going to be very difficult for Vietnam in particular to say, okay, China's our friend and the US isn't. Vietnam, like all of these countries, is going to have to balance both superpowers.
Right. Peter, my final question, what would be the expectation from China in terms of dropping some of the irritants in the trading relationship? Yes, countries want to manufacture in China, have a trade partnership with China because China provides a skilled workforce, manufacturing at scale. But there are problems also that Western companies have been facing there. What are some of the barriers that countries in Europe and also in Southeast Asia would want China to drop?
China's long-standing issues for countries in Europe, for example, intellectual property has been a concern about China's ability to protect intellectual property. There are consistent concerns about dumping of goods because China subsidizes goods. Exports can be cheaper and compete with, for example, European automobile industry. A lot of trade partners may see this as an opportunity to persuade China to be more cooperative, less focused on making China great and more on the mutual benefits of trade. But while China might see some more integration, for example, she oversaw a deal with Vietnam to improve road and rail infrastructure. China might become more integrated with these countries of the region, but the likelihood that some of the trade irritants and security irritants are going to go away, it's very unlikely.
All right, Peter Seidel, thank you very much for joining us. With that, it's a wrap on this edition of Global Eye. Thank you for watching and stay tuned to CNBC-TV18.
Things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
From an India perspective, India was completely sidelined in this whole global chessboard. We were not in the UN Security Council. We were not ever allowed to get into WTO. Even countries around us with the chessboard which was played, which should have been a home market for us in Pakistan, Bangladesh, Nepal, Sri Lanka, were all gone. And geopolitically, we were on a back foot. We didn't have really depth in our markets. And even exporters from Bangladesh, Pakistan were doing better than, say, Indian textile companies, because the rules of the game were laid out in a manner to keep kind of India held back. So in a sense, what is going on, you're going to end up, I hope, on the right side of this new drawing of the chessboard. And Secretary Bessent has already said that we will, the first 4 deals we sign are with allies, and he used the word, we didn't, which was UK, Japan, Korea, and India. I was very intrigued to hear that, because they've always said we want to bring things onshore. We want to bring things near shore, which is Mexico and others, and then we want people which are friend shore. And with India already being the GCC and the IT hub for the US, it already is like a friend shoring of that in a sense for them. So in that context, the way they are laying out this new chessboard, I'm hopeful it plays out in a way which plays to India's advantage. So the way this is playing out, I think, look, US is a $80,000 per capita economy. We are a $3,000 per capita economy. There are very, very few things which are going to land from the US into the Indian market which we can afford to buy. Our market really doesn't have that depth. So optically, it looks very scary when you say, oh, Harley Davidson.
Hello and welcome to India Business Hour. I'm Parikshit Luthra. Here are the headlines we are tracking this evening. Sensex and Nifty gain 4% this week as stock markets attempt to recover from the tariff jolt. This is the biggest weekly gain in 2 years, with major indices trading near 4-month highs. Infosys misses estimates in Q4. Dollar revenue declines 4%. The company misses its full-year growth guidance, expects 0 to 3% revenue growth this financial year. US President Trump lashes out at Federal Reserve Chair Jerome Powell. This after the central bank chief issued a stark warning on tariffs and appeared to rule out any near-term rate cuts. Trump says Powell is always too late and wrong, adding his termination cannot come fast enough. European markets recover after ECB cuts its benchmark lending rate by 25 basis points for the third time this year. Asia gains on the back of what Trump called a big progress on trade talks between US and Japan. Gold prices hit a fresh high as safe haven buying picks up. Indigo aims to increase its international capacity to 40% this year. CEO Peter Elbers says he also welcomes a grievance redressal body for customers while also calling for correlation between cost of doing business and airfares. Says rising airport fees run the risk of tipping over. That's an exclusive. Capital cushion for IDFC First Bank private equity investors, Warburg Pincus and Abu Dhabi Investment Authority to invest 7,500 crore rupees into the bank and pick up a 15% stake.
This is the year that ChatGPT goes from answering questions for you to doing things for you in the real world.
OpenAI is betting big on India. Chief Product Officer says India is the company's second largest and fastest growing market. Active users in India has grown threefold in 2024. That's an exclusive. Supreme Court stops short of saying the Waqf Act after an undertaking from the government. Centre will not make any new appointments or change the status of current Waqf properties. Government gets 7 days to file a response to a batch of petitions challenging the new legislation. The sunscreen ad battle heads to a truce. HUL tells the Delhi High Court it will make changes to its Lakme sunscreen ad, which Mama Earth's parent Honasa had termed disparaging. In return, Honasa agrees to take down its social media posts, which allegedly targeted Lakme from all platforms. We will come to that and much more in just a bit, but first to the market action of the day. Markets in India and around the world are recovering from the tariff jolt. Sensex and Nifty gained nearly 2% today. Bank stocks led the rally with the Nifty Bank Index gaining over 2%. Mid-caps fared slightly better than the blue chips. Nifty gained 4% this week, the biggest weekly gain in 2 years. Nifty Bank Index gained over 6% and the Real Estate Index gained 7% this week. The markets are shut tomorrow on account of Good Friday. Prashant Nair is here with the market wrap.
It was a short week, only 3 trading days, but it was a punchy one. I mean, the number of days, the sort of lack of them did not stop the market from notching big gains. And, instead of sort of wrapping up what happened today, I'm just going to run you through the week per se because, we've done quite a bit. The Nifty Bank, as of today's close, is almost at a new all-time high. We were about between 30 and 40 points away from reaching a new all-time high. This week, the Nifty Bank is up 6.5%, by far the biggest winner. The Nifty is not very far behind, but it's up 4.5%. There's only one Nifty stock in the red over the last 3 sessions from last Friday's close. That is Wipro, which is down about 1.5% or so. And of course, the broader market, the mid-cap index is going to end about 4.5% higher, the small-cap index with about 4% in just 3 trading sessions. So that's the kind of a week that we've had. The big winners this week coming through on the Nifty, at least to begin with, IndusInd Bank, all financials. IndusInd Bank, 15% gain. There was ICICI Bank, which was up 7%. Axis Bank was up 11%. Shriram Finance was up 8%. And Jio Financial Services about 7% gains as well. I mean, there were one or two other names from other sectors, but the bulk of it, of course, was all banks and financial services. Broader market, mid-caps and small caps, I looked at the NSE 500 list, and this is what came up. FACT, the fertilizer company, 22% this week. MCure, 19%. SW Solar, big absolute sort of, the stock's been beaten up nowhere, and 16% over the last 3 sessions. GMDC, Intellect, Delivery was up 14%. Home First 13%, and NTPC Green was up about 13% this week. But this week was, of course, about large caps more than the broader markets, really. Markets, of course, are going to be on headline watch, but next week as well, you're going to be coming out from a 3-day weekend. It's the Good Friday weekend, so Friday to Sunday. Many markets are shut on Friday, US, India included. So that is one. US-Japan negotiations. I mean, first off the block in terms of talks, Trump has said that he's going to join them, and that perhaps should provide us with a template of where these negotiations go. Markets, of course, will watch for any hint, however small, of China or the US initiating or showing their willingness to talk, because that's the big one. And of course, I mean, here in India, you'll have the US Vice President J.D. Vance and his family in town. And I think, there will be talks and a lot of excitement around that visit as well. So I'm not going into all the numbers, etc., which are going to be reported. And that, of course, is bread and butter. But some of the important stuff as we come back after a 3-day weekend. Back to you.
All right. Thanks, Prashant, for joining us with all the market action and what to look forward to next week. Donald Trump has trained guns on Jerome Powell yet again. A day after the Federal Reserve Chair warned of challenging scenarios in the light of U.S. reciprocal tariffs, Trump took to Truth Social to take a dig at him. Powell, while speaking at an event in Chicago, had given a stark warning on tariffs. He said that the tariff hikes were significantly higher than what was anticipated and could lead to stagflation, a phenomenon of higher inflation and slower growth. Powell also played down hopes of any rate intervention by the Fed. Trump, while responding to Powell's comments on social media, said that he's always too late and wrong and should have cut rates earlier. He went as far as to say that Powell's termination cannot come fast enough. Listen in to Powell's comments that sparked a strong response.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And, it's really the policies, particularly the trade policy. And really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs.
And the big earnings this evening. Infosys misses estimates in the fourth quarter. Dollar revenue growth contracted by 4%, forcing the company to miss its full-year growth guidance. The IT major is also expecting growth to remain subdued this financial year. Reema Tendulkar is here with the Infosys numbers.
Thanks so much for that. So let me give you the key points from Infi's numbers. One, for the March quarter, a big revenue miss. The company's top line has declined by 3.5% on a quarter-on-quarter basis, lower than street expectations. The good part is the company is giving us a guidance. They are saying in FY26, revenue growth will be 0 to 3%, slightly lower than the 1 to 4% that the street analysts were hoping for. But the environment is uncertain. But the management did say that at the lower end of the guidance, which is 0%, they are baking in some deterioration in the macro. At the upper end, that's 3%. They're assuming the macros remain stable or slight improvement. Margin guidance remains unchanged at 20 to 22%. But back to Q4. Now, Q4 was very weak for the company, at least in terms of the top line. At minus 3.5% revenue growth, it's also lower than peers. And because of that, the company has missed achieving its FY25 guidance. They end FY25 with a top line growth of 4.2%, lower than the 4.5% to 5% that they had guided for. That said, their margin defense has been strong. The company's EBIT margins were at 21%, very modest decline on a sequential basis, but considering the negative top line growth, it's a strong performance on the margin front. Deal wins too have inched up by 4-5% on a sequential basis at $2.6 billion. So on the whole, it's a muted Q4. The guidance is slightly lower than street expectations, but the guidance shouldn't come as a surprise based on the commentary that we've heard from the management, and the street will take comfort from the deal wins and even the margin performance.
In terms of mega deals, we had 2 mega deals in the last financial year. We have a pipeline of mega deals today. What is sort of what we saw in the past when things of this nature happen, which is changes in the environment, there's also an interest with clients on cost takeout, automation and efficiency and consolidation. We will see how it plays out because it's only a few days as clients have looked at it. But we have seen our large deals moving, meaning which we have closed, moving into the next phases, as was evident.
And staying with the IT sector, Wipro CEO Srini Pallia hopes that market uncertainty settles in the coming few months. He added that the company is seeing delays in the start of new projects and discretionary spends because of this volatility.
There is definitely uncertainty in the market. We are hoping in the next few months, things would settle down and the clients will come back and restart the discretionary spend. I think what we are seeing more and more from the clients is the new projects, discretionary spend, when they need to start them. I think that's a delay that I'm seeing. But overall, if I look at our pipeline, which is very robust at this point in time across Americas and Europe and APMEA, and majority of those deals are also more around the cost transformation, influencing through AI optimization and improving the customer experience. Those deals to me will continue because that's going to help the client in a situation which is a lot more uncertain for them.
The Bombay Stock Exchange marked its 150th anniversary today. Finance Minister Nirmala Sitharaman attended the celebrations in Mumbai and rang the closing bell. Speaking at the event, the FM touched upon the tariff war. The FM warned that protectionist policies can disrupt supply chains as well.
The recalibration efforts on trade are very, very challenging. I wouldn't say it is worrisome, but it is also going to be very challenging. The intensification of tariff wars and the rise of protectionist policies have the potential to disrupt global supply chains, increase production costs, and create uncertainty in investment decisions across borders as well.
And speaking of the tariff wars, Shamika Ravi, a member of the Prime Minister's Economic Advisory Council, believes India will be the least impacted. Listen in. She was speaking to my colleague Sapna Das.
All the top 10 economies have become steadily protectionist. So what Trump has done is sort of heightened it, but the trend is exactly in the same direction as it has been for the last 10 years. We are going to be least affected on account of the fact that this is a very large economy with a very large domestic market. You see, unlike China, which is export-led and they have a repressed domestic market, they are responding in the way they are largely on account of the fact that their domestic market has been repressed and it cannot possibly subsume all this excess capacity.
And private equity investors Warburg Pincus and Abu Dhabi Investment Authority have inked a deal to buy stake in IDFC First Bank. Affiliates of Warburg and ADIA will pick up 15% stake for 7,500 crore rupees. The board of IDFC First Bank has approved the investment. IDFC First Bank has more than 970 branches and a deposit base of over 2.2 lakh crore rupees. Warburg's affiliate will invest over 4,000 crore rupees for a 9.8% stake. Abu Dhabi Investment Authority's wholly owned subsidiary will invest over 2,600 crore rupees for a 5.1% stake. The deal is subject to regulatory and shareholder approvals. The bank's CEO Vaidyanathan said that they needed capital and he reached out to the PE investors.
I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, then we pitched the story. We told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time. So they felt excited to come again.
All right, let's move on. SEBI chairperson Tuhin Kantapande has urged corporates to move beyond the mindset of minimum compliance and embrace maximum governance. His remarks came after SEBI uncovered financial irregularities at Gensol Engineering, raising fresh concerns about corporate accountability and oversight.
What we can do about effective self-regulation by entities. We need to move from a thinking of minimum compliance to maximum governance. Boards must rise above routine and ask difficult questions, and auditors and independent directors must act as gatekeepers of integrity.
And SEBI's internal committee is set to review a no-objection request from the National Stock Exchange for its IPO. The exchange has submitted its response to the concerns raised by the regulator, including on executive salaries and ownership structures of the clearing corporation. SEBI Chief Tuhin Kantapande said that the regulator will try to take a decision on the matter as soon as possible and will prioritize public interest. Yash now joins us with more.
Well, just last month, that was on March 28th, the National Stock Exchange or NSE had filed for an NOC with market regulator SEBI for its IPO proposal. An NOC or a no objection certificate is a precursor which enables the National Stock Exchange to go ahead and file the DRHP when it comes to its IPO. Now, what we've been given to understand from SEBI is that an internal committee at market regulator will look at NSE's proposal when it comes to this no objection certificate. Last time when this NOC was filed, there were certain concerns also with market regulator. SEBI had flagged when it comes to, it requiring the resolution to those concerns. These were salaries of the KMPs of NSE, technical glitches, resolution of ongoing cases around co-location, also ownership of the clearing corporation. NSE, as a part of its NOC document, had submitted resolution or addressed all these concerns which market regulator SEBI had pointed out, and that's what SEBI's internal committee is expected to do, which is to discuss all these resolutions or how NSE is trying to address these concerns from SEBI and then finally decide on whether to approve that NOC for NSE's IPO or not.
All right, let's move on. Indigo is aiming to increase its international capacity to 40% this year, says CEO Peter Elbers. Speaking to Shireen Bhan, Elbers welcomed a grievance redressal body for customers on airfares, but he also called for correlation between cost of doing business and airfares. The Indigo CEO also warned about rising airport fees, saying it runs a risk of tipping over.
The Indigo International Network, Shireen, is started some years back, very traditional, if you wish, between India and the Gulf and the Middle East countries. We've been slowly expanding that. So in 23, we started flights into Central Asia. We started flights into Nairobi. We have moved, and I had a meeting earlier this week with the CEO of Changi Airport. We moved from moving into Singapore from 3 Indian cities to 9 today. But that's still within that 5 to 6 hour radius. I think the next step for Indigo is to make sure that even Europe and further parts of Asia would be accessible directly operated by Indigo. And, if India is going to be the 3rd largest economy in the world by 27, the country needs and deserves actually an airline of the size and scale and potential of the nation.
We've once again seen the parliamentary panel recommend the possibility of looking at intervening in the market as far as prices are concerned. We've now got the government setting up a special cell where customers can actually talk about their complaints as far as pricing is concerned. Would you worry about the possibility of government intervention on pricing at this point in time?
Well, when there's a body where customers can complain about certain things, I think that's a good thing. There's always good for companies to have a body which keeps sort of things in balance and things. So I think in general to have a body like that is a good thing. Having said that, looking at the Indian market, it's one of the most, if not the most competitive market in the world. The average price levels are extremely competitive. There has been some recent reports which made a comparison. How did inflation go over the years and how did airfares go? And actually you could see that the inflation has gone much faster than the airfare. So we need to catch up in that in efficiency and sort of in order to keep the margins. Because in the long run, there must be a correlation between the cost of doing business and the price of airfares, right? Otherwise, you'll be out of business. Looking at the price sensitivity, a few hundred of rupees sometimes is enough to have people flying or not flying. So we should be mindful of looking how these user fees will eventually find their way into ticket prices. Because at the end of the day, there's a correlation between what is the price and the cost price of a product and what is the price for the consumer eventually. So full support for all the changes. I think it's important that it's being done, but we should be mindful that, at the end of the day, the price of the ticket is based on different elements, and this aspect is an important part of that, and that should be in line with it.
Is it in line with what you believe is the kind of threshold, or do you believe it's tipped over?
I think at some points it runs the risk of tipping over. If you take the price of a ticket, the price of some of the UDFs should, in terms of percentage and correlation, should be not too much as the total price of the ticket, right? There's going to be fuel and flying and this and that and the other. So I think, again, full support for all the changes we're making, but we should be mindful of what would it do eventually for the total ticket prices.
And coming up on India Business Hour, the sunscreen ad battle between Lakme and Mamaearth heads to a truce. More details in just a bit. And you can also catch all CNBC TV18's news and updates on YouTube, Facebook, Instagram, X and Jio Hotstar.
How many will you sell? You sell like 5,000 BYD cars over here. You sell like 15,000 Mercedes cars of all varieties over here. So it's not like this market is going to get flooded or has the ability to absorb that. But to kickstart an economic cycle, like it happened with Southeast Asia and China, unless you create a catalyst, which is I create capacity which goes to the West and gives those workers the income to then kickstart local consumption, that's how you got export, investment and domestic consumption aligned up. Today we are in that holding range of 6% GDP growth. Because why does an Indian industrialist want to invest? Because the consumption is still very, very feeble. And that consumption is feeble because unfortunately there are no great job creation happening. And we've gone from the $100,000 IT services jobs of the 1990s to maybe a $15,000 Zomato rider today. Nothing wrong, we have to create all these jobs, but we've gone down.
You're watching India Business Hour. OpenAI is betting big on India in an exclusive conversation with CNBC-TV18. The company's chief product officer, Kevin Weil, said India is OpenAI's second largest and fastest growing market. He added that active users in India have grown over threefold in 2024.
India is an incredibly important market for OpenAI and ChatGPT. It's our second largest market, it's our fastest growing market, and it's also the market where we saw our image generation just take off. Our active users in India more than tripled in 2024. So it's been incredible to watch. A few weeks ago, we launched a new image generation tool using AI to generate incredibly images that you can control to a great degree, whether you want them to be vivid and lifelike or cartoony or following a particular style. We saw, Prime Minister Modi tweeted using our image gen feature. We had cricketers like Sachin Tendulkar tweet images from ChatGPT, and it just took off. I mean, unlike anything I've ever seen. This is the year that ChatGPT goes from answering questions for you to doing things for you in the real world. So, by that I mean we launched a product earlier this year called Operator that can browse the web like a human and do things for you. It can order food for you, through an online food ordering website. But it can also fill out forms. It can shop. It can do anything that you would do on the web, and of course you're in control the whole way.
All right, you can catch the entire conversation with OpenAI's Kevin Weil on Global Dialogues at 9:30 p.m. right here on CNBC-TV18. In Court Corner, Supreme Court stopped short of staying the Waqf Act after an undertaking from the government. The centre agreed to not make any new appointments or change the status of current Waqf properties. The government needs to respond in 7 days to a batch of petitions challenging the new legislation. Ashwin Kumar explains.
Well, a whole host of petitions being considered by the Apex Court in a huge day as far as the life of this newly passed bill is concerned. Again, newly passed by the Parliament, now facing challenges, constitutional challenges before the highest court of the country. Now, bear in mind that these proceedings began yesterday, and then there were two critical aspects that the Apex Court had pointed out. Two aspects. Number one was Waqf by user being discontinued. Waqf by user, of course, being the legal doctrine under the earlier act, which allowed for a property which had been recognized as Waqf to continue as Waqf, provided it's been used for religious or charitable purposes over an extended period of time. This practice, this doctrine is being discontinued under the Act. The question that was posed by the Apex Court to the government is that how is it that the centre is now insisting on some form of registration for recognition as a Waqf property when a lot of these properties which are Waqf by user have been going on for the last hundreds of years. In fact, the Supreme Court had given the example of Jama Masjid and said that 14th and 15th centuries when this entire mosque had in fact been constructed. How is it that the government now in 2025 is asking for registration? And these are the questions which were raised by the Apex Court in asking how the centre can travel back through this law hundreds of years and ask for documentation going back hundreds of years. Again, another second point that the Apex Court had raised is that what about the question as far as going forward, as far as non-Muslim members of the council and Waqf boards are concerned. In fact, the question, the direct question that was posed to the centre by the Apex Court is that Hindu endowments, will the centre now provide for Muslims to be a part of the managing committee of a Hindu endowment? These are questions that were posed. Now, in response to this, the centre came back to say that it is willing to make two key concessions. It's willing to give an undertaking that no fresh appointments, no fresh non-Muslim appointments will be made to the Waqf boards as well as the council. And the second key undertaking was that the status of Waqf properties as it exists right now will not be denotified under the new Act. And it is only after recording these two undertakings that the Apex Court has said that, fine, we will not stay the Act as of right now, but we'll put on record these two undertakings that the centre has given. The centre has now been allowed 7 days' time to respond to these challenges, and that's when we'll begin to get more clarity on the road forward as far as the new Waqf Act is concerned.
All right, thanks Ashmit for joining us. Let's move on to the sunscreen advertisement battle that has now landed up in a truce. HUL told Delhi High Court that it will make changes to its Lakme sunscreen advertisement, which Mamaearth's parent Honasa had termed disparaging. In return, Honasa agreed to take down its social media posts, which allegedly targeted Lakme from all platforms. Shilpa Ranipeta gets us more.
Well, you're absolutely right there. So it looks like Honasa Consumer and Hindustan Unilever are bringing the sunscreen matter to a close. Now, HUL has voluntarily agreed to make some modifications to the Lakme sunscreen campaign. Now, it's important to note here that there has been no injunction against the Lakme campaign or any takedown order. HUL has now agreed to make the modifications within 24 hours. Now, these modifications include replacing the phrase online bestseller with some seller and also changing the color of the sunscreen packaging shown in the ad from orange to yellow to avoid any visual similarities with Honasa's product, the Dermaco sunscreen. Honasa Consumer on its part has agreed to take down all social media posts that allegedly disparaged Lakme. Both parties have also agreed to remove all the adjacent physical hoardings within 48 hours. Now, the ad here in question is Lakme's SPF lie detector test campaign, which suggested that several sunscreen brands, including online bestsellers, offered only SPF 20 protection despite claiming SPF 50 in their on their packaging, and the accompanying visuals in these ads, Honasa had alleged, resembled Dermaco's packaging. Now, HUL on its part had moved Bombay High Court, alleging that Honasa Consumer's social media posts were disparaging the Lakme brand by taking its name directly. Now, the Delhi High Court will now take stock of the action taken by both companies in this matter on Monday, the 21st of April. And HUL has said that it will continue to air the campaign with the minor modifications, and it defended its campaign in a statement reiterating that Lakme has been conducting SPF efficacy and safety tests for over a decade now, and that the campaign is part of its larger commitment to inform users about sun protection standards in India. Back to you.
All right. Thank you very much, Shilpa, for joining us. So that was a big advertisement battle now coming to an end with a truce. With that, it's a wrap on this edition of India Business Hour. Thank you for watching. News continues right here on CNBC-TV18.
In a sense, even IT went down to GCCs. It's not gone up to making IT products and technology and ownership of IP. But that cannot come until you're part of an ecosystem where you're learning, and then you can start, making your own product. Because we were just not in any of these global supply chains for so long.
Stock markets are recovering from the tariff jolt across the world. The Sensex and the Nifty are up over 4% this week, the biggest weekly gain in 2 years. The Wall Street is now back to levels seen in January of 2025, before Donald Trump assumed office as the US president. So is this recovery sustainable? What next? Well, you're watching Editors Roundtable. I'm Surabhi Upadhyay, and with me as always are Prashant, Nimesh and Nigel. And today joining us on the show would be Harish Bihani, Senior Fund Manager at Kotak Mutual Fund. But guys, what a super week. 3 days, turbocharge, and the bulls are back.
Bulls are back, and how? I mean, from the lows, Nifty's up 2,000 points, and nobody realized. I mean, everybody was, cautious, careful, not committing capital. And so we are back to 23,800 from 28,800.
Phenomenal.
So, phenomenal
and
move.
I think the consensus mood also, just this last weekend, it's not as if there was no big teasy mood or anything. People
generally were
very somber. Chalega, dhire dhire chalega. But
one needs to be careful, cautious.
Just this weekend. And 3 days, markets are up. Bank Nifty is up 6.5%. Nifty is up 4.5%.
And look at today's market. Just we have a 3-day long weekend, right? A truncated week. And on a day like this, the Nifty to close 2% higher, Bank Nifty to close 2.5% higher. When we know that there's going to be a 3-day holiday and we don't know what's going to come from the global market, that's to my mind was a big surprise today. Nobody expected such a move today.
The other thing is gold, right? I mean, I was thinking gold last night was up 3%. I mean, that is 3% on gold after such a large move. It's a safe haven. And you need safety when there is risk everywhere else.
But equity and gold both moving together.
That's the thing.
That's a surprise.
It's been absolutely phenomenal. And let's not forget flows. I mean, the FPI flows are back. Large caps are dancing, and the party, for now at least, seems to be on.
Well, that's right. And you have that benefit, right? Because the FIs were net short. And then, in fact, you have them showing us the money in the cash market as well. Always feels good. And I'll tell you what, earlier we went to 21,900. Then we saw a 1,000-point rally. And everyone says second dip is coming. Second dip came. And people said, no, now we'll get a further dip. I don't know whether that's coming or not. But, you clearly missed out if you're sitting on the sidelines. And I think, those monthly installments should keep going, because then you get the best entry point, I think so.
Absolutely. Okay, so what we'll do is I'll quickly recap in numbers what we've been discussing, and then we'll straight away get to the conversation with our guest. It's been a solid showing, like we're talking about it. 3 days, and look at this. The Nifty has not only recovered all the losses from the 2nd of April, it's actually trading 2.5% above that level. 23,800. I mean, this is what we're talking about. And on Thursday, which was the last trading day of the week, the Bank Nifty was just shy of hitting its all-time high. So this is how it's been. India, by the way, is leading this global recovery. If you look at price moves across the last 5 trading sessions, ex of all the holidays, just 5 trading sessions. Then China, Shanghai Composite is up about 2%. The Japanese market also recovering, but more measured, 1.3, 1.4%. The US market is still struggling because of the up and down. The S&P 500 is down about 1.5%. And look at the Nifty, 5 trading sessions, 6.5%. That's the kind of impetus that we're talking about. Now, this recovery is definitely backed by FPI flows, because we've had a couple of very large days in between. One of the days, it was 6,000 crores of buying. Another day, it was over 3,000 crores of buying. And it's really showing up in large cap stocks, particularly in the financials. They have taken on the leadership mantle, and they're making sure that while IT is faltering with a lot of questions, the market itself is running higher and higher. So for the week, the Nifty Bank, 6.5%. Nifty Private Bank, almost 7%. And Nifty financials, go beyond the banks, go look at the non-banks and the NBFCs. Even this index is up about 6.2%. As a contrast, Nifty IT is up 1.6%. Actually, no sector has ended negative this week. IT is the least performing, but even there, the gain is about 1.6%. What are we looking forward to? Well, we'll definitely be looking at the earnings over the weekend. Infosys, HDFC Bank, ICICI Bank, earnings continues to drive the market action from here. FPI flows, will we keep getting in those big 4-digit buy numbers or not? And last but not the least, we can't fully ignore the global headlines, right? Because a lot is still up in the air. And next week, we'll have the US Vice President, J.D. Vance, in town, not particularly in Mumbai, but he'll be in Delhi and in Agra. And the market will watch out for any clues on the progress in the India-US bilateral trade agreement. So plenty to keep us busy next week.
Plenty and more. Let's bring in, I think, Harish Behani, who's with us, Senior Fund Manager at Kotak Mutual Fund. Harish, good to have you with us here. Thank you for joining us. You know, we are the big market, the first major market to get back to pre-tariff levels. Nifty Bank is almost at new highs. What have fund managers across schemes at Kotak been doing? Give us a sense.
No, it's amazing what's happened over the past few weeks and months. And if I had told you, Prashant, say about a month back with the benefit of hindsight, that there'll be a significant US tariff across the world and how will markets behave, in all likelihood, your and all the other answers would be the market would correct fairly sharply. And here we are at this point in time, where markets are up about 6-7% from about a month back. If I had told you again about a month back that if this happens and then US dollar will go down, US bonds will go down, and US equities will go down, and how will Indian markets behave? And again, we would have got a fairly similar answer that Indian markets will come off. So we have fairly interesting times. The entire narrative that is getting built up is that US exceptionalism is over. And with that, a lot of financial capital that used to move to US will look to go to other emerging markets and other markets, which are growth markets, better return on equity markets. And that particular narrative is gaining prominence as we speak. Very, very early days. I think that this is a long way to go. Still, despite all the impact that India too will have in the near term with regard to growth slowdown. If global economy is slowing, India will certainly see a growth slowdown. We'll see earnings cut in the coming earnings season. So we'll certainly have a lot of impact in the near term. Is market looking beyond the near term and thinking about medium term? We'll need to see very, very early days. But we should be prepared for earnings cut and slower growth in the coming quarters.
Well, that's right, Harish. And if you look at it, quarter four is not going to be anything great, in terms of earnings. So it appears the street is looking ahead. I guess the commentary could be positive because of the kind of capex, push that we have seen. The RBI rate cuts as well will help our costs, particularly for the latter part of this fiscal. But Harish, I wanted your view on banks as well as financials. First up, just wanted to, brush through what happened in the past week. The Nifty Bank financials, well, they were really the ones that took this market higher. You have the FI flows that are coming back in. Remember, most of the holding of FIs is in banks and financials. So when the flows come in, it obviously helps the Nifty Bank. And that's why now the Nifty Bank was a couple of 100 points away from the fresh all-time highs. Besides that, you also had the RBI governor when he cut rates. He was sounding very, very pro-growth. That definitely helps sentiment as well. But there were two big factors that played out in this week. HDFC Bank, they went ahead. They cut the rates by close to around 25 basis points. Remember, it was at around 3%. They brought it down to around 2.75% on. They had some cushion out there because the other big lender was SBI. They were already sitting at around 2.7%. So that's why they had a bit of a cushion. So even after this cut of around 25 basis points, it's more or less similar between both these two. Macquarie says because of this cut, well, the cost of deposits goes down a little bit. And that's why they're saying NIMs could go up by around 5 basis points. Remember, that's one of their biggest overweights Macquarie or the sell side report had mentioned. Well, the other big cue was IDFC First Bank. Nimesh had alerted us there's likely to be some kind of infusion. There's likely to be some kind of preference. And that's precisely the way it played out. They said they're going to be meeting for a preference issue. They have issued close to 7,500 crores or two marquee names. You had Warburg as well as Adya coming in there and pumping in close to around $1 billion or thereabouts. Now, how does this change things? Well, rough calculations suggest that the net worth goes up by close to around 20% or thereabouts. And we had a chat with Mr. Vaidyanathan, and he said that, in fact, the capital adequacy ratio will go up by around 300 basis points or thereabouts. You have equity dilution to the tune of close to around 15%. And he's saying there'll be better times to come. Profitability is something that he's focusing on with better return ratios in the times to come. So clearly, those are the big two talking points: lowering, the deposit rates as well as the preference issue to IDFC First Bank. Harish, how do you read this? Big funds coming in there, signing $1 billion check for a private bank. Well, that definitely gives you some kind of confidence. How would you view this, and how does this change things around? There'll be a couple of other banking names in there that are trading at similar valuations as well. So do you think interest will go up from here?
I think we are cautiously optimistic on the banking names. And I was speaking to someone yesterday and we were discussing that, is the narrative catching up with the fundamentals, or will fundamentals improve significantly from here on? Clearly, it's more of narrative at this point in time, because if you look at there are positives and negatives, maybe the negatives outweigh the positives at this point in time. First of all, as we spoke, if you look at the global growth, we'll certainly see weaker global growth in the coming quarters. And weaker global growth will flow through to the Indian market too, and which will have an impact on the overall credit growth. Second is that large banks will have NIM pressure from a repo rate cut. So if there is weaker global growth, it will lead to higher repo rate cut, about a 75 to 100 bips. Some people are expecting even higher. Let's assume a 50 to 100 bips, which should also lead to a NIM contraction, all else being equal. People got excited by a 25 bips rate cut, but that will not do much. Finally, what we'll all have to look at is whether the core deposit rate cuts is happening or not, which is clearly not happened at this point in time. It's happened in some one-off schemes, but the core deposit rates are still similar versus what it was a couple of months back. So that is what we are watching at this point in time. Narrative is playing up much more versus fundamentals. When you look at the positives, I think from a positive, we're clearly seeing that the RBI has clearly indicated, both with its intent and it's already reflected in terms of the overall liquidity improvement, whether you look at open market OMOs or whether you look at many other measures that have been taken. We have a couple of more measures which will help improve the liquidity. First, in May, we'll have RBI dividend coming through. Most market participants are expecting a 2.5 lakh crores of RBI dividend. Second is we are expecting the central bank spending to improve in the coming quarters. That should also improve liquidity in the system. Third is that despite the entire global volatility, rupee has behaved very well. And that also has a bearing on how and will RBI intervene in the currency market or not, which is a bearing on liquidity. So liquidity has certainly improved, which has helped the overall narrative. On average, I think that valuations have moved up for private banks. And maybe with the catch-up that has played out over the past 1 month, we'll take a pause for the time being.
By the way, I just want to say, guys, Donald Trump has woken up.
Oh, is it? Has it tweeted something fresh?
And he's going after Powell now.
So
he wants the rate cut, or Powell has to go.
Even earlier he said, right, don't play politics and all that. It's time to cut the rate.
That's
What
not the
is he saying
important
now?
point. The point is it is 3:30 in the morning in Washington. And he's up and he's tweeting. They says the ECB is expected to cut interest rates for the 7th time, and yet too late, Jerome Powell of the Fed, that's the nickname, I think, who's always too late and wrong, yesterday issued a report which was another and typical complete mess. Oil is down, groceries are down, US is getting rich in tariffs. Too late should have lowered interest rates, like the ECB long ago, and he should certainly lower them now. Powell's termination cannot come fast enough.
Ooh, that last line. I mean, it's just so much for the freedom of central banks and monetary policy makers.
I'm just thinking, it's 3:30 in the morning. But I think as Trump famously back in the 90s, I think on the Oprah show, back in the 90s, he once claimed that he said, I don't need too much sleep. I'm built different. So, I mean...
And market participants are just kind of bracing themselves for the open. But yeah, it's really incredible. I mean, Harish, just come in on this. We're talking about, of course, the Indian market recovering and rejoicing, and we want to go back to looking at earnings, our own domestic issues. But this worst of the global volatility, do you feel that this at least is over?
Very difficult to say, but given the noise that was created post April 2nd, market participants are presuming that we'll see some kind of relief in the coming quarters. On average, we'll see more deals, tariff deals. We're already talking about early deals with Japan, with a couple of other countries. So the noise will keep reducing. And as we see some deal signing, hopefully better sense will prevail and we'll come to a normalized tariff, which is win-win for both the parties concerned. So that's very, very important to see, because Fed finally, we were speaking about Fed a couple of minutes back, Fed can't do much if there's a scenario of stagflation in USA, right? So we'll need more help from Trump and his team to ensure that global market stabilizes, and then we'll have to see how it impacts growth, earnings outlook, and take a call on both the Indian and global markets.
Okay, all right, Arish, stay on. We've got Nimesh with some analysis. Nimesh has been looking at some of the leaders in individual sectors. So what is this analysis showing up?
So I was just looking at some data, and if you look at the stocks which have hit all-time highs this week, all are sector leaders within those sectors, right? So if you look at, say, Indigo has hit an all-time high, leader in aviation. HDFC Bank, the leader of banking, has hit an all-time high. Eicher Motors in autos has hit an all-time high, and so is Bharti Airtel in telecom. So all 5 leaders within the space have done an all-time high. But that's not the story. The story is within the sectors itself, there has been a stark difference between the leaders and the peers as well. I'll just identify within those 4 names, right? Look at Indigo. Y2D returns. Y2D, the Indigo stock is up 15%, whereas SpiceJet, even after the fundraise, is down 12%. So that's a kind of divergence we've seen within the aviation stock. Second stock is Bharti Airtel. Y2D, the stock is up 17%, whereas Vodafone Idea is still down 10%. HDFC Bank, Y2D, the stock is up 6%, and Bandhan Bank is down 1%. And so is the case with Eicher Motors. The stock is up 16% Y2D. At the same time, Ola Electric is down 41%. This is the Y2D data. But even if you look at a longer period, say 1 year period, that gives a similar story. The leaders have actually outperformed in these markets. Indigo in last 1 year is up 47%, whereas SpiceJet is still down 20%. Bharti Airtel, everybody's chasing the Vodafone story and AGR and whatever. Bharti Airtel last 1 year is up 47 versus Vodafone Idea down 45. So the alpha is almost 90% if you're in the right stock in the right sector, right? So that's the story there. HDFC Bank, the stock, Y2D, the stock is up 27. Bandhan is still down 8.5%, 9%. And even in Eicher Motors, Y2D, the stock is up 30%, whereas Ola Electric, which all the fanfare, is down 34%. So even in auto, the alpha could be as high as 70% if you're not in the right stock, or if you have to be in the right stock. So what is the key message? In uncertain times, normally the market seems to chase the leaders or hide with the leaders. So that's one big message. The other is, it's a very old saying, the turnarounds rarely turn. A lot of people bet on these turnaround stories like SpiceJet and Vodafone, but the fact is, if you stick to the leaders, you normally make a lot of returns. So that was a key message. I was just looking at not all-time highs which have hit the stocks, but within those sector leaders, it's definitely the sector leaders which have outperformed the peers in a very big margin, especially in these uncertain markets.
Okay, so the big boys are standing up tall and they're shining bright.
Absolutely.
All right, interesting observation. We do have to take a very quick break, but we'll come back on the other side and continue this conversation.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions.